approach until the effects of government policies were more clear. The committee said they were well positioned to wait for more clarity on inflation and economic outlooks. The risk for higher inflation and higher unemployment both had risen. And remember, this meeting came before the May 12th relaxation of those China tariffs. Almost all participants were concerned about more persistent inflation from the tariffs, and also they were concerned about the difficult trade-off if inflation was persistent and you had weaker growth. On the issue of weaker growth, the staff saw weaker growth in 2025 and 2026. The Fed said ultimately the effects of changing government policy and impact to the economy were highly uncertain. That word uncertain comes up quite a bit here. Certainly about the economic outlook, almost all participants noted the risk of inflation could prove more persistent, and they assessed tariffs on intermediate goods could lead to more persistent inflation. Guys, I think I'll leave it there. I'm just looking through more of these headlines. They really amount to the same thing. Some participants saw businesses limit hiring because of the elevated uncertainty. Several members noted downbeat sentiment among manufacturers. A few members commented that retailers were downbeat due to perceived tariff impact. But I guess what we don't know is how much the world has changed since May 12th. Then the threat of the European tariffs put on, taken off. I think the uncertainty is high, but maybe the immediate danger of tariffs it has abated a bit.
Well, that's all from the global market action, and there is a lot of action in the global markets. But how will all of this overnight and early morning cues impact our own markets? Our research team now joins in with the trade setup, the stocks that are likely to be in the news, and of course the setup on the FNO side of things as well. Firstly, Vinny joins in to get all the market cues that we need to watch out for. Vinny, good morning. After 2 days of a bit of consolidation, it's expiry today, of course, and we are bracing for a gap up.
Absolutely, we're watching out for a gap up this morning, but just taking a look at what happened yesterday. Now, obviously, like you mentioned, second consecutive day of fall and consolidation that we saw coming in for the benchmark indices. Nifty closed below the 24,800 level, so that'll be important to watch out for today. As of now, yes, a positive start is indicated, but given that market expiry is there, a monthly expiry is there, so that is something to watch out for. Sensex was closed lower by around 240 points, 81,300 levels. Around that mark is what the Sensex closed at. Mid and small cap that continued to outperform in yesterday's trading session as well, though the mid cap managed to actually just hold on to a slight bit of the negative side or a flat line at what it closed at. But that was a key factor to watch out for in terms of outperformance versus the benchmark indices. We saw the FMCG and the auto pack continuing to be a bit of a drag in yesterday's trading session, while FIIs continue to be buyers. We saw FIIs buying around 4,662 crores yesterday, as well as DIIs also continue to be buyers, 7,911 crores in terms of what we saw coming in as a buying over there. Factors to watch out for today, monthly expiry like we mentioned, a lot of commentary that's coming in on the global front. The federal court has blocked Trump tariffs, so that is something that the market will be reacting to. Other than that, we'll obviously have the industrial production data from India, IIP data that came in, not bad data point coming in there, so that will be something that India will react to. FOMC minutes meeting, that's a reaction there, as well as NVIDIA earnings is what we'll be reacting to. So a lot of positive signs that have come in. That's why we are maybe an indication coming in of a gap up start. Will it sustain will be key to watch out for in the markets.
Oh, absolutely, and NVIDIA's earnings were above expectations, and that too is adding to the boost that the US futures are receiving in today's session. But a commonality among the last few trading sessions has been that the action has been pretty stock specific, and Vamakshi will tell us what are the stocks that you need to keep an eye out for today.
Well, Pharma's stock-specific action is likely to continue today as well. Lots of earnings, that came through. We're at the fag end of the earnings season. But let's get started with SAIL then. The numbers were above estimates. The revenue saw an uptick of 4.9%. The margins have contracted to 11.9%. And the net profit is seeing an uptick of almost 11%. Largely, the numbers have come in much higher as compared to the CNBC TV18 poll. Cummins has met its double-digit growth guidance for FY25. The revenue has seen a marginal uptick of 6.4%. We were going with an expectation of double-digit uptick in the revenue, but that seems to have missed, mainly on account of the subduedness in the domestic market. But the margins and the operational performance of the company has been quite good. Welspun Corp, the revenue has seen a downtick of almost 12%. The margins have increased to 11.7% from 7.5%. The EBITDA margin, though, has come in almost 39% higher. This is at a 5-quarter quarter high. Deepak Nitrite's revenue saw an uptick of 2.4%. The margins have improved slightly to 14.5%, but the net profit is taking a downtick of almost 20%. Mishra Dhatu Nigam will also be in focus on the back of its numbers. Revenue was rather flat, up only 1%. The margins have improved substantially to 22.8%, and the order book position of the company stood at 1,832 crores. Nuvama Wealth reported a rather decent set of numbers. Revenue saw an uptick of almost 8% sequentially. The margins have declined by 492 basis points, and the net profit is up only 1.4%. So those are some of the counters that you'll be watching out for in trade today. But now moving on to the FNO space then, and we now have Mangalam joining in with cues from that. Good morning, Mangalam. Seems like we're off to a great start.
Seems like we're off to a great start, but so much happened overnight, both locally as well as globally, that if you had to pick one day for all these news pieces to come by together, it would have had to be a special day, and that is what it is. It is the May series expiry day in today's trading session. The GIFT Nifty is indicating a positive start. The Nifty itself has gained about 500 points in May series, making it the third straight series of gains for the frontline index. If you look at the series gains, March was up 4.6%. We had April up 2.8%. May so far is up 2.1%. And indications are that it'll start fast as well. But the important part is, where do we go from here? May series, just the gain does not do justice to the sort of volatility that we saw in the series. Earlier in the series, because of the border skirmish, we saw the Nifty go below 24,000, and at one point it went above 25,000 as well. Yesterday's cash market flows, both the DII and FII flows put together, were close to around 12,000 crores, and that is completely explained by the large trade by BAT, where they sold about 12,100 crore worth stake in ITC, and that is what is reflecting in the cash market flows. However, with the positive start that the GIFT Nifty is indicating, we're also going with a lot of short fuel. FIs have been writing in index futures for the last two trading sessions. Nearly 5,000 crore worth sale, and they've added 8,500 shorts in yesterday's session as well. So if you look at it from May 26th to now, the FII short exposure has increased by about 6 percentage points, and we have the net contracts increasing by about 30,000 contracts as well. So if the market sustains gap up, then perhaps there could be some short covering. The FIs have also written more puts, telling you that lower levels would be supported for the frontline index, and 24,750 put as well as 24,650 put are seeing a lot of writing, and 24,800 call along with 24,750 call have seen a fair amount of writing as well. The Nifty sees support at 24,600 to 650, opens right in the resistance zone of 24,850 to 24,900. RBL Bank is the one stock which is out of FNO ban.
Indeed, we'll keep an eye out on RBL Bank out of the FNO ban today, and of course a whole host of other stocks, of course, earnings reactions and those reporting earnings today as well. Mangalam, thanks a lot for that. Take a short break. More news and updates on the other side. Stay tuned.
Welcome back. You're watching Power Breakfast on CNBC TV18. Well, the Securities and Exchange Board of India has passed an interim order in the high-profile insider trading case involving key managerial personnel of IndusInd Bank, including the bank's former CEO and other senior executives. The regulator has barred 5 individuals from buying or selling securities and has frozen their bank accounts. Ritu is here to give us more details. Ritu?
Well, SEBI has barred former MD and CEO of IndusInd Bank Sumant Katpalia, former Deputy CEO Arun Khurana, and 3 other senior executives for alleged insider trading. Now, this comes as part of an interim order that was passed by the regulator pending the conclusion of its investigation. For now, SEBI has impounded the bank accounts of these 5 key managerial personnel to the extent of the losses that they allegedly avoided through insider trading, amounting to 19.78 crore rupees in total. Now, Arun Khurana, the former Deputy CEO, made the largest gains by far, with his account impounded for 14.4 crore rupees, which is the extent of the losses he avoided. Sumant Katpalia, the former CEO, follows with 5.2 crores. Sushant Saurav, the head of Treasury Operations, for 7.14 lakh rupees. Rohan Jatanna, Senior VP of Global Markets, for 6.87 lakh. And Anil Rao, interestingly, the Chief Administrative Officer of the bank, who's also part of the executive committee who's currently overseeing the bank in the absence of a new CEO, has also been impounded for 3.94 lakh rupees. Now, according to SEBI, all 5 of these executives sold shares of IndusInd Bank during the UPSI, or the unpublished price-sensitive information period, between the 4th of December 2023 and the 10th of March this year, without making any purchases. The regulator found that these trades helped them avoid losses that would have occurred if the information had been made public at the time. Now, as part of the interim order, all of them have been barred from buying, selling, or dealing in securities directly or indirectly until further notice. They have also been prohibited from making deposits or withdrawals from their bank accounts without SEBI's approval, and they've been directed to submit a full inventory of all their assets to the regulator. Now, apart from these 5 individuals, SEBI is also examining the roles of other suspects who have not been named. We've already seen the former CEO and Deputy CEO exit the bank, and this order may now have repercussions for others who are found guilty of insider trading. The order, keep in mind, is going to remain in force until SEBI concludes its final investigation in the matter.
Ritu, thanks a lot for that. IndusInd Bank, definitely one of the stocks to watch out for in today's trading session. Now, in a major relief to former SEBI chief Madhabi Puri Buch, the Lokpal held that no grounds have been made for directing an investigation against her under the Prevention of Corruption Act. Ashmit is now joining in with more details on this. Ashmit.
Well, the prayer that had been sought by the complainant is that there needs to be an investigation under the Prevention of Corruption Act. The finding that the Lokpal has given at the end of this brief order, it's not very long, about 36 odd pages. Here what the Lokpal says is that some of the allegations that have come are bordering frivolous, that they have not been substantiated with facts, and therefore as a result, no fit case, no grounds have been made out for launching an investigation. And in doing so, Lokpal granting relief to Madhabi Puri Buch, the former SEBI chief. Now, what's important is that these complainants had raised various multiple issues with respect to conflict of interest, with respect to quid pro quo. They had flagged her investments that she had made in certain funds that were linked to the Adani Group. There were questions regarding quid pro quo being raised with regarding consultancy income, with regarding rental income, with respect to sale of her ESOPs from her ICICI Bank days. Now, on all of those questions, the finding that the Lokpal has given is that a bulk of these charges and questions that have been raised on the back of the Hindenburg report, which came in context of Adani Enterprises. Having said that, what the Lokpal concludes is that that report alone by a US-based short seller is not grounds enough for escalation into a probe. There has to be other criteria that has to be met. But unfortunately, what the Lokpal says is that those criteria have not been met, going on to say that the allegations are untenable, they're unsubstantiated, they're bordering frivolity, they're presumptuous, and also then finally going on to say that there is no verifiable material to back those allegations, to back those questions. So on that count, Lokpal making it clear, no fit case made out for launching an investigation under the Prevention of Corruption Act.
Well, thank you so much for that, Ashmit. But let's slip into a very short break. Up next, we get you cues from the commodities market. Don't go anywhere.
Welcome back. Getting you the latest now on the developments related to Donald Trump. Dia is joining in our special segment, Trump Watch.
The big news this morning from the United States, a federal trade court has struck down the reciprocal tariffs that President Trump imposed on what he called Liberation Day, putting an immediate stop to the collection of a sweeping set of levies. The ruling from a 3-judge panel at the New York-based U.S. Court of International Trade came after several lawsuits arguing Trump has exceeded his authority and left the country's trade policy dependent on his whims. The other news that's making loud headlines, and it is billionaire Elon Musk at the center of it. Musk announces that his time as formal advisor to President Donald Trump is coming to a close, raising questions about the future of the Department of Government Efficiency effort he spearheaded. Meanwhile, President Trump is firing back at Wall Street's latest jab, the so-called taco trade, short for Trump always chickens out. The nickname reflects investor bets that Trump will not follow through on tough tariff threats. But Trump says his pullbacks are strategic, a way to gain trade concessions, not a sign of weakness. Let's listen to what he said.
And then I chicken out. I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said, you have to open up your whole country. And because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now. And I said, okay, I'll give you till July 9. I actually asked them, I said, what's the date? Because they weren't willing to meet. And after I did what I did, they said, we'll meet anytime you want. And we have an end date of July 9th. You call that chickening out? Because we have $14 trillion now invested, committed to investing. 6 months ago, this country was stone cold dead. We had a dead country. We had a country people didn't think it was going to survive, and you ask a nasty question like that. It's called negotiation.
In a move drawing legal and institutional backlash, Trump said Harvard University should cap foreign student enrollment at 15%, ratcheting up his effort to force policy changes at the elite institution. Harvard University said the Trump administration's ban on enrolling international students is already causing harm and spreading fear, even though a judge has temporarily barred the order from taking effect. Let's listen to what the bite is.
We want to know where those students come. Are they troublemakers? What countries do they come? And we're not going to, if somebody is coming from a certain country and they're 100% fine, which I hope most of them are, but many of them won't be, you're going to see some very radical people. They're taking people from areas of the world that are very radicalized, and we don't want them making trouble in our country. These countries aren't helping us. They're not investing in Harvard and all of our, we are. So why would 31%, why would a number so big? I think, number one, I think they should have a cap of maybe around 15%, not 31%. We have people who want to go to Harvard and other schools. They can't get in because we have foreign students there. But I want to make sure that the foreign students are people that can love our country. We don't want to see shopping centers exploding. We don't want to see the kind of riots that you had. And I'll tell you what, many of those students didn't go anywhere. Many of those students were troublemakers.
Secretary of State Marco Rubio said the U.S. will revoke visas for Chinese students, escalating the Trump administration's push for greater scrutiny on foreigners attending U.S. universities. Rubio said in a post on X that students affected would include those with connections to the Chinese Communist Party or studying in critical fields. He also added that this would also include those who target American technology companies. Moving on, U.S. President Donald Trump said he told Israeli Prime Minister Benjamin Netanyahu that a military strike against Iran would risk disrupting efforts to broker a deal on Tehran's nuclear program. The U.S. president added that he believed a deal with Iran could be completed within the next couple of weeks and that talks had made a lot of progress. President Trump also said he's holding off on new sanctions against Russia in order to preserve the chance for a deal with President Vladimir Putin to end the war in Ukraine. Lastly, sources tell Bloomberg that the Trump administration is telling immigration officials to ramp up arrests to 3,000 per day with a goal of more than 1 million a year, a target that would significantly escalate the pace of detention. That's all for today. Now back to you.
Well, thank you so much for that, Dia. But moving on then, let's look at what the world of commodities is doing. We now have Manisha Gupta joining in with all the updates from the commodity space. Good morning, Manisha.
Morning, and thank you for that, Ramakshi. Well, we are looking at, or rather, all the asset classes are reacting to the U.S. federal ruling that Trump has overstepped authority on imposing reciprocal tariffs. That's unlawful to all, and orders should be vacated and blocked. So the markets, while they're looking at the next step that the Trump administration will take, we already have seen those reactions come into the market. The dollar index is now trading above 100, a sharp surge onto that one. And the gold and silver prices have seen a decline in the overnight markets and early Asia as well, as the risk-on sentiment comes back into the market. The crude oil prices are the first ones to react, and we are trading above $65 a barrel. Also, what is aiding and supporting crude is the OPEC and allies meeting, which concluded yesterday with maintaining the current output quota and not increasing it. While, of course, there's another meeting today as well, and the markets will wait for reaction from that. In the meanwhile, the metal prices have continued to trade off highs. You have copper, which is off its 4-week highs. Nickel has declined to a 6-week lows. Steel rebar in China is now trading at an 8-month lows, and the decline clearly is seen in case of sugar as well. That one is trading at a 4-year lows as well. A very sharp cut coming in for sugar prices globally in the overnight markets.
Indeed, plenty of reactions across asset classes. Manisha, thanks a lot for that. We call time on this edition of Power Breakfast. From Amakshi, me and the team that put this show together, thank you so much for watching. We leave you with the Dow futures 550 points higher, and the implied open also suggesting a gap up start. Bazar Morning Call on the other side.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazar Morning Call. As always, we're coming to you from the CNBC TV18 Motilal Oswal studios. It's a very interesting morning as we're getting into the second half of the week. There is a legal challenge to the great Trump tariff juggernaut. We have plenty to talk about, lots of local cues as well. I'm Surbhi Upadhyay. With me, as always, is Nigel D'Souza. And today we have Rima in the house joining in. Hi, guys. Morning.
Hi, good morning. It's been a historical roller coaster ride, right, with Trump headlines. Sometimes tariffs are on, sometimes they're off. But as you said, this time, it's coming in from the court.
Yeah.
Well, that's right. And from the time Trump took over, we were getting used to MAGA, right? Make America great again. But now we have a new one, TACO, right?
What's this? What's TACO?
Trump, again, chickened out.
Always chicken.
Always chicken.
Always chicken.
Wow.
And I'll tell you another one. I was just looking at some feed overnight, and every time the press has asked him, when are we going to hear about this finally? A month ago, he said 2 weeks. 10 days ago, he said 2 weeks. And yesterday, he said 2 weeks again. So 2 weeks, or is it 2 week? So let's see.
There was another acronym. I don't know if you knew. ABUSA?
Yeah.
Oh, God. You guys are really on fire with the acronyms today. Now, what is ABUSA?
That is anywhere but USA.
Anywhere but USA.
But today's one is TACO. Today's, the acronym for the day is TACO.
You'd say, you'd counter that by saying that he's not actually chickening out. They've gone to the higher court. And this is going all the way to the Supreme Court. So actually on that, let's...
Federal court.
Let's get to it. So what we have is plenty of excitement post the US market close. The market close was actually negative. US indices were down about 0.5%. The Dow, the S&P 500 and the Nasdaq, they all ended with cuts of about 0.5%. But then this news came in. So the US Court of International Trade has struck down Trump's reciprocal tariffs. There were, 5 to 6 people who had gone to the court, businesses, US businesses, challenging the reciprocal tariff order, saying that it is constitutionally not valid, and the court ruled in their favor. So the court, in fact, has said that the reciprocal tariff order needs to be vacated. And the court says that the International Emergency Economic Powers Act, remember, it was this particular piece of legislation under which Trump, initiated these reciprocal tariffs on the 2nd of April. The court said that this particular act does not give him unilateral powers to pass a law like this. It needs to go through Congress. So therefore, the court struck this down. But the US administration, as expected, they were very quick on the response. They've already gone and appealed this in the Court of Appeals at the federal circuit level. The sense is that this is not ending. I mean, these are the lower courts in the US. Eventually, this might go all the way to the US Supreme Court. Let's see, the legal challenge is on. In the interim, the market first reaction, as you would expect, is that of, relief. And that's what we're seeing across asset classes, starting with US equities. So if you look at Wall Street futures, Nasdaq, Dow, S&P 500, I mean, they're up anywhere between 1% to 2%. Nasdaq, of course, being the most jubilant at this point in time. And this is also playing out across, the dollar index as well as yields. Actually, let's pull up the dollar index while we're speaking about it. Last I checked, the DXY had rallied about 0.5%, and it's once again back above the 100 handle. So watch out for this. On the yields front, the US 10-year is still at around 4.5%. So we don't have a massive reaction in the bond market just yet. Let's see. We'll see how this plays out as the US market opens and digests this piece of news. As I said, this is also not certain. The legal challenge is by no means done. This is going probably to higher court. So we'll see how this plays out. The other piece of news that the market was reacting very well to, especially in after hours, was NVIDIA's numbers. And NVIDIA's numbers, despite the fact that they're almost completely restricted from selling their chips to China, the numbers are better. The top line growth was 69%, which is more than what the estimates were. And of course, the company acknowledged the fact that they've had to take a $4.5 billion charge because they've been restrained from selling those chips because of security concerns to a big market like China. In fact, NVIDIA CEO Jensen Huang said that the $50 billion Chinese market for AI chips is effectively closed for US industry. I mean, he was very vocal in that analyst call in calling this out. But he then also went on to say that there is a very strong demand for their Blackwell chips, the other chips in the rest of the world. And that's where the beat kind of came in from. NVIDIA shares in after hours are up almost 5-6%. So let's watch for this. So this coupled with that court order is getting the markets very, very excited. Some of that is playing out across Asia. Rima will talk about that in more detail in just a bit. Now, for us here, the issue is that the market at an index level is getting very, very narrow and range-bound. And we saw that on the index, Nifty, Bank Nifty, very, very ranged. The action is all in the mid-caps and the small caps. And we're seeing outsized earnings reactions wherever earnings are positive. Today, we have some interesting names like Bata. Bata is still weak. Cummins, estimates were weak. It's better than those weak estimates. So let's see how this goes. So watch out for specific stock reactions. Speaking of specific stocks, IndusInd Bank. Now, once again, the bad news just doesn't seem to be ending. Yesterday, the market regulator has come out with a scathing order. It has banned not just the ex-CEO Sumant Katpalia, but 4 others, key management personnel, from accessing the securities market on charges of violation of insider trading rules. What is SEBI saying? SEBI saying, remember, this was on the 10th of April when the announcements were made about the discrepancy in the derivative portfolio. And it seems that there was some selling of shares before that announcement was made to the public. So the allegation is, or the assessment of the regulator is, that these key management personnel acted on unpublished price-sensitive information and prevented, themselves from huge losses. So the notice has gone out. Not just that, SEBI is looking to impound close to 20 crores from these 5 personnel. So let's watch for this. We'll talk more about this from the experts as well. Need to see if this has an overall impact. IndusInd Bank, whether it's limited to that or whether there's a spillover impact, we'll see. Usually it's been ring-fenced around one stock and not the entire Bank Nifty. So we'll watch for this. Rima?
Well, back to the Asian markets, Asian markets are on the move. So this latest headline on the tariff block seems to have triggered buying across the Asian markets. Kospi is leading the gains, 1.7% up. Nikkei is up 1.6%. You've got the Taiwanese markets also higher, as you can see, by close to about 0.6%. Hang Seng muted gains, but gains nonetheless. But as we said, the bigger moves are in Kospi and Nikkei, where gains are about 1.5 to 2%. The big cues in Dalal Street today, one are the flows numbers. But remember, yesterday we had that very large BAT stake sale in ITC. So numbers are skewed on account of that. But yesterday we had the DIs buying 7,900 crores, while the FIs net bought 4,662 crore. So that's a positive, but India's macro is flashing some caution. So just want to put on board the April industrial IIP growth. That's the IIP growth for the month of April. It slowed to 2.7% versus 3.9% in March, and it's sharply below last year's figure of 5.2%. Also, gold prices, by the way, have declined slightly. And oil prices have climbed on account of supply concerns. But Nigel, today is the Nifty monthly expiry, and so far we've been ranged. It's been what, 24,500 on the way down to 25,000, 25,100 on the way up. What will expiry throw up for us?
That's right. That should be the broad range, 24,650 on the downside and 25,050 odd on the upside. Now, if you're looking at the rollovers getting into expiry day, the Nifty rollovers actually are a little bit higher than what we have seen in the past series. So at around 70%, previous series it was at around 65%. Though the Nifty Bank, that's more or less in line. For the market on the whole, the rollovers are fairly in line with what we see getting into an expiry day. So that's about the rollover picture. Well, moving to what the FIs did, well, they added shorts. They added shorts both on index futures. They added close to 9,000 shorts, while even on stock futures, they added close to around 30,000 short contracts, while they unwound some longs. This could be, though, some kind of arbitrage that's taking place, getting into expiry day. A bigger trend, though, will emerge from tomorrow. But I like a market with some shorts in the system, and that's been the trend for the last many, many months. So if you look at the FI positioning, from around 30,000 short contracts, well, that number has moved all the way to around 80,000 short contracts. Shorts in the system is not such a bad thing, and FI shorts was something that actually this market was missing. But will require some good news to actually make them squeeze the shorts out. Clients on the flip side, well, they are on the opposite end of the spectrum. Clients, that's the domestic big players, they have net long positions on the market to the tune of close to around 70,000 contracts or thereabouts. But today, since it's expiry day, we'll have to keep an eye on the options data. And that's going to be very, very important. And the PCR, last week it hit a high of around 1.2. That's cooled off to around 0.7. It's at the lower end of the band because the call writers, they believe they've got this covered just for today at least, till the end of the series. That's why you're seeing aggressive writing at around the 24,800 call, 24,750 call. Extremely active in yesterday's trading session. But there is some writing being seen at the 24,750. So just plugging the numbers, looking at the options data, well, you'll get the levels that come up for you on the screen. On the upside, 25,080, that's been a bit of a resistance mark. We visited that mark, in fact, earlier this week, and it got rejected. So this is the resistance zone that you're looking at. The Nifty can actually trade above the 25,000 mark for some part of the trading session, getting into the expiry hour, then anything can work out there. But on the downside, you don't want to see this level getting broken out. 25,000, 24,600, 24,650, It has the 20 DMA as well out there. But since it appears the tariffs could take a bit of a backseat just in the near term, and we also have NVIDIA's numbers that actually have been taken positively, I'll keep an eye out on two global-facing sectors. The metal index as well as the tech index, both of them will be in focus. The metal index will be interesting because the dollar index actually has strengthened a little bit. And from the metals pack itself, you had Nalco yesterday that ended at the high point of the day. In Guinea, we are seeing some of those bauxite mines where the leases are getting cancelled out. That's what could keep alumina prices elevated. So that's why I'll keep an eye out on Nalco. Very, very strong close is what we had yesterday. Maybe the alumina prices get some kind of support, which is good for Nalco. So that one's on my radar.
Okay, we'll watch out for Nalco for sure. Nigel, thanks for that. Let's take it away then with our first set of guests. We have with us Ed Yardini, President at Yardini Research, as well as Arvind Sanga, Managing Partner, Geosphere Capital Management, to make sense of now what seems to be a bit of a legal challenge that has started. Gentlemen, thanks very much for joining in. Mr. Yardini, let me come to you. You've been actually very positive otherwise fundamentally on US equities. How do you see this legal issue now playing out? The administration has gone ahead and appealed in the Court of Appeals. Does this put a pause in the current negotiations at all? I mean, what happens now?
It's a very messy situation for sure. Why would any country now want to proceed with negotiating with the administration when the court just questioned whether the tariffs have any constitutional right to exist in the first place? But I think everybody knows that there's no way that you can negotiate a trade treaty in 90 days. I think we're still going to get some letters of agreement between us and our major trading partners on continuing to negotiate fair trade deals. So I think there'll be a lot of face saving going on, and I think the president is basically going to declare victory and try to put this whole thing behind him by the middle to the end of the summer. I think the president really can't afford to have this thing go on and risk causing a recession, which then would create some real problems for him in the midterm elections next year in November. So all in all, I've been anticipating that this too shall pass, that it'll be over by the summer, and it looks like it's pretty much on schedule to do that.
So you're saying that countries will keep the negotiation window open. I mean, I don't know if they have a choice. This is despite the fact that the legal challenges there. Do you expect it to be a more prolonged, long drawn out kind of legal battle till we have a final order from, I don't know, maybe the US Supreme Court?
Yeah, I think it, I don't know the exact route that it goes to from this court. There's obviously an appeals court, but it could very quickly go up to the Supreme Court, and the Supreme Court might very well confirm that the president was out of step with claiming that there's a national emergency related to the trade deficit that required these kind of actions on the tariff side. But I think our major trading partners are going to go along with they're going to go with the flow, and I think then the discussions will continue. There will be short letters of agreement or maybe 5 pages of frameworks that the president can declare as victory, and then put this issue behind us.
Arvind, hi, morning. Night to you. This is Rima here. As Ed just said, things are going to get messy right now. Given that the Trump administration plans to appeal this decision, what are the various market scenarios one needs to prepare for?
Well, there's one other thing that Ed didn't cover, which is that what the court did not rule out or push back on is the Section 232 tariffs on steel and aluminum. And what I think will end up happening is, for the easy victories, there's a Section 232 study or whatever it's called going on by the Commerce Department on copper. There's another one on pharmaceuticals, and I think there's a third one on auto parts. What is going to end up happening is President Trump will try to move those forward, and then try to use exemptions on those tariffs as bargaining chips. I agree with what Ed said, that people will give Trump some face-saving quote-unquote victory.
Oops.
Oopsie. All right. Well, we'll get Arvind back, into this discussion. But let's go back to Ed. Ed, what should the approach be then to equity markets? India's done quite well. You told us in the past that S&P 500 is closer to your target. I think you had scaled it down from around 6,500 to around 6,000. Right. How would you approach this entire global equity market piece? And do you think that for the second half now, we should be satisfied with more subdued returns?
Well, while all this was going on, all this Trump tariff turmoil, as I call it, has been going on, the market also sold off on concerns that the introduction of China's DeepSeek back in January meant that companies were spending much too much money on AI infrastructure that they would never get a return on. And so I think that was another important reason why the stock market in the United States and in China and other places took a dive, because AI, the whole digital revolution, the whole idea that technology is going to create tremendous opportunities, that all got kind of threatened by DeepSeek. But then the major U.S. Companies that are involved in AI infrastructure and in the cloud, like Microsoft and Amazon and Meta and Google, they all confirmed that they intend to spend collectively $350 billion on AI infrastructure, which really means cloud infrastructure. I think we have to get over this idea that it's all AI. What it really is processing as much data as we possibly can, as quickly as we can, as cheaply as we can. And AI just is a evolution of that digital revolution. And so I think NVIDIA today, after the market close in the United States, certainly provided some very good indicators of how strong their sales still are, how strong their earnings still are. The stock rose sharply. So I think the market's up this evening, at least in the futures market for the United States, is up because of these two developments. First, NVIDIA's better than expected. And secondly, the whole tariff situation may get messier, but it's probably on its way to being much less important.
All right, we have Arvind back with us as well. Arvind, you want to give us your comment with regard to how the entire global scenario is playing out, your preference with regard to equities, particularly India, and from India, which is the couple of themes that you like? I think power in the past, defense as well, we have briefly spoken about. But if you name one sector, which one would it be?
Well, I would say that anything domestic facing is something that we like. Obviously this removes a headwind on the global sectors, but I think that India is not as big a play on global sectors. So I would say anything domestic facing. And then I think metals is an area that I don't look at India too often, but I think there are a couple of interesting metals companies. And to the extent that global growth is back on track, I think metals is an area that is of great interest to us.
Arvind, just a question. Around you, are you really still hearing that chatter saying, let's diversify a little away from US equities, or is it kind of back to the US because the tech story is still strong, tariffs, etc.? Basically, what are you hearing on this whole point on diversification away from the US? And then where does India fit in that chatter, if at all?
Well, I would say that, yes, because of the uncertainty in the US, there has been move to diversify away from the US and reduce risk. To the extent that the courts severely constrain President Trump, it'll make the risk a little bit less in the US. But I still think that, the global diversification is alive, but I don't think there'll be as much of a dumping of US assets and as much of a weakening of US dollar. But I think there's another risk. We're talking about tariffs right now, but there's the the fiscal deficit risk and the US bond yields shooting up. And if that continues to misbehave because of, a widening fiscal deficit, then avoiding the US and going elsewhere is something that will still come to the fore. So there's an offsetting factor here on tariffs, but the fiscal deficit issue has not gone away. On the other hand, like you correctly said, the tech sector still, the US remains the envy of the world. And so, India and other countries will benefit if their domestic growth is good. And right now, in India, for instance, we're seeing some mixed numbers on domestic growth. So I think that's going to be the challenge in terms of from diversifying away from the US to where.
Ed, just getting back to the legal block story, can the administration reclassify the tariffs under different legislations since the court has deemed that you can't do it under the Emergency Economic Powers Act? And also, since the court has said that, the Trump has exceeded his authority by using the IEEPA, and only the Congress has the constitutional right to regulate tariffs, will this undermine any future administrative decisions?
Well, again, I think the only logical conclusion right now is it's a messy situation. It's not clear which way the administration is going to go. Right now, it looks like it's just going to stick with its current policies and its current claim of why they have the power to declare an emergency and then use that declaration as an excuse for renegotiating tariff deals. I think they're going to pursue that right up to the Supreme Court. And I don't know that there really is much of an alternative to that. I think Arvind makes a very good point about industry-specific tariffs on steel and aluminum and pharmaceuticals, and that might be an interesting way to claim victory, that we still have those tariffs on. And as Arvind said, that they may very well be a useful way to negotiate additional trade deals with countries without using the national emergency excuse.
Sanger was just reading that, what next after the reciprocal tariffs were struck down by the court? If the Court of International Trade's ruling is upheld, then will all the tariffs collected by the US from 2nd of April, will that have to be refunded?
From what I've read, that's what it seems to be, that they will be have to be refunded. Now, they haven't collected that much, but, it's been one of the hidden kind of economic benefits of tariffs in terms of fiscal deficit. Just, I think, in the last 24 hours, there was an article by Peter Navarro claiming that the Congressional Budget Office is not taking into account all the revenues that are going to come from tariffs that are going to help reduce the fiscal deficit. And now that argument is out the window. So, yes, I think that there is a real question about all these tens of billions that have been collected will need to be refunded. So, I think, as Ed has correctly put it, it's a messy situation. And I'm not sure how this is going to go. But, it's not some kind of, a lot of the court cases that have gone against Trump have been local jurisdictions putting national, kind of claim. And there is a case in front of the Supreme Court claiming that these local courts shouldn't have jurisdiction to stop anything nationally. This is the International Trade Court. There is no claim that they don't have jurisdiction on trade. Now, it's not a jurisdiction question, which Trump is arguing against the Supreme Court or other cases. This is really a question of whether the court ruled incorrectly or not. And that's going to be a harder case to overturn because these guys are specialists on international trade law. Doesn't mean it can't be overturned, but I think that it looks to me like this is going to be, again, I'm no legal expert, but it looks like just from the logic standpoint, it seems like what they said makes complete logical sense, and it's going to be a tough one for Trump to overturn.
Okay, all right. Thanks a lot, gentlemen, for joining in, Arvind as well as Ed. Appreciate you joining in and giving us your thoughts on how do you all see markets pan out. Well, taco, though, seems to be the buzzword among the international press. But Trump remains firm and clarifies he is not chickening out on trade. Let's listen into that soundbite.
And then I chicken out. I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said you have to open up your whole country. And because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now. And I said, okay, I'll give you till July 9. I actually asked them, I said, what's the date? Because they weren't willing to meet. And after I did what I did, they said, we'll meet anytime you want. And we have an end date of July 9th. You call that chickening out? Because we have $14 trillion now invested, committed to investing. 6 months ago, this country was stone cold dead. We had a dead country. We had a country people didn't think it was going to survive, and you ask a nasty question like that. It's called negotiation.
Okay, that's the big global story, but let's get back to the Dalal Street and tell you what's lined up for you on our show today. These are the interactions. So coming up first at 8:35, we'll connect with Amit Tandon, MD of IIAS, SEBI Bar's former IndusInd CEO, 4 others from the market for insider trading. 9:20, we'll connect with our market master of the day, BofA Securities' Amish Shah and Arbind Maheshwari. They'll talk about BofA Securities' 2025 India Conference. Following that, the management of EID Pari India will be chatting with us at 9:40 to discuss their Q4 earnings. A little later, 9:50 a.m., Vishal Goyal of UBS Securities will join in from the UBS Asian Investment Conference 2025. Towards the end of the show, in our special segment, It's the Economy, Lata will be in conversation with Ashish Gupta of Axis AMC and Rikin Shah of IIFL Capital on the state of bond yields and banks in India.
Well, time to slip into a quick break, but we have a lot of stock-specific action to track for you today. We'll get to that in just a bit in our special Top 10 segment. We're looking at IRCTC, Cummins India, SAIL and Welspun Corp. All of them will be reacting to positive news flow on the flip side. We have IndusInd Bank, Max Financial, Bata India, Cohance Life Sciences, Natco Pharma and Birla Soft. They'll be reacting to negative news flow. Slip into that break. Come back, we'll get into further detail on all of these names.
Welcome back. Let's get to the top stocks you need to watch this Thursday morning. Our research team is standing by with CNBC TV18's list of top stocks for the day. And first up, the big one will be IndusInd Bank on allegations of insider trading. Ritu joins in with more. Ritu.
Well, SEBI has barred former IndusInd Bank CEO Sumant Katpalia, former Deputy CEO Arun Khurana, and 3 other top executives for alleged insider trading, which includes Anil Rao, the Chief Administrative Officer, who's currently part of the executive committee overseeing the bank in the absence of a new CEO. Now, their bank accounts have been impounded for a total of 19.78 crore rupees, 14.4 crores of which is for Khurana alone, 5.2 crores for Katpalia and smaller amounts for the others. Now, SEBI found that they sold shares during the UPSI period without any purchases, avoiding significant losses, and all 5 of them have now been banned from dealing in securities and cannot move their funds or assets without SEBI's permission until final orders. The regulator is also probing others and says this interim order is going to remain in force until the investigation is completed.
Okay, all right, Ritu, got that. That's a really important story, and we'll dive a little deeper into that in just a bit. But there's more news coming in from Max Financial, not earnings, but it seems that there could be a change in the management. Vamakshi, good morning.
Well, good morning, Surbi. Well, that's right. Prashant Tripathi is expected to take an early retirement from his position as MD and CEO of Axis Max Life Insurance. Keep in mind that he has been at the helm since the last 6 years, and his retirement will come into effect from September 30th of this year. This news is largely negative, and that is because, there has been no clear succession plan that has been announced for now, and September is not very far away. We also have a note coming in from Jefferies, and they say that this development comes as a tad setback for the company. Smooth succession will be key, and an internal elevation may be preferred. However, they also add that sectoral tailwinds on regulations, some shift to non-par and healthy business growth can provide some cushion. They're expecting some correction, but they say that this could be an opportunity to add. As of now, they have a buy rating, target price of 1,700, but this development doesn't bode well for the company, therefore going with the red for this counter.
Okay, all right, Vamakshi, thanks a lot for that. Well, let's hop across to Mangalam. He's here to tell us about IRCTC and Bata India. Mangalam?
Well, for IRCTC, the results are pretty much on track. We have 10% revenue growth that has come by. The profitability has grown by about 26%. Margins steady at that 30% mark as well. We saw a boost coming in from other income. And their key segment, the key driver for earnings for them is the ticketing business, which saw near 9% revenue growth, 11% operating profit growth, so no problems out there. Catering business, well, the revenues were flat. There was a big jump in profitability out there, so that supported their overall business. And tourism, which saw a big surge year on year, my sense is that has been on account of Kumbh, 38% revenue growth and 161% EBIT growth on a favorable base as well. Bata, on the other hand, has been a tired set of numbers. I mean, it reminds you of a shoe that you've put in your cabinet, used to be your favorite some 5-6 years ago, but you don't get occasions to wear it anymore, but you still can't throw it. That's the kind of numbers that Bata has reported. 1% decline in revenues, about 2.5% decline in profits in EBITDA, and net profit has declined by about 27% as well. The company said volume growth has taken place this quarter, but importantly, they've gone ahead and reduced their inventory. So they are, downsizing their inventory, and that's impacted their overall revenue performance. But just keep an eye out on how this performs, largely because over the last many quarters, these numbers have disappointed. There hasn't been that funk or spring in the step.
Mangalam, you touched a raw nerve there. A shoe that you don't feel like throwing out and you don't feel like wearing either. I have plenty of those in my cabinet, I can tell you. That's a great analogy. Thanks very much. Go back to Vamakshi then on Cummins. The expectations are always running low, but I guess, Vamakshi, it's beaten at least those low expectations.
Well, Surbi, when you look at the revenue, that has come in as a tad lower as compared to what the street was expecting. The street was expecting some double-digit growth in the revenue, but this time around we're only seeing a 6% growth in the revenue, and that is because the domestic market was largely flat. It is up only 0.5% on a year-on-year basis, but what actually led the growth was the exports part of the business, because that saw a very good uptick of almost 39%. In fact, this is the second quarter wherein the company has reported a year-on-year uptick in the exports, given the kind of low base that we saw last year. But apart from that, when we look at the operational performance of the company, that has come in much better than what the street was anticipating. Keep in mind that there was a one-off in the base quarter, which sort of, pushed the margins higher back then. But, given that, the margins were expected to decline. But the decline in margins this time around has been, not as worse as it was feared. So the margins have only declined by 235 basis points. The net profit too is taking a hit of almost 72.2%, but this is much better than what the street was expecting. Now, the management has said that they witnessed partial recovery in export demand. They're hopeful that the positive trend will continue, but they're quite cautiously optimistic as far as both the exports and domestic market is concerned. The con call is scheduled at 10, so we'll be waiting for the management commentary and the guidance for FY26. But for now, it's an operations-led beat for Cummins.
All right, got it, Vama. Thanks a lot for that. Well, I'm looking at SAIL, and first look of it, actually, the numbers look very, very good, but there are a couple of adjustments you need to make. Nonetheless, even with those adjustments, the numbers actually look good. So to run you through the fine print on the top line, there's a big beat. The key reason for the beat on the top line is actually volumes, because volume growth came in at around 17%. They clocked 5.3 million tons. The sheet was closer to the vicinity of around 5 to around 5.1 million tons. So volumes are strong. But realizations actually were a little weaker than what the sheet was working with. First look of it, the EBITDA number looked very, very good, came in at around 3,400 crores. However, it included an element of the railway price increases that they normally get, which was to the tune of around 680 crores. So adjusted for that, actually, the adjusted EBITDA is mildly better. It's a beat of close to around 3 or 4% or thereabouts. Not as a bigger beat as it looked like at first look. Other expenditure as well was up only around 10%, while you have volumes that are up by around 17%. Tells you that the other expenditure on a per ton basis was actually down by close to around 5%. The kicker is that they've again reduced their debt by close to around a couple of thousand crores, close to around 3,500 crores. So release of working capital has played out as well. Going with green on this one, the stock has already seen a good rally, but these numbers deserve a thumbs up. Let's go to Ekta. Ekta's tracking a couple of pharma names. Ekta, take it away.
Well, yes, I'll start with Natco Pharma, which is in focus on the back of its numbers. So its revenue, EBITDA, margins as well as profit came in below what the street was anticipating. I'm working with two estimates, Axis as well as Nuvama. So it missed those estimates. It came in at around 1,221 crores. Axis was at around 1,431 crores. EBITDA margins 44.9% versus estimates of around even 55%. And profit of around 406 crores versus estimates of even up to 600 odd crores. Now the numbers were aided by Revlimid generic, which was expected. The formulation Q4 revenue was the key driver because of Revlimid sales, but that seemed to have missed estimates. The call is at 11 a.m. today. More details then. But if you look at it, based on these estimates, which the street was working it with, it's a little bit of a disappointment.
Thank you very much for that. I'm looking at Birlasoft. It's the last of the mid-cap IT companies yet to report numbers. It's a mixed bag. The top line has disappointed, but margins have positively surprised. So constant currency revenue growth has declined sharply, both quarter-on-quarter and on a year-on-year basis. Revenues down 5.3% sequentially, and on a year-on-year basis, revenues are down nearly 7%. But the good part is the company has managed to expand margins by 120 basis points to 13.2%, and that drove about a 4.5% increase in the company's profitability. There's a conference call which is actually currently underway. It started at 8 o'clock, so we'll await clarity from what comes out of it.
Okay, that's Birlasoft. Let's get back to Ekta. Ekta, Cohance, how did this one fare?
Well, you know, it's a lot of one-offs this quarter because it is a CDMO API play, but it is formed by the merger of multiple companies, inclusive of Suven Pharma. So the numbers are not really comparable. So I'm just going to go with the margins, which look a little disappointing on a year-on-year as well as on a sequential basis. It came in at 18.3% versus around 29% on a year-on-year basis, and the profit was lower as well. But the outlook seems quite positive from the management, so that's probably going to negate a little bit of the margin pressure. Overall, it's a moving picture really for Cohance, considering that it's the integration of multiple companies that we're dealing with. The CDMO Q4 revenue was up around 31% on a year-on-year basis. Their outlook, even for the specialty chemicals business, is quite positive. So overall, that should probably, cushion the stock, if nothing.
Okay, all right, Ekta, thanks a lot for that. Well, I'm going to be looking at Welspun Corp, and yesterday the stock, you need to note that it ended with solid gains of close to around 3% or thereabouts, though it's close to around 10% away from its fresh 52-week high. Well, looking at the numbers, it's good because just track the EBITDA number. That's gradually been improving, and it came in at around 460 crores. That's almost the highest quarterly run rate that the company has ever achieved. So that's good news. Now, the guidance that they lay out, well, it includes the other income. But that guidance is very, very strong because they are factoring in an EBITDA growth of close to around 18% in FY26 in comparison to what they have delivered in FY25, which is again better than what they had guided for both in FY25 as well as FY24. Now, from a net debt company, they've turned into a net cash company. They have a big capex of close to around 5,000 crores or thereabouts, but they have close to 1,000 crores of cash in their books, and they're throwing up free cash flows of roughly around operating cash flows of close to around 1,500 crores. They've also announced a new project in LSAW pipes in the United States because they're saying that demand is very, very strong. Put everything together, good visibility from here on, and good guidance going with green on Welspun Corp.
Okay, all right. Let's quickly recap then our list of top stocks to watch. The ones that have positive news flow are IRCTC, Cummins India, SAIL and Welspun Corp. Stocks with negative news flow, IndusInd Bank, Max Financial, Bata India, Cohance Life Sciences, Natco Pharma and Birlasoft. Okay, so that's our stock list for the morning. Let's now head across to Manisha, talk about commodities and all the headlines coming in from the US courts now. Manisha, I don't know if that's more exciting or the fact that, by the way, oil prices have risen over 1% overnight with all these OPEC discussions. Tell us more.
Oh, well, absolutely. The major headline, of course, comes in from U.S., from the federal court, ruling out Trump overstepping authority on imposing reciprocal tariffs. That is one major reason. And yes, the OPEC and allies meeting that happened yesterday, which winded down without moving anything really. They have maintained current quota in sense of their outputs there, and that has supported the crude oil prices. So we're trading above $65 a barrel right now. It was a good gain in the New York session, and the Asian markets seem to be building up on that. Having said that, the US dollar index has climbed over 100, and that seems to be capping some gains for many of these dollar-denominated commodities. Gold and silver as one, where we've seen profit taking come in for both of them in New York session as a knee-jerk reaction. But some opportunity buying really seems to be returning in the Asian markets right now. It is a lot of things. I mean, U.S. federal court is one part of it, but if you look at the markets, it still is supply concerns coming in. Chile, the biggest copper producing country, has raised price projections for metals in this year and next as well on easing trade war tensions, supply disruptions that signal that the market is swinging into deficit, especially in case of copper. So after seeing that profit taking in the New York session, we've seen some buying happen in the Asian markets right now. So copper is trading in the positive. We've also seen silver prices gain up a bit. Aluminum has turned in the positive as well. Zinc prices gained up 1% yesterday and are trading 0.5% up right now. So for overall metals and energy, it seems like a good start.
Thank you, Manisha. For that, we will get into a break. On the other side, we'll connect with Dipan Mehta of Elixir Equities for some fundamental stock talk. Stay tuned.
Welcome back. You're tuned in to Bazar Morning Call and hope you're having a good morning. Well, as promised, let's get in Dipan Mehta, Director at Elixir Equities, who joins us on the show. Hi, Dipan. Good morning. It seems the global markets are in a better place, going by the cues that we've got overnight. And maybe Trump's tariffs get pushed back a little bit, but there's still uncertainty. That said, earnings season has almost come to an end, and we have plenty of earnings here to track. Cummins, we have Sale, Welspun Corp. Anything stood out for you?
Yeah, good morning, Nigel, and thank you for having me on your show. Well, not really, I think, not from yesterday's earnings season, but there have been a few, I would say, outperformers in this earnings season as well. And they are scattered across various industries. Like, for example, cement, which you were very positive on. Large cap cement largely came in line, but smaller company like Birla Corp delivered an exceptionally good set of numbers. And then within the tech space, I thought Persistent and Forge came with good set of numbers, but the rest of the industry really disappointed. Within the NBFC space, I was particularly pleased with Bajaj Finance, but a lot of other companies disappointed. Piramal Enterprises slowly getting into recovery mode in the NBFC space. So like that, if you go sector by sector, there are certain outperforming companies within that sector. But by and large, I'm not completely pleased with the banking, with the quarterly season, purely on account of very, I would say, tepid set of numbers coming from the banks, which were below our expectation.
Okay. Speaking of banks, Dipan, hi, morning. IndusInd Bank, in this entire episode, rather disastrous episode, the low that it's hit is closer to 680. I mean, basically, the stock has been below 700, but it rallied from there, and now it's at 800. And more skeletons keep tumbling out, and this is just, it really shakes confidence, right? That this is not an inadvertent entry by, some member of the team, but this smacks of a deeper rot. While it's a very big story otherwise, and we'll discuss and debate it, what about the stock? Could it fall more, or do you think it's all in the price as well?
No, I think that largely it's got discounted, and it's trading at extremely attractive valuations, price to book, price to earnings. Typically, banks in the past who have got into such kind of a mess, they trade at those valuations. And I think all eyes are on the new team which takes over, and give them a year or so to kind of get the house in order. And you may see again the bank recovering lost ground. So I think by and large investors have factored in all of these negative aspects. But the banking industry per se is doing well, and interest rate cuts and improvement in liquidity, higher credit growth will help IndusInd tide over this crisis which they are in just now. And if valuations go back to 1.2 times book, that's 30-40% type of appreciation from here. So I think investors sticking in over there just as we are. I think we are also investors of IndusInd Bank. The time to sell is gone, so you just hang in there, I guess.
Yeah, I mean, the stock is halved. I mean, from the peak was in January 24, 1.5 years back. The stock used to be a 1,600 rupee stock. Today it's 800. So it's halved, and I think that's the point that Dipan is making. The worst is already in the price, and you're waiting to play the turnaround now.
In fact, now it's eroded all the returns over the last 3 years. In the last 3 years, the stock is down close to about 10-13%. But Dipan, is it time to buy at 800? It may not be time to sell, but at this price, would you look at averaging out?
Now he's smiling. Now Dipan is smiling.
You're asking the wrong person.
You're saying enough exposure I have already.
Yeah,
no, but for a neutral person, Dipan, this is actually a serious question, right? I mean, there will be people out in the market who will wonder whether this is a great time you buy, a company in disaster and in crisis. But is that approach, is that a advisable approach, a fresh buy now?
First of all, if investors want to increase their exposure to the lenders, the better way to do it would be to the NBFCs. So I prefer Bajaj Finance, L&T Finance, Chola, companies like that. You could even look at gold loan companies. I think Muthoot came with a very good set of numbers, and a lot of other banks also expanding their gold loan portfolio. You could look at some other banks focused over there. So there are a lot of choices within the lending space. And I prefer the NBFCs because the lower interest rate clearly benefits them, and then certain changes are taking place in the risk weightages as well. And they are far more flexible when it comes to lending and growing the loan book. So that's why I would avoid IndusInd Bank at this point of time. Just playing for recovery is not a great strategy. It doesn't really work out. 1 year could be 2 years, 3 years, who knows, So I wouldn't advocate buying IndusInd at these levels.
The other financial stock, Dipan, in focus would be Max Financial. Because the CEO, Prashant Tripathi's sudden resignation would have come as a setback, would have taken people by surprise. If the stock corrects today, is it an opportunity to buy?
See, Rima, I have kind of given up on insurance. I spent years and years trying to understand the business, try and value it, see what variables make it tick, and, what are the kind of factors one should look for. But look at the 10-year track record of the industry in terms of delivering returns to shareholders. That is very, very ordinary, well below the Sensex Nifty returns as well. And I've come to the conclusion that this industry is heavily regulated, and to value it is a bit of a challenge for ordinary investors, even professional investors. So I'm kind of, getting underweight to nil-weight insurance companies. When you want to play the financialization scheme, I think there are better choices, better segments within that, like the wealth managers are there, the asset managers are there. There are the stockbrokers, the exchanges. I think the better way to play financialization is through those segments than through insurance companies. So I'm just kind of, getting very, very underweight all of these stocks, Max Financial included.
Okay, all right. Dipan, request you to stay with us. We have a few more questions for you. For the time being, we take a short break. Come back, we'll get to our technical experts. Sudarshan Sukhani and Mitesh Thakkar are waiting for us.
All right. Well, let's get to the technical picture. Like we've been telling you, that the picture overall is fairly okay, and Asian markets are tracking that sharp gain that's expected on Wall Street, which is why the implied open is suggesting that we'll have a 70-point pop at the start, getting once again back to the closer to the 25,000 mark, perhaps. Sudarshan Sukhani and Mitesh Thakur are with us, so let's ask them for some advice. Gentlemen, good morning. Thanks very much for joining in. So it's this whole U.S. Legal situation that's suddenly, getting markets excited. As we're gearing up for probably a gap up open, what should the approach be from here on, Mitesh?
Good morning. We have a mild gap up as the GIFT Nifty is indicating, but the broader picture to me still remains when the indicators are flat, and I still don't see any evidence of strength which could suggest that we'll be able to get past 25,050 or levels. So I think on the index, I'll maintain a sideways stance. Closer to 25,000, I think traders can look at taking profits, but try to buy on the lower side, which is about 24,500, and this 550, 560 point kind of range could remain for the next few days to come.
Okay. Sudarshan, how would you look at trade today with this slight gap up that we're set for?
Yeah, good morning. Well, yesterday was a complete no trade day, but I think that markets have changed, at least the atmosphere and the environment has changed today. The chances are that the gap up that we are seeing could be sustained, but we must remember that today's options expiry weekly as well as monthly. Now that can do strange things. But with that constraint, I would be a buyer in the Nifty today. And this doesn't mean that the market has broken out. We are still locked inside a trading range, but it is possible that we could get that sympathy from worldwide markets. So take a small low risk trade by simply buying call options at the money, and then see what happens. Your stops in the unlikely event that the market doesn't respond is 24,700.
All right, so you'll be buying the 24,800 call?
That's right, 24,800 or 850, depending on how the market's open.
Okay, got that. What about individual stocks?
Well, there's
a
larger buy list. AU Bank is a buy. The financial sector has been a favorite for some time, and I hope it will continue. Buy with a stop under 690. M&M Finance is a buy. That's a very interesting chart. A decline, a base building process, and hopefully a breakout. Buy with a stop under 258. I also have Ramco Cement as an intraday short with a stop above 978. And finally, a buy in Metropolis. Buy with a stop under 1637. So 3 buys and 1 sell.
Mitesh, hi. Morning. What would your stock calls be this morning?
So I also have 3 buys and 1 sell. I think, on the stock side, a buy on CDSL can be looked at with the stop below 1,500 for targets of 1,560. Bank of India is a buy as well. Keep the stop at 118, look for targets of 125. A sell on Aurobindo Pharma. Keep a stop at 1163, look for targets of 1110. And Birla Soft is the final buy call. Buy with a stop below 414 for targets of 440.
Thank you very much for this call. We'll touch base soon. For now, it's a break. We'll come back with the pre-opening rates. We'll also be joined by Amit Tandon, MD of Institutional Investor Advisory Services, IIAS, on SEBI's order against IndusInd Bank over insider trading. Welcome back. In conversation with Dipan, awaiting the opening in about 17 minutes. Dipan, lots of earnings came out over the overnight. Midcap earnings, important ones like Cummins, IRCTC, Bata. Your thoughts? Did you track which one stood out for you?
Not really. I think that none of them really, checked all the boxes and interested us in taking it up as a fresh idea. But, companies like Cummins and all, when the results are a bit down and maybe the stock price reacts negatively, those are good entry points because end of the day, I think, over a longer period of time, these companies do deliver exceptional returns. And it's bang in the middle of this Capex cycle and benefits from many other, variables which are in play. And sooner or later, the uncertainty around exports also will evaporate, and that particular segment within Cummins also can do well. So it's good to buy a great quality company with strong competitive advantage when the chips are really down. And 2-3 years down the line, they turn out to be great, performers. And there's a lot of comfort in big blue chip names like Cummins.
Okay. That's Cummins. So if there's a dip, buy it. Got that point. What about railway stocks, Dipan? This week on and off, we've seen some interest come back. Yesterday, IRCTC reported numbers. Numbers were pretty decent, actually. Quite steady. But railways, any exposure, any interest?
No, not really. I think it's a great business and, government have been increasing its budgetary support. But unfortunately, last 4 years, the budgetary support has stagnated. And that has resulted in order books peaking out, or rather visibility of order books peaking out for a lot of railway companies. And look, even after a 30-40% type of a correction, there is still very high valuation. But we can discuss one company. It's a really small one. It's called Kernex Microsystem. And when I studied that company, it has, I think, 1,800 crore kind of a order book position for this Kavach. And that's about 16-17 years, it's trailing 12-month revenues. Don't look at the P multiples because, that's just crazy because it doesn't make any profits at this point of time. But certainly a company worth watching if they can execute and deliver on that order book position. Having said that, it's a company in which we haven't invested as yet, but it is on our watch list. And at some point of time, we may invest for ourselves and our clients.
Okay, so that's a full disclosure. Kernex Micro, a stock that's on your radar and that you like. But I think we have some metal business now with Nigel. Over to him.
Well, that's right. Jefferies, they have come out with a note. They have initiated coverage on Jindal Stainless. They have a buy rating target price of around 800 rupees. They have cited the company's leadership in India's stainless steel market and the favorable structural positioning. They've also pointed out that the company is the top player in India, which is, rapidly growing in the stainless steel market itself. They go on to make this point that the company is well placed as it has lower EBITDA per ton volatility, and they also have a healthier balance sheet if you compare it with any of the carbon steel players. Now, China stainless conversion spreads, well, they are at the lowest we've seen in the last 10 years. Margins could be, though, near a cyclical bottom. So if we see any kind of recovery in the global spreads, that's what could boost Jindal Stainless's profitability as well. What are the expectations from Jefferies? Well, they are expecting the company to deliver 10% volume growth, 21% EPS CAGR, with around a 17% ROE over the next few years. Finally, on valuations, they say the company is reasonable, trading at around 11 times FY26 EV upon EBITDA, given the 25% stainless steel premium over carbon steel globally. So put all this together, Jefferies, they're bullish on Jindal Stainless. They are citing the global factors, the leadership, and valuations as well are palatable according to them. Deepan, what's your view? Jindal Stainless, you don't like the carbon steel players too much, but this is more of a converter. Higher EBITDA per ton. There is some outlook with regard to volumes as well. What's your take?
No, I think it's a good story. And you could also add the fact that more and more stainless steel is being used in building, construction, in improving structures. And then we have this entire Amrit station. Some program is there of the government where they want to improve the modernize the station. So a lot of stainless steel can get consumed over there as well. And more there's preference towards using stainless steel utensils as compared to other metals. So yes, it's a good story. And steel companies like Jindal Stainless and all, you hold them for 3, 4, 5, 10 years or so, and they turn out to be great compounding machines. They can easily compound at 8, 10, 12% or thereabout. And if you buy them when the cycle is down, the returns can be even higher. So I think it looks good from our point of view.
Okay. All right, so that's a thought on Jindal Stainless. Dipan, thank you very much.
Dipan, cement has come in your favor.
And now there's a steel.
And now, after a while, on a metal company, you're a little bit positive also, Dipan.
Nigel is thrilled.
Yeah.
You could, if I may say so, you could call it the Nigel effect.
Oh, the Nigel effect. Now the sector seems to be coming in Deepan's good books.
So persistent, he is so persistent. For the time you have to recognize his enthusiasm. Yeah.
Oh, lovely, lovely. Now Nigel's party. Breakfast party after the show.
Only facts and figures, Dipan. Cement, we had pointed out in March that it's a global is in a bit of a tizzy. So maybe domestic themes could do well. And I think things have started looking up. On metals, anyone's guess. But as you said, and as Jeffries is saying as well, it appears Jindal Stainless at least is better placed in comparison to the steel names.
A breakfast party after the show. Just repeating.
Whatever you want.
All right. Thank you so much, Deepan. Great conversation. You have a good day, and we'll connect again soon. But back to what was a very serious development last evening. And this was SEBI coming out with an order against 5 key management personnel of IndusInd Bank. These are former personnel, of course, and this is an ex parte interim order that the market regulator came out with, finding prima facie violations by these 5 bank executives, including former CEO Sumant Katpalia, and these are violations relating to insider trading norms. We have Amit Tandon, MD at IIAS, joining in to talk about this. Mr. Tandon, thanks very much for being with us this morning. It's just the feeling, I think the market kind of knows, it's been hearing about these skeletons tumbling out for a while. But yes, this is new. This very clearly tells us that there was malified intent somewhere. It was not just about an inadvertent entry, which is what we thought back in March when the news first came out. This runs bigger than that. And now allegations of insider trading. I mean, materially, does it impact in any way the ongoing process, getting in the new management, and basically getting the bank on track? Does this impact that in any way, or should we look at this as 2 separate issues?
Good morning. You're absolutely right. After they'd taken the big bath and we'd had the chairman speak to the investors, we thought most of the worst is behind us, but clearly more and more is kind of coming out. To my mind, there are a couple of questions which need to be asked. First is, what does it do to the existing structure which was put in place? If you recall, they have an executive committee, and 2 of the members of the executive committee, Sushant Saurabh and Anil Rao, who've been named in the insider trading charges by SEBI, have been named by SEBI. So therefore, the first question to ask is that, look, will the bank persist with these 2 people, or is there going to be a big change which will be underway? The second question to ask, of course, is that, look, all this is coming out. Of course, we have implications for Sumant Katpalia and Arun Khurana and so on and so forth. But also, what does it mean for the board? Were they kind of aware of, they kind of had said in the past that they're not aware of it. But if you read what SEBI said that, look, we've appointed KPMG on the basis of a board note. So again, you have to ask whether the board were shielding the management or whether they were taken by surprise. I think that is really not clear at this stage, and we'll need to hear a little bit more. So if there is action against the board, you can expect that there is going to be some more tumultuous times going ahead. We need to remember that, look, RBI is asking the boards to have direct control over the assurance function. By that, it means they have to look at the internal audit, they have to look at risk management, and they have to look at compliance. And in all these 3, it's clear that the board has not lived up to what RBI's expectations were and what the investors' expectations were. So I think we are going to be in for some amount of volatility or internal churn as far as the bank is concerned.
Okay. Amit, so you're saying the board may need to take responsibility, and this could imply a shakeout of the entire board in IndusInd Bank?
As I said, things are not at the moment tying up. One of the things which was said was the board was made aware of it only as far as March is concerned, this March. But if you read what SEBI's order has said, there is a reference to KPMG being appointed way back in 23 on account of a board note. Now, of course, you can say the board had done its job then, but the question then to ask is, have they been asking the right questions, saying what is the status of the report, what is the amount? Of course, everyone, and they're right, there's no risk to the bank. The bank is solvent. But it has, the whole thing has become a matter of concern, because if you look at the size of the problem, which they were seeing, 1,500 crores, 2,000 crores, thereabouts, it's, for a long time, the quarterly profits of the bank were before tax were about 3,000 crores. So it's a significant hit that the bank would take, which is why you can understand why there was some attempt to kind of shield the numbers. And I don't know, they were looking at a wing and a prayer and hoping that, look, some of these, the market will correct itself to some extent, and therefore the extent of the derivative losses will come down. But I don't know what they were thinking about. But clearly, what it's pointing out to is that there could likely to be a shakeout as far as the board is concerned. There is, of course, the existing board structure, existing management structure, or the leadership structure will change. So the question is, how quickly will they be able to bring in a new CEO? And that in itself will mean there's going to be a round of internal cleaning up. Every bank is going to become much, much more internal focused rather than looking at opportunities out in the market. So I think there's going to be some degree of slowdown as far as this bank operations are concerned.
But Mr. Tandon, that's really the question. Will simply finding a new CEO be enough? Will it really restore confidence? Because like you very rightly are pointing out, there have been lapses at multiple levels. Accounting, risk management. I mean, earlier, like I said earlier, perhaps one could argue that maybe this was inadvertent, some wrong accounting of derivatives, and then there was something in the MFI books. But now, I mean, a willful violation of insider trading regulations. Basically, my question is, what more needs to be done? I was just reading the National Financial Reporting Authority, the NFRA, has also been receiving complaints. So now, is there a need for a wider probe? Is there a need for, I don't know, maybe some sort of forensic investigation? What needs to be done?
Look, the bank has already said that they're going to categorize this as a fraud. So once they categorize it as a fraud, you have the NFRA, you have the SFIO, you have, the auditors, and the current and the past auditors are going to be questioned. So therefore, there is going to be a great period where there is going to be uncertainty with regard to the bank. We've all been in the markets long enough. So we know that if a financial institution loses trust, it does take a long, long time for it to be built back, if it can build it back. Now, one of the things clearly is there is going to be an internal, it appears that one of the first ways to build trust is to bring in a completely new leadership team, revamp the compliance function, revamp risk management, relook at the internal audit. So, as I just mentioned, the bank is Sunday, for the foreseeable future, going to be much, much more internal focused on building some of these trends. Once they're able to demonstrate that, it's only then that the market will start, and by market, I mean retail investors and others, come back to the bank in the numbers or the numbers we've seen in the past.
Absolutely. I mean, there are those in the stock market who are willing to take a quick punt, thinking that this is a distressed asset, let's buy it. But from what you're saying, this could be a much more long drawn-out process before that confidence comes back.
Absolutely.
Okay. All right. Thank you, sir, for joining in. Good to get that perspective from you. Really appreciate it. That's IndusInd Bank. Of course, it's on our radar, one of the top stocks to watch this morning. But let's look at some more trading calls as well. We have Sudarshan back with us. Sudarshan, what's the 910 call?
It's M&M Finance, buy with a stop under 258.
Okay, Mitesh?
I go with the Bank of India for targets of 125.
Got that. Thank you very much for that. Let's talk about real estate. Looks like there is an upgrade coming through for the sector or some bullish notes. Ria joins in for more. Ria?
Well, good morning. Morgan Stanley has come out with a note on the entire real estate space today. What they believe is that top-tier developers continue to show strong momentum, which is supported by improving capital market sentiment as well as favorable policy cues, which includes some potential RBI rate cuts going ahead. They've also highlighted that the real estate sector has corrected by around 8% over the last 12 months compared to a 9% increase in the Sensex. And this has been because of subdued pre-sales in the second half of FY25, which has resulted in excess NAV premium unwind as well. They've also said that this reset offers a reasonable entry for some stocks, with the fundamentals still looking intact and the outlook remaining positive for the overall sector. On the back of this, they've upgraded DLF to an overweight rating with a target price of rupees 900. Prestige has also been upgraded to an overweight rating, with the target price being raised to rupees 1700 for this one. For Godrej Properties, however, this has been downgraded to an equal weight rating, target price being cut to rupees 2400. Oberoi Realty also has an equal weight rating, with the target price being cut to rupees 1700 for this one. And for Macrotech Developers as well, an equal weight rating with a target price of rupees 1400.
Thanks, Ria. Let's hop across to Vamakshi. She's here to squeeze in a quick word on Cummins. Vama?
Well, Nigel, when we look at the revenue, it was missed as compared to what the street was anticipating. The street was working with double-digit kind of growth, but the growth this time around has come in at only 6.4%. This is largely being dragged by the domestic business, which was largely flat on a year-on-year basis. But the exports business, that did quite well. The exports saw an uptick of almost 39%. And this is the second consecutive quarter where we've seen an uptick, year-on-year uptick in the exports. As far as the operational performance of the company is concerned, that was quite good. Keep in mind that there was a one-time gain in the previous quarter. So that seems to have, sort of the base quarter margins have been pushed up because of that. And therefore, we were expecting margins to contract, but by, not such a big amount. And this time around, the margins have actually come in much better than what the street was anticipating. The net profit has seen a decline of 7.2%, but this is again much better than what the street was working with. They're witnessing some partial recovery in the export demand. They are hopeful that this positive trend will continue. They're cautiously optimistic about the momentum in the domestic as well as the international market as well. Con call is scheduled at 10 a.m. today, so we'll be watching out for the commentary that comes through from the management as far as FY26 is concerned. So largely, when you look at the Cummins numbers, an operational-led beat.
Stocks up 1% in the pre-open session right now. Thanks very much for that, Vamakshi. The market overall, we're going to start exactly what the implied open was suggesting with this 70-point up move. And the Midcap index up about 0.5% at this point in time. So let's see. Some of the metal names are actually looking quite good. Tata Steel, JSW Steel, all these stocks on the high side. I think globally it's a bit of a risk-on day, thanks to this, court situation in the US. And therefore, we're seeing, dollars up, equities are up, metals are up, and this is what's playing out. Just a couple of minutes to go. Watch out for tech as well, by the way, because of the excitement around NVIDIA. Nasdaq futures are substantially higher. Tech stocks, let's see if they can retain
Global
their
facing
mojo.
indices will be in focus.
Global, metals, tech. That's how we start the morning. Okay, the bell's going to go off any second now. And we are opening with this 70-point up move. Make that 100 the moment the bell went. And it's actually a 100-point gap up opening. So looking very good. 24,850 on the screen, inching back slowly towards that 25,000 handle. And global facing, that's how it is. JSW Steel, 1.6%. Tata Steel, about 1.2%. Then you have all of tech. Infosys, 1.5%. You've got, names like HCL Tech, Wipro also higher. Let's not forget, stocks like Tata Motors. Easing tariff worries, obviously good news. US is a big market for that company. So that stock's higher as well. Banks actually in sync with the Nifty now, so not too bad. Axis Bank, for instance, up and about. IndusInd Bank is not reacting to the SEBI announcement. This is, quite understandable, frankly, because these, Mr. Sumant Katpalia has anyway been moved out. He is no longer the current CEO. And they will have to, these 5 individuals will have to sort of, deal with the market regulator independently. From here on, it's about rebuilding the business. So the stock, not too perturbed at this juncture. Actually, most Nifty stocks are positive. The only negatives are Tata Consumer, Bajaj Finance, that's about it. But this is a good morning, galloping away 120 points higher.
By the way, Tata Consumer's gone ex-dividend by 8 rupees 25 paise. So that explains the cut on Tata Consumer, Nigel.
Okay, all right. Well, a few stocks, though, that are calling for our attention. Avanti Feeds, that one, in fact, is a bazooka move this morning. Big uptick is what you're seeing on Avanti Feeds. I think it's reacting to its set of numbers. So good reaction out there. The EBITDA number came in high by closure around 36%. The margins at around 12.5%. The street likes it. The other stock that's doing well is Welspun Corp. We told you earlier today the margins have improved. The EBITDA per quarter is the best that we have seen in numerous quarters. Good order book and net cash in the books. The street likes it. Sale as well, the volume growth of around 17%. Well, that was much better than what the street was working with. They have released some working capital. The street likes that as well. Marginally up, closer to 100%. IRCTC, I think that one as well had a good start to trade. So that should come up for you on the screen. IFB Industries, that's the other one of those bombed up names. But the growth out there was quite good. Margins didn't look that good. But, the growth out there was good. It was better than one of their competitors as well. So I think that's why that stock is up close to around 3.5%. Invero Infra, that's the other one that's up close to around 4%. Big volumes out there. So though you have, the headline index that's up marginally, you have from the broader markets, lot of earnings reactions actually, and the stocks are off to the races.
Okay, some more then. Welspun Corp, 4.5% higher. Mishra Dhatu, Deepak Nitrite. Prestige Estates is also open with a 2.5% uptick. As the company says, they've completed 3 Mumbai projects and they will be handing over 700 residences and 130 office units. And plus, there is that bullish note coming through from Morgan Stanley on the entire real estate pack. So Prestige Estates has started off with some strength. Cummins, we were just talking about it, 2.5% higher. Birla Soft, revenues were soft. The company's top line declined by 5% on a sequential basis, but the company managed to expand their margins and the street is reacting to that. And generally, there has been an uptick in most of the IT names. I think one of the big drags today is Bharat Rasayan. And that is, I think, on the back of numbers. EBITDA for Bharat Rasayan is down 42%. EBITDA margins 13% versus 22%, and that stock straight away, it's tanked close to about 8%. The other one is Balaji Amines. Again here, there is a margin decline. Margins have sharply come off. The overall EBITDA is lower by 39%. Street doesn't like it, and it's getting punished to some extent. Bata was a lackluster set of numbers. The stock isn't doing too much, and Max Financial is reacting to the surprise CEO exit. Mr. Prashant Tripathi will be stepping down, so Max Financial has a 2% fall to begin trade.
Okay, so lots of stock-specific action, but overall as well, it's a positive morning, 100 points straight away up. Well, time to then get to our market masters of the day. Bank of America Securities 2025 India Conference has kicked off. In fact, it will kick off actually next week. The focus is going to be on growth acceleration in India. So let's discuss the view, the house view, then just ahead of that conference with Amish Shah, head of India Research, and Arvind Maheshwari, head of India Equities at Bank of America Securities. Gentlemen, morning, and thank you so much for joining us in person in the studio. It's always a pleasure to speak in person. And I was going through your note, Amish, you and your team's note, 9 structural drivers for India, right? Sounds fantastic. So I think in the near term, you folks are slightly cautious, given the run-up, given the valuation. So let's just start there by understanding the top-down house view on the near term. Then we'll come to the 9 drivers.
Sure. So look, near term, we had set out a target for Nifty at 25,000 for December. I think we are right about there. So we think markets are now likely to mostly consolidate as far as Nifty is concerned. Valuations are full. Clearly, we can't fault the long-term drivers or the growth in India. Macro story continues to stay well. But 21 times at Nifty, it's almost at +1 standard deviation. So if you're a near-term investor, our advice is that maybe start booking some profits. If you're a long-term investor for a 2 or 3 year period, then the view is that you should expect muted returns going forward.
Wait, but you're saying that maybe the best is over for the calendar year, despite the fact that, look at global markets. And it's tough to call these things, but now the courts are challenging Mr. Donald Trump and markets are rejoicing it. There's so much still going on.
And Surbi, there will be therefore some excitement to the markets in the near term. But if you would recollect, we were always pricing in that India will go through a trade deal quite soon. And there'll be benefits of China +1 on the back of that. So there has been some market rally on the back of that already. So some sectors which were going to be more impacted, like autos, maybe pharma, IT, on the worries that US economic slowdown could cut down on tech spends. There might be some rally as a relief as of now. But beyond that, India was never pricing in for a Trump tariff impact. and logically should not get a big rally on the back of that either.
Fair enough.
Amish, just to complete the point about the way markets are going to move now in the near term. So we're in the last leg of the rally, at least for this year. 25,000 is your Nifty target. But your note also talks about 5 emerging risks that make you cautious. So tell us about that. And is there a risk of a downside from here on? Could we see some derating?
So, Rima, think of it like this, that if you were bullish markets, I'm sure you are going to talk about 5 factors, which is there is lower crude, weaker dollar, there is ongoing monetary stimulus, there is a possibility of a fiscal stimulus on the back of extra RBI dividend and excise duties on fuel, and you could possibly talk about the India-US trade deal going through, or maybe the tariffs not existing anymore. All of these put together, therefore the bullish view is that growth will accelerate.
Correct.
And we completely agree with that view. The problem is that this is only half the view, because growth will accelerate is a directional view. The moment you start to quantify it, our problem is that we think that whether you talk about Capex growth, consumption growth, corporate earnings growth, credit growth, all of them will have a shallow recovery in comparison to what markets are already pricing in. Take, for example, Nifty in FY25 has delivered 5.5% earnings growth.
Okay.
We are expecting it to go up to 9 in F26, but the street was at 22, has scaled down to 14, but it's still 14, not 9.
Correct.
Same goes for Capex and credit and consumption and so on and so forth. So the worry is that every result season, therefore, acts as a market correction event because earnings will keep on disappointing. So that's the first problem. The second risk that we see is that over the next 12 months, there are 6 state elections, starting with Bihar in October. And I think that will lead to a re-acceleration of populism, which is something that market never likes. Second concern. The third concern is that, yes, there is a tariff scale down, but then there is a re-appeal to that. So the point is that the global macro and geopolitical uncertainties are not gone. They will keep markets volatile, right? So when you club it all together in the context of full valuations for Nifty, maybe at almost +2 standard deviation valuations for mid and small caps, the room for error is limited. And as a result, when we are saying that the markets will consolidate, obviously it's not going to be a straight line.
Yeah.
So depending on the news flow, you will have a little bit of a volatility. And actually, we've been using that volatility to our advantage quite well. And I'm not trying to claim credit here, but because we knew that market fair value is 25, when the markets were at 26,500 back in August last year, we were negative, and we were calling for a 17% downside. When the markets actually came down to 22,000 in March of this year, we upgraded markets with the price target remaining the same as 25,000. Okay. And we played for that 15% rally. Now that the markets are at our price target of 25, we are asking investors
This range stays 22 to 25 broadly, or 26?
So 22 now, I think, will really require some big macro or a geopolitical event. There is nothing in the horizon right now. So I think a pullback as sharp is unlikely. But could there be a +5, -5 kind of a trading range? Quite possible.
All right. Hi, Amish. Hi, Arvind. Welcome to the studio, and all the best for the conference as well. So you're sounding far more, skeptical about the markets as of now, a little bit cautious at least. And kudos on that call. I recollect, when we were at lower levels, we were calling for 25,000 odd. That said, one thing that's keeping the markets afloat is this strong DI flows. But you all are calling out peak DI flows. Explain that to us. What's the rationale? I mean, because everyone talks about this financialization theme, a larger number of people contributing, but you all are calling this out. So run us through that.
So Nigel, if you look at the number of demat accounts in India, just 5 years, like January of 2020, before when the entire rally of the markets has started, or the financialization theme has started, we had about 2.7% of Indians investing in equities, right? That number is now close to 13.7%. So there's more than 5-fold increase in terms of the number of investors in equity markets. Now, I can explain this in a variety of ways, but let's say loosely speaking, you talk to any consumer discretionary company, they would tell you that 20% of India is the real market, right? So 20% of India has some discretionary income to consume something discretionary. It is only logical, therefore, to assume that if you have some discretionary money, only then will you go and invest in equity markets. Otherwise the money that you earn is just catering for your basic needs. So if the cap is going to be at 20 and you are already at almost 14, the acceleration from 14 to 20 now is going to be slower versus an acceleration from 3 to 14. The second point to think about it is that obviously the investor who came in at 3 to 5% was richer and had more disposable income to invest in market as compared to the 14 to the 20th guy, right? So the per capita dollar that an incremental investor will now invest is also going to be lower, right? And given the valuations that we are, as we are discussing, clearly Indian retail investor is also quite smart, and that is reflecting in numbers. So if you look at markets peaked in September last year, domestic inflows peaked in October last year. Yeah. So October inflow number was $8.6 billion a month. That number since then, if you track from November, December all the way to now, has been between $4.5 to $6 billion. So markets peaked, flows peaked. Obviously, if they were to go back to 22,000, I'm sure there will be a flood of money coming in. So a retail investor will buy the dip. He will try to sell the top. And in that context, I would say that the pace of acceleration of flows that we've seen in the last 5-6 years, the pace slows and the pace now becomes more volatile versus a secular trend earlier.
That's a very interesting trend that you've noticed, absolutely. And I track those flows here. Every month the mutual fund data comes out, and you're right, 41,000 crores of inflow coming in around Diwali, and now we are down to about 25,000. So that's an interesting point. When we hope when markets fall, people keep buying. I think that's the new normal. But Arvind, let me come to you as well. Tell us a bit more about the sense, the expectations from the conference, and more importantly, when we're in an environment where there is a lot of expectation that globally investors will look away from the US. They've been very US focused all this while. Now money needs newer homes. Are you hearing that within your ecosystem? And then how is India stacking up? Because the Chinese market has the advantage of valuation on its side. Much, much better. They don't have the problems that Amish just described. So, what is the expectation from the FPI fraternity?
Sure, and thank you for having us here again. It's exciting times. There is massive interest in the conference. Last time was a super successful event, and this time it's bigger, it's better. And hopefully we'll have you at the conference as well. The number of investors is just testament to the fact that investor sentiment, despite all of this caution, is still very, very alive and kicking. Some of the themes, like you mentioned about the demand for non-US dollar assets, I think it's just about starting. And it's going to remain that way for a while. It is clear President Trump wants a weaker dollar, and we are not going to fight it. So you will continue to see demand for non-US dollar assets increase. And when we look at emerging markets as an asset class, that itself becomes a very interesting play on the back of that non-US dollar demand, because you saw from, even from mid-24, the outflow numbers were massive. Now, April to date, since what is called now the Liberation Day, that when the tariff noise started, we've seen about $19 billion of inflow in emerging markets. And what we saw as outflows from the middle of 24, only 20% of money has come back so far. So I think there is still room for that to grow in terms of inflows from emerging markets. And then India being at the heart and center of now the emerging market indices, I think there will be increased amount of passive allocation anyway coming our way. And plus, whoever is looking at benchmarking against the emerging market indices, I think India becomes a very sort of safe haven. So yes, valuations are one part of the problem, but if you look at top-down macro, it's hard to find fault with India at this point. And I think that story is going to be, there's not too many large pockets of investment opportunities in the world outside of the US that will be able to absorb capital.
For the benefit of our viewers, I just want to call out the 9 themes that you've singled out in your latest report. And these are medium-term structural themes for India that Bank of America Securities likes: rapid infrastructure build-out, productivity gains, digitization, financialization, the resilience in household savings, the shift in discretionary consumption, formalization of the economy, the current account, moving from a deficit to a potential surplus and decarbonization. So all of it tying in together to present perhaps a solid medium-term picture for India. Based on this, I mean, either of you gentlemen can take this. Which are the key highlight themes that you plan to call out in the conference? What is it that as a house view that you're most optimistic on? Is it renewables? Is it power? Is it, what's the new sunrise sector, or even if it's an old sector, and what's the sector of the future?
So I can take that, and maybe Arvind can chime in. So see, first of all, I think Surbi, the good news is that some of these themes have been playing out for a while, but now they are coming together. So a confluence of them coming together, I think, can have a bigger impact. So to some extent, they are all connected. So let's say, for example, India is doing a lot of Capex, but how do you fund that Capex? So when you have household balance sheets getting better, and then they go back to savings, that saving then in turn funnels into funding the investments. And then that once the infrastructure kicks in, then you have the productivity gains to it. The formalization of economy is equal to larger, better, bigger companies growing market share at the expense of unorganized players. Unorganized players, as we know, were leaking taxes. Organized players pay taxes. So then the government gets more money, and the government then wants to use that money into productive use. So a lot of these things, I'm just trying to say, is that it's connected. And when they come together, it's a even bigger or a powerful theme. So when I started my career, I recollect there was a perennial complaint about India running twin deficits. Like we are a current account deficit and a fiscal deficit country, and as a result, we had higher rates, higher inflation. Currency was always a problem. We don't talk about that anymore. Currency is stable. Little bit up and down, it's fine, but it's markets. But otherwise, currency is stable, rates are quite low. The gap between US Treasury and our Treasury has been the lowest ever. So all of these are macro benefits, and it just makes cost of doing business cheaper. And when the cost of capital is cheaper, obviously, there are more businesses that become viable.
But you're still saying 25,000 on the index.
Yeah, meaning if I were to put a target up until December of 25, which is in the here and now, because meaning unfortunately, as we know, markets is nothing but EPS multiplied by valuation multiple. Valuation multiple for 10% EPS growth is already at 21 times. How much more are you likely to pay? We are already at +1 standard deviation. So I think the good news is that a lot of countries globally don't have that structural theme. Yeah. So at least India is a structural growth story.
We have the background, the
yes,
backing.
Amish, for the longer term, India is good. Come on.
Absolutely.
I'm putting most of what I earn into the Indian market.
So Nigel, in fact, I would support it with a data point. Yeah. We looked at India 15, 20, 30 years. Yeah. You'll be surprised that after US, India is the only market globally to have delivered the best market returns in US dollar terms.
Yes.
So despite the rupee depreciation, second largest return generating market. And over a 10-year period, India is the highest number of stock compounders globally.
Wow.
Right. So clearly, there is need to find the bottom-up ideas. There will be compounders. Market will grow structurally.
Yes.
But for the near-term investor, 25,000 is the full price.
And also just one more point on that, because the SIP investor, I think only in the Indian markets and the United States have made a lot of money. So keeping your SIPs going, that's something that our retail audience obviously, looks for some guidance on. I personally do that as well. So keeping a SIP going, the longer duration, maybe the near term we're hitting a peak on the headline index, but longer duration, India should do well. Another quick point, since you all were talking about this rate easing cycle, a couple of sectors will do well. Sure. One such theme you all are pointing out is autos. Could we narrow down a little bit, because the rate easing cycle will give more amount of money in the hands. You have the tax cuts as well that are coming there. So what do you like from the auto pack? Either of you all could take it.
So, and I will broaden that answer to some extent, Nigel. We are of the view that economy needs a stimulation. Unfortunately, there is not too much of room from a fiscal side to stimulate right now. Therefore, large part of the onus is on monetary. Yeah. Monetary, there are plenty of tools, and the government will use it, or the RBI will use it. So because monetary stimulus will continue, we are broadly positive on everything which is rate sensitive, domestic cyclical. So that includes financials, autos, as you mentioned, REITs, real estate, some internet. So this is all that we like. Within the auto space particularly, we are more constructive on the passenger vehicles right now, followed by two-wheelers. given that we think that the infrastructure growth is relatively going to ease, we are not that optimistic on the commercial vehicles as of now.
Arvind, Capex has been a big theme for our markets. It's, stocks have done very well. In fact, it's one of the 9 structural ideas for you, a good infrastructure rollout. Yet you are underweight on Capex-linked plays like industrial cement. Why is that?
So, look, ultimately what Amish also pointed out earlier, if there is elections coming up, there is more populism, generally that money goes away from Capex into doing these kind of measures, and it becomes harder then for anyway execution challenges remain in that segment. So as much as we want the Capex push to be there, you have to be able to execute the allocated outlays, and if that doesn't come through into execution, ultimately the growth challenge then becomes a bottleneck. So which is why to what Amish was mentioning about the money tracking financials and autos, rate sensitives, and we are seeing that in April to now, whatever money flow has come through from foreign investors, you can already see more than 50% has gone into financials if you track the data. So clearly the market also wants to be where the policy support is going to be.
You're also cautious on momentum plays. What would you classify as momentum plays? Would it include, say, for instance, defense, which has had a fantastic run up until now?
I'll let Amish take that.
So, Rima, the short answer is yes.
Defense is one. What else comes in momentum? And then tell us more about it.
So, I would say defense, SOE pack in general, railways, industrials, power utilities. Primarily, the bigger definition of it is Capex-linked stocks. So, as Arvind mentioned it, if I were to just put some numbers to it, central government Capex between 21 to 24 was growing at 30% CAGR. Is now likely to grow at 10. State government Capex was growing at 21% CAGR, is now likely to grow at 8 or 9, right? The overall Capex pie was growing at 20% CAGR, is likely to now be at 10. So there is a rapid scale down in terms of growth or the second derivative that we are talking about. On the other hand, subsidy bill of India, states and center put together was $91 billion back in FY23. FY24 in 2 years' time is expected to be $127 billion. So there's a 40% increase in a couple of years' time.
And this moderation in Capex, is that a structural theme? Because it'll keep putting a lid on stocks that you're talking about.
So in terms of the growth rates, yes, given where the tax collection growth rate numbers are. Meaning, is there a stoppage to Capex? Not really.
No.
But are we in the era of growing at 20+%? We are not in that phase anymore, right? So the nominal GDP will grow at 10-11. I think Capex will grow at the same run rate. So if you had an economist in the room, he would argue that Capex as a percentage of GDP is at least a flat line. It's not shrinking. So why are we complaining?
It's the alpha.
The Capex analyst in the room will argue that the growth is down from 20 to 11, and therefore stocks needs to adjust to the valuations. Therefore,
I'm glad you brought that up, put it on the table before anybody could ask counter questions. Finally, gentlemen, where are you on the mid-cap, the SMID versus large-cap universe debate? Because the narrative so far this year, and it's played out, is that large caps offer a lot more value. Just stay with the big boys, and that's where the money is. How do you see it now?
If I take a fundamental cap on, then I clearly think that SMID caps are more expensive than the large caps. There are various ways to argue it. I will just give you a couple of data points. In the last 3 years, the growth premium of small and mid caps over the large caps was 16 percentage points, 16% extra growth. Okay. So clearly that justified valuation premium. Yeah. Right? If you go into the next couple of years, that growth premium is going to shrink to 400 basis points. Okay. But the valuation premium at the peak was 50%. Right now is at 45%. So growth premium has massively shrunk. Valuation premium has hardly shrunk. So from a fundamental basis, I would say that large caps are cheaper, mid caps are more expensive. But from a flows perspective, till the time the money continues to rotate into small and mid-cap mutual funds, as a mutual fund manager, what choice do I have but to chase the same stocks and bid them at higher valuations?
When money comes in, all bets are off. Then all arguments fail, right? You don't stand in front of
There is a lot of supply of paper as well coming through, right? So that is, and that will, once the large caps and the big boys have raised some money and that is out, you will see a whole host of mid, small cap names also. And look, I think
I'm glad you brought that up, Arvind. Could that put a further lid on the market's excitement because there's so much of supply in blocks on a daily basis? There are IPOs coming.
Look, I think at some point it will be a cause for concern, but I think we are starting out from a very low base, right? We had a very dry Jan to April. So 4 months, literally, we had like $1.65 billion in cap raises in deals across all segments, whether it was IPOs and blocks, etc. Now, this is the first month in May where we have seen almost $5 to $6 billion. Now, if you recall, second half of last year, we had almost $7 billion every month. And ultimately, obviously, that at some point started to fatigue the secondary market. So I think it's still early to call that a reason for concern. And obviously, as the market expands, the free float expands. I think we want more companies listed. There are some great stories in India. We want them to come into the listed space and get all retail investors to be able to participate as well. So I think it's great for a great outcome structurally for the markets longer term.
Okay, all right, gentlemen. Good hearing your thoughts. In fact, on that point, it could explain why the mutual fund industry was sitting at such elevated cash levels. I think it was around 2 lakh crore. Pure equity AUM as a percentage are around 7%, so prepared for some kind of supply. But thanks a lot for coming down. We take your thoughts on boards and wishing you all the best for the conference. Look forward to having you all post the conference as well. All the best, gentlemen.
Thank you, Nigel.
Thank you.
Well, time to slip into a short break. On the other side, we'll get chatting with Vishal Goel of UBS Securities. We'll talk about the Indian banking sector. Stay with us. Welcome back. Well, the market's still holding with some mild gains, though we have come off the top of the day. But there are plenty of stocks actually from the broader markets that are doing well. Federal Mogul Gots, after a while, this one's come on the radar. It's up 15%. Vito Switch Gears, well, that's up close to around 15%. So I don't know what's going on there. Welspun Corp, the one that we spoke about earlier today, well, that's making almost on the verge of making a fresh 52-week high. So broader markets, plenty of stocks doing a thing of their own. But as promised, let's focus on the banking universe now. Our banks back to the golden era. Our asset quality woes, unsecured lending concerns, a thing of the past. Let's discuss this and more with Vishal Goel, the head of India Research and Banks Analyst at UBS. Hi, Vishal. Good morning. Thanks a lot for joining in. Well, before we get to talk about PSU, private banks, and the entire industry, I just wanted to ask you about credit growth. That's yet to show signs of picking up. In fact, it's moderated in the last few months. What kind of credit growth are you all working with? And if you could tell us, do you expect things to pick up from here on?
Yeah, hi. Thanks for having us. Clearly, I think the impact of tightening, which we have seen in last years, plus the growth slowdown, which we saw in the last half, it's reflected in the slowing credit growth. I guess from here, like from the current 10% number, we are expecting it to go towards 12% by the end of this year. Multiple tailwinds we have for credit growth this year. We have the consumption stimulus from the government, which should start, reflecting somewhere, this year. Also, the liquidity easing, that also enables banks to start lending more than what they've been doing. Clear constraint has been deposit growth. That also generally would start improving towards end of this year. And also, I think if you look at the risk weightages from RBI recently, they have in fact relaxed all those. So the overall environment, especially from the regulatory point of view, is easing plus liquidity. I think this should start, reflecting in the credit growth over this year.
Vishal, thanks for joining us from the sidelines of your conference. Thank you very much. This is Rima here. Last month, you all turned bullish on some of the PSU banking names. So I can see an upgrade on SBI to a neutral, an upgrade of Bank of Baroda to a buy. Tell us the thinking on PSU banks right now. What's the narrative playing out?
Yeah. Hi, Rima. See, I think we've been cautious on PSU banks, especially due to their lower profitability and their ability to keep profitability. So they gained because of falling credit costs. Generally, their operating profitability has remained weak. We have reached a point where their profitability, especially in terms of core PPOP, is stabilizing. Plus, there is no major pressure from corporate lending. Also, their exposure to retail unsecured is generally small. I'm talking about the overall pack. And I think all those, again, gives us some confidence on their credit cost. And valuation, given their underperformance, I think have become reasonable. So those were the views, from cautious to more like a neutralish view on state-owned banks. We still prefer private sector, banks, as a pack in terms of overweights, just to clarify that.
All right. Speaking about the bank that's been in focus for a variety of reasons, may not be the best, is IndusInd Bank. And a lot of news flow out there. But a stock that was at around 1,600, today it's less than half that price. Give and take everything, do you think bulk of the bad news is in the price? Or do you think things are too fluid and there could be a negative surprise coming out of somewhere that you'd rather stay away?
Yeah, Nigel, sorry, I'll not be able to discuss stock specific due to our internal compliance. I think, yeah, so maybe I can make a general comment on the industry, but maybe not stock specific.
But do you want to make a general comment on IndusInd Bank? Will this have any kind of ripple effect? Because what we're seeing right now is that incremental bad news is not further hurting the stock price. Like, for instance, today there are allegations of the SEBI investigation throws up insider trading. It's not that the stock has fallen further. So, I mean, from a shareholder point of view, how should they go about thinking about a stock like IndusInd Bank without getting into specifics?
See, again, I think without discussing stock specific, I'll tell the way I would look at this is we have had similar cases in the past, right? There have been a couple of such banks who went through a similar journey, I mean, in a different form, but they had serious losses, change in management, regulatory interventions. And post that, what typically happened is you see a consolidation in metrics, like the growth disappears. The focus goes back in terms of protecting the depositors versus shareholders. That generally is the script from regulator. And in generally the period followed by maybe 18 months to 24 months, in that period, you typically see no activity, from such companies. In terms of growth, generally it's a cleanup period. So that's been the case in previous, similar cases.
Any big anti-consensus call, by you, not on stocks, but even in terms of a trend? I can see Bajaj Finance, for instance, is a sell for you. And that seems anti-consensus to me.
Yeah, see, again, I think if I think about broader sector themes, the way we looked at is we've been cautious on the sector for last 12 months or more. We turned constructive, recently. And clearly, there are reasons for that. I think when I say anti-consensus, probably when I look at valuations, which is still below average for the sector, I think clearly there is room for making money in this sector. And we think the regulatory landscape is turned favorable for the banking sector. Like we have seen multiple tightening in the last 2 years, which is getting now relaxed. If you see, incremental last 3 months. I feel more relaxation could come through in the next maybe 12 to 18 months. Second, I think the consumption credit cycle, the unsecured credit cycle, that also has seen like NPL buildup. It's probably in the last stage of cleanup in our view, as per the data we are seeing. So the pressure on credit cost also should start easing from here. The only thing which is left is NIM compression due to rate cuts. That I think will have to factor in this particular year. But otherwise, I think if I look at the compounding on ROE, I think the sector should be comfortably compounding at anywhere between 13 to 15% on ROE and reasonable valuation. So, yeah.
As a house, how many rate cuts are you all factoring in?
See, our economics team is expecting 75 bips of additional rate cuts this year.
Okay, so Vishal, hi, Surabhi here. Just to kind of recap the main headlines from this. For this year, what is your expectation of credit growth system-wide, I mean banking system-wide, given the rate cut expectations? And just purely in terms of growth, which kind of lenders could be ahead?
Sure. See, we are expecting 12% credit growth. So this 10% should improve towards 12%. That's our view on the credit side. We feel consumption credit would drive this growth because we have seen multiple, I would say, stimulus waiting actually to come through in the next 12-18 months. That should support growth. Falling interest rates, the housing cycle itself, that also should accelerate towards the end of this year or second half of this year. So a lot of, I would say, growth will be visible in the second half of this year in terms of loan growth.
So finally, for this year, I mean, the next 12 months or so, the biggest driver of stock prices, of course, is going to be, the credit metrics, credit growth itself. What else to watch out for? What will be the biggest factors that will lead to perhaps the best delta in stock prices, whether it's banks or non-bank lenders?
Sure. See, I think growth will be, as you said, will be the biggest factor because we've been seeing lack of growth for some time. I think the second factor will be stability in net interest margins because currently there's a lot of uncertainty around how much the NIM would fall due to the repo rate, basically how much banks would be able to retain, right, or offset versus the repo cuts. So that stability also will be reassuring because then people will have some visibility on FY27 NII and FY27 NIM. And lastly, of course, the last leg of unsecured credit cycle, that's still going on. I think the incremental data points are encouraging, but once we see that kind of fully stabilizing, then banks will also be able to grow the unsecured credit with more confidence going forward. So that's the other data point to watch out.
Thank you, Vishal. Great conversation. Enjoy the rest of your conference. Look forward to the next one. Now let's get in a corporate conversation. EID Pari. Now the Q4 revenue saw healthy growth, but margins were under pressure. For FY25, most of the businesses did well, barring the sugar business, where there was a revenue decline of about 13%. The sugar business also reported losses, and that's on account of the lower crushing. So how is FY26 shaping up for them? Let's connect with Muthu Murugappan, CEO at EID Pari. Thank you very much, sir, for joining in. This is Reema here. That's the first question. In FY25, except sugar, the rest of your businesses did pretty well. So, for instance, distillery revenues were up 38%. The consumer products business revenue growth was 25%. Nutraceuticals saw a growth of about 18%, but sugar was subdued. For FY26, how would all these individual segments fare for you?
Very good morning, Reema, and thank you for having me on the show. Yes, it was a challenging year for the sugar business on account of lower cane availability, primarily in TN and AP, and also lower cane recoveries. I think this impacted our sugar segment performance. Looking ahead to FY26, I think challenges in TN and AP continue. We are hopeful that planting will improve, in the upcoming season. But for this season, we do see challenges continuing in TN and AP. However, coverage is about close to 60% of our crushing capacity looks, much stronger. So that.
Okay. So, sorry.
There was some sugars. We are seeing good monsoons. They've in fact started early.
I think that line is slightly that line is slightly patchy, Mr. Murugappan. If you could just recap for us. So you've done, in terms of sugar revenues, this year you've done 1571 crores, which is obviously a decline from last year. The current year, do you expect some of the crushing issues to come back on stream? What is the sugar revenue that you're hoping to achieve this year? If not revenue,
so
it's
in
a
the
function of-
upcoming year, we're still.
Yeah, please go on.
So we're still, more cautious on the Yeah, we're still more cautious on the upcoming year because of lower cane availability in TN and AP. Also, we're seeing a trend of release quotas, coming down. So from the sugar perspective, it could be a challenging year going forward. Karnataka, however, looks good, from a crop perspective. More broadly, I think monsoons are there, and I think they are expected to be normal. So this should strengthen the general availability and capacity utilizations across the sector. From a price standpoint, given that there's likely to be more sugar in the domestic balance, pricing might correct. But then again, we'll have to see what kind of policy interventions are made on exports as well as on ethanol. And hopefully positive interventions here will bolster pricing. But we're still, quite cautious and rather neutral on the sugar segment.
Okay. All right. Hi, Madhu. Good morning. Good to see you. Nigel on this side. Give us a couple of details then on the distillery part of your business. What kind of volumes did you do last year? And since I think you have some capacities that have come on, FY26, we should see a bit of an uptick in terms of volume. So if you could give us a brief number in crore liters.
Sure. Thanks, Nigel. The distillery was a good story last year. We did about 16 crore liters of volume. Some of our capacity came on stream.
Okay.
And
for the coming year,
in F24, so that was a good growth.
If I got the numbers correctly, sir, Muthu, it was 16 crore liters last year.
That's correct. For F25, it was 16 crore liters. F24 was 12.5.
Okay.
And the upcoming year as well, we should see a slight uptick in distillery volume. However, on the margin front, we have seen some challenges. Challenges on account of ethanol pricing, that hasn't changed. The offtake pricing hasn't changed for close to 3 years now. Also, given we had lower cane feedstock, this increased input costs. We had to insource a lot of molasses, which was quite costly. So this has impacted margins. We're down to about 8% on EBITDA margin, as opposed to 12.5% in F24. And we expect this 8% trend to continue. Ideally, if there are some positive policy interventions, this could move higher.
Okay, all right. Just a couple of questions. From 16 crore liters, what should you end this year with? 17, 18 crore at least? Should that be a doable number? Is it higher? And also, you all made a pitch for this ethanol price hike, right? What is the quantum you all were looking forward to, and how optimistic are you all about that seeing the light of day?
Sure. So in terms of volumes, I think we should comfortably move to 17 crore liters. And, I think if there are positive policy interventions and some improvements in cane planting, that could, go even higher. In terms of ethanol price, I think industry has made some representations. I think the policymakers have, given us detailed hearings. I think industry representations have been to the tune of 4 to 5 rupees. However, we'll have to see where that lands. Policymakers have been receptive to our representations. We remain hopeful.
Muthu, the ethanol price in the last year, November 1 to October 31st sugar year, that was 57.97 from what I'm seeing right now, basically around 58 rupees. Would that be right?
For B-heavy molasses, yes.
Okay. Now, which is the feedstock which you use? I mean, because you're saying that distillery, the volumes are fine. The top line is growing. The problem is with the margins. So what kind of a price increase would make it more viable for you? And also tell us about different feedstock. I don't know if you're using maize, for instance, because there was an increase on maize as well.
So we use 3 feedstocks. We use B-heavy molasses. During the crushing season, we use a little bit of sugarcane syrup as well. That pricing is about 65 odd rupees. We use maize as well. Maize is about 71.8. Maize is about just under 20% of our capacity. It's only one distillery which has maize capacity. So we use these 3 feedstocks. Ideally, on the sugarcane-based feedstock side, it would be good to see an improved offtake pricing. I think we would resonate with the industry ask of about 5 rupees here.
And I mean, assuming this is an assumption, where would the margins be if, let's say, the industry got what it's asking for, which is about 5 rupees. I mean, as of now, what is the projection minus any ethanol price increase? What's your projection of margins for the distillery business? And how much could they look better if there is this price increase that comes through this year?
So Surabhi, as mentioned, I think we will hold margins at 8% if nothing changes. If I take you back 6 to 7 quarters, I think we were around 20-21% EBITDA margin, and we were quite comfortable. It would have moved slightly north, if that trend of offtake prices was going to move up. And we were very happy with that because we, just coming off a significant Capex program on ethanol. And I think this would really keep our payback aspirations in check. However, with these margins of 8%, I think there would be challenges around the payback periods. If there is a price increase to this tune, I would say the margins would move back into the late teens.
Late teens, okay. That would, of course, your shareholders would really like that. So it all is now hinging on this price increase for ethanol on the B-heavy molasses. Muthu, I just want to come to your other business, which has been growing really well as well, and that's consumer products. I mean, there the revenue from about 530 crores has grown this year to about 880 crores. So it's a substantial increase. Give us an overview. What can we expect from this business? Any new likely launches? And again, the margin profile that you're aiming for this year for this business.
So I think, Surabhi, this is a new business which we're building for the future. We have a multi-decadal view on this. It's really in branded food, FMCG. We started off with sweeteners, and if I was to focus on the sweetener segment first, I think our branded white sugar volumes are holding stable. We've put a lot of focus in on the value added, especially the browns, which is jaggery, brown sugar, etc. And I think that has grown. Our value added component is about 12% of overall sales. This is, of course, margin accretive. And also with the trend of consumption of sweetener moving towards more healthier sweeteners, this is in line with the sort of movement of the market. We launched into staples this year, which is beyond sweetener with millets, dal and rice. And this portfolio fared well. It was a good start. We did just under 300 crores of revenue. This will continue. I think we are focused on, building a strong organization, a strong team.
So how much growth this year in this business? I mean, just a sense, do you touch 1,100 crores of revenue more?
On the non-sweetener side, I think we'll grow another 20 to 25%. On the sweetener front, we will actually focus more on, growing the value-added piece. I think we're quite happy with the base business of branded white sugar that we have. And on the non-sweetener front, on the staples front, rather looking at bringing in more products which are margin accretive on the lines of, convenient foods, which is, your roti mixes, dosa mixes, so on and so forth. So I think we'd focus on that. Of course, our focus is also on distribution. We closed F25 with a little over 2 lakh outlets of coverage. This will move closer to 3, and we will focus on deepening our presence in the quick commerce, e-commerce, as well as the larger modern trade channels.
Thank you very much, Mr. Murugappan, for joining in. That's EID Parry for you. For the markets holding up with a gain of about 0.3%, the Nifty is above 24,800. Let's find out if there are any 10 a.m. trades. Mitesh Thakkar is back with us. Mitesh.
Yeah. So I think, the index has come off. As I said, it's mostly a market which is sideways, just chopping around and not too much of a directional bias. On the stock side, I have one buy and one sell. Bharat Forge is something which has broken into a fresh swing high. So buy here, the stop just below levels of 1255 for targets of 1300. And Phoenix Limited is on the negative on the sell side. I would suggest a stop just around 1595 for targets of 1530.
Okay. All right, Mitesh, thanks very much. We'll take a very quick break on that note. Come back. Latest commodity market action coming up with Manisha Gupta. Welcome back. So, as promised, let's go to the commodity markets. Equities are holding up fine. Nifty still up about 70 odd points. Commodity markets now. Manisha is in here with us in the studios. Manisha, what's the headline? Mr. Donald Trump is keeping the markets excited.
Oh, absolutely. Since he's taken office, even before that, it's been quite exciting in the commodity markets here. But overnight, with the kind of statements that we've heard from the federal court, trade court, is what really seems to be moving many of these commodities. So, overnight, we saw the crude oil prices gain up by a percentage point. And after the U.S. Court of International Trade has declared tariffs unlawful and has also said, or rather ordered tariffs to be vacated and blocked, we've seen some bit of an ease in business here. And many of the industrial commodities, energy as a space, has seen some buying in the overnight market. There. Well, apart from that, what really seems to be supporting the crude oil prices also is the OPEC plus ministerial meeting that happened yesterday, and they haven't moved the current output quota. So that was supportive as well. Having said that, the OPEC 8 plus are going to be meeting on Sunday, that is 31st of May, and they could be talking about increasing production from the month of July to the tune of 411,000 barrels per day. Remember, they want to increase production and bring it to 2.2 million barrels per day by the month of November. So statements on Sunday perhaps could move the markets on Monday here. Having said that, it also is about U.S. barring Chevron from exporting crude from Venezuela. That is a developing story and can have implications in sense of supplies going forward. Chevron can continue to hold its assets in Venezuela, but it cannot increase assets or export Venezuelan oil. So that's a bit of a tricky situation there. Also, the markets are anticipating that the summer season demand is going to be on the stronger side. That starts from mid of June. The markets also are looking at a heavy Atlantic hurricane season within that part of the world that perhaps will also bring premium to markets. And then the Canadian wildfires have been going on for too long and could be hurting supplies, is what the reports really seem to be suggesting right now. The markets have a keen eye on the US and Iran nuclear conversations as well. We've seen 5 rounds of conversation without much progress there. So what happens onto this one? There's another meeting happening this weekend. Keep your eyes on that one as well. The US inventories also have declined by nearly 4.2 million barrels in the previous week, adding support. So when you look at all of these factors and fundamentals, suddenly it seems to be turning for the positive for the crude oil prices. Other one that I want to add is the Baker Hughes report, which says that the operating oil rigs are now at the lowest since November 2021. So that drill, baby drill, also doesn't seem to be really happening on ground there. What the markets will now watch out for is the first quarter GDP estimates that would come in from US. It also is going to be about the weekly jobless claims that comes in today, and the PCE price index data comes in tomorrow. So it's going to be a loaded next couple of days.
Okay, all right. Manisha, thanks a lot for that. Well, let's focus on a couple of stocks that are moving around. In Welspun Corp, that's the one that delivered its set of numbers, and let's run you through the top points why the street likes this set of numbers. First up, in terms of an EBITDA, in the quarter it came in at around 460 crores, and we pull up a chart, you'll see it's been steadily improving from around the 350, 400 crores, it's moved to 460, and in fact that's almost the record high that we've seen. So EBITDA per quarter coming in at 5-quarter high. Next up, the guidance, very, very impressive out there. Last 2 years, the EBITDA guidance that they lay out, they go ahead and they've achieved more than that. Now, for this year, if you compare the guidance that they've given of around 2,200 crores with what they've achieved last year, they're guiding for an 18% growth in terms of an EBITDA growth, which is fairly good. Keep in mind that they include the other income in the EBITDA calculations as well. They had a small net debt as of the last year. Well, that's turned into net cash. So now cash in the books is close to around 5% of the market cap, though they have a big Capex plan for the next few years. The order book as well, very impressive, close to around 19,500 crores. So they've got order visibility for more than the next 1 year or so. And since things are looking up for them, they have announced a greenfield project in the United States. That's for LSO pipes. They've given us a lot of reasons out there, but they are saying that demand is very, very strong. And remember, for the US business, which was virtually absent for the last year, that gives them better margins. So put everything together, the stock is almost at the highest level we have seen in the last 52 weeks or so. Currently, that it's up close to around 8%. Good set of numbers, good order book, fabulous guidance going ahead.
Okay, that's Welspun Corp. Stock is fired up in excitement today on the back of those numbers. By the way, as we take our next break, just a quick check on the market. It's cooled off a little bit from that initial pop of almost 120 points. The Nifty has now come down to a gain of just about 70 odd points. The weak hands include the non-banks today. Very interesting. Bajaj Finserv, Bajaj Finance, Jio Finance, Shriram Finance, HDFC Life. So the non-banking financials, they are the ones that are not too excited this morning. And then there are 1 or 2 other names like Tata Consumer and BEL. So that's where the Slight sense of caution is in the market, but otherwise, I mean, it's not bad at all. Tech and consumer-facing, tech and global-facing names like metals doing really well. So JSW Steel, Infosys, these are the stocks that are retaining a bulk of their gains. And IndusInd Bank, unshaken, unstirred with this whole insider trading issue coming up. Because remember, it is, many of these 5 key management personnel, they've anyway been sort of moved out. They're no longer with the bank. So let's see. Market not too perturbed with the SEBI order that came in yesterday. That's about 1% on IndusInd Bank.
Okay, Som Distilleries, by the way, the numbers were fine, but the stock is now nosedived. It's down close to about 10 to 11%. And on the way up, buying has emerged in names like MMTC and India Pesticides. Good volumes, on these names and big moves on the way up. Well, that brings us, we're going to slip into a break on that note. On the other side is our special segment. It's The Economy. Lata will discuss the state of bond yields and banks in India with Ashish Gupta of Axis and Rikin Shah of IFL.
India's 10-year bond yield is at 6.7%. This is the lowest we have seen it since September 2021, 3.5-year low. The immediate trigger, of course, is the record 2.7 trillion rupee dividend from the Reserve Bank to the government, which is the largest historically, even if it is a little lower than street expectations. On the other hand, against the bond yields is the US 10-year yield. They've touched 4.5% this morning after the court announcement setting aside the Trump tariffs, at least the reciprocal tariffs. The 30-year bond yield is at 5%, maybe even crossing the 5%, again, because of the court cancelling the Trump's reciprocal tariffs. The rise in US yields has led to foreign funds selling nearly $5 billion of Indian bonds in April and May. So what we are trying to understand today is where are Indian bond yields headed? There's a positive in terms of liquidity and a negative in terms of FPI sales. And what does all this mean to banks? I have with me Rikin Shah, the Senior Vice President of IIFL Capital, to talk about this and about banks in particular. In a bit, we will be joined by Ashish Gupta to speak to us about bond markets. Rikin, first to you, because we have a big banking event on our hands. Before I come to bond yields, I wanted to ask you about your views on IndusInd Bank. With the latest salvo from the SEBI, you have not seen much of a change in the bank's prices, but how would you approach the bank?
Hi, morning, Lata. So, IndusInd Bank, we know that there have been multiple frauds that have kind of been communicated to the market in the last couple of months. While the interim order passed by the SEBI does, on the insider trading, does implicate the ex-MD and CEO, given that they are no longer part of the system, we have not seen the stock price getting impacted by that. But focusing on the fundamentals per se, I think the near-term fundamentals appear challenging for the stock. The growth is likely to be very subdued given the liquidity constraint that they will be grappling with. The incremental funds that they are raising, they are still at 50, 70 basis points higher than what the other peers are raising at. And hence the margins will remain under pressure. And the path to a normalized 1% ROA seems a bit long drawn from the current moment. But while this is the fundamental, I think the next couple of months, the focus is likely to be on the new CEO name, which would be first communicated to the RBI and then subsequently appointed and approved by the RBI. So that's where the near-term focus is likely to be. And post that, we expect the stock to start behaving more, looking at how the fundamentals trend.
But is the worst in the price with this negative news? Does it become a buy?
Given that the next 1 to 2 months, the news flow is likely to be a bit more positive vis-a-vis what we saw in the last 3-4 months, do not expect a significant negative stock price action from the current levels. However, as I mentioned, post the CEO appointment happens, we expect the stock to start reflecting the fundamental trends, which we expect to be a bit more challenging still for the next 12 months.
Okay, now let me come to the overall banking space itself. We are seeing this fall in government bond yields. Wouldn't this be a challenge to banks in terms of their ability to, charge higher rates for, say, NBFCs or for any corporate, even for MSMEs? So do you expect, therefore, bank margins to be under pressure because of the fall in yields and because of the expected rate cuts?
Sure, Lata. So, we wrote a report recently where we said that the banking sector as a whole is ripe for a near-term breather. The essential argument underpinning this call is that given the rate cuts that we are likely to see, 50 bips have already happened, and the house view is that at least another 50 basis point will happen in this calendar year. The margins are likely to be under meaningful pressure. So we are expecting the margins to go down by 20-25 basis points in the next 3 quarters and subsequently recoup or stabilize thereafter from 4Q or FY27 onwards. The typical margin sensitivity says that for a 25 basis point of rate cut, you see margin pressures of around 5-7 basis point. And while the liquidity has improved and the cost of deposits, both on the savings account, time deposit, as well as the bulk account is going down, the full transmission of that will take a few quarters to play out. And hence we expect significant margin pressure for the large private banks in the near term, followed by the PSU banks. And the least impacted should be the mid-sized private banks who have higher share of fixed rate loans and hence lesser margin pressure vis-a-vis the other 2 categories.
Okay, got that. I'm just coming to you in a minute in terms of more nuances for banks. But let me invite Ashish Gupta, the Chief Investment Officer of Axis Mutual Fund, into the conversation. Good morning, Ashish. Thank you again for your time.
Good morning.
Well, I began by, triumphantly announcing that bond yields at 6.17% are a 3.5-year low. And this is even without the Reserve Bank rate cut. If the rate cut were to come, and given the liquidity, it looks like the call market will go even below the 5.75% that it now is. So, what is your view on US 10-year, on India 10-year yields and on the call yields over, say, the next 6 months?
Oh, I think I agree with you that RBI has taken significant steps, both in terms of the rate cuts they have done, but more importantly, the liquidity infusion that they have provided. And at the lower end, therefore, the effective easing is also not just the rate cut, but the corridor that has opened up between repo and the STF rate of 50 basis points. So I think the flow for the short-term rates is falling much more, almost about 50 basis points higher than the cut in rates. On the long end, on the 10-year, I think given the drop that we have already had, I think market is built in to a significant extent the rate cuts that are coming. We believe a large part of the 10-year rally is actually behind us. And what we will probably see is more steepening of the curve rather than a parallel shift down in the curve. So we actually expect the shorter rates to fall more than at the longer end, because at the long end, a lot of rate cuts have actually already been priced in.
Okay. Okay. So by the end, I mean, just to get an idea of how far the rate cuts and the liquidity can go, the government hasn't spent the money, the nearly 3 trillion rupees. That also will come into the banking system. And looks like we have a much more bountiful monsoon than we expected, say, a couple of weeks ago. So are you looking at a 5-quarter repo? I mean, can repo rate cut go that far? And therefore, can call rate go even to 5%?
So our view is actually rate cuts to be about 25 to 50 basis points from here. I know there are forecasts in the market that are calling for even larger rate cuts of about 75 basis points or so. But we have to be mindful that in addition to domestic factors, we have to be cognizant of how rates are globally. And globally, unfortunately, rates have not been coming down. And actually, if you see in the last 9 months, most major markets, whether you look at US, Germany, Japan, even Brazil, bond yields are up between 50 to 150 basis points, while in India, as we talked about earlier, at the long end, bond yields have come down by about 70 basis points. Having said that, as of now, the higher global bond yields is not really curtailing the room for the RBI, because the dollar index has actually been weakening despite rising yields. And that allows RBI to conduct its monetary policy looking at domestic inflation.
1 minute, Ashish. 1 minute, Ashish. We have seen $5 billion move out of Indian bonds in April and May. At some point, this might accelerate even more. We got, 40 billion, 20 billion in the last several months, in the last 18 months or so. If there is a very big legging out, do you think that caps the Reserve Bank's both liquidity and interest rate elbow room?
So actually, foreign ownership of the Indian bond market is not very material, right? Actually, foreign ownership in India is much more in the equity markets, both in the FII and FDI route. The good news is that over the last month and a half, we have seen foreign portfolio flows turning positive. And if you see, therefore, RBI has, despite the $5 billion of bond outflow that you mentioned, we have actually seen forex reserves again started getting accumulated. And we are again moving close to nearly $700 billion of forex reserve. So I think given that construct, RBI still has the elbow room to pursue its independent monetary policy. But I think it will also make them a bit more conservative on how aggressively they want to take down rates.
Okay, okay. Well, very quickly then, what's your view on, which is what I was discussing with Rikin, do you expect bank margins to take a fairly severe hit, considering that, the actual rates are lower than what the 10-year is indicating?
So I think, as Rikin also mentioned, there's no doubt bank margins will be under pressure. I think having said that, the easing monetary policy was always expected to pull down bank margins. What has been a positive surprise over the last month is that banks have actually been willing to take a cut, particularly the private banks, in their savings deposit rate. And that actually protects the margins much more. Compared to really the pace at which you take down the term deposit rates, because the repricing is immediate. I think what, in terms of stocks, will be an equally important indicator is how does credit growth respond to these lower rates and better liquidity? Because if you see last 2 years, even though bank margins were very strong and among the highest that they have had, the stocks had not done anything till about 6 months ago because credit growth outlook was weakening. And I think it will be a positive for the banks if on back of this surplus liquidity, sharp cut in interest rate, you see a rebound in loan growth. And if, say, we can go back from 10-11% loan growth to 15-16% loan growth, I think investors should be quite happy with that.
Well, at least there are two problems for that. The last IIP number we got is an 8-month low. The number that we got yesterday. It doesn't look like credit growth is really picking up. Rikin, your thoughts? Actually, two quick questions because we have to wind up out of time. What do you expect in terms of credit growth? It's not just margins, but looks like even credit growth is not very good. And therefore, the second question separately, should we stop looking at margins and start looking only at ROA when we pick banks?
Sure. So in terms of the credit growth, the long 10, 20-year CAGR of banking system loan growth has typically been around 10-11%. But what we had seen in the last couple of years, the system loan growth had accelerated to almost 16%. Now, since then, it has been steadily decelerating. And the latest fortnightly print shows that the banking system loan growth is down to around 10% YOY right now. And we expect this banking system loan growth to slightly pick up from current 10% level. But the view is that it's unlikely that it will go back to 15-16%. The inherent reason for this softness in the credit growth in our view is twofold. First one is that the corporate Capex cycle, first, it's not significantly or cyclically turning up. And whatever the funding requirement of corporates is largely being catered to by the bond market, ECBs, and to some extent, some NBFCs. So the large banks have actually lost 25 percentage point of market share in the last decade. So the corporate demand and corporate loan growth is not coming. On the other hand, we have seen that some of the larger retail loan segments like housing loan, etc., we have done a study which shows that whenever the rates are cut, the loan growth in lower yielding segments like home loan also decelerate. So these are the two drags. On the other hand, we expect some pickup in the unsecured loan growth following the significant slowdown in last 1.5 years. And some MSME growth to be there. So from 10%, it can go up to 11-12%, but unlikely to go back to 15-16%. And margin, as we discussed earlier, is more of a cyclical pressure. We expect all of the margins that are being lost in this year to be recouped back in FY27. But ROA in FY26 is likely to go down by anywhere between 10 to 20 basis points. So investors will have to see through this cyclical pain and focus more on FY27 to be invested in the banks.
Okay. Actually, completely out of time. A one-line answer from you, Ashish. Would you also be as bearish on banks as Rikin is? ROA under pressure this year?
I agree with Rikin that ROA will be under pressure this year. I think ROAs will certainly come off from the highs of last year. But as he also mentioned, if we kind of take a more medium-term 2-3 year outlook, I think banks are still kind of quite comfortable.
Okay. Well, the audio is not obliging. Thank you very much, Ashish and Rikin. Get your point that there is possibly a cyclical low in terms of investor attraction for banks because of the lower ROAs, but medium term, it should be fine. We wrap up on Bazar on that note. Chartbusters coming.
Market opens mildly higher on expiry day but gives up gains. Global cues remain positive as US federal court strikes down Trump's reciprocal tariffs. The Nifty trades higher, led by metals and the IT sector. The broader markets in line with key indices.
Deepak Nitride rallies after a better than expected fourth quarter. The margins expand 150 basis points while the Phenolics business drives revenue growth.
Max Financial Services revenues decline almost 2%, or rather the company stock declines 2% after Axis Max Life Insurance MD and CEO Prashant Tripathi announces early retirement effective from the 30th of September.
Cummins India trades with solid gains on the back of its fourth quarter numbers. The revenue grows by close to 6% on a year-on-year basis. The company has also met its double-digit growth guidance for FY25. The con call is underway and the commentary is fairly optimistic.
Mishra Dhatu Nigam rises over 4% on steady fourth quarter numbers. The company's net profit jumps 21% year on year. Margins too expand 300 basis points.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. It's expiry day, and as we speak, though, Mangalam, the market's still trading with some green, though we've come off the high point of the day.
Yes, Nigel, it opened higher. The street expected there would be some supply because that's the zone from where we had seen some retreat, markets retreating earlier as well. That's exactly what took place. The question is whether we see a bounce from here or not. And if we do, then there could be a pop towards the last hour of trade, largely because of the shots that are there in the system for the market and the fact that there is May series settlement that takes place today. It's the Nifty Bank that has to move higher for the overall markets to move up as well. But we're talking about all things global economics. Arend Kapiten, who is the chief economist at UBS Investment Bank, joins us from the sidelines of the UBS Asian Investment Conference. Thanks a lot for joining in, Arend. It was a pleasure speaking with you. Speaking about the global economic outlook, and I look at your forecasts as well, I just wanted to understand what proportion of your growth estimates are contingent upon US-China or the global tariff uncertainty, because there's so much back and forth out here. What weightage have you accorded to these in your model? And how much of this is agnostic of what transpires in global trade?
Yeah, the short answer is all of it's conditional on what happens on the tariffs, to be honest. So now, related to tariffs, there's other things like, uncertainty. You could argue that not all of the uncertainty is related to the tariffs, but it's really all about the tariffs. So had we not put the tariffs into our forecasts, we wouldn't be forecasting global growth at 2.7. We'd probably be much closer to the levels that we had last year, which were a little bit above 3.
No, so the reason why I ask you this is because, it is so back and forth. There is a certain number today, there is a certain number tomorrow, and then day after tomorrow, chances are that there is no number. How does one then account for all of these?
Yeah, no, exactly. So we've adopted the approach that we will mark to market whatever tariffs are in place. We're filming this on the 29th, and we just had this court ruling that basically has vacated all the tariffs.
Exactly.
It doesn't vacate, of course, some of the sectoral investigations. So the auto and steel tariffs, those are still there, but we'll now have to see what happens. There's 10 days to appeal the court ruling, so we'll have to see whether these tariffs actually get removed or not. My guess is that even if they do get removed, then the administration will find another legal authority to try to put them back in place. But where we stand today is that the U.S. has imposed roughly 1.5% of GDP worth of tariffs. Back at the peak before the China de-escalation, it was about 2.5% of GDP. But as you say, it keeps moving around, right? This threat against the EU, that's another 0.5% of GDP. So we just keep changing our numbers. And I think today's good news, right? So there's the hope now that maybe these numbers come down. But I think we'll wait to see the appeals ruling before we change our numbers.
We've heard of economists. We've heard of hedge fund traders mark to market. We've heard of long-term investors not mark to market. But here we have economists marking to market as well. That's the world that we're in, Nigel.
Well, that's right. Hi, Arend. Good to see you on the show, and thanks a lot for joining in. This is Nigel on this side. The world was focusing on MAGA, that's Make America Great Again, and suddenly this morning we're waking up to TACO, that is Trump again. chickened out. He says no, but let's hope there's some rationality that does play out. And in fact, it'll be a better place, on the global front as well. But Arvind, from an India market perspective, we have plenty going for us, right? We have crude oil prices that are lower. We have a rupee that's fairly stable, good leadership as well. The problem for us is the globe, because the globe is in a tizzy and plenty of uncertainty, with central banks as well being fairly uncertain of being fairly flimsical. What are you assuming with regard to the India growth story? And do you think there are enough tailwinds for us to continue to growing?
So India is in a relatively better place just because it's more closed than most economies, right? So I think in Asia, the countries that are sort of relatively immune to all this tariff uncertainty and the drag from global trade are India, Indonesia, really the large sort of more closed economies. But there's also a silver lining, I think, for India. Like if these tariffs were to actually be implemented, and particularly if the tariffs on China are very high, then India is potentially one of the big beneficiaries. Now, that's more, I think, medium term as the Chinese trade surplus gets redistributed across the region. In the near term, I think what's playing out is just sort of a very disinflationary dynamic. So everyone's growth is a little bit lower, right? So we're feeling the pain of the reduction in trade, the lower growth in China, Europe, the US, right? So that hurts everyone. But there's also a disinflationary impulse because outside of the US, these tariffs really are not inflationary if you don't respond to them. If you don't raise tariffs, it's not inflationary. And so that's opening the door for significantly more rate cuts. And so one of the places where we think there is basically scope to cut more is India.
Right. In your report, you've written that as long as orders don't turn around, it is unlikely that we see a turn in global trade and production, which have been depressed for the last 2 years. And at the same time, you've written that there is no stimulus coming in from any government in the world apart from China, which is about 2% of their GDP. What, according to you, will drive global growth from here on? And what should really happen? Because even the labor force participation is now back normalized.
Yeah, so I mean that's on the fiscal stimulus. So I do think we get globally some monetary stimulus, but you're right. So fiscally, I think there's not a whole lot that is moving, and so so we do. We think in the next sort of 4 quarters we do have a slowdown. It's very difficult to offset that if no one is actually providing any kind of fiscal stimulus, but it's very much a slowdown concentrated in the net export sector. So if you look at the domestic demand dynamics, they are generally a lot healthier than I think the export dynamics, and so that part of the economy is generally a little bit more shielded. But it'll take until the middle of next year before we sort of start to climb out of this uncertainty and this tariff shock. So we call that a deadweight loss. It's basically a level shift lower in the global economy, and then eventually we'll go back to the old growth trajectory.
All right, Arvind, what about this US deficit and the debt? That's clearly worrying, right? What kind of numbers are you assuming? And could the administration, the United States, find some kind of a way out? Because you have yields that are spiking, which is clearly a sign of caution.
Yeah, so we're on a clearly unsustainable trajectory. We even with the bill that's now come out of the House, we're looking at a deficit that's still going to be in excess of 6% of GDP. That's including the tariff revenue. If it's excluding tariffs, then it's about 6.5. That means the debt's going up by 3 percentage points of GDP per year. That is faster than any other country that we have under our coverage. But it still means that it's going to take another 10 years before the US overtakes Italy, which is trading at a lower yield, right? So yes, we're on an unsustainable trajectory. It's not yet clear that automatically then should translate into a significant repricing of the debt. Now, the fact that that's happening is partly because it's getting mixed in with, I think, all the other reasons people want to be reducing their US positions, which is the policy uncertainty, some of the erratic decisions that are being made. I think that global investors came into the year with too much US exposure. And so that unwind is sort of getting mixed in, I think, a little bit with the long-term sort of debt sustainability concerns. The one thing I'd say is because there's sort of a common narrative that the backup in long-end yields that we've seen in the US is related to this rotation of foreign investors away from the US in the last couple of weeks. That is actually not the case. And the US Treasury puts out numbers every few weeks about what is the foreign demand for their debt. And the interesting thing is that it's not the foreign demand that's fallen off, it's to some extent the domestic demand that's fallen off.
That's an interesting point that you make out there. So foreign demand for US debt is still fairly steady. Then, the simple question and perhaps a not so simple answer to this would be, what happens? What has to happen for, all of this to turn around and for us to come up? Because from where we see right now, there is a fair amount of fog on the windscreen.
Yeah, so I think that's one of the things we struggle with, right? So even if you remove all the tariffs, the question is, have you removed all the uncertainties? So if you look at, for instance, US and Eurozone uncertainty indices, then they're about 4 standard deviations above a long run average. Now that is so far above normal that, and if you run, we call this impulse response functions. If you basically try to estimate how much that is worth in terms of the growth drag, that is more than the entire forecast revision that all the banks have made for the global economy. So it's very, very significant. So if you're a corporate and these tariffs are now removed, the question is then, how certain are you that the US administration is not going to try to reimpose those tariffs? Is it really the case that you can now place 100% of the order that you had been delaying? And so I think there's some lasting damage here based on what's happened the last sort of 3-4 months, even if the tariffs now get taken down by this court ruling.
All right, Arvind, we have been hearing Mr. Trump talk about drill, baby, drill. I'm wondering whether he's going to start pushing for print, baby, print. What are you factoring in with regard to the Fed action from here on? Could they go ahead and cut rate cuts? Because even the last year, we were factoring in far number of rate cuts, but by the end of the year, they were much lower. And for this year now, there is some question mark on whether or not you're even going to get a couple of rate cuts. What are you factoring in?
Yeah, so I mean, unfortunately, he doesn't control the Feds, right? So,
yeah, that's good.
And the court ruling we had, I think, last week was very significant, right? So the Fed's independence seemed to be explicitly sort of mentioned as being separate from some of these other regulatory agencies. But so we think, our view is that the Fed is going to, if these tariffs do go ahead and you get unemployment starting to increase, then even if there's inflation, their reaction function will be to try to ease into that. And the reason is that the level of the Fed funds rates is still in restrictive territory. So they will basically want to get to something that is much closer to neutral. So we have about 100 basis points in cuts penned in for the second half of the year. But that is really conditional on seeing the labor market start to weaken. We haven't seen that yet. And so if we do not see labor markets weakening and we do see some of the inflation pressure come through, then I think they're stuck and they probably stay where they are. But I think their inherent bias here is to want to get to slightly less restrictive territory if you have tariffs that are basically doing all the slowing of the economy for you.
Right. Final question before we let you go around. I think the crux of your report, one of the most interesting things was the vacancy to unemployment ratio. What does that tell you about where we're likely to go from here?
So vacancy to unemployment ratios are coming down all over the world, and they've actually been coming down pretty rapidly in the US, but they're more or less back at 2019 levels. So, and those were still very, very tight labor markets. So the starting point is actually quite healthy, I think, going into this sort of potential growth shock or this tariff shock. So labor markets are tight. I think that's holding up demand. But from these levels, I think we are going to see that vacancy to unemployment continue to go down. If you remove demand and everyone is growing below potential growth, then we're going to start to see unemployment creep up. And that's basically in the forecast for the next sort of 6 months to 12 months.
And if you had to, deploy $100 in a portfolio for the next 6 to 12 months, how would you distribute that across asset classes and geographies?
So right now I would be, if it were me personally, I would be, you can go back to what happened in 2018 and 19. In 2018, the best performing asset was actually just to stay in the sideline and be in cash or in gold and stay away from the risk assets. And then in 2019, you had to do the reverse, right? And so there's basically an issue here of when is all the bad news priced? And until that happens and you have clarity about where the tariffs settle, you want to be incredibly defensive. And for us, that means being effectively trying to be long fixed income, maybe not in the US, but certainly as we have about a basket of emerging markets, some of the European countries, you try to sort of stay a little bit in the assets that sort of benefit from lower growth. So that's fixed income, golds. Stay away from equity effects. But then as we sort of price the news and we start to get some easing, then you rotate back into some of the risk assets, which will be equity. Credit, I think, is too early, hasn't really repriced yet. And then geographically, I think right now you largely want to stay away a little bit from the US. So we're sort of neutral US and we're basically overweight some of the European countries and some very select emerging markets. But in general, I think it's a bit too early to be long equity here. even with today's headlines.
Incredible. Thank you so much, Sharon, for joining in. Wish you a good conference and maybe a lot of insights emerge from that as well, and perhaps some clarity over the next couple of weeks as well. Take a short break, come back. We focus on the micros, the stock-specific action with Sachidanand Uttekar of Trade Bulls. Virtually unchanged for the market right now, so good time to get in a quick view on where we're likely to go from here. Sachidanand Uttekar of Trade Bulls joins in now. Sachi, the Nifty has petered out all the gains that we saw at the open. Right now, absolutely flat. What would your trade on the indices and individual stocks be quickly?
Good morning, Mangalam. Mangalam, clearly, I think the view on the market remains sideways. Even yesterday, for the last two trading sessions, we have been maintaining this particular view that it is ideal to, build some long positions on a decline, but the support is placed somewhere close to around 24,630, where its 5-day exponential moving average is placed. And on the higher side, we need a decisive close above that 24,830 to unlock that move towards 25,000. So overall, the structure is bullish, but we are locked into a range-bound, mode. And probably, one should wait for the decline to deploy some long positions. The best position, the best level would be close to that 5-day exponential moving average, which is placed at 24,630, or on a breakout about 24,830 itself. So when we look at Nifty Bank, it's a very similar, data set. 55,000 remains as a very strong support, but on the higher side, we need a closing above 55,540. After that, we may see some directional up move. So as of now, for the day, I think it's better to wait and wait for the decline to extend, and probably 24,630 would be an ideal level wherein some contra longs on the Nifty can be deployed.
Okay, all right. Hi, Sachi. What about individual stocks? What are you looking at?
Nigel, I'm liking MGL. The stock has maintained a strong range throughout this particular series. We have seen good support at around 1,300, 1,320 levels. It has again displayed a good rebound. We're expecting that this particular rally may continue towards 1440, and eventually we may see an extended move towards 1475 in the coming series. And that's why we are recommending building long positions in MGL, keeping a stop loss at 1370. And intraday, a positional target would be placed at around 1440. The second stock on our radar is Trent Limited. Again, here, if you look at the overall structure, the stock is challenging its 200-day exponential moving average. What we expect is that there could be a breakout soon in this particular counter, looking at the way the trend state indicators are placed. So we are expecting a rally towards 5830, and that's why we are recommending building long positions with a stop loss at 5560.
All right, Sachi, thanks a lot for that. Let's get you some ideas for profit coming in from our colleagues at Money Control Pro now. We have Varsha Bang, who's joining in with a stock that she's been tracking. Varsha.
Bazar Style, an emerging player in India's value fashion retail segment, operates under the Style Bazar brand and has expanded rapidly since its inception 2013. With 2014 stores across 170 cities, the company focuses on Tier 2, 3 and 4 markets, especially in East India, benefiting from a cluster-based expansion model that enhances operational efficiency and market penetration. A key growth driver is its private label offerings such as Square Up and Avia, which contributed 44% of revenue, expected to increase 60% by FY27. enhancing margins and profitability. In FY25, Bazar Style recorded a strong 12.8% same-store sales growth, driven by increasing footfalls and larger basket size. The company's family-centric approach and localized merchandising have fostered strong customer loyalty with 73% repeat customer rate. Looking ahead, Bazar Style is strategically positioned to tap into the rapid growth of Indians' value fashion market, particularly in the under-penetrated regions. With plans to open 40-50 new stores and expected revenue growth of 20 to 25% annually over FY26-27, it represents an attractive investment opportunity.
Thanks a lot for that, Varsha. Well, time to slip into a short break. As we do that, we are excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on India businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset and the Global Lens at 8:30 p.m. Welcome back. Markets as flat as can be, but let's tell you about a few stocks that are moving around in today's trading session. Avanti Feeds, that's surging after reporting a solid set of numbers. Ria joins us to decode that set. Ria?
Well, good morning. Let's take a look at how the numbers have panned out for Avanti Feeds in this quarter. For quarter 4, they've seen good growth in the overall revenue, up around 8% over the previous year. Very strong improvement on the profitability front as well. For quarter 4, EBITDA and net profit have jumped up by around 26% and 39% respectively. Even on a full year basis, EBITDA and net profit are up around 38% and 51% respectively on a year-on-year basis. Quarter 4 EBITDA margins have also seen a jump of around 267 basis points, with the full year margins going up by around 200 basis points compared to the previous year. Coming to the segments of the company, for the shrimp feed revenues for FY25, remember this constitutes around 78% of the total revenues. For this segment, the revenues have increased marginally, just about 3% over the previous year, but the EBIT margins have seen a very sharp jump up of around 500 basis points compared to the previous year. For the processed shrimp segment, though, this contributes around 21% of the total revenue. For this segment, the revenues have gone up by around 9%, but on the margin front, we've seen a very sharp decline of around 500 basis points over the previous year. And remember, the margins have been under pressure over the last year because of increased freight costs, higher raw material costs as well, and even the higher countervailing duties imposed by the US have caused some margin pressure for this segment. So this is one segment where the company has underperformed, but largely the results look very strong for Avanti Feeds, which is why the stock is trading higher today.
Take that point, Ria. Thanks a lot for that. Meanwhile, just watch out for Cummins. That stock is now surging up around 6%. The conference call is currently underway. We are, getting some positive commentary coming in. They said that they will continue their Capex in the same range as FY25. But more importantly, what they're expecting to see is maintain their gross margins for FY26 and look at some growth as well for the next year. What we'll do is we'll at some point get in Vamakshi to give us a roundup of all the key takeaways from the conference call. Currently, the street likes what the management is saying. The other one is Deepak Nitrite on the back of good numbers. Remember, their conference call starts at around 12 today, so we'll have our team listening into that as well. And finally, we have Strides Pharma, which too has surged to the high point of trade. So even as the frontline indices are consolidating, a lot of individual stocks clocking in big gains. Take a short break, come back. On the other side, we have the team of Trading Hour taking the next hour of trade forward.
Hello, good morning. You've tuned into Trading Hour, coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala, and with me is Hormaz Patak as well. Hormaz, very good morning to you. We were expecting a better morning so far even now, but let's not forget it's Nifty expiry as well, monthly expiry. So volatility is the name of the game, and today taco, that's the name of the game as well. I hope we do get some tacos to eat as well is what I'm watching out for.
I just asked the PCR for some tacos if we can.
By the end of the show, I hope we're getting that then. But today, Nifty flip-flopping between the red and the green, 24,750 as of now.
Blame it on the expiry, right? And that's what has been happening. Even the good news is not being appreciated here by the street. We did open higher though, but we have come off significantly from the highs of the day, almost giving up all the gains that we have had. And this despite the Dow futures trading with gains of 600 points as we speak. So the Wall Street is cheering the announcements that were made by the US trade court overnight, but that is not being reflected in our own markets. Of course, banks are the principal culprits here, 150 points down on the Nifty Bank. So that is also weighing in on the sentiments. And as you can see some flashes on your screen, the RBI has released its annual report for FY25. We'll get you more details on that as well over the course of the show. But for now, the index has given up the gains. The broader markets too have given up their gains from the morning. So it's a fairly choppy choppy start to the trading session. And of course, you can't not ignore the earnings reactions that are coming in today. Welspun Corp among the top gainers on the Nifty 500, 8.5% higher on that stock after a strong result performance coming in for the fourth quarter. And MMTC too, 12% higher, building on to gains from yesterday, mind you. So 12% higher on MMTC. That's doing fairly well for itself as well. So good going for some of these earnings names. But the stock of the morning that we've been speaking about, and it was a big development that came in last evening, and that is IndusInd Bank. And that is after the Securities and Exchange Board of India, or the market regulator SEBI, has passed an interim order in the high-profile insider trading case involving key managerial personnel of the lender, including the bank's former CEO and other senior executives. Now, the regulator has barred all of these 5 individuals from buying or selling securities and has also frozen their bank accounts. Ritu is here to give us more details on this. Ritu.
Well, Hormaz, as you said, it is a damning order, against the 5 senior executives, and that includes the former CEO Sumant Katpalia and former Deputy CEO Arun Khurana in this insider trading case. The regulators found essentially that these individuals sold shares of the bank while they were in possession of unpublished price-sensitive information and thereby avoided losses of nearly 20 crore rupees. In this interim order, SEBI has frozen their bank and demat accounts to the extent of those gains. It has barred them from trading in securities until further notice and asked them to submit a full inventory of all of their assets. Collectively, the order shows that these individuals avoided losses of 19.78 crore rupees, out of which 14.4 crores was by Arun Khurana alone and about 5.2 crores by Sumant Katpalia. The others that have been named in this order for alleged insider trading are Sushant Saurabh, who is the head of Treasury Operations, Rohan Jatanna, the Senior Vice President of Global Markets, and picture this, Anil Rao, the Chief Administrative Officer, who is also part of the 2-member executive committee approved by the RBI, currently running the bank in the absence of a new CEO. Now, SEBI's investigation shows that these people were aware of the discrepancies a good 15 months before they made this disclosure. And not only their internal team, even the external auditor, KPMG, had flagged this impact long before. Sumant Katpalia, for instance, he alone sold about 1.25 lakh shares of IndusInd, while Arun Khurana offloaded 3.5 lakh shares without making a single new share purchase in the period between December of 2023, that is when the management first found out about the discrepancies, and March of 2025 when the information was made public. Now, beyond these 5 executives, SEBI said it is still investigating other suspects that it did not name. So, questions are already, of course, swirling around the board's oversight, the auditor's role, and importantly, Anil Rao being part of the 2-member executive committee, whether we will see that committee getting revamped and the repercussions that he would have to face. Now, with the CEO and the deputy CEO already out of the picture, the story is still far from over and more heads may roll if the insider trading charges stick.
Okay, Ritu, thank you so much for that. And on that note, we had Amit Tandon earlier on the day as well. And he was talking about these issues coming in and discussing more on, the IndusInd prospect going forward as well, especially after this order that has come in. Listen into that conversation.
If you read what SEBI said that, look, we've appointed KPMG on the basis of a board note. So again, you have to ask whether the board were shielding the management or whether they were taken by surprise. I think that is really not clear at this stage, and we'll need to hear a little bit more. So if there is action against the board, you can expect that there is going to be some more tumultuous times going ahead. It's clear that the board has not lived up to what RBI's expectations were and what the investors' expectations were. So I think we are going to be in for some amount of volatility or internal churn as far as the bank is concerned. Likely to be a shakeout as far as the board is concerned. There is, of course, the existing board structure, existing management structure or the leadership structure will change. So the question is, how quickly will they be able to bring in a new CEO? And that in itself will mean there's going to be a round of internal cleaning up. Every bank is going to become much, much more internal focused rather than looking at opportunities out in the market. So I think there's going to be some degree of slowdown as far as these bank operations are concerned.
So important conversation there on IndusInd Bank. The stock though has not seen much of a reaction to that, and it's almost a hope trade now that the clean out process has begun, things will start to normalize for IndusInd Bank, and it's showing up on the screen as well, 1.25% higher for IndusInd Bank. The stock is now up 35% from its 52-week low of 566 that the stock had fallen to, or 606, I beg your pardon, that the stock had fallen to after the first instance of the derivative accounting issue had come out. So IndusInd Bank there for you. By the way, the flashes of the RBI annual report on your screen. The global economic outlook for 2025 and 26 remains clouded by multiple challenges. The RBI annual report also talks of the fact that there are elevated debt, public debt across several economies, and that has been a subject of the conversation as well, particularly in the US. The pace of disinflation is losing momentum. Challenges also include trade tensions, financial market volatility, climate shocks. So a lot of issues being addressed in the RBI annual report. We'll talk more about this as the show goes by as well. But from the broader markets, the earnings reactions continue. As we just mentioned earlier, Insecticides India and Bharat Rasayan are two of them, and both of them are seeing reactions at the opposite ends of the spectrum. Rhea has the fine print for both of these shares. Rhea.
We've got two earnings candidates in focus today, both Insecticides India and Bharat Rasayan. First, focusing on Insecticides India, the revenue growth has come in at around 2% for FY25, below the guided range of 3 to 4%, with a volume growth at around 10% and a price decline of 8% in this year. EBITDA margins, however, have remained strong at around 11%, in line with the company's guidance of double-digit margins. Gross margins have also seen a jump up of around 650 basis points in this year, which was led by a better product mix, improved pricing strategy, and as well as the new launches that were taken by the company this year. Overall, the profit growth has been led by an increased focus on the value-added premium products, which have seen a growth of around 13% in this year. Going forward, the company has said that their growth outlook remains intact. They're expecting an expansion in the premium products, stable gross profit margins, as well as a further improvement in the EBITDA margins as well. For the newly launched herbicide called Altair, they are expecting to generate around 10 to 15 crores of revenue initially, with the revenue going up to around 40 to 50 crores in the subsequent year as well. So overall, healthy set for Insecticides India, and the street is reacting positively to that. On the flip side, Bharat Rasayan has posted a very weak set of numbers in this quarter. The full year performance though has remained largely healthy, but quarter 4 has disappointed by a lot. Revenue growth has remained flat in this quarter. Profitability has been sharply lower. EBITDA and net profit have seen declines of around 42% and 62% respectively, both on a year-on-year basis. And margins, EBITDA margins, have also seen a very steep cut of around 925 basis points. So the street has been reacting negatively to that. Stock down around 8% on the back of this.
Thank you so much for that, Priya. But a quick look at what these other stocks are doing in today's trading session. We have Zentek, that's coming back in action as well. As of now, is up 5% in the trading session. Obviously, this is one of those companies that makes drones, and during the run-up that we saw in the defense stock, Zentek was one of them that saw a run-up. ITI Limited, they reported their numbers, and yesterday we had already seen a run-up. Today also that's continued, so surely good set of numbers from ITI is keeping the stock a buzz. Let's also look at, Castrol India, that's buzzing in trade today, 5% gain on that front. Vari Energies are some of the gainers that are coming in. And other than that, overall, from the broader end of the market, we're seeing a lot more performance coming in because of the earnings reaction that we're seeing for some of the companies, and Ria mentioned a few of them as well. But let's talk about Cummins India, because that's also buzzing away in trade, almost trading at the day's highest point, and this is after its Q4 numbers, but also commentary came in from their con call that was just there a short while ago. Vamakshi is joining in with us to give us the latest on this front. Vamakshi, what were the key highlights coming in from the earnings as well as the con call?
Well, absolutely. When it was a good set of numbers that came through from the company. Of course, revenue came in much lower as compared to what the street was expecting, largely led by the miss on the domestic front, but the exports business for the company did quite well. They saw an uptick of almost 39% on a year-on-year basis. Largely, when you look at the operational numbers, they came in much better than anticipated. Keep in mind that in the same quarter last year, there was a one-time gain. Therefore, the margins looked higher last year, and we were expecting a significant contraction this time around in the margins, but that has not really panned out. The contraction in margins is not as worse as one would have expected. The net profit, though, has seen a downtick of almost 7%, and largely this is the number for the net profit has come in much better than what the street was anticipating. The con call actually just concluded just a couple of minutes ago, and the management said that they are anticipating double-digit revenue growth growth to continue in FY26 as well. They endeavor to sustain as well as slightly improve the margins. This is the gross margins that I'm talking about in FY26. However, they are cautiously optimistic on their demand outlook. Keep in mind that they have said that the pricing could take 1 to 2 quarters to settle completely, and the competitive intensity out here has picked up, but largely they have been able to hold on to their prices, which bodes well from a margin perspective. Capex will be in the same range as seen in FY25. So largely those were some of the important takeaways that have come through from the con call. Resultantly, the stock is trading higher.
Well, the street likes what the management has said in the earnings call. The stock had surged to the highest point of the day at Cummins India, almost 6% higher now on the stock. Vamakshi, thanks a lot for that. By the way, the index has cooled off further from the highs of the day. But we take a short break. On the other side, we get you all things commodities with Manisha Gupta. Welcome back. Well, the index has cooled off significantly from the highs of the day, and now it's into the red. Now 20 points down on the Sensex at 24,730 now is where we stand, and that is in comparison to the highs of the day of 24,889. So almost 160 point downtick from the highs of the day is what the Nifty has seen. The monthly expiry for the index today, and that seems to be weighing in on the sentiments on the Wall Street as of now, because the Dow futures continue to remain where they are, 600 points higher for the Dow futures. The US dollar has staged a rebound. It's above the mark of 100. Crude oil prices too have seen a rebound. Brent is now heading towards $66 a barrel. We'll talk more about that as the day goes by. But on to earnings conversations. Then GIC-RE reported its fourth quarter numbers, and we are now being joined by Mr. Ramaswamy Narayanan, who is the chairman and managing director at the company. Mr. Narayanan, good morning. Thank you so much for joining in. Your gross premiums for the quarter grew by 10%, and your net earned premiums were also up 9%. Now, what are you penciling in for FY26 when it comes to both these aspects, both the gross premium and the net earned premium as well?
So typically we would be looking for about 10% growth going forward, and simply because we are planning to grow both our domestic and international business. The international business for last year, actually we had degrown, and honestly in the last maybe 2-3 years we have been kind of consolidating our book. Our growth journey started last year. Last year we grew by about 10.72% year on year. So last year in October, we got our credit rating upgraded. We, for writing international business, you need to have a good international credit rating. So currently AM Best has rated us A- excellent, which allows us to really look at and get to see good quality international business. So 1st Jan, when the international business normally renews, we got to see a lot of good business from the market, and we wrote about 28% more. And the revenue for that will come in 25-26. Similarly, in 1st April 25, when the Indian market renewed, we grew there by about 8%. So overall, we expect to grow by about 10% in this year.
Right, good morning. This is Vinny joining in the conversation as well. What I want to also understand is in terms of your underwriting loss. There's a loss this time of around 224 crore rupees in Q4 versus a profit of 490 crores. What has led to that? One, is that a one-off that is coming in, or maybe possible that this could see an impact in Q1, FY26, Q2 as well?
Vinny, hi, good morning. Again, this is something that I've been telling analysts, the last couple of years, that unlike, I understand that, the financial markets and analysts tend to look at quarter-on-quarter figures. But then for our industry, whether it is insurance or reinsurance, honestly, I don't think it makes sense. Simply because, you could get a catastrophe in one quarter, which was not there the previous year. It would have happened in a different quarter. So suddenly some quarters look good, some do not look so good. So coming back to our performance, if I were to look at it from an annual perspective, we've actually done very well. Last year around the same time in April, when people had asked me what we were proposing to do, I said, after 3 years of consolidation, we are growing now. So we would grow 10%. But actually, we have done better. We've grown by about 10.72% for 24-25. We also said that we will be striving to remove or shave off 2% from our combined ratio every year. Now, this year, we've actually done better. We have shaved off 3%. From 111, we have come down to 108. And our loss ratios have come down by 4%. Our profit before tax is at 8,650 crores, which is, a record for this company. In its 53 years, it has never touched this kind of figures. So we are very sanguine about what we are doing, the underwriting that we are doing, and how we are, essentially trying to ensure that the business that we are writing are profitable. Coming back to your question about Q4, what happened there? Simple. We write international business. So obviously, we also write US. It's a big market. Now, if you see in the first week of Jan, the Los Angeles suffered the wildfire attacks, and obviously there were losses there. And we have got some losses, and the initial figures that we have got from our business partners, it's around $38 million. Currently, we haven't paid anything. This is all outstanding. But our actuaries also felt that, going forward, we should ensure that there are no shocks to the balance sheet from these losses. So we've actually provided for about $150 million for these losses. So that is one thing which has kind of caused a dip in the Q4. Second is again on provisioning of life business. Life, as you can make out, is a long-tailed business, goes over 20, 25, 30 years. And some of the business that we wrote about 10 years back, the loss ratios went up in the last couple of years. It could be due to COVID or something else. Based on that, we felt that the provisioning must improve, so we have improved it. So honestly, I think the loss ratios have been well under control. It's just that we have been more conservative and we have provided more. So honestly, I would say Q4 is a one-off. We will not see those losses in Q1 of this year.
Now, Mr. Narayanan, since you mentioned the combined ratio, you brought it down from 111 to 108. Do you go below 105 in FY26?
Well, we will definitely try to do that. But last year, I had made a similar advisory, I would say, when somebody asked what is the glide path, how or when would you reach 100%? I had said it's not a one-year thing. We will need to do it over a period of years. And we had typically said 2% each year for the first 3 years and then about 1% for the rest of the next 4 years. I still stick with that. I would say this year also we will be looking to cut down by 2% for the next couple of years and then come closer to 100%.
How big is the US market for you, Mr. Narayanan? You just mentioned that there were losses that you saw in the fourth quarter. How big is your international business? If you could give us a mix as well. And within that, the US exposure as well.
So currently, if you see my international domestic mix is 25-75. 25 is international, 75 is domestic. That's simply because, in the last 2-3 years when my credit rating was not up there, we've not been able to write international book as much as we want to. Like typically any reinsurer, we would want to spread our bets, not have too much in one country. So obviously our desire is to have international to domestic at 50-50 at some point of time. It will take some time simply because, some of the international markets, economies are not doing well. So I don't expect to grow too much there. Whereas the Indian economy is actually doing so well that, you see a lot of opportunities to grow. Having said that, there are a few markets that we will try. Obviously, US and Japan are two markets that we are looking to. Japan simply because they value long-term relationships. They're also very security conscious. So we used to write a lot of business there. We paid a lot of their losses. And when due to the credit rating going down, when we had to step back, we knew that the relationship is still there. We've already started talking to them. So that is a market we will write. It will still not reach the levels that we were before the downgrade, but we will slowly increase that. Similarly, US is one market. It's a big market. So obviously, we will look to write business there. It's a difficult market to write simply because compliances are difficult. What we do is we write business in head office from the US. We also use our Lloyd syndicate to write business there. Because when I write from the head office, I need to provide collaterals, which becomes difficult for us.
Okay, sir, a quick one. I just wanted to know in terms of your fire as well as the motor side of your insurance, which accounts for almost 54% of the gross written premium. The performance there has improved. What is the expectation for FY26? And in terms of pricing, some analysts are highlighting better pricing. Is that something we're watching out for here?
Yes, definitely. So again, property, of course, we write both in the international market and here. And we are seeing pricing improving in both places. In India, honestly, we have been pushing the insurance companies to ensure that the direct market pricing that they do is definitely better, because otherwise this market becomes unviable. So that is something that we have been doing for the market, trying to tell companies how they should price, how they should manage their exposures, overall how they should ensure that the property portfolio remains profitable. So that we will continue to do, and we are very confident about the property portfolio. On the motor side, we write it only majorly in India. Very rarely do we write motor internationally because compliances can be difficult. It's a long tail class. So obviously we need to end up putting more capital there, which we don't want to do. So to come back to your point, yes, we expect property and motor to do better. It will of course depend on what catastrophes India face, because typically any floods happen, the first casualty is motor.
All right, Mr. Narayanan, thank you so much for sparing time and joining us on this insightful conversation. Wish you good luck for the rest of the year as well, the management of GIC-RE. Shifting focus now to the commodity space, Manisha Gupta joining in. And since it is a sweet day for most of the global equity markets, we are focusing on sugar, Manisha.
Oh, well, yes, that is because the sugar prices also have continued to decline. When you look at the global markets, the New York sugar prices are trading at a 4-year lows, and the London sugar prices have declined to 4.5-month lows as well. This is after the US Department of Agriculture says that this time around for 2025-26, we are looking at a global sugar production at a record number of around 189 million tons. They also anticipate that the global surplus could be as high as 41 million tons as well. For the Indian markets as well, while the current season has seen sugar production less than 30 million tons, but the next season, 25-26, the sowing has been great, the monsoon expected above normal as well, and the anticipation is that we could be looking at 34 million tons of sugar production therein. Also, the Indian sugar demand has seen a bit of a decline from beverages, from cold drinks, from ice creams as well, because it's not so much hot there and the monsoons have been early as well. So most of the FMCG reports do suggest that you could be looking at a slight decline in demand from there as well. These are the numbers that we've seen in sense of allocation of sugar from mills to sell into the open market. And as you can see, that allocation also has been slightly on the lower side for the month of June in 2025, less than last year and less than last month as well. And that really tells you that the demand is slightly on the weaker side there. The street also anticipates that going forward from here, you could be looking at higher sugar supplies and lesser production, or rather lesser demand going forward. That could continue to be onto the Indian prices as well.
Okay, that's a word coming in on sugar. Thank you so much for that, Manisha. But on that note, we're going to slip into a very short break. And as we go to the break, we're excited to unveil our brand new global business news channel. The all-new CNBC TV18 Prime brings you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. Welcome back to Trading Hour on CNBC TV18. Nifty as of now is almost trading at the day's lowest point. 24,720 levels is what it's trading at. But let's talk about Bajaj Auto because that's expected to report its numbers today. What are we watching out for this time from the company in Q4 FY25? Sudarshan is joining in with us to give us those expectations. Good morning, Sudarshan.
Good morning. So for Bajaj Auto, we are expecting a steady set of earnings. Higher volumes will support revenue, while better product mix will aid realization. Also, margin is expected to hold the levels above 20%. Talk about the headline numbers. Profit is seen rising 3%, may come in at rupees 2,002 crore. Revenue too can increase by 4%. EBITDA may increase by 4%, can come in at rupees 2,406 crore. And margin may hold about 20%. It may come in at 20.1%, same as the Q4 of FY24. Volumes were higher 4% year-on-year and down 10% sequentially. Realization can increase 1% year-on-year. Also, on a sequential basis, it may increase by 4%. So overall, we're expecting a steady set of earnings from Bajaj Auto. What we'll be watching out for in the commentary? First, what exactly company talks about a PLI benefits, and also domestic outlook if there is a major recovery that company is saying, especially in the rural segment. Also, what would be the most important is the recovery in exports and especially the Nigerian market. So these are the things, some of the things that we'll be watching out for the commentary. But overall, steady set of earnings expected.
Some much awaited results from Bajaj Auto. Sudarshan, thanks a lot for that. Generally coming after market hours, so it'll be interesting to see what Bajaj Auto has to deliver. The stock, though, significantly down from the highs that it had made, which were well in excess of 12,000 rupees. We keep an eye out on Bajaj Auto, 10% higher in the last 1 month. But time for a quick chart check then. Sudeep Shah from SBI Securities is now joining in. Sudeep, good morning. Thank you for joining in. Expiry related volatility, if you could call it that, because despite positive global cues, you're still not seeing any move towards that 25,000 mark. What are the charts indicating here on the Nifty? Do we grind lower from here? And what are your stock recommendations for the morning?
Yeah, good morning, Hormaz. Yeah, you can call it expiry-related volatility because, see, what's happening is that even post-opening, initially 24,800 seemed difficult to hold, and now sustaining below that, indices are heading towards 24,680, 24,700. However, overall, what we feel is that the range of 24,600 to 24,900 by and large could still continue for the next few sessions. On the downside, this 24,600 zone is now acting as a strong support, being the 20-day exponential moving average. And in the last 4 to 5 weeks, there has been 1 or 2 times that this moving average has been retested, and we have seen a strong bounce back from that zone. So overall, 24,600 is the support zone that I feel, and about 24,900, 24,930 indices are good to go for 25,300, 25,500. From a stock specific perspective, I feel a lot of mid caps, a lot of select large caps are moving. And the first stock that is there on my radar is MCX. Now, most of these platform related stocks or exchange related stocks have been doing well of late in the last several weeks, and MCX has given a fresh breakout above 6,500, 6,480 zone, and now from here on the stock is it looks like the stock is headed towards 6,900, 7,000 zone on the upside, and this can be bought with a stop loss at 6,500 on the downside. The second stock that is there on our radar is Cummins India. Now here, after many weeks, we've seen some kind of a breakout in this chart. The stock has been in a range since last 4 to 5 months, right from the month of January, and it has broken out above 3,050, 3,080 zone, and with that is also with strong volumes now. So here the stock is headed towards a recovery up to 3,400, 3,450 zone, and can be bought with a stop loss at 3,000.
Okay, Sudeep, thank you so much, for joining in with us, giving us a check in terms of the market as well as the stocks that you're looking at. But on that note, we're going to submit to a very short break, viewers. Don't go anywhere. We'll be back with more news and updates, and we'll discuss the fundamentals with Madan Gopal Ramu of Sundaram Alternate Assets after the break.
Back with us here on Trading Hour. The Nifty continues to remain choppy on the day of its monthly expiry. Good time to get in Madan Gopal Ramu from Sundaram Alternate Assets, who's now joining in. Madan Gopal, good morning. Thank you for joining in. You know, I just read your note where you mentioned that you continue to have a fairly higher exposure to the mid and small caps in comparison to a fairly street consensus of moving towards the large caps, because they are the ones that now offer more value compared to the broader markets. If you could explain why is that so, and if the broader markets are set to do well, what happens to the large cap trade?
Right. Large caps, we feel the problem is on the earnings side. While the valuation, you can still argue that there are certain sectors, because the earnings has been subdued, the valuations also been moderate. But it's not that large caps are not costly. For the kind of almost like Q4, we saw the earnings growth of large caps were in single digit, even adjusted for financials. So we feel that large caps lack earnings growth. Even if you take a 2 to 3 year view, there are many sectors in large cap like banks and IT sector, FMCG, and even oil and gas. Together, they form almost like 60-70% of the Nifty. The earnings growth may not be in double digit. It will be in higher single digit. So we feel that if you want to make money in market, you can't be exposed to these traditional sectors. You have to move beyond the large caps. You are right, mid caps valuations are looking higher, but it's looking higher because of the earnings growth in specific pockets being much, much better. And we feel comfortable in playing some of these segments. And even in Q4, segments like capital goods, NBFCs, even some of the spaces in healthcare have delivered quite a good earnings beat. So we feel that it's better to approach the market not as a Capco basis, which is more traditional way of approaching the market. It's better to approach stock specific and sector specific and theme specific. And and there are segments within the market, even across the Capcos, which are offering high double-digit sort of earnings growth. Even last year, when the overall Nifty's earnings growth was in single digit. So that's the reason that we remained with the mid and small cap during the correction, and we also added we made some sector rotations, but fairly remained more towards the mid and small cap space.
Okay, you've remained more towards the mid and small cap space. You've said that you've made some sector rotations as well. And right now also sector stocks is what one should look at more than just looking at large cap traditional side of investing. What sectors are you looking at then?
Capital goods, particularly the power equipment side of the capital goods, have given a major beat to the earnings, and also from the commentary point of view, given what is happening in India as well as globally. Power equipment side looks pretty good. Across the transmission, generation, and distribution side, there is a lot of Capex happening. If you look at recent grid stability issues that came in Europe, there is a lot more talk about the renewables mix in the grid, creating more opportunity for more transmission Capex. If you see some of these, the equipment manufacturers, there are only 3 companies globally, excluding some of the Chinese players, who are capable of doing these transmission equipments. Even in India, if you see the HVDC projects, you see bidding only coming from Hitachi, GE, and Siemens. It clearly plays where competition is lower, opportunity is going up. At least for next 2-3 years, we see visibility of Capex happening across transmission and generation, and the competition is limited in India as well as global as well. In India, particularly last decade, we saw Chinese competition being higher, which has come off now. And India is very clear on supporting the domestic manufacturing. So that is, if you see the margins of these companies, which were in single digit in the last decade, it has moved into almost a higher double digit, sort of higher teen sort of margins. In addition to it, you are seeing the order book almost growing 30-40% across these companies. So we feel that capital goods in power sector looks pretty interesting. At least next 2-3 years, the visibility is good. We also feel NBFCs, which has been always our structural call, and we feel that compared to banks, NBFCs are better positioned. I'm very specific to the companies we are referring here. And growth has been pretty meaningful. Healthcare also looks pretty good. The rotation that we did was we booked some profits in e-commerce space, where we saw the earnings growth is getting cut right now, and we shifted them back to some of the capital goods names and financial space.
Okay. Madan, you highlighted a couple of points. One, in terms of power. Power is what you're talking about. You're expecting them to do well going forward. But do you expect across the board, so transmission, generation, as well as distribution, and which companies are you looking at? Because you're looking company-specific also. So which companies in India are a better bet right now?
Obviously, I even mentioned these names. GE, Hitachi are listed names and pure play on transmission capex in India. And also they are getting opportunity to export right now. So we feel these companies, there has been a bit of a rally in these names. So investors can look for some sort of a correction to get in. But if you take a 3-year view, I think still they have quite a bit of growth left in them to support decent returns from these spaces. We would rather play capital goods, the entire power story in the early cycle, rather than playing the utilities. So that's the reason to highlight on the capital goods space within the power sector. We also like, with the recent correction that has happened in the cable space, like KA, Polycap, the valuations become reasonable, and the companies are looking at 20% sort of a growth. If you look at even the large cap, if you exclude the traditional sectors which generally trade low in terms of multiple, even growth part of the Nifty is trading at 25 times. So if you're getting, and growth part of the Nifty is around 15% sort of a number. But if you're getting mid-cap names at 20% plus sort of a growth with 25 times sort of a 1 year forward multiple, make a decent entry point for the investors with a 2 to 3 year view.
What about the oil marketing companies, Madan? Because there is a fair amount of chatter with regards to them in the oil and gas space. And when you mention oil and gas, these are the names that first come up, the HPBPs and the IOCs. Where, in terms of where are you positioned here? Would you prefer the OMCs in comparison to the ONGCs or the Oil Indias, or your preference is otherwise? Because in both cases, the dividend yield factor also comes into play as well.
No, actually, I mentioned that these are part of the Nifty which we are avoiding at this point, primarily because the earnings growth has not been pretty impressive. And we don't think, given the global noise around the slowdown, oil prices are not likely, oil demand particularly not likely to surprise you on the positive front. So we would stay away from it, and it's very difficult to track the global commodities, in our opinion. There could be some tactical opportunities sometime, but we have felt that taking a high conviction bet on these are very, very risky. So we have mostly avoided the oil companies in our portfolios.
You're avoiding these oil companies in your portfolios. Madan, quick question, right? You said you do like healthcare space as well. Is it only healthcare or even some of these pharma companies? Because you have a lot of commentary that keeps coming in on tariff front. Today also we did have some updates coming in. So is there something like, you would look at global pharma companies, CDMOs? What are you looking at there?
Within healthcare space, we have hospitals, and that's a very specific call on one of the hospital names, which is going to a merger now with and thereby becoming third largest hospital group in India. Creating a good bit of value if you come in and stay invested for 3 years as this merger happens, and then the synergy benefits plays through, and the valuation also gets a chance to get re-rated here. On the other side of the pharma space, we like CDMO companies. CDMO companies, we are seeing quite a bit of activity and healthy pipeline for the Indian CDMO companies from global, and this is irrespective of whether tariff happens or not in favor of India. China plus one story has been pretty much happening in the CDMO space. So we are interested in CDMO space and hospitals. Generic pharma, no. We actually had Cipla, which we exited recently because the earnings growth trajectory is pretty subdued in the generic pharma space. Even in the domestic pharma space, growth is decent, but will you really pay 30-40 times multiple for a 10% growth? That's a question that we are finding it difficult to justify.
Okay. Madan, last quick one. You spoke about NBFCs and you said particular names in NBFCs, and you've also had a tactical bet on MFI space. So what is the name over there? What should one look at right now?
I think in the previous episodes also we have discussed about some of the regional NBFCs becoming bigger over a 10-year period, like what happened with Sundaram Finance itself, our parent, how they've grown from a Tamil Nadu-oriented sort of business now to pan-India, and growing from, starting from vehicle finance, now moving into housing loans. So this is a very well-established model of growth and very successful model. And given what you have seen with Sundaram Finance creating wealth for the investors in the last 15 years, since the time I've joined Sundaram also, it's phenomenal. And you can't take eyes away of it, but you have to select the right names here. So when we look at it, Chola has done it well. Bajaj Finance, no need to mention about it. And of the other emerging names, we find Five-Star, Home First, sort of companies having similar attributes. They are looking at a long-term growth. They are building right kind of franchising, and they are starting from 2-3 states now and then becoming larger in other states, at least 10 to 12 states in India, where you can build a similar size of what you have built in the homegrown states. So this is a well-established, very clear structural model, and getting them early is very helpful. And that's the reason to stay with some of these NBFCs. Despite last year has not been great for NBFCs, recently they have pulled back pretty nicely with the noise around the unsecured loans coming down.
Sure.
On the MFI space, yes, it was a tactical bet, and we have gone into credit access recently. We hear that the NPA issues are getting resolved. It's not happening as quick as what you'd like to be, but I think first quarter to second quarter next year, most of it should be behind you. And valuations are reasonable in the space, and lack of competition and lack of capital will create value in MFI space for good players.
Okay. Okay, Madan, thank you so much for joining in with us on the show and giving us insight in terms of markets as well as sector-specific view. But on that note, we're going to slip into a very short break, and on the other side, we'll put the spotlight on stocks like Deepak Nitrite, Welspun Corp that are buzzing in trade, so don't go anywhere.
Welcome back. On to some stocks that are moving around in today's trading session. And Cohance Life Sciences is also under pressure, among the top losers on the Nifty 500 in today's session after its fourth quarter results. Ekta is here to break the numbers down for us. Ekta.
Thanks for that. Well, yes, Cohance is in focus on account of its numbers. It was the first fully integrated quarter of, the entire merger of RA Chem, Avra, ZCL, Suven Pharma, etc. So it was the first full integrated quarter with that. The revenue was at around 402 crores, but the margins dipped to around 18.3%, and the profit came in lower Q-on-Q as well as year-on-year. The CDMO Q4 revenue was up 31% year-on-year. This quarter. So that was basically, bulk of the entire sales. Now, the company, however, said that FY25 was a year of transformation. They did improve on key business metrics. For example, phase 3 molecules went from 9 versus 2 earlier. And the RFPs have been from large innovator pharma companies as well. They've expanded their R&D team to around 500 plus. FY26, however, according to them, will be a year of acceleration and execution. Will be built by pharma, CDMO specialty as well as API, specialty chemicals, that is. This will put the building blocks for a $1 billion revenue target by 2030. So the guidance looks okay, but let's see whether it's, there's any kind of improvement in terms of the overall revenue. But this quarter was a lot of, the integration of multiple businesses, and hence maybe a little choppy.
Okay, thank you so much for that, Ekta. Keep an eye out on the stock hence as well. But let's move on to the next one. We have Avanti Feeds that's surging in trade after they reported a good set of numbers in Q4. Ria is here to tell us more about that. Ria.
Well, good morning. Let's take a look at how the numbers have panned out for Avanti Feeds in this quarter. For quarter 4, they've seen good growth in the overall revenue, up around 8% over the previous year. Very strong improvement on the profitability front as well. For quarter 4, EBITDA and net profit have jumped up by around 26% and 39% respectively. Even on a full year basis, EBITDA and net profit are up around 38% and 51% respectively on a year-on-year basis. Quarter 4 EBITDA margins have also seen a jump of around 267 basis points, with the full year margins going up by around 200 basis points compared to the previous year. Coming to the segments of the company, for the shrimp feed revenues for FY25, remember this constitutes around 78% of the total revenues. For this segment, the revenues have increased marginally, just about 3% over the previous year, but the EBIT margins have seen a very sharp jump up of around 500 basis points compared to the previous year. For the processed shrimp segment, though, this contributes around 21% of the total revenue. For this segment, the revenues have gone up by around 9%, but on the margin front, we've seen a very sharp decline of around 500 basis points over the previous year. And remember, the margins have been under pressure over the last year because of increased freight costs, higher raw material costs as well, and even the higher countervailing duties imposed by the US have caused some margin pressure for this segment. So this is one segment where the company has underperformed, but largely the results look very strong for Avanti Feeds, which is why the stock is trading higher today.
Indeed, good performance from Avanti Feeds showing up on the stock as well. The other one that's doing well for itself today is Deepak Nitrite, and that is after another better than expected quarterly performance. The margins were higher as well. The phenolics business drove the top line growth. Upasna is joining in with the fine print of Deepak Nitrite. Upasna.
Well, it's certainly a strong beat versus the street estimates. The recovery was seen sequentially as well, despite the geopolitical tension, elevated prices, and even oversupply from China. Mind you, Q3 was a subdued quarter, but in Q4, certainly the recovery is seen. Now, growth was driven by company's key segment, that is phenolics, which saw 5% revenue growth, and margins also saw an uptick of as high as 150 basis points. Now, overall, if we talk about the margins expanded due to mainly favorable product mix of the company, and this came in spite of pricing headwinds seen across the portfolio. Now, company says that it is seeing an initial signs of recovery in demand for products related to dyes, pigments, home and personal care, and even select pharma application products. Now, coming to their numbers for Q4 on a consolidated basis, revenue saw an uptick of 2%, EBITDA saw an uptick of 5%, EBITDA margin stood as high as 14.5% with an uptick of 30 basis points, while Street was estimating somewhere around 9.7%. So a big beat on the margins, and PAT saw a downtick of 20% at 202 crore, while the Street was working with an estimate of somewhere around 110 crores. Now, coming to the segments, key segment, that is phenolics, as mentioned earlier, saw a revenue uptick of 5%, and margins here stood at 15.6% with an uptick of 150 basis points. And next one is advanced intermediates. This saw revenue downtick of 2%, a bit of a subdued performance here because of the low volume is what the company has indicated, and margins here stood low at 7% versus 20% on a Y-on-Y basis. So overall, good set of numbers from Deepak Nitrite.
Overall, good set of numbers. We'll be waiting for those con call highlights that will be starting at 12 noon right now as well. So keep an eye on that. But let's move on to the next stock that is also buzzing in trade today, and that is Welspun Corp. And this is after a good set of numbers that came in Q4 FY25. Nigel is here to give us details on this one and why is the street excited. Nigel, over to you.
Well, Welspun Corp reported a very strong set of numbers, and the management commentary as well on the con call was very, very positive. So let's run you through a few pointers. The EBITDA per quarter came in at around 460 crores. And if you pull up with the last few quarters, well, we've not seen this sort of a number. So the EBITDA per quarter came in at the highest we've seen in the last 5 quarters. And also it's close to a record high on a quarterly basis. So that was great news. Not just that, they're guiding that things will get even better from here on. So they've given their EBITDA guidance for the next year, which is at around 2,200 crores, which is very, very strong. But if you look at it, what they've done in the last 2 years, they've given a guidance, they've gone ahead and outbeaten that. Remember, the EBITDA guidance that they give includes the other income as well. But even if you go by the guidance that they've given in comparison to what they've achieved, that would mean an EBITDA growth of close to around 18%, which is very, very strong. Now, in terms of their balance sheet, things have looked up because they've sold some of their non-core assets and now they're sitting on cash of close to around 5% of their market cap, which is good. They have a big Capex plan of around 5,000 crores in the next few years, but they're generating cash and they have a clean balance sheet as well. The street likes that. And order visibility, it's very, very strong. They're sitting on an order book of around 19,500 crores and they've got a lot of orders from the United States, which is the higher margin business. And because of the strong demand they're seeing in the United States and because they have a plant in the United States, they're a potential beneficiary of higher usage of LSAW pipes. And that's why they're going ahead and setting up a greenfield facility as well. So they're saying that they have a 30% market share out there in the United States and things will only get better from here on. So put all this together, good set of numbers, good guidance, good order book, clean balance sheet. The street likes what they see.
Multiple positives for Welspun Corp and 10% higher on the stock. The street rewarding the multiple positives that Nigel just highlighted. Take a short break. More on the markets on the other side. Welcome back. Quiet as of now on the index, still remaining at the flat line. And the broader markets, though, also the Nifty Bank, though, is a bit of a worry here. 220 points lower on that index. And that is what is keeping the index under check as of now on the monthly expiry day. Take a leave on Trading Hour from Vinny and me. Thank you so much for watching. Halftime report on the other side.
Stocks trade ranged after a U.S. federal court scraps Liberation Day tariffs, but the Trump administration files an appeal. IT and metals notched some gains, while energy and auto drag.
SEBI bars IndusInd Bank ex-CEO Sumant Katpalia, ex-Deputy CEO Arun Khurana, Anil Rao, a member of the Executive Committee, and 2 others for insider trading. The naming of Anil Rao is a blow for the bank's current management structure.
Max Life Insurance MD Prashant Tripathi will retire early in September end. The sudden exit is seen as a near-term setback for the life insurer that recently came into the Axis fold.
A U.S. court scraps tariffs imposed by Trump under the International Emergency Economic Power Act, calling its use unjustified, even as the Trump administration files an appeal. Experts point to other sections under which tariffs can be imposed, keeping the uncertainty alive.
Elon Musk announces the end of his term as a special government employee leading DOGE. This comes soon after his criticism of Trump's Big Beautiful Bill and follows demands on his time from Tesla investors.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Ekta Batra. We come to you live from the CNBC TV18 Motilal Oswal studio. It's an expiry day, yet unlike an expiry day, because there has been a fair amount of volatility. We opened in the green. Thereafter, we saw a bit of sell-off from the top, but the lows have been maintained on the frontline index, just below the red line for the Nifty as well as the Sensex, led lower by the Nifty Bank. It's the IT and metals which are doing a lot better. Even at an index level, the Midcap index is mildly in the green. So no different from what we've seen over the last few trading sessions, but yet different in the form of the factors that are moving the market in different directions. So expiry day, yet not an expiry day.
Hi, Mangalam. Yes, maybe there would be more fireworks in the second half of the trading session. But as of now, we have the Nifty, which is just about lower by around 13 odd points. The Midcap index, which is just about consolidating with a little bit of a positive bias as we speak. But just want to point out, you mentioned IT stocks which are gaining. So, for example, yes, LTI Mindtree is up around 1.8% and Wipro is up around 1.3%. But a couple of these pharma stocks are higher as well. So, Sun Pharma is up around 1.4%. Dr. Reddy's is up around 0.6%. And remember that these companies have a large amount of a generic focus and generic business, which is US focused. So maybe there is an expectation that there could be a possibility on relief when it comes to tariffs as well. But let's see, that's just some amount of speculation there. As of now, the stocks are doing well. But nonetheless, let's start the show with some news, and important news at that. The Securities and Exchange Board of India has passed an interim order in the high-profile insider trading case involving key managerial personnel of IndusInd Bank, including the bank's former CEO and other senior executives. The regulator has barred 5 individuals from buying or selling securities and has frozen their bank accounts. Ritu's here with the details on this.
That's right, SEBI has passed an interim order against 5 senior executives, including former CEO Sumant Katpalia and former Deputy CEO Arun Khurana of IndusInd Bank, in an insider trading case where the regulator found that these individuals had sold shares of the bank while in possession of unpublished price-sensitive information, avoiding losses of nearly 20 crore rupees. Now, in the interim order, SEBI has frozen their bank and demat accounts to the extent of the losses avoided, barred them from trading in securities until further notice, and directed them to submit a full inventory of their assets. Now, together, SEBI says they avoided losses of 19.78 crore rupees, out of which 14.4 crores was by Arun Khurana alone and 5.2 crores by Sumant Katpalia. The others who have been named are Sushant Saurav, the head of Treasury Operations of the bank, Rohan Jatanna, the Senior Vice President of Global Markets, and Anil Rao, the Chief Administrative Officer, who notably is also part of the 2-member Executive Committee currently overseeing the operations of the bank in the absence of a CEO. Now, SEBI's investigation showed that senior management was aware of the discrepancies a good 15 months before they made the exchange disclosure, and not only their internal team, even external auditor KPMG had flagged the impact long before. Sumant Katpalia alone sold 1.25 lakh shares of IndusInd, while Arun Khurana offloaded about 3.5 lakh shares without making a single new share purchase in the period between December of 2023, when the management first found out about the discrepancies, and March of 2025, when the information was made public. Now, beyond the 5 executives named, SEBI is also investigating other suspects that it did not name. Questions are already swirling around the board's oversight and the auditor's role. And importantly, Anil Rao, who's part of the 2-member executive committee running the bank, is also named in this order. So we will probably see the committee getting revamped as well. Now, with the CEO and deputy CEO already out, the story, of course, is far from over, and more heads may roll if insider trading charges stick.
Take that point, Ritu. Thanks a lot for that. In fact, earlier today, we spoke with Amit Tandon, who is, the MD at IIAS, to discuss more on the IndusInd Bank insider trading. Here are some of the excerpts from that conversation.
If you read what SEBI said that, look, we've appointed KPMG on the basis of a board note. So again, you have to ask whether the board were shielding the management or whether they were taken by surprise. I think that is really not clear at this stage, and we'll need to hear a little bit more. So if there is action against the board, you can expect that there is going to be some more tumultuous times going ahead. It's clear that the board has not lived up to what RBI's expectations were and what the investors' expectations were. So I think we are going to be in for some amount of volatility or internal churn as far as the bank is concerned. Likely to be a shakeout as far as the board is concerned. There is, of course, the existing board structure, existing management structure or the leadership structure will change. So the question is, how quickly will they be able to bring in a new CEO? And that in itself will mean there's going to be a round of internal cleaning up. Every bank is going to become much, much more internal focused, rather than looking at opportunities out in the market. So I think there's going to be some degree of slowdown as far as these bank operations are concerned.
Okay, we could probably see a little bit of a slowdown in terms of the IndusInd Bank operations. That's the word coming in from Amit Tandon. But let's move to the mid-cap space. Insecticides India and Bharat Rasayan are reacting to their Q4 numbers. Ria has the fine print.
We've got 2 earnings candidates in focus today, both Insecticides India and Bharat Rasayan. First, focusing on Insecticides India, the revenue growth has come in at around 2% for FY25, below the guided range of 3 to 4%, with a volume growth at around 10% and a price decline of 8% in this year. EBITDA margins, however, have remained strong at around 11%, in line with the company's guidance of double-digit margins. Gross margins have also seen a jump up of around 650 basis points in this year, which was led by a better product mix, improved pricing strategy, and as well as the new launches that were taken by the company this year. Overall, the profit growth has been led by an increased focus on the value-added premium products, which have seen a growth of around 13% in this year. Going forward, the company has said that their growth outlook remains intact. They're expecting an expansion in the premium products, stable gross profit margins, as well as a further improvement in the EBITDA margins as well. For the newly launched herbicide called Altair, they are expecting to generate around 10 to 15 crores of revenue initially, with the revenue going up to around 40 to 50 crores in the subsequent year as well. So overall, healthy set for Insecticides India, and the street is reacting positively to that. On the flip side, Bharat Rasayan has posted a very weak set of numbers in this quarter. The full year performance though has remained largely healthy, but quarter 4 has disappointed by a lot. Revenue growth has remained flat in this quarter. Profitability has been sharply lower. EBITDA and net profit have seen declines of around 42% and 62% respectively, both on a year-on-year basis. And margins, EBITDA margins, have also seen a very steep cut of around 925 basis points. So the street has been reacting negatively to that. Stock down around 8% on the back of this.
Right, Ria, hang in there, because, there is something around real estate as well. What does Morgan Stanley like about this sector so far?
Well, good morning. Morgan Stanley has come out with a note on the entire real estate space today. What they believe is that top-tier developers continue to show strong momentum, which is supported by improving capital market sentiment as well as favorable policy cues, which includes some potential RBI rate cuts going ahead. They've also highlighted that the real estate sector has corrected by around 8% over the last 12 months compared to a 9% increase in the Sensex. And this has been because of subdued pre-sales in the second half of FY25, which has resulted in an excess NAV premium unwind as well. They've also said that this reset offers a reasonable entry for some stocks, with the fundamentals still looking intact and the outlook remaining positive for the overall sector. On the back of this, they've upgraded DLF to an overweight rating with a target price of rupees 900. Prestige has also been upgraded to an overweight rating, with the target price being raised to rupees 1700 for this one. For Godrej Properties, however, this has been downgraded to an equal weight rating, target price being cut to rupees 2400. Oberoi Realty also has an equal weight rating, with the target price being cut to rupees 1700 for this one. And for Macrotech Developers as well, an equal weight rating with a target price of rupees 1400.
Okay, all right, Ria, thanks very much for that. Well, for the markets, like we mentioned, it's a bit sluggish, you'd say, for the Bank Nifty, so down around 0.4% as we speak. And in terms of specific stocks which are leading the downside is Kotak Mahindra Bank, which is down around 0.7%. We have HDFC Bank, which is down around 0.6%, and State Bank of India, which is under pressure as well. So that stock is down around 0.5%. Overall, advanced decline ratio still even keel, so stands at around 1:1. Like Mangala mentioned, it's a quiet expiry. Let's see what happens in the second half of the trading session. We take a short break, but before we do that, we're excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. Welcome back. Well, let's focus on one pharma company, Aurobindo Pharma. For Q4, their revenue growth came in line with street estimates, while the US sales were above the expectations. I did catch up with Mr. S. Subramaniam, who is the Chief Financial Officer at Aurobindo Pharma, to talk about their performance, and began by asking about the company's growth guidance for FY26. Listen in.
Even with a high base of 31,700 crore, which you achieved in FY26, our objective is to grow high single digit because of the various factors which I will explain to you in detail. All right. The growth will be across all businesses with the capacities of over 60 billion doses. So this is one of the highest capacity we are having, and we will continue to grow all businesses because of the high capacity. If I go into straight away to US business, we have already had a very high base. So we will continue to go anywhere between mid to high single digit. That is what we are aiming for. And why we are saying that, if you really see our market share in prescription audit, if you see the last IQVIA data, we are holding a position of around 10.6% as per the March 25 data. Second, we are also commissioning the new plant, Dayton, Raleigh, etc. during the year. Possibility Dayton will be commissioned in the second quarter, which will also add to some more growth during the year. Plus, we are also doing the new product launches during the year, which will help us to grow the business. Right? If you go into UGA business, if you go into the Europe business, we are already achieved a growth of around 16% on currency basis. We have achieved it, and even though the market is there, which we will continue to grow. And we are very conservatively, we are putting it a high growth of around 8% to 9%, despite the market is growing around 5%. So this also will help us to grow the business. Then you go into the UGA business. If you go into the UGA business, as Yugandhar said, despite Revlimid not going to contribute the same quantum which has contributed last year, with the new product launches, etc., which he has explained, he will able to maintain, and which will help, because the base is low. UGA business, if you compare to the overall company growth, it is $3.75 billion. UGA business is around only 500 million plus. So even though there is a drop in the Revlimid, but he will able to make it up in the other products, which will help us to grow the business. Okay. And we are also launching new product. Then you go into the growth markets. The growth markets, China is coming there, and we are also doing Indonesia, South Africa, Canada. These markets are relatively growing, and this also helps. And the last is the API supplies, PNG, 6-APA, etc., which even if I assume I'll do it fully, right, I will be able to grow the business. And this is what I'm sure we'll be able to grow by high single digit. That is what you're saying. If you're doing double digit, it's a bonus, or it's a bonus. That's the way we look at it. Plus, apart from all the other things, the tailwind is also there in terms of the rupee depreciation against euro, dollar, etc., which also will aid to the growth, which may take us to the double digit also.
Okay, all right. Now, just to narrow down a little bit on what the industry has also indicated, Sun Pharma also indicated high single-digit growth this quarter, but it was mainly due to global uncertainties also. How much of your guidance includes global uncertainties at this point?
So, if you really see, Ekta, as we have been seeing, if I see the prescription audit data in the last 3-4 years, we have been growing continuously every year by about 0.5 to 1%, and we have, we have been consolidating our positions in the generics because of the high capacity which we are doing. So we don't think global uncertainties will have an impact in the healthcare, at least in the generics business, which we are present, right? So I don't see a major issue in terms of we are achieving the growth because of the product profile which we are having, and apart from that, we are having around nearly 600 plus ANDA approvals, and we are active more than 400 products. So I don't think if we take the top 25 products, I am selling only, if I take the top 10 products, I am doing only around 20% of my sales. If I take the top 25 products, I am doing around 35% of my sale in US market alone, I'm talking, right? So with all these things, I think we will be able to grow. That's what our belief is.
Okay. So, but what are you expecting when it comes to tariffs from the Trump administration? You yourself in the call said that we could probably hear something in July.
Yeah. See, we do not want to speculate at this stage, right? We do not want to speculate at this stage. But having said that, even if there are two scenarios, there are no tariff and there is a tariff. If there is no tariff, there is no issue. It's a status quo. If there is a tariff, I think we will be able to pass it on to some extent, and then we are also commissioning our Dayton plant, which will able to mitigate the overall impact of it in our view.
Well, let's come to your margin guidance then. You've said that you're looking to maintain margins in FY26. FY25 was around 20-21%. What will aid these margins and any upside potential to it, considering that you did say that the rupee depreciation could be a tailwind and could probably even result in double-digit growth? Anything of that sort on the margins?
See, what we have done is last year and the last 2 years, we have consciously moved the product. I mean, we have increased the production in India for the US business, which has helped Europe business, which has helped to improve the European turnover as well as we are able to improve the margin. So we continue to do that, and we are also expanding the capacity relating to Europe. Also, we are expanding the capacity, which will help us to supply more material to Europe and also reduce the cost.
All right. Just break it up with, on a quarterly run rate basis for us when it comes to the US business. In Q4, it was around $470 million. And if you look at the past couple of quarters, it's ranged between, say, 420 to 450 and now 470, which was, I think, a multi-quarter high for you all. What do you think would be a base that you would probably generate in terms of US sales in FY26 on a quarterly basis?
Even Ekta, what is going to happen next year is we are going to have launches, both in oral as well as in injectables. Injectables, there are products which already Yugandhar was mentioning, right? We are also already launched some of the products already in the US market. These things will help us to grow. I mean, if you take 1,700, I mean, US business will be around 1,100 to 1,200. 5% is equal to around 60 million. 8% will be to 100 million. 60 to 100 million, I don't think it's a big challenge, which means you break it into quarter. If you break it into month-wise, it is 5 to 5 million type. So I don't see a big challenge, and team is very excited about taking the business forward.
Okay. FY27, you're expecting a bigger fillip in the US. What are the launches lined up?
FY27 as in UGA business will grow as explained by specialty business will grow as explained by the business CEO, as well as our own business oral also will grow, and we will easily grow the because the new product, the new plants are getting commissioned, new volumes are getting into the to the market, so which will help us to grow the business.
Okay, you're expecting UGA to normalize by Q1 FY26.
Ekta, if you really see every year, we have been launching around at least 40 products, correct? We have been mentioning every year we have been launching around 40 products, and we have not faced any. The pricing was very stable or neutral in the last 2 years. Even assuming 40 products, you make 2 million per product, etc. Also, you will make around 60 to 80 million every year, which will aid the growth, right? With no price erosion, increasing the volume, and you do a minimum sales, ensure that we are launching this product, will help us to achieve that growth which we have been contemplating.
Okay. You're expecting UGA to normalize by Q1 FY26. Is there any kind of inspection lined up? What is the status?
No, there is nothing lined up, and we will be, nothing has been lined up as on date. And it's going to be surprise, so we may not be knowing actually.
Okay, correct. Because that is also something that the Trump administration is probably going to be looking at, more surprise inspections. How does the company read that?
Fine. We should have a perpetual inspection. A plan. Perpetual pre-audit every time, which we continue to do that.
Okay. All right. Just wanted to, quickly also get your view on the PenG plant, which was impacted by a fire in April 2025. You've booked losses also due to the fire incident, and it's affected, there's been an operating loss as well. Just tell us, what is the status? When does it come back on stream?
So the fire accident, and we are setting the coal belt, everything ready. We are waiting for the approval from the Pollution Control Board. We are also commissioning some of the equipments which are required more to ramp it up fast, which is also being done. And we'll wait for the approval from the. And as on date, the prices are in such a manner, the prices are low, it is not going to impact it at all. In fact, we are benefiting because of the current prices, right? So it is not an issue really.
All right, so that's some insightful commentary coming in from the management of Aurobindo Pharma stock, about 1.5% right now, outperforming the broader markets in general. With that, we'll step into a short break, and as we do that, good news for our viewers. It's India's business news leader, which is now just a click away. That's CNBC TV18's all-new app, which gives you instant access to breaking news, in-depth articles, all the financial world updates at your fingertips. So what you got to do is download the app from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen. Welcome back. The Nifty just around the flat line, and we've seen the Midcap index as well recover a little bit from the lows. So good time to get in the FNO perspective on the market right now. And, if you look at the way this entire week has been, we've seen some support at lower levels for the Nifty, while there has been some supply at higher levels as well. So the Nifty Bank is the one which is underperforming right now. Sectoral indices, Nifty IT as well as the Nifty Metals are doing a lot better, and that's capping or supporting the market from the downside. So if this continues to outperform and we see a turnaround in the Nifty Bank, then could we see an up move in the next half of trade or not is the big question. The mid-caps, at an index level, they are marginally outperforming, and there is a quiet intersection between the red and green lines when it comes to the crisscross advanced decline ratio. Which way it moves, it will be determined in the next half hour or so. What are the option writers doing? 24,800 call, that's seen some writing, premium of 25 rupees. 24,750 call as well has seen some writing, premium of 34 rupees, telling you that the congestion zone for the market is about 30 points from here, 24,780 to 24,820. And at the lower level, there is support at around 24,650, 24,670. That's what the action on 24,700 put is telling you. But my sense is that maybe we see a big up move in the last hour of trade. And why do I say that? There are three data points that suggest so. One, the put call ratio has dropped to 0.64. That is the lower end of the range. Secondly, there is a lot of punt buying that is taking place at the 25,000 call. The 25,000 call comes up for you on the screen, 8.5 rupees. Moments ago, this was 7 rupees. So there's been a 20% jump in the option premiums already for something which is so far out of the money. And the third thing, the last few trading sessions, even as the market was consolidating, the India VIX was rising. Now as we move towards expiry, the India VIX has fallen 8%. So that's telling you that there has been a lot of unwinding of long puts or writing of puts as well. So that's strong support for the market. If it sustains above, then we have a lot of fuel on the short side for the markets to go higher. What can lead to this change? It has to be the Nifty Bank. Nifty Bank is very close to its support zone. 55,000 is the lower end of the zone for the Nifty Bank. If we find a support out there and the Nifty Bank moves higher, by virtue of the other indices doing well, the market is in for a bit of a rally. That's what the data points are indicating. Let's see whether that happens or not.
Okay, all right, Mangalam, thanks for that. We have Aditya Agarwal here to tell us what he's tracking technically today on expiry day. Aditya, hi, welcome to the show. Well, it's turning out to be a quiet session as of now. How would you read the overall, the overall texture of the market considering it's quiet on expiry day?
Hi, good afternoon, Ekta. Hi, Mangalam. Good afternoon. Thanks for having the show. I completely concur with Mangalam and the analysis that he just put out right now, that if you look at the way markets are positioned, and especially if you take a look at the VIX, the way it has cooled off suddenly in trade today, and yesterday we saw the glimpse of that. After 19, VIX had started to cool off. I'm just keeping a close eye on the 16 mark on the VIX. If that is taken out on the downside in the second half of the trading session in trade today, I too feel we could be in for a sharp short covering rally in the market. And 25,000 is something that can be seen on the markets. A 200, 250 point kind of a rally on the market cannot be ruled out with 24,700 to about 24,600 as a strong support for the Nifty. And Bank Nifty too, while it is consolidating in a very narrow band after initial drop, I think it can also test levels of 55,500, about 55,600 on the upside. So both the Nifty and the Bank Nifty could be in for a short covering rally towards the second of the trading session. I would just keep a close eye on the India VIX, and I would like that to trade below that mark of 16. If that happens, my sense is you will be in for a good short covering rally.
All right, good short covering rally. Any individual stocks that you think one should keep an eye out on?
Oh, absolutely, Mangalam. In fact, two names that stand out for me. The first one is MCX. We have seen a lot of buzz around all these capital market stocks. And I think MCX is one of them, which clearly should be in the radar of all the traders. Current level, I'll be a buyer in the stock for a target of 7,000 with a stop loss at 64.50 on the downside. I think is a good short covering rally for probably a long build-up that I see in MCX at current levels. The second is IGL. This too is looking very interesting to me on the chart setup, has broken out from 200 DMA at current levels, makes a very good buy for a target of 245 on the upside with a stop loss at 205 on the downside. This too can be bought.
Okay. All right, Aditya. Thanks for that. We take a short break, but we'll get you a lot more on the stocks once we're back. Stay tuned.
way.
Welcome back. Well, it's quiet for the equity markets now, so let's shift focus on to the macros. The Reserve Bank of India has announced that its balance sheet for the financial year ended March 31st, 2025 increased by 8.2%. Lata's here to discuss more about it. Lata.
Well, first, I'll just run through some very interesting things that we've got from the RBI annual report. The RBI has bought more gold. It has bought 54 tons more gold. So the total value of its gold has risen by 57%. That's more because of the rise in gold prices, but it also bought 54.13 tons more gold, and so its gold holding rises to 879 tons. A table will come up for you. This is higher than previous years, that is year 24 and 23, but it's not the highest, you know. In FY22, they bought 65 tons of gold, and the percentage increase was something like 9%. This time, the gold holding has increased by 7%. Now, the other important takeaway that I got from the annual report is that, as already announced, the Reserve Bank has raised the contingency reserves, the reserves that they hold if, you know, the value of gold falls, value of dollar falls, all that they hold if it falls, you have a contingency reserve or buffer. That was increased from 6.5% to 7.5% in a previous board meeting. If it had remained at 6.5%, the Reserve Bank could have declared a dividend of 3.6 trillion. But because it has increased the reserves, an additional 76,254 crore had to be transferred. That's another interesting takeaway. Otherwise, the dividend would have been super, but maybe they're reserving something for this year. The other takeaways on the economy front, the Reserve Bank has an economy outlook chapter where it points out that the global outlook is very bleak. Advanced economy growth rate has been scaled down from 1.8 to 1.4%. And even the global disinflation advantage which we had seems to be going away. It's moderating. But the Indian economy is strong, supported by revival in consumption. Capex push is continuing. Very clean balance sheets of corporates and banks. Easier liquidity conditions are all leading to good growth expectations. Given the good monsoon, they're also expecting inflation to remain below the 4% mark. Those are some of the key takeaways. There are very interesting details on what kind of notes are in circulation, how many frauds have been done. Total number of frauds have fallen 33%, but in value terms, it has almost doubled. Although the number of frauds have come down. So interesting details. Let's get some more asides from the annual report. We have a guest joining us. Indranil Pan, the chief economist at Yes Bank, joins us. Indranil, good morning. I know it's just an hour you had to look at the report, but what were your key takeaways first in terms of the dividend? Do you think they are gearing up for a higher dividend this year?
That's a very difficult sort of call to take at this point in time, whether they're gearing up for a higher dividend. But no doubt the risk contingency buffer has increased, and I think the total as a proportion of the balance sheet, it is now 7.11% compared to the 6.05% that was there the last time. This I'm talking about the total risk provisions that have been done. Now, the global atmosphere in terms of the risks are quite volatile, and that is possibly the reason why the economic capital framework was widened to take care of the risks that might actually happen. My sense is that next year we might actually get a relatively lower sort of dividend, because in terms of the income, if we are not expecting the significant volatility in the forex markets continuing to in this year vis-a-vis the last year, and therefore a huge amount of sales by of FX reserves that have happened, the income from the foreign sources in terms of the buy and sell of dollars may actually be lower. So that's one thing. The other thing to remember is that in the fourth quarter specifically, because of the huge amount of liquidity infusion that happened from the government of India, the interest earned on these LAF has actually increased. So these are some things we need to watch out as we go ahead because of the huge amount of uncertainties that are there in the system.
Fair point. Even otherwise, the amount of government securities they own is going to fetch a lower interest rate because Reserve Bank has been cutting interest rates, as well what they lend out by repo in MSF is also going to earn less. I take your point that probably that is why they've given themselves a 7.5% reserves. They can reduce it all the way to 4.5%. Even if they reduce it to 6.5%, that can perhaps give them another 1 trillion rupees, which can make up for the loss. Indranil, there is also a detailed chapter on the outlook of the economy. Any key takeaways? Are you feeling as confident about the domestic economy as the Reserve Bank seems to be suggesting?
Yes, the resilience in terms of the economic growth continues. But whether we actually see an upside in terms of the growth numbers is something that is very difficult to decide at this point in time. Now, on one side, sort of if tariffs are avoided, because we have seen the trade ruling from the Reserve from the US, which says that so most of the trade tariffs are unconstitutional, is what they say. So if the tariff threat is reduced, then possibly the US avoids a recession, and along with that, the significant proportion of the world avoids a significant lower growth, and therefore exports dynamics are likely to be on the positive side. So that's one perspective to look at. The other thing which is very important is that for the current financial year, we are definitely looking at investments being the leader in terms of pushing growth. We are looking at more consumption in terms of pushing growth. One, because of the lower interest rates of the government. Two, because of between even the rural versus the urban, the rural is likely to be picking up. That's what most of the survey results tend to show at this point in time. The direct implications of a good monsoon in the agriculture will be felt on the GDP. The indirect implications will also be felt in terms of the higher income generated for the rural segment, as well as a fall in the general prices of the food items. So that is also a positive in terms of the demand story going forward. So looking at the more holistic picture, I think we are penciling it in a 6.5% growth for the current financial year, compared to our full year estimate of 6.4% for the year gone by, which necessarily means that yes, there is resilience, but the upward momentum may actually be missing. Of course, I did forget to mention that I'm not really hopeful of private Capex building up, even though interest rates are coming down, unless there is a clear visibility in terms of the tariff structures, the implications of that in terms of both the domestic sort of demand as well as the external demand.
Okay. So GDP growth likely to be better than last year. Inflation likely to be lower than last year, and that itself is a very positive trajectory. But private capex may not pick up. Is there anything else in the annual report that we should pay attention to? I mean, we have got very interesting trivia in terms of the number of frauds declining, but the amount of value of frauds are higher. There is such interesting trivia, but any other takeaway from the annual report?
No, possibly. I think I wouldn't want to comment on the frauds thing. It's very difficult to have read.
No, anything outside. I just meant key takeaways.
Yeah, so I think the key takeaways for me would be also, apart from the annual report, in terms of the overall projections and the direction of the economy that they are looking at. And this gives us confidence that given that the inflation is now below the 4% handle, and the RBI is also looking at household inflation expectations coming down, and a durable consolidation of inflation below the 4% handle. They possibly have a scope of going much deeper into the rate cut if that is needed, given the growth inflation dynamics that pans out through the year. So we are currently penciling it about 75 basis points, June, August, a pause maybe in October, and then one more last one in December is what we are penciling in at this point in time.
Okay.
The other interesting fact is the fact that the balance sheet size, the Reserve Bank's balance sheet size has grown at only 8.2%, which was growing at 11% last year. And that could also have its implication in terms of the domestic deposit cycle. So that's something that we need to sort of understand, because it also directly influences the reserve money growth. Yes, reserve money growth has become relatively better with all the durable liquidity infusion from the Reserve Bank of India. And we need to, and I think the Reserve Bank of India needs to take a call now whether they need to push up the balance sheet and the reserve money growth to facilitate growth beyond the rate cycle that they are anyways into.
Fair enough. We'll have to wait and watch. We will perhaps hear from the Reserve Bank on June 6th. Thank you very much, Indranil Pan, for your preliminary observations on the RBI annual report. Basically, a very strong word for the Indian economy. Worries, of course, global, and nothing new in that. I think it's more the trivia that are interesting, the amount of gold, the amount of frauds, and the fact that the Reserve Bank has kept this huge reserve, 7.5%. They have, 4.5 to 7.5 as the range. So in case they earn less from government securities because interest rate has cut, both in the US and in India, they can always make up by reducing the reserves. So it looks like it's prepared for a good year.
Okay, all right, Lata, thanks very much for that. We'll take a short break, but before we do that, just keep your eye out on the Bank Nifty, which is now down around 280 odd points, down around 0.5% as we speak. There is some pressure which is seeping into the banking stocks. We pointed out stocks such as Kotak Mahindra Bank as well as HDFC Bank, ICICI. All of these stocks are currently trading anywhere with a loss of around 0.5% to 1%. We'll take a short break, but we'll get you more on the markets as well as commodities on the other side. Stay tuned. Welcome back. Well, Bajaj Auto is expected to share their Q4 numbers today. Sudarshan is here with the details on what we can expect from the auto major.
We are expecting a steady set of earnings from Bajaj Auto. As far as revenue growth is concerned, it would be supported by healthy volumes, which have seen an increase of 4% year-on-year. Also, realization is expected to improve both year-on-year, also on a sequential basis, and it would be supported by better product mix. Now, talk about the headline numbers. Profit is seen rising 3%. Revenue may increase by 4%. It may come around rupees 11,995 crore. EBITDA too can increase by 4% to rupees 2,406, and margin may hold above 20% for 9th consecutive quarter. It may come in around 20.1%, same what company had reported in Q4 of FY24. Volumes were higher 4% year-on-year, but were down 10% sequentially. Realization is seen increasing 1% year-on-year and up 4% on a sequential basis. In the commentary, what exactly would be watching out for? First, what does company say about the domestic outlook? Because as of now, whichever companies have reported earnings, they believe that growth in FY26 is going to be at the similar level what the industry saw in FY25. Apart from the domestic, what would be important for Bajaj Auto is the export outlook, because Nigeria is a very important market for Bajaj Auto. So we'll have to see what does company say on export front. And lastly, about the outlook on EV, because the EV contribution in the last few months has seen a significant rise for Bajaj Auto. But as far as earnings are concerned, we are expecting a steady set.
Okay, steady set of numbers expected from Bajaj Auto. So watch out for that. Just watch out for a couple of these stocks. MMTC, for example, is up around 13% odd. Huge volumes traded on that one, which has picked up around 20% in terms of gains this week itself. Strides Pharma is doing well, so that stock is up around 9% odd. It's gained 18% this year. We also have a couple of other companies such as Supriya Life, which is up around 5% odd. And it's doing well in today's trading session. The guidance from the management was quite positive. They expect to maintain margins at around 33 or to 35% in the coming fiscal. And they are seeing, some kind of interest from global companies in terms of possible long-term contracts. But nonetheless, that's on Supriya Life. But separately, on the downside, just watch out for Orchid Pharma, because that one is lower today as well. And if you look at it on a week-to-date basis, just in the past 3 to 4 trading sessions, it's lost around 16% at current reckoning. So very weak performance coming in for Orchid Pharma. United Breweries is the other one, which is down around 2.5% odd. JM Financial is a bit under pressure. Polo Tires is down around 2% odd. And Tollens Tires also down around 1.7%. Not that much in terms of volumes for that one. Overall, the picture for the markets is consolidatory for the Nifty and the Midcap index. Bank Nifty obviously taking it a bit more on the chin at this point. We'll take a short break. Manisha Gupta joins in next. She's going to take us through what she's following in the commodity segment today.
Welcome back, and we're joined by Shubha Rawal. She's Director Procurement at IG International on the show now. Shubha, hi, thank you so much for joining in. When you look at the numbers, well, India holds a very strong position globally when it comes to horticulture. We are the second largest producers in sense of fruits and vegetables, and we only have seen the share increasing of horticulture within that agriculture space. How are you looking at the overall sector and the number in sense of growth now?
Horticulture has shown a great improvement if I compare it with the food grains. If I talk about numbers, the last numbers recorded were almost 355 million tons on just fresh produce, flowers and horticulture complete sector compared to the food grains, which is still 330 million. So I think the farmers here are getting better per acre returns on the fresh produce farming compared to grains. So they are moving towards the horticulture more.
Oh, well, absolutely. Those numbers are quite great. Also, Shubha, how would you look at the trends when it comes to India's export and imports? We do understand that India does lead in various fruit exports into the country. How is that pattern looking like?
See, imports are growing fairly well because of the seasonality in India. India is very strong on mangoes, as we know, the grapes, and the exports are rising. I think last year we exported almost 750,000 tons of fruits, which included your mangoes, pomegranates, grapes, bananas. And the imports have fairly increased, like from 500,000 tons, the import market on fresh produce has gone up to 900,000 tons. So there's a big shift, and this is very seasonal. Like we are importing more of apples and avocados and all other fruits, and less of the fruits that are grown in India. So yeah, it's rising every year, and this is clearly due to the demand that is increasing in India.
Well, absolutely. It's not just India demand that is increasing. Shobha, would you also say that there is an increase in India's exotic food production as well? I mean, there was a time we used to import a lot of avocados and dragon fruit and kiwis, but India's production itself seems to be increasing now.
Yeah, we are growing blueberries, as you rightly mentioned. We are almost second largest company in Asia to grow blueberries. But other than blueberries, the fact that I would like to highlight is the dragon fruit. Like dragon fruit is significantly increasing in last 5 years. The total acreage, if we talk about, has become 5x. So the dragon fruit is showing a great demand, followed by some avocados and kiwi fruit plantation in India.
All right, very interesting, all of those. And I do believe and I do hope that the prices can also come off the kind of highs that we're looking at for many of these organic exotic fruits there. But what's new at IG International? You're one of the biggest food producers, fruit importers into the country as well. What are the plans ahead?
The IG is very actively working on the back-end integration because we have our, front end quite sorted. But with the increase in demand, with all the quick commerce players who have come in, like Zepto, Blinkit, the increase in demand of fresh produce has increased quite a bit. So our main focus is to grow the back-end and plant more fruit, which is not readily available here, focus on more varieties, focus on yield per hectare, and, help farmers do better in India with the current given growing conditions. On the import side, I think we are very focused on the supply chain and reducing the carbon footprint focusing on origins which are not too far off, which hampers the sustainability factor. But we're working towards it, and we are working to enhance the capability to strengthen our supply chain.
Shobha, also weigh in on the tariff impact on the fresh produce, because that really seems to be impacting a lot of countries right now. Has that seen an impact on horticulture within India?
Tariffs on USA, if I have to particularly mention that the tariffs, since they have gone back, the imports from US have increased quite significantly. I mean, as you would remember that 2 years ago, it was 75%, went up to 50% as all other origin on apples. So they have been very active in the game, and now the imports from US is increasing. But the other fruit, I think apples is the same from all origins if we talk about, and like to name the other products as well. So obviously, if there is a reduction on tariffs, it will definitely help grow the demand better. But I don't think that it is happening in your future.
All right. Shobha, we'll wind down this conversation with a final question on the outlook for India's demand growth going forward for the sector.
On the imported side, if I talk about, the demand is definitely growing. Like I still remember sharing the last numbers a couple of years ago when we were at 500,000 tons, and now it's almost 1 million that we have reached. I mean, last year we recorded 900,000. This year, significantly, it has increased. We will know the numbers by end of the year. But with the climatic change happening, and Indian the produce being delayed, and all the damages that are happening in India, so they imported the demand and also the supply is increasing, and people are now from different countries focusing more on India.
Oh, well, absolutely. Shobha, thank you so much for joining in with that understanding on what the fruit market really looks like in India. So has doubled in last couple of years from 500,000 to almost 900,000 tons at this point in time in this year, with the final numbers still awaited. But with that, that's all the time that we have on Halftime Report. Business Lunch will take all the action ahead.
Stocks trade ranged after the US federal court scraps Liberation Day tariffs, but the Trump administration files an appeal. IT and metals notched some gains, while energy and auto drag. SEBI bars IndusInd Bank ex-CEO Sumant Katpalia, ex-Deputy CEO Arun, as well as Anil Rao, a member of the executive committee, and 2 others for insider trading. The naming of Anil Rao is a blow for the bank's current management structure. Max Life Insurance's MD Prashant Tripathi will retire early in September end. The sudden exit is seen as a near-term setback for the life insurer that recently came into the Axis fold. A US court scraps tariff imposed by Trump under the International Emergency Economic Power Act, calling it use unjustified. Even as Trump administration files an appeal, experts point to other sections under the tariffs and can be imposed, keeping the uncertainty alive. Elon Musk announces the end of his term as a special government employee, leading DOGE. This comes soon after the criticism of Trump's Big Beautiful Bill and follows demand on his time from Tesla's investors. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, slight bit of a recovery that we're seeing coming in the markets from the day's lowest point. We're seeing it flip-flopping between the red and the green is what the Nifty is doing. Look at it right now. It's come back to the green side. Is it going to sustain and go on and move forward? Is something to watch out for. Today is obviously the monthly expiry, so that is what we'll keep an eye out on. But as of now, the Nifty is at 24,760 levels, approximately around that mark. Broader end of the market, that continues to do well. The outperformance is continuing even today. So the smaller end of the market, the small cap, that specifically is doing very well, and mid-cap also very good recovery from the day's lowest point, up 0.2%, small cap up 0.5% in the trading session as well. Let's look at the bank Nifty. What is that doing? Because that is also under pressure, and that is causing some bit of a pressure on the overall market as well. So bank Nifty tried to make some bit of a recovery as of now from the day's lowest point, but still holding on to cuts of 0.3%. So that's how the market setup is looking like. We're seeing a lot of move coming in on the broader end of the market due to their earnings as well, and that's what, this is the last leg of the earning, so will be interesting to see where we are headed. But the most important thing that came out today in terms of the day was RBI's annual report that shows that central bank bought 57.5 tons of fresh gold last year, increasing its gold hoard by 78% to 879.58 tons. Fraud cases have fallen, but the value of money involved on the frauds have risen. Lata is joining in with us to give us some of these interesting takeaways that have come in from the RBI's annual report. Lata, over to you.
Okay, well, gold is always something we watch out for from the annual report, how much gold has the RBI bought. Its total value of gold that it holds has risen by 57.7% to 4.3 trillion rupees. Last year, it was 2.75 trillion rupees. The rise is largely because of the rise in the price of gold, but RBI has also bought more gold. It has bought 54 tons of more gold. So its total gold holding goes up by 7% to 879 tons. But this is not the highest. It's higher than last year. If you go to FY24, its total, it bought 28 tons of gold. FY23, it bought 34 tons, which is 4.6% higher. But FY22, it had bought a lot more gold, about 65 tons, and its gold holding went up by 9.3%. But still, 7% rise in gold is a 3-year high. The other point to note is the way in which the RBI balance sheet has been treated. If you remember, about a couple of weeks back, the RBI board met and said that they're raising the contingency reserve from earlier 5.5 to 6.5 to 4.5 to 7.5. They expanded it. Now, if the RBI has kept 7.5% of its total liabilities as reserves. If it had kept it at 6.5, that is the old number, then the total surplus to the government would have been 3.6 trillion rupees. But they have actually given only 2.7 trillion rupees because they had to put in additional 76,000 crores in the reserves because of the rise in the percentage. And this could be just smoothing out dividend so that they can pay more next year. But that's the important part, that they have reduced the potential surplus by increasing the reserve percentage. The other major point from the annual report is what they look at in terms of the economy. The global economy obviously is going to be the pain point. They are pointing to slower disinflation. Now, that is new. Until now, global economy was giving us disinflation, but RBI believes that this disinflation process will slow down. Maybe a little bit of inflation from the global economy. The high public debt, because all countries are indebted, geopolitical and trade tensions. These are the headwinds. Positive is the domestic economy, very resilient, growing consumption, continued capex push, strong balance sheets of banks and of corporates, liquidity higher, so easy financial conditions, and resilient. The services sector being resilient makes for a strong economy. The other important point they point out, because of good monsoons, chances of inflation remaining under 4% are a given. That's basically what you're getting from the Reserve Bank. Number of fraud cases have fallen, but the amount of fraud, amount of money involved in fraud cases actually risen, almost doubled to 36,000 crores. It was about 18,000 crores last year. Those are the key takeaways from the annual report.
Okay, Lata, thank you so much for that. Interesting highlights coming in from the RBI's annual report. Let's move on. And the SEBI has actually passed an interim order in the high-profile insider trading case involving key managerial personnel of IndusInd Bank, including the bank's former CEO and other senior executives. The regulator has barred 5 individuals from buying or selling securities and has frozen their bank accounts. Ritu is joining in with us to give us more details on this one. Ritu, over to you.
That's right, SEBI has passed an interim order against 5 senior executives, including former CEO Sumant Katpalia and former Deputy CEO Arun Khurana of IndusInd Bank, in an insider trading case where the regulator found that these individuals had sold shares of the bank while in possession of unpublished price-sensitive information, avoiding losses of nearly 20 crore rupees. Now, in the interim order, SEBI has frozen their bank and demat accounts to the extent of the losses avoided, barred them from trading in securities until further notice, and directed them to submit a full inventory of their assets. Now, together, SEBI says they avoided losses of 19.78 crore rupees, out of which 14.4 crores was by Arun Khurana alone and 5.2 crores by Sumant Katpalia. The others who have been named are Sushant Saurav, the head of Treasury Operations of the bank, Rohan Jatanna, the Senior Vice President of Global Markets, and Anil Rao, the Chief Administrative Officer, who notably is also part of the 2-member executive committee currently overseeing the operations of the bank in the absence of a CEO. Now, SEBI's investigation showed that senior management was aware of the discrepancies a good 15 months before they made the exchange disclosure, and not only their internal team, even external auditor KPMG had flagged the impact long before. Sumant Katpalia alone sold 1.25 lakh shares of IndusInd, while Arun Khurana offloaded about 3.5 lakh shares without making a single new share purchase in the period between December of 2023, when the management first found out about the discrepancies, and March of 2025, when the information was made public. Now, beyond the 5 executives named, SEBI is also investigating other suspects that it did not name. Questions are already swirling around the board's oversight and the auditor's role. And importantly, Anil Rao, who's part of the 2-member executive committee running the bank, is also named in this order, so we will probably see the committee getting revamped as well. Now, with the CEO and Deputy CEO already out, the story, of course, is far from over, and more heads may roll if insider trading charges stick.
Okay, Ritu, thank you so much for that. But let's move on the MSCI index rejig. Those changes will come into effect from tomorrow, 30th of May. Vivek is here to tell us what are the changes that we're expecting this time. Afternoon, Vivek.
Good afternoon. Well, MSCI earlier, this month had gone ahead and informed about the kind of changes that they would be making as part of the index review. Remember, 2 entries from India as far as this particular May index review is concerned. Coromandel and Nykaa will enter the MSCI Global Standard Index. So Coromandel tomorrow will see flows of close to $227 million, while Nykaa will see flows of a little over $180 million. These flows are as per IIFL capital estimates. But the more important news flow will be the fact that MSCI, like FTSE, has taken cognizance of the fact that the foreign ownership limit in Eternal, earlier known as Zomato, has now dropped to 49.5%. So MSCI has said that they will be reducing the weightage of Eternal in the MSCI standard indexes, and tomorrow is when that particular outflows too will be seen. Eternal is likely to see outflows in the range of $460 to $480 million in tomorrow's trading session. So that too continues to remain as a slight overhang as far as the stock of Eternal is concerned.
Okay, Vivek, thank you so much for that. We'll keep an eye out on all those names in tomorrow's trading session as well. But on that note, we're going to slip into a very short break. And before we slip into the break, we are excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m.
People talk about the Flipkart mafia and all the startups that came about. I think
you're part of the mafia.
I think it's the startup university. Still equal number of good decisions and bad decisions.
Yeah.
But the fact is that looking back, vision is always 2020. And I think we have that advantage building PhonePe after having seen the Flipkart journey.
I want to have the ability to look somebody in the eye and say that I have a clear path to profitability before I can say that I will IPO.
I think the business is in a good place, the org is in a good place, the sector is in a good place. If you're a market leader in a growth sector, I think it's a good time.
Who's the maverick and who's the goose, since we're talking about the
He's
wing?
the maverick.
He's the maverick.
You're both pointing at each other.
I think we have more conversations with each other than our wives.
You've known each other longer than you've known your wives, so it makes kind of makes sense.
That is true.
Investing.
Welcome back to Business Lunch on CNBC TV18. Now let's move on, and in a massive development which will have global ramifications, a US court has blocked President Donald Trump's tariffs. Here is what you need to know.
A U.S. federal trade court has blocked President Donald Trump's Liberation Day tariffs from going into effect. Wednesday's ruling from the Manhattan-based Court of International Trade said the president had overreached his authority. The court said Congress is empowered by the Constitution to regulate international commerce, and the president's use of emergency powers does not override that power. The Trump administration appealed the ruling within minutes. Trump had claimed broad authority in order to impose his tariffs in April. He cited an emergency powers law, the International Emergency Economic Powers Act, to set 10% duties on all imports. Countries with the highest U.S. trade deficits saw even higher rates, particularly China. The law has historically been used for sanctions against Washington's enemies, But Trump is the first US president to use it to impose tariffs, as he had argued the trade deficit was a national emergency. A 3-judge panel disagreed in Wednesday's ruling, saying, "The court does not pass upon the wisdom or likely effectiveness of the president's use of tariffs as leverage. That use is impermissible not because it is unwise or ineffective, but because federal law does not allow it." That ruling came after a pair of lawsuits. One was filed by the nonpartisan Liberty Justice Center on behalf of 5 small U.S. businesses. They ranged from a wine and spirits importer to a maker of musical instruments, all importing goods targeted by tariffs. The other lawsuit was brought by the Democratic Attorneys General of 13 U.S. states. The White House and lawyers for groups that sued did not immediately respond to requests for comment. Stephen Miller, a White House Deputy Chief of Staff and leading Trump advisor, said in a brief social media post, quote, "The judicial coup is out of control." Trump has said his tariffs are intended to restore U.S. manufacturing, but suspending, delaying, or raising them since his tariff decisions have sent shockwaves and uncertainty through financial markets. At least 5 other legal challenges to the tariffs are pending.
And taco seems to be the buzzword among international press, but Trump remains firm and clarifies he is not chickening out on trade. Listen in.
Isn't that nice? Chicken out. I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said you have to open up your whole country. And because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now. And I said, okay, I'll give you till July 9. I actually asked them, I said, what's the date? Because they weren't willing to meet. And after I did what I did, they said, we'll meet anytime you want. And we have an end date of July 9th. You call that chickening out? Because we have $14 trillion now invested, committed to investing. 6 months ago, this country was stone cold dead. We had a dead country. We had a country people didn't think it was going to survive, and you ask a nasty question like that. It's called negotiation.
And earlier today, we also spoke to Ed Yardeni, president of Yardeni Research, as well as Arvind Sanger, managing partner at Geosphere Capital Management, to discuss U.S. trade court order. Listen in to what they had to say on this front.
It's a very messy situation for sure. Why would any country now want to proceed with negotiating with the administration when the court just questioned whether the tariffs have any constitutional right to exist in the first place? But I think everybody knows that there's no way that you can negotiate a trade treaty in 90 days. I think we're still going to get some letters of agreement between us and our major trading partners on continuing to negotiate fair trade deals. So I think there'll be a lot of face saving going on, and I think the president is basically going to declare victory and try to put this whole thing behind him by the middle to the end of the summer.
A lot of the court cases that have gone against Trump have been local jurisdictions putting national claim, and there is a case in front of the Supreme Court claiming that these local courts shouldn't have jurisdiction to stop anything nationally. This is the International Trade Court. There is no claim that they don't have jurisdiction on trade. Now, it's not a jurisdiction question, which Trump is arguing against the Supreme Court on other cases. This is really a question of whether the court ruled incorrectly or not, and that's going to be a harder case to overturn because these guys are specialists on international trade law. Doesn't mean it can't be overturned, but I think that it looks to me like this is going to be, again, I'm no legal expert, but it looks like just from the logic standpoint, it seems like what they said makes complete logical sense, and it's going to be a tough one for Trump to overturn.
Okay, on that note, we're going to slip into a very short break, and here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to Business Lunch on CNBC TV18. Now, staying with the U.S., Marco Rubio, U.S. Secretary of State, has announced that Trump administration will work aggressively to revoke visas for Chinese students. The visas will be cancelled for those students who have connections to the Chinese Communist Party or are enrolled in the critical fields. Rubio also said that the U.S. State Department is revising the visa criteria to enhance scrutiny of all future applicants from China and Hong Kong. Here is what the U.S. President Donald Trump had to say on this front.
We want to know where those students come. Are they troublemakers? What countries do they come? And we're not going to, if somebody is coming from a certain country and they're 100% fine, which I hope most of them are, but many of them won't be, you're going to see some very radical people. They're taking people from areas of the world that are very radicalized, and we don't want them making trouble in our country. These countries aren't helping us. They're not investing in Harvard and all of our, we are. So why would 31%, why would a number so big? I think, number one, I think they should have a cap of maybe around 15%, not 31%. We have people who want to go to Harvard and other schools. They can't get in because we have foreign students there. But I want to make sure that the foreign students are people that can love our country. We don't want to see shopping centers exploding. We don't want to see the kind of riots that you had. And I'll tell you what, many of those students didn't go anywhere. Many of those students were troublemakers.
And another development within the Trump administration, billionaire Elon Musk has quit the administration months after he joined the newly created Department of Government Efficiency in a bid to cut huge U.S. deficit. Watch the next report.
Elon Musk is leaving his role in government. A White House official confirmed the move late Wednesday, saying the billionaire's offboarding would begin the same night. The exit caps a tumultuous period since U.S. President Donald Trump returned to power, vowing to give Musk a big job.
And to that end, I have created the brand new Department of Government Efficiency, DOGE. Perhaps you've heard of it, perhaps. Which is headed by Elon Musk, who is in the gallery tonight.
Musk set out to slash government spending, saying in March he could cut at least $1 trillion off federal expenditures.
If we don't do something about this deficit, the country's going bankrupt.
But DOGE attracted huge controversy, with critics saying it was making indiscriminate cuts that threatened vital services without even delivering the promised savings. Many were also angered by the resulting wave of job losses, with some 260,000 roles cut from the federal workforce. The controversy may also have done deep harm to some of Musk's businesses. Tesla sales have slumped in some markets, notably Europe, amid anger over his embrace of far-right politics in some countries.
Some investors have also been concerned that Musk simply had too many roles and wasn't spending enough time at his various firms.
You know, they say I wear a lot of hats. It's true. Even my hat has a hat.
Among the worries Musk faces are an aging model lineup at Tesla and a series of failed launches at rocket company SpaceX. Now he says he'll devote himself to business again and says his firms will be revived with world-changing products, including humanoid robots and robotaxis. Signs of a possible rift with Trump had been apparent in recent days. On Tuesday, Musk criticized the president's big tax bill, saying it was too expensive and undermined DOGE's efforts to trim the budget deficit. However, in a post on X, Musk thanked Trump for his time in government. He said the DOGE mission would continue and only strengthen over time.
And with that, we're absolutely out of time on this edition of Business Lunch, leaving the Nifty at where we started the show with. But don't go anywhere. You have Midcap Radar up next, which will take you through more market actions after this break.
Good afternoon and welcome to Midcap Radar live from the CNBC TV18 Motilal Oswal studio. I am Vamakshi Doria and with me is Vivek Iyer. Good afternoon to you, Vivek. But you know, when we started off the day, it was a good start. Unfortunately, we are not where we thought we would be today. The Midcap end of the market, though, holding up well.
That's right. Good afternoon, Vamakshi. Remember, it's expiry day, a couple of hours. Rolls going on quite strongly is what we gather, especially as far as derivatives are concerned. So overall, but still, we are managing to hold out with 0.25% of a gain. We have quite a lot lined up on the show, a couple of managements as well. So let's start off with the top headlines. Stocks continue to trade range amidst uncertainty over Trump's tariffs. IT and metals notched some gains, while energy and auto drag midcaps relatively outperform.
A U.S. court scraps tariffs imposed by Trump under the International Emergency Economic Power Act, calling its use unjustified. Even as the Trump administration files an appeal, experts point to other sections under which tariffs can be imposed, keeping the uncertainty alive.
Welspun Corp gains after reporting a strong set of Q4 numbers. EBITDA is at a 5-quarter high and the order book is at 19,553 crore. The company also announced new greenfield facility in US with an investment of $125 million.
Deepak Nitrite rallies after a better than expected fourth quarter. Margins expand 150 basis points while the phenolics business drives revenue growth. Management says domestic demand showed early signs of recovery.
Cummins India trades with gains on the back of its fourth quarter numbers. Revenue grows 6% on a year-on-year basis. The company also has met its double-digit growth guidance for FY25.
Well, 24,761 thereabouts is where the Nifty is at. Of course, we've seen some bit of recovery coming from the day's lowest point, but we're still about 100 points or so off the day's high. As far as the mid-cap end of the market is, what it's doing, it's actually up almost 0.3%. The advanced decline ratio has now moved in slightly in favor of the declines. Let's also look at what the sectoral indices are doing this afternoon. It's the metal index that is leading the gains. We have obviously Welspun Corp in focus after the company reported its EBITDA, which was at a 5-quarter high. Jindal Stainless as well is seeing a good session today after Jefferies has initiated a note on the company with a buy rating target price of 800, and Vedanta also some relief coming in from the NCLAT. That stock is also seeing an uptick. But we have a lot of movers in the mid-cap end of the market, and we have our special segment, Mid-Cap Movers. Hormas is across the world to take us through the mid-caps that are moving around in trade. Good afternoon, Hormas.
Good afternoon, Amakshi, and it's almost anticlimactic, right? When you are expecting an action-packed day, it hasn't transpired so far, but never say never. You still have the second half of the day coming. But we start off with some of the losers then in the broader markets. There aren't many, but there are some of them. Electra Greentech continuing to grind lower, 4% lower on that stock. Poly Medicure, Nugent Software also trading lower with losses of close to 3%. But there are earnings reactions where there are some losers as we speak, and Bharat Rasayan is one of them. Has recovered from the low slightly, but still 7% lower. Cummins India, after a very strong earnings call, is up 7%. Welspun Corp, multiple internals that were positive, as Nigel has been highlighting through the day, 9% higher there. And Avanti Feeds, off the highs of the day, still holding on to gains of around 3%. Realty is seeing some buying in today's session after a very interesting note from Morgan Stanley, where it has upgraded stocks like Prestige Estates and DLF, both of them at the highest point of the day. Prestige, in fact, will even report results today. And Anantraj is at the highest point of the day too, 5.5% higher here. On the stocks, on the volumes front, if we take a look at those names, then you'll have Castrol, of course, the Bloomberg story that was earlier in the day about a potential stake sale. Asahi India and Deepak Nitrite too, trading with gains of anywhere between 4.5% to 6% on very strong volumes. And lastly, some stocks that are bucking the trend, if you could call it that, in today's trading session in some of the gainers. MMTC continues to move higher. Vari Energies has just received an order which is around about 1,500 crore rupees, which is around a 6.5% gain here. HEG and ITI too building on to the gains that they have seen earlier in the week. Back to you guys.
Thank you so much, Hormas, for joining us and giving us a sense of how exactly stocks are moving as far as the broader end of the markets are concerned. Well, as we now slip into a short break, we are excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in into CNBC TV18 Prime at 12 noon for the Global Reset and the Global Lens at 8:30 p.m.
Welcome back. You're watching Midcap Radar on CNBC TV18. Let's pull up the chart for HEG as well as Graphite. Both of these companies are electrode makers, and in today's trading session, they're trading with good gains. When you look at HEG, it is up almost 6%. Graphite is trading with a gain of almost 4.6%. But, we have a management lined up on the show. Insecticides India is in focus. The stock is gaining in trade after reporting a good set of Q4 numbers. Revenue surged by 31% and margin came in quite healthy. Management expects to launch at least 6 more products this year. To discuss this and more, we now have Mr. Rajesh Agarwal, who is the Managing Director at Insecticides India, joining us. Mr. Agarwal, good afternoon. This is Vamakshi. Thank you so much for joining in with us. I'd first like to start off by asking you about the kind of growth guidance that you have for FY26. You've given a double-digit growth guidance. Now, you only managed to grow the top line by 2% this year. What gives you the kind of confidence that you will be able to achieve this double-digit growth guidance?
If we talk about 25, it was a very disturbed year. The rainfalls were very erratic. Number one. Number two, we had a lot of launches. Like if you see, we had about 12 launches which happened in the last fiscal. But all these launches came almost at the fag end of the season. So we did not get the time to establish these products, but the response for these products is very nice. So much so that our largest range, which is we call it Focus Maratna. So these are the products which sells in large volumes, and they are the premium products for the company. So we are adding from last year introduction 4 products to the FM range, which means they are going to be the star products for this year. And we are launching 6 new products. They are also very interesting molecules. So we are very, very confident that this year we should be able to register the top line growth as well as the bottom line growth.
Sure, and the double-digit growth, this is now a very broad range. So could you narrow it down for us? Would we expect maybe, say, high teens or would it be early teens kind of double-digit growth that you're factoring?
Like when I have to give the projection, I'll always say 10% should be good actually. So it will be 10% plus. So now let's look at the season and the achievements. So since last year has been very subtle growth, so I don't want to give very aggressive numbers. So we'll retain with 10% plus or lower teens or whatever you may say. And let's see the future.
Okay, Mr. Agarwal, let's talk about some of the partnerships that you have with a few multinational corporations. You have partnerships with Nissan, OAT, Agrio, as well as Momentive. Especially when it comes to Nissan, we understand that it's almost 1/4 of the top line. So how's the partnership progressing? What has been the kind of launch pipeline as far as new molecules are concerned? And what has been the response, especially in that particular segment? FY26 onwards, what will be the contribution from Nissan and the other 2 large partnerships?
Nissan is a very important partnership we have. We have lost almost half a dozen products from Nissan's stable, and many of them are still patented. And they are number 1 products in my segment. Like if I talk about Shinva is the top product in my segment and giving us the gross revenue of more than 150 crores, followed by Hachiman, which again from the stable of Nissan. It's doing very good. Almost 70-80 crores of revenue comes from Hachiman. And then there are lots of products actually which are doing very good. Pulsar being another 50 crore product. Then we have Izuki. So all the products from Nissan are doing good actually. And now we are introducing Altair, which is a new rice herbicide. So yes, this year is, since it's a start year and it's a little expensive molecule, which is going to control the weeds, which are very difficult weed to control, and the farmer has to invest a lot of money in doing the manual weeding, and he spends about 4,000 to 5,000 rupees per acre in doing this manual weeding after using the multiple sprays of the chemicals. So we are going to eradicate those weeds with this product. So I'm very, very confident that this should turn out to be a very good product, particularly for the areas where the weed population is very high and water availability is little limited. So these are the areas of central India, eastern part of the country and southern part of the country. So we are going to go very aggressive here.
Mr. Agarwal, can you quantify the opportunity for us, the contribution, as far as FY26 is concerned from these molecules?
This year we'll go subtle. We'll go with a target of about 15 crores in mind, but we'll be multiplying it by at least 2 or 3 in the next fiscal.
Sure, and you managed to achieve your EBITDA margin guidance of double digits. So EBITDA margin at the end of FY25 stood at 11.1% with these new launches that you're doing, along with the products that you launched last year, which were not able to ramp up last year. This year, what is your EBITDA margin guidance?
So guidance will be the double-digit guidance, but it will improve further. Because of this, the entire growth, what we are projecting is going to come in 26 is going to be from Focus Maharatna and Maharatna products, which means that the profitability is going to be better and will surpass the last year. In terms
And
of
how much better would that be?
I don't want to give the numbers again, but we'll surpass those numbers and first quarter will be evident.
Mr. Agarwal, if we understand, you classify your products into three categories, the Focus Maharatna, the gold as well as the silver. Now, when you're talking about, the first category, which is the Focus Maharatna and Maharatna, almost 50% of the total top line is coming from this particular segment. We understand that is also a higher margin segment. Going forward, what is the ideal mix for you? Are you looking to ramp up the contribution to the top line from these two categories themselves? And what is the visibility that you see?
Yeah, definitely. That is our vision, actually. We want to take it to 70%, but it will take 3 to 4 years.
And the timeline? Yeah.
And 3 to 4 years from here. So we have already achieved 61% in this fiscal and we'll be improving it further in this FY26. So we should be able to improve it by 2 to 3% actually from here. 61 to 63, 4, we should be able to do actually this year.
Sure, and when I look at your working capital days, they have actually gone up to 122 this year as compared to 109 last year. So when do you expect this to normalize? And, how much reduction can we expect in the working capital in FY26?
Actually, the inventory increased a little at the end of the year because it was a strategic move because we had to introduce a lot of products and we were also starting up the new plant. So we had to arrange for the raw materials. It increased little extra. I know that, and we are working on that, and we have already started working on economizing everywhere actually and improve the efficiencies, particularly in the working capital, in the inventories, in the projects, everywhere we are working. And the good news is like we are getting the permission for starting the Dahej plant, which was long overdue. So we are going to start that plant also from the month of June. So things will improve. You will see some improvement happening in Q1 itself. And I think by Q2, end of Q2, by August, we'll normalize 100%.
Understood that. Currently, in terms of capacity, do you have sufficient capacity on stream? What is the current capacity utilization levels at various facilities? And plans to ramp up any Capex plans?
Yes, Capex plans are always there at Insecticide India. We have just completed our expansion at Dahej, and still there are some small things which are in process. So for the current fiscal, we are targeting the expansion at Sotanala, Rajasthan, where we are going to spend 100 crore rupees in our expansions. Majority of it is going to go in Sotanala, and then there is some small maintenance Capex which is going to go across the plants. So at the moment, we are 100% utilized because we are under pressure. The rains have started before time. The pre-monsoon showers are good. The expectation from the market is very good. Huge demand for herbicides, and it is very difficult to meet out that demand at this moment. So the plants are working day and night, 24/7 at full capacity.
Sure, and you were also looking at registrations in the US and other countries, if I'm not wrong. So by when will you be completing these, and what is the opportunity size that is there for you? And the export contribution currently very minuscule, 5%. Where does it go?
Insecticide India is basically a domestic market company, but we are investing a lot on the registrations. So we'll start our America business this year. So expected, like the trial quantities are going to go in this quarter itself. And after this, the success of the trials, then we'll start it commercially. So I don't want to give big figures for the international business, though we are going to start some business in Japan, some business in America, some business in some other countries. So, but still, like our guidance of 200 crores, which is there for last 2 years, we are not able to reach there in exports. We are going to keep it same. So, though my team is little jittery with 200 also, but we'll keep it at 200 crores because I don't want to downsize my target of exports. But I'm very, very confident that we'll be meeting it with the domestic sales, whatever are the gaps. And in totality, company will have a 10% gain. And of course, we are investing a lot on these registrations and expect a good success out of it. Though the timeline, it may, if we don't achieve 100% in this year for the export business, then export business will cross 200 crores in the next fiscal for sure. That I'm confident.
All right. Thank you so much for that, Mr. Agarwal. Wish you luck for the year ahead. But as we slip into a very short break, here is some good news for our viewers. India's business news leader is now only a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back to Midcap Radar. Well, let's shift focus to Enviro Infra Engineering. The company reported their Q4 numbers. Their consolidated revenue surged over 30%, while EBITDA rose 12% on a year-on-year basis. Manish Jain, who's the managing director at Enviro Infra Engineers, joins us now to discuss this and other things as far as FY26 outlook is concerned. Thank you so much for joining us, sir. First up, when we met last time around, you gave us a guidance of for FY25 to be slightly northwards of 1,000 crore. You've gone ahead and achieved that, almost a 5 to 6% beat as far as your own guidance was concerned. Now, going into FY26 with the order book in hand, what is it that you can guide the street towards in terms of top line, in terms of EBITDA, margins, as well as bottom line?
Good afternoon, and thanks a lot for having me on the show. I'm glad to inform that the numbers which we could foresee in our last meeting, we have been able to outdo those numbers. Our top line has been 1,066 crores. Our margins are still better because we had given a guidance of 22 to 24% EBITDA margins. We have been able to achieve EBITDA margins of more than 25%. And then our PAT margins are also better. These are at 16% plus. So the profitability is 177 crores for the entire financial year FY25. Going ahead, our order book present is 1,180 crores. We have bagged another 200 crore worth of orders in the current financial year. On the positive side, we have submitted bids for around 5,000 crore plus projects. So we are having a good success ratio of more than 40%. Still, if we see a conservative success ratio of around 20 to 25%, so we can have a good order inflow into the company. We foresee an order book of around 2,500 to 3,000 odd crore coming into the company in this current financial year. So on the basis of this new bids which we have submitted, the order inflow which we expect, we maintain the guidance of around 35 to 40 odd percentage growth in the company for the current financial year as well, along with the profitability margins that we peg at 22 to 24% EBITDA margins. So we maintain the same growth. We'll continue with this.
Sure. And when we look at your margins, then you're expecting a much lower margin as compared to what you've posted this time around, right? Because this year you've managed to post 25% margins. So you're saying that will not sustain going forward?
No.
And what would be the
Our guidance for the margins have ever been 22 to 24%. We have been able to achieve those numbers, still better numbers in current financial year, and definitely we look forward to achieving similar type of margins in future as well. So the guidance factor that will always be in the range of 22 to 24% EBITDA margins. So this is how the efficiencies that get derived, we have been able to achieve still better what we can foresee.
Okay. The other thing we want to understand from you, Mr. Jain, is that especially when it comes to the water segment, and a whole host of other players, have gone ahead and flagged off this particular concern, is the issue of receivables. We understand that you two currently are facing this particular issue. So what is the on-ground scenario? Are there worries, especially in terms of receivables that you're getting? And are there any delays when it comes to execution?
If you see the cash flow statement of the company, there has been a significant improvement. From a cash flow of minus 80 crore pre-tax of cash flow from operations, it has turned positive. And now we are around 25 crore cash flow positive, cash flow from operations pre-tax. So that says that there has been a substantial improvement and the cash flow position is substantially improved in the company. It is right that there has been some cash flow issues in the JJM projects in this current financial year. However, we were operating in other segments as well, wherein under Amrut 2 and Namami Gange, we were executing a number of projects. So we could fairly make up for the cash flow shortfall from the JJM projects. The cash flow position from JJM also improved in the month of January, February, March. So it has the cash flow position of the company, it has improved significantly. If I say there were some funds which were released on 4th or 5th of April, rather I will say these funds were to be released by 31st March. So these got delayed by maybe for 3-4 days. If we just compilate these numbers, so you can just conclude that we are OCF positive. So that way we have been fairly comfortable. The funds flow have been comfortable in the company for all the projects wherein we were executing. And the similar condition seems to be there because government is proactive and the funds are getting released in the projects.
Right. Mr. Jain, very quickly, order inflow guidance, number one, private versus PSU, and number two, export opportunities, especially we understand you're looking at orders coming in from Saudi. Can you quantify it as well?
Basically, our order book currently is from the government projects, from the various government initiatives. It is basically under JJM, Amrut 2 and Namami Gange.
Right.
I give the order split right now under JJM. My current order book is around 175 odd crores. Rest of the projects are under Amrut and Namami Gange. So there the fund realization was better even in the last financial year. Now coming to the these around 200 crore odd projects which we have backed in this current financial year, they are again these sewage treatment plants and one water treatment plant, which is around 70 crores. So that way our order book is more inclined towards the WWTP projects, which is sewage treatment plants and common effluent treatment plants. So going forward, we are the projects which we have submitted our bids. These are again more under this Amrut 2 and Namami Gange. We are not bidding in JJM. So the orders inflow are expected to be in the range of around 1,200 to 1,500 crore from our current bids which we have submitted. And going forward on a quarter-on-quarter basis, we can expect that yes, we can close this particular financial year with an additional order book of somewhere in the range of 2,500 to 3,000 odd crore.
Understood that. Lastly, unbilled revenues, we understand that was close to almost 25% of the total operating revenue. Where does that stand currently?
The overall unbilled revenue position in our books is 265 crores. And if I calculate in the number of days, it comes out to 91 days. So a guidance of somewhere around 90 days of the unbilled revenue, it can be there in the books. And I think we are pretty comfortable on this.
Sure. Thank you so much, Mr. Jain, for joining us and giving us some perspective on how your numbers were and what is the outlook going forward. So that was the management of Enviro Infra. As of now, the stock is trading with a gain of nearly 0.4%. But let's also focus in on some industrial stocks. You know, GE Vernova, this stock, Vivek, has been doing exceptionally well throughout this week. In fact, this week itself, that stock is up almost 23%. Hitachi Energy also has managed to hit an all-time high. Week to date, it is up almost 10%. Other stocks that are moving around in trade include Kirloskar Oil as well as Transformers and Rectifiers India. But with that, that's all we have on this edition of Midcap Radar. Don't go anywhere because MF Corner comes up next.
Hello, good afternoon. You've tuned into MF Corner, coming live from CNBC TV18. I'm Vinny Motiwala. Thank you so much for tuning in, as always. Now, index funds. We've spoken about what are index funds. You're all very excited about it. And this is the new favorite that's become in the town. It's low cost, passive and promising market returns. But the question comes in that investors are asking now that how many is more than enough in terms of an index fund? While in October 2024, sometime you had seen that index fund reach those highs of around 7,000 crores, 7,900 crores in terms of index funds. And there was somewhere in Jan 2025, it was at 5,254 crores, the investment that came in for index funds. And this is according to the AMFI data. We've seen a bit of a tapering off coming in, but still, index fund is the flavor. Everyone is looking at passive investing. So how much is too much of index fund as well? What's the smart strategy to build an efficient, clutter-free mutual fund portfolio? Let's decode all of this with Udyan Adhya, the founder of Udyan on Money. Udyan, thank you so much for joining in with us, and a very good afternoon to you. Udyan, this is a very pertinent question right now, that given that there is a growing variety of index funds, whether you say factor-based, sectoral, international, how should investors decide which type of these funds, index funds, is genuinely something that will add value to your portfolio?
Good afternoon, Vinny, and all the viewers. Thank you so much for having me. Always wonderful to be back at CNBC. So I think the entire idea of index funds, right, is to simplify your investments, right? Because you don't want to try to look for a mutual fund manager or a mutual fund that has its own investment philosophy, or that is trying to do something different. The idea of index funds is to invest passively, as you said earlier, is to have a very hands-off approach. You're essentially investing in one entire category of stocks or one entire category of securities. So with all these different types of index funds that have come in, whether it's a sectoral index fund, whether it's factor-based index funds, that have complicated just the process of index fund investing. Having said all of that, right, for all practical purposes, anyone investing, no matter where they are in their life, no matter what their goals are, if you're investing for over, say, a 4 or 5 year period for an equity-oriented portfolio, just having pure index funds will help you achieve the various goals you have. They're multi-purpose, and very specifically, all you essentially need if you are a very hands-off investor is to have a Nifty 50 index fund. Just one index fund will help you, build that long-term wealth. But at the same time, sticking to only one fund, whether it's an index fund, whether it's an actively managed fund, is difficult, right? Because our human mind is always trying to look for something better. So in that case, a large cap index fund, a mid cap index fund, a small cap index fund will basically give you exposure to most of the activity, most of the returns that are happening in the stock market.
Okay. Udyan, what are the main risks also that come in of holding too many index funds? And how can investors assess this if their portfolio is over-diversified into this situation?
So one common sort of problem I see in most portfolio constructions that have index funds, and this is either with prospects or even with clients before we start working with them, is something very specific. And I'll give you a very straightforward example. So let's say someone is investing in 4 different types of funds, right? Now, there's always a very high chance that if they're only investing in index funds, that's going to be a Nifty 50 index fund. That's going to be a Nifty Next 50 index fund, maybe a Nifty 100 index fund, and a Nifty Large Midcap 250 index fund. Now, for anyone not well versed with index fund nomenclature, this can get complicated, but what it essentially means is the Nifty 50 is India's top 50 companies. Next 50 big companies after that. The Nifty 100, essentially the same 100 top companies, right? So you straight away start noticing that even though you're owning multiple index funds, even though you have multiple different types of funds, they're actually buying the same stocks. So you may think that you're diversifying. You may think that, okay, this is reducing the risk in our portfolio, but it's like, you're having 4 different glasses of water, but one is yellow colored, one is blue colored because some color has been added to it. But at the end of the day, all that you're having is still water, right? Even though you have 4 different glasses. So that's one mistake that I see happening all the time, where people think they have diversified, but actually they're just investing in the same stocks at the end of the day.
Okay. I know you did mention that, Nifty Index Fund, Nifty Midcap Fund also is something that you can look at. what is the right mix in terms of index funds that they could invest in terms of the right balance that one could have, simply put, as well as how much is too much? You know, when does it become a bad investment also? So number that he could have, which type in terms of index funds? What is your suggestion there?
So I am index fund biased when it comes to the large cap category. So all your large cap exposure can essentially be through just index fund. So it could, let's say, be the Nifty50 or the Nifty100 index fund, right? Which gives you access to India's largest companies. Then when you get to the mid and small cap categories, I personally prefer having actively managed funds there. So when you're looking at a portfolio construction, ideally, I would say a 5 to 6 fund portfolio is going to be more than enough for you to access different parts of the market without investing in the same place. Because the moment you get to a number higher than that, you're going to end up owning the same stocks. So in that 5-6 fund portfolio, I would personally lean towards having 2 index funds specifically. One is the Nifty50 or the Nifty100, as I said. And the second could be a momentum index fund in the mid-cap space. Okay. So there's a momentum mid-cap index called the Nifty150 mid-cap momentum 50 index, which essentially means that in the 150 mid-cap stocks that are available in India, the 50 with the highest momentum are a part of that fund. Now, the reason this mix sort of, according to me, makes sense, we construct portfolios for clients also using a similar-ish mix, is because the momentum style of investing is not readily available in many actively managed funds today. There are funds that follow it, but those are fewer in number than, let's say, quality, value, or growth style of investing. So by having this very strategic mid-cap momentum allocation through an index fund, by having a large cap index fund, I think that is more than enough when it comes to index fund investing.
Okay, and any thing that, you know, there are a lot of options also, there are a lot of fund houses. So why should you pick up one over the other, right? Because it's mirroring the Nifty50 or the Nifty Midcap or any sort of an index that you would pick up. So which one is the best one, and what is a checklist in terms of picking these 2 funds that you would say also?
So when it comes to index fund selection, honestly speaking, one index fund is not very different from the other. Yes, if you really drill down into the very absolute numbers, there will be a difference of about 0.1 to 0.2, 0.25% returns every year because of just how they are managed. But honestly speaking, just go with a good brand pedigree. So the names that you recognize, just go with an index fund offered by them. If you want to get very technical, right, then you want to look at the tracking error or the tracking difference. And then you want to look at the expense ratio of the funds. Because think about it this way, right? Let's say the index, let's say Nifty50 has given 10% returns. But to manage the fund, the mutual fund house that is floating that index fund is going to charge you some money, right? They have to still run a business. So let's say that is, instead of now getting 10% after fees, you're getting 9.9%. And when the fund manager is trying to replicate what is happening in the Nifty50, which is the idea of an index fund, there's going to be some error or there's some difference in the allocation that they're trying to match. So even that can eat into return. So that is, let's say, 0.1% once again. So while the index has returned 10%, right, your fund has returned 0.1% negative across 2 parameters. So the total return is going to be 9.8%. So again, this can get complicated. There's a wonderful website called Index Fund Insights. It's based on an open source GitHub repo. Check it out. It basically, you select an index and it tells you which are the lowest total expense ratio, total, what is the difference, what is the tracking difference, and what is the total expense it costs you in total.
Okay, thanks for that. Surely we'll look into the site, and viewers, you all can also look in to the site as well and get a better hand on what you're investing in and how you could go about it as well. But, you know, Udyan, how should one actually, and is it possible that I could invest in different asset classes using index funds without causing some bit of an overlap in terms of different asset classes? Is it a possibility for an investor? And how should one go about it?
There is a possibility. Having said that, I personally lean towards actively managed fund for, say, a multi-asset allocation, primarily because these funds have been in existence for a very long time. Like 2 funds that come straight to my mind, and these are not recommendations, are the ICICI Prudential Multi-Asset Fund, for example, or the HDFC Multi-Asset Fund, right? Very old funds, big pedigree names. So I personally prefer having allocation into these other categories, personally through actively managed funds. There are very few index funds that are tracking different multi-asset categories or there are very few ETFs that track this. So I just personally lean towards actively managed for all these categories.
Okay, actively managed obviously is better if you want to invest in different asset classes. There is an option, but actively managed would give you better returns as well. Udyan, what about how often actually am I supposed to review my passive portfolio as well? Or when you're holding these index funds, what is it in terms of a rebalancing, or how should one look at this situation?
So in terms of whether you should change your fund, with passive investing, the entire idea is you are investing in index funds because you don't want to keep changing your fund, right? Because you're investing in just one category. Or let's say when you invest in Nifty50, you are investing in basically a large part of the entire Indian stock market, right? Because of the 50 largest companies being a part of the Nifty50. So if it comes to changing index funds, I am not in favor of it. Because once you invest in an index fund, just stick through with it for as long as you're basically investing for that particular goal. The one reason you may want to review your portfolio when it has index fund is rebalancing, like you said. So rebalancing essentially means, let's say you start off with, let's keep it simple, 100 rupees you're investing, 50 rupees in the Nifty50 and 50 rupees in the Midcap index. That's the Nifty 150 Midcap index. Now, over a 3-year period, the mid-cap space and the large-cap space would move at different paces, right? And let's say now, 3 years down the line, your portfolio has grown to 150 rupees. And now out of that, your original allocation was 50-50, right? But now let's say mid-cap has done better. So mid-cap now forms not 75 rupees, but now 90 rupees of your portfolio. So at that time, just from a mental sanity perspective, because we always like to book some profit as investors, it keeps us happy, it keeps us invested, which is the most important part. Then in that case, it makes sense to just book some of the profit from the mid-cap space and invest it in the large-cap space. This is also a wonderful habit because everything is cyclical in the market. So, and there's enough evidence out there to actually observe that at the end of every market cycle, right, let's say over a 7-8 year period, the returns of large, mid, and small cap, they actually converge, right? So, so if you're rebalancing, then at every stage, you are basically looking after some of your profit and you're buying into something that is not perhaps doing well. And because it's cyclical, it is likely to do well in the future as well.
Okay, surely. Then we'll keep an eye out on that. But, just one word, if you're to round all of this up, what is the checklist that I should keep when I'm investing in passive investing, in index fund investing? What should I be doing there?
So I would give you 2 words. I feel I'll give you 2 points, rather 2 words you put me in the spot, Vinny. So one is purely from a numbers perspective, we look at the tracking difference and the expense ratio if you're selecting an index fund. And secondly, see how it fits your portfolio. So if you're already investing in a large cap fund and you're investing in a Nifty50 index fund, they're investing in the same place. So it doesn't matter. You're not diversifying. You're just using 2 funds to invest in the same place. So identify where your fund is actively managed fund is investing. The easiest way to do this is go to perplexity.ai and put in your fund name, right? Whatever that is. Let's say HDFC top 100 fund, and ask what investing style is it? Where is it investing? It will tell you exactly.
Okay. Okay, Udyan, thanks for that view coming in there. But on that note, viewers, we're going to slip into a very short break. And after the break, we'll talk about mutual fund growth in B30 as well as T30 cities. So stay tuned in for that.
investing.
Welcome back to MF Corner on CNBC TV18. Now, mutual fund investments are experiencing a surge, largely mainly driven by investors in B30 cities, which are areas beyond the top 30 cities in India. These smaller cities are witnessing a faster adoption of mutual funds, especially equity-linked investments compared to larger T30 cities that we are seeing. Now, to know more about this, is this trend something that will sustain as well? We have the Choti SIP that is coming in. We'll be discussing all of this with Udyan as well. Udyan, thank you so much for staying on with us as well. And, you know, since the last couple of years, the growth that one has seen coming in, especially for B30 cities, has been phenomenal in terms of the growth there. So this shows that investment community surely, is moving just beyond the major cities. Are there any new regions or states within which B30 cities are emerging as a significant contributor, especially in terms of mutual fund growth?
So B30 has seen a surge in the growth that is taking place, in how much they are now contributing, the rate at which their contributions to the Indian total AUM that is accumulating, it's just phenomenal. A few states that pop up are Telangana and Haryana. Then in terms of cities, you have Cochin that is also seeing a big surge. It's very exciting to see, because when investment education translating into actual investments starts happening outside of the biggest centers in India, that is when you know that there's a big wave of just very good things happening in the entire investment space.
Okay, surely it's interesting, there's that big wave that is happening. So how has investor actually in passive funds evolved in these B30 cities? Have we seen that also coming in? Because that means that they're not just here for the short returns. They are looking for those long term as well. And what are the trends that you have seen?
So one very interesting trend that is observable in B30 cities is that almost 2/3 of investors are essentially investing in just one fund house and one scheme, which is very interesting, because that kind of shows you a trend where they are putting in money, and it's also very equity heavy. There's very little money going into other categories, other asset classes. So that is again very interesting, because as the market evolves more, you would see fund houses spread their sort of wings into smaller cities as well. And more awareness campaigns would happen, which in turn would drive perhaps even more investment, right? Even a higher quantum of investment, because still the average ticket size of a B30 investor compared to the top 30 cities is still lower. If I remember correctly, I think it's in fact less than half of it. So as the market evolves more, as more players get involved, as marketing budgets get diverted to all these places, I think that will just contribute to higher AUM. It's already very high. It's already faster than T30, but I think it's going to accelerate even more.
Are they looking more in terms of other kinds of funds like FlexiCap or sectoral funds? Is that something piquing the investors' mind as well? Obviously, sectoral funds was a trend last year, at least in major cities, but I'm not very sure about B30. Was that the trend there as well, or are they picking up the trend now after it's already come into the major cities?
So earlier, Vinny had shown a graph of how the money was flowing into passive funds or index funds, and it peaked in October, and then it sort of has been dipping, and it was very low in the past few months. Again, that is very reflective of what's happening in the B30 market, because at the end of the day, right, a B30 investor is going to think in a similar manner when it comes to growing their money. They're going to think in the same manner as a T30 investor. And what I mean by that is, what happened in October 2024, right, when the index fund, passive fund inflows peaked? That was the time when the Indian market was at its highest, right? It started dipping end of September, last week of September. So how the markets do, in a way, is very directly correlated with where the money is flowing. With sectoral funds, the markets were doing well, so fund houses were launching sectoral funds left, right, center, right? We saw sectors or categories that we hadn't heard of before, or we rarely would have had a fund there. But just when the markets do well, the categories that do well, that is where the money follows, because unfortunately, as investors, a lot of people have short-term memory. And that's one of the caveats, or I would say learnings that would obviously evolve as an investor gets more experienced. But usually the trend, what is doing well, what has done well in the past 1 year, that tends to attract the most inflows.
Okay. And, between B30, T30, where are we seeing higher AUM growth right now?
B30 by far. The annualized growth, I think, is over 40% over the past 4 to 5 years in the B30 category. So it's the fastest growing segment as from a geographical diversification perspective in India. From a geographical sort of allocation perspective, it's the fastest growing sector of investors.
Okay. And, do you think those smaller ticket SIPs, we do have the Choti SIP coming in, this is something that will further boost the growth that comes in from B30 as well as T30?
100%. So there are some platforms that today offer a 100 rupee SIP, though the minimum ticket size is still 500. There are talks of it coming down to 250. I think those are great moves because if you think about it, right, a lot of investors, when they first start investing in equities, and when their parents, grandparents had never done that, or they're just about getting to it, these are people who want to first test the waters. And we already know the average ticket size of a B30 investor is lower than a T30 investor. Just having the minimum SIP formally to be reduced would just make a lot of sense. It would attract a lot more people because they want to try it out, or perhaps their budget only allows them to invest a certain amount of money. So it helps them, again, get invested. Once they get invested, if the markets do well, they become happy, more money flows in.
Okay, and are you noticing a shift that has come in terms of risk appetite or investment strategies in B30 investors recently? Has it seen an improvement there?
So, like I said, right, about 2/3 of investors are basically investing with one fund house. That is one thing that is very stark. I think that would change as more players get involved and there's deeper penetration. So that is one difference. But apart from that, again, it's a human mentality, right? What does well, where the money goes. That's not a great investment strategy, like we know, but that's what ends up happening.
Okay, and demographic-wise, B30 investors, is there any insight on that front as well? The age group that is investing, are we seeing young and early investors also come in, or it's much more in terms of, senior investors who are much more experienced, or, age group of 40 plus is someone who's investing there?
A large part of the new wave of, or the new investors, the new SIP folios that are getting created, I think if I remember the number correctly, it's between 50-60%, is of people under the age of 30 in the B30 space. Okay. Which again tells you a lot, right? If you just were to explore reasons, there are not many studies that have happened that have actually explored why this is happening. But if you were to venture a guess, right, deeper internet penetration, more digital platforms being available. When you looked at trends, one thing I missed out on telling you was the allocation to direct plans, that is without a mutual fund distributor or an intermediary. Even that is at, I think, 2/3 in the B30 space. So that just tells you that, people are downloading apps, the famous ones that we know, and they're investing directly through those. So I think, again, that's a trend that we are seeing across the industry, but I think it's much faster in the B30 space.
Okay, much faster. And overall SIP registrations are also improving, right? You mentioned, or is it just Choti SIP, or overall there's an improvement in terms of SIPs?
Overall SIP registrations have shot up, and it's not just a flash in the pan. It's not a one-year thing. It has happened consistently for the past 5 years, year on year, and I think it will only go higher because of two specific reasons. Firstly, starting April 1st, people have more money in hand, right? Because of the tax slabs increasing. Not just that, but people who were earlier on the old tax regime and were making tax-saving investments, it could be countered because now they don't have to make that tax-saving investment. But I think just the surge of how much money is available, some part of it at least would get invested. And secondly, as India grows, these tier 2 cities, tier 3 cities, they start evolving. We saw that happening in China during a big Chinese boom. Happens to every country when they make the next big leap, and I think we're just seeing that right now pan out in India as well.
Okay, Udyan, thank you so much for joining in with us, explaining us the trends that we're seeing in the B30 and T30 cities, as well as always talking about index funds in the previous segment as well. So thank you so much for joining in with us on the show today. And thank you so much for tuning in to Mutual Fund Corner, viewers. With that, we're absolutely out of time on this edition of the show. Don't go anywhere. Up next, you have Closing Bell to take you through the last hour of trade.
To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
It's a positive sentiment across the equity screen in the Asia Pacific.
SEBI has barred former MD and CEO of IndusInd Bank Sumant Katpalia, former Deputy CEO Arun Khurana, and 3 other senior executives for alleged insider trading.
US Court of International Trade has struck down Trump's reciprocal tariffs.
If there is action against the board, you can expect that there is going to be some more tumultuous times going ahead.
The moment the bell went, it's actually a 100-point gap up opening, so it's looking very good. 24,850 on the screen, inching back slowly towards that 25,000 handle.
India was never pricing in for a Trump tariff impact, and logically should not get a big rally on the back of that either.
Nifty flip-flopping between the red and the green, 24,750.
Its total value of gold that it holds has risen by 57.7% to 4.3 trillion rupees.
See, remember, it's expiry day, a couple of hours. Rolls going on quite strongly is what we gather, especially as far as derivatives are concerned.
Well, that was the day so far. Hello and welcome to Closing Bell live from the CNBC TV18 Motilal Oswal studio. I'm Reema, with me Surbhi and Nigel. And if you thought in the morning that the global risk on trade due to the tariffs being put on hold on account of the US court, well, you're mistaken. It's a very, very quiet day. Well, the rest of the global markets have partied. So whether it's this 1.5% kind of up move in the Taiwanese markets or the Japanese markets and the Korean markets, or the 0.5% plus up move in most of the European markets, things are up and about in Asia and Europe, but Indian markets are very, very quiet and range-bound today.
Quiet today and quiet for the week so far. We've really gone nowhere on the index. I mean, it's just consolidation. For the week, we're down 0.5% so far. But I think, Reema, this is like, the gentleman from Bank of America Securities were telling us in the morning that while for the rest of the world, this could be a huge sigh of relief, even if it's temporary, for India, it's not really a tailwind because India didn't fall as much. We weren't slammed when the tariff orders came in. We were singled out as one of the markets which was lesser impacted. So therefore, even if the tariffs are off for whatever reason, perhaps, we're not the biggest beneficiaries. And whether the tariffs are really off or not, that indeed is a big question mark. I'll talk more about that as we go along. But yeah, for the timing, I think back to tracking individual stocks.
Well, that's right. It's a quiet day, but next 60 minutes, we'll have a big bazooka move in one or the other direction.
You want to bet it's up or down?
No, I don't want. But I'll tell you what, on the downside, the level you should be looking at is around 24,670 approximately. That's closer to the low point of the day. So 24,670 is the important mark we need to defend on the downside. And if that is defended, that on the upside, I think the high today was around 24,850. So we have got our range set for the day between the high and the low. I think we will get a move. Normally you see, just take a look at that. For the last couple of hours, there's been barely any movement.
Yeah.
So it's lull before the storm. I'm expecting a storm. Let's see how that goes.
I was exactly coming to that analogy. It's before the monsoon hits, it's like dead heat. And then you have the storm hitting. So let's see, we'll figure out whether it's green or red, the color of the storm.
I was wondering with Surbhi, before the monsoon, I thought you were going to say before Friday. It's the dull and then party.
All right.
Till Thursday.
Till Thursday. Well, the best person perhaps to tell us how to position yourself in the last hour of trade, which direction the market is going to take. We have with us Mitesh Thakkar joining in with a few closing strategies. Mitesh, you want to wager? Is there going to be an up move, down move in the last 1 hour? If yes, which side? And what would be the key levels in trades now?
Yeah, good afternoon. I've been maintaining that the way the indicators are positioned on the hourly, 2-hourly charts, it still looks like a very flat market. The breakout will happen if the Nifty will show signals of getting past 25,050, which as of now are not there. So for the time being, we'll go with the assumption that 25,050 on the upside to about 24,500, 450 on the downside is the area which index will do. Similarly, on the bank Nifty, you would have noticed repeated attempts around 55,600 failing. So that becomes the ceiling in the short term. And around on the downside, 54,550 is the broad area. So it's about 1,000 point kind of a range. The market seems to be very, very sideways. And therefore, trading should be more concentrated towards identifying stock opportunities. On the stock side, I have a buy on Hind Zinc with a stop at about 456. Look for targets of around 475 here, maybe even 480. But yeah, so the chart is good, so it can even exceed targets in the upside. And the second stock which I have is more of a sell call on ITC. We'll keep a stop at about 422. Look for targets of around 408.
Okay. ITC, well, after yesterday's cut on the back of the stake sale and the fact that it went ex-dividend, it's not that the stock has rebounded today. ITC is still down, close to about 0.6%. But Cummins is trading with gains on the back of the Q4 numbers. The top line is up 6% on a year-on-year basis. There was this conference call. Vamakshi is here with the latest.
Well, Reema, a good operational growth that has come in for the company. When you look at the revenue growth, it came in at 6.4%. This is much lower as compared to what the street was building in. And this is largely on account of flat growth in the domestic business. The exports, on the other hand, that did quite well. The exports were up almost 39% on a year-on-year basis. As far as operational performance of the company is concerned, same quarter last year, there was an one-time gain of around 60 odd crores, which is why the margins last time around were much higher. Therefore, we were expecting some bit of reduction in the margins, but the reduction that has actually come in this time around is much lower than what we were penciling in, and the net profit at 521 crores, even though is down almost 7.2%, is above our expectations. The company held a conference call this morning. They say that they will be posting double-digit revenue growth in FY26. Their endeavor to sustain gross margins at the same level that we saw in FY25 or rather improve it slightly. They're cautiously optimistic on the demand outlook. They did see a 7% decline in the power gen revenue, and this is because in the base quarter there were pre-sales for CBCP2 products. Now they do expect volumes for this new product, that is the CBCP4 Plus products, to rise going forward. In another 2 quarters, they believe that the volumes could actually cross those of the earlier products seen. Prices will take 1 to 2 quarters to settle down completely. The competitive intensity has picked up, but they are able to hold on to their prices, which bodes well from a margin perspective. They're seeing a lot of demand coming in from data centers, and as far as their Capex plan is concerned, they believe that they will continue in the same range as seen in FY25. This will largely be sustained in Capex. So overall, when you look at the numbers, good set, good commentary from the management. Resultantly, the stock is higher.
Okay, Cummins, indeed. Stock's been doing very, very well today. Vamakshi, thank you so much for that. In fact, let's go to our first guest on the show to get a sense on this. Mehraboon is with us right now, so let's ask him what he thinks about Cummins. Mehraboon, great to have you on. Thanks so much for joining in. It's the fag end of earnings season. Lots of stocks still in focus. What are your thoughts on something like Cummins? Any interest?
Well, I would say that the conference call did go well, but in terms of numbers, I think there was slightly below expectations. And if you ask me, Surabhi, I'm invested, clear disclosure, in Kirloskar Oil Engines, a business which is similar, complete, I think, reporting segments also are quite similar to Cummins. So while Cummins, considering the fact that the stock has come down sharply from its 52-week high and the conference call has gone well, it could be a good trading bet from the long side. But if it's a hold and if it's a buy and hold, I would still prefer Kirloskar Oil, a company which I'm tracking very closely. Nothing negative about Cummins, but between the two, I prefer Kirloskar Oil.
Since we're on the subject of some of these capex-oriented stocks, capital goods, power or power equipment, Mehraboon, any other thoughts? Names like Hitachi, GE Vernova, TNT. GE Vernova, after results, also rallied a lot earlier this week. Anything else you like in this space?
I think I like this complete space, if you ask me, Surabhi. And I think Hitachi, one of the names which you mentioned, is also quite good. Again, a disclosure, I'm holding the stocks of that. Besides, if you ask me the entire capital goods space, there are names like a Kirloskar Pneumatic, a Kirloskar Industries also, which look very attractive at the present valuations. And the numbers which they gave, the conference call which took place, I think everything was well received by the analyst community.
Okay, let's talk about the crypto landscape in India. So far, it's characterized by a lot of taxation. The regulatory framework is still evolving. In fact, CNBC TV18 asked Sunil Bharti Mittal, chairman of Bharti Enterprises, his view on cryptocurrencies and their regulation in India. Listen into what he had to say.
A revisit of crypto regulation is what you suggested. Would you like to expand on that?
No, all I said is we have Mr. Vaishnav after me, the next session. I only saying that things have started to move very fast on crypto. And of course, AI, we already discussed, is moving very fast. And this is an area where the government will have to start applying their mind on how to ensure that the right regulatory framework is available for India to make full use of AI, crypto, whenever the time comes.
Interesting times. Let's see how that pans out. For the time being, let's get back to stocks. And Mehraboon, I wanted to ask you about Welspun Corp. Now, the stock is surging in today's trading session because there was a combination of very, very good numbers that came out, good management commentary and good visibility as well. So let's run you through the top 5 points. First, on the EBITDA front, EBITDA in the quarter came in at the highest in the last 5 quarters. And as you can see on the screen, it's a steady improvement that we're seeing at around 460 crores or thereabouts. That's almost the highest that we've ever seen. Point number one. Point number two, if you look at it, it's not just the past quarter, but the guidance going ahead is very, very good. And as you can see in the last couple of years, when they give a guidance, they go ahead and beat the guidance. Now, in their EBITDA calculations, they include other income. So just keep that in mind. Even taking that into account, they are factoring in an 18% growth on the EBITDA guidance that they're talking about, 2,200 crores. Well, that's the higher end in comparison to what the street was working with. So that's a positive. Besides that, you want to look at the balance sheet as well as the order book. And that's important as well. So as of now, they have cash in the books of around 1,000 crores. That's close to around 4-5% of the current market cap. They are throwing up free cash flows every year, operating cash flows as well, keeping in mind that they have a big Capex plan of around 5,000 crores. But cash in the books is always good news. And order visibility as well is there to back them up. 19,500 crores. So they're booked out for the next year or so. And more importantly, the US business will be part of that big order book, which will gradually get executed. And that's the high margin business as well. And since things are looking up for them, they are going on to say that they're going to be setting up a greenfield LSAW pipes business in the United States. Remember, as of now, they were sending the LSAW pipes from India to the United States. But now with these tariffs, they're saying they rather set up shop in the United States because imports are not going to come in. And there's a ready market out there. The commentary on demand as well in the United States is very, very encouraging, which tells you that things are looking up for them because they are favorably placed in the United States. So any kind of tariffs actually is a positive for Welspun Corp, and Trump's drill baby drill outlook as well, that he's been talking about, that will benefit them because it will help in the transportation of oil and gas. Merabun, Welspun Corp, the stock actually went through a period of consolidation after rallying in the last few years. I think in the last 9 months or so, it's not moved much. It's been in this 10% band or thereabouts. Today, it makes a fresh 52-week high. What's the outlook? You have 22,000 crores of market cap, but you're guiding for an EBITDA of around 2,200 crores. Your take?
I think, Nigel, you described everything quite well. And I have been, again, one more disclosure over here that coincidentally, this is also a stock which I'm holding for quite some years, and I have been following this company for many years. Allow me to say that the company has really evolved itself well over the years by diversifying its product portfolio across various segments as far as the pipe business goes. It's also gone now into something like a Sensex plastic. So there are a lot of things which this company is doing. Apart from what you stated, I would like to add something, that there are three major triggers which I see. One is the government initiatives such as the National Gas Grid policy, which is helping the company. Number two, you mentioned somewhere in passing the Saudi Vision 2030, which is emphasizing on safeguarding water and energy security, which is also aiding the company. And third is increasing the Sensex share in water storage tank. And fourth is the robust US business operations. The company is booked for the next 2 years as far as US goes. Now, the company has made many investments over the last 2, 3, 4 years, I think, and this is getting fructified. I think its Raipur plant has started business operations, Bhopal plant has started business operations, Chhattisgarh should start soon in the near future. The company's presentation, which is there available on the site, I think where they are mentioning about the EBITDA of 2,200 crores and guided for 70,500 crores turnover in FY26 looks easily achievable if you ask me, considering that the investments are now going to bear fruits. With an earning per share, which is my estimate, which should be around 65 to 70 rupees in FY26 at the present price, despite the run-up post the numbers yesterday, I would say the share still offers value to investors. So even if I would say that with clear disclosure, even if I would say that somebody goes and buys into it despite the rally which has been seen today and is ready to hold on, I think this company should consistently grow, and the growth will be reflected ultimately in the valuation, because at 65, 70 rupees earning per share at the present level, you're getting the stock at around 12, 13, 14 times, which is very, very, very attractive. So because the company will keep on growing, I personally believe there should be upgrades coming in the stock in the future.
Okay, so that's a thumbs up to Welspun Corp. Got that, Merabun. Thanks very much. The next stock on our radar has to be, of course, IndusInd Bank, right? Let's pull up the stock. It's actually the best performer on the Nifty today on a dull day. And you'd imagine, what a move given the kind of news flow that we had over the, over last evening of several key management personnel being barred from the securities market, including former MD and CEO Sumant Katpalia. The story is that IndusInd Bank is half from its peak. It used to trade at 1,600 plus just about a year and a half back. So it's half from there, and the market seems to be taking a view that perhaps from here on, things can only get better. Now, is that view correct or not? We'll discuss this with Merabun, and we'll tell you what experts have been saying in just a bit. But first, let's bring in Ritu to exactly understand what market regulator SEBI said in the matter yesterday. Certain scathing observations came through. Ritu, tell us more.
That's right, SEBI has passed an interim order against 5 senior executives, including former CEO Sumant Katpalia and former Deputy CEO Arun Khurana of IndusInd Bank, in an insider trading case where the regulator found that these individuals had sold shares of the bank while in possession of unpublished price-sensitive information, avoiding losses of nearly 20 crore rupees. Now, in the interim order, SEBI has frozen their bank and demat accounts to the extent of the losses avoided, barred them from trading in securities until further notice, and directed them to submit a full inventory of their assets. Now, together, SEBI says they avoided losses of 19.78 crore rupees, out of which 14.4 crores was by Arun Khurana alone and 5.2 crores by Sumant Katpalia. The others who have been named are Sushant Saurav, the head of Treasury Operations of the bank, Rohan Jatanna, the Senior Vice President of Global Markets, and Anil Rao, the Chief Administrative Officer, who notably is also part of the 2-member executive committee currently overseeing the operations of the bank in the absence of a CEO. Now, SEBI's investigation showed that senior management was aware of the discrepancies a good 15 months before they made the exchange disclosure, and not only their internal team, even external auditor KPMG had flagged the impact long before. Sumant Katpalia alone sold 1.25 lakh shares of IndusInd, while Arun Khurana offloaded about 3.5 lakh shares without making a single new share purchase in the period between December of 2023, when the management first found out about the discrepancies, and March of 2025, when the information was made public. Now, beyond the 5 executives named, SEBI is also investigating other suspects that it did not name. Questions are already swirling around the board's oversight and the auditor's role. And importantly, Anil Rao, who's part of the 2-member executive committee running the bank, is also named in this order, so we will probably see the committee getting revamped as well. Now, with the CEO and Deputy CEO already out, the story, of course, is far from over, and more heads may roll if insider trading charges stick.
Absolutely, Ritu, got that point. I mean, 2 of these 5 KMPs are no longer with the bank, including Mr. Sumant Katpalia, but 3 of them are still in senior positions and on committees that were entrusted with the responsibility of setting things in order. And then, they've been sort of slapped with these insider trading penalties and charges. Mehrabun, the market's view again. I mean, the market wisdom seems to say that how bad can it get? It gets better from here, and the asset is good. But do you agree with that? Because sometimes these turnarounds, building confidence, cleaning up the books, absolutely all the forensic audits, etc. Sometimes it can be a very long drawn process. Your advice?
I would put it this way, Surbi, that on our channel, CNBC, for the last 18-20 years that I've been coming, I think I have mentioned many times positively about IndusInd Bank, and my positive tone completely changed and I became subdued as far as IndusInd Bank goes after Ramesh Sopti left, full stop. And my experience in the stock market tells me one thing, that the banking sector is one sector where the weight which the management puts is the maximum. If the management is good, they will do well. But if the management somewhere changes or it's not all that good, you should not be married to the stock forever. So if you had asked anybody this question of IndusInd Bank 6, 7, 8 years ago, I think IndusInd Bank was in the top 5 for everybody. HDFC Bank, ICICI Bank, Kotak Bank, Axis Bank, and somewhere IndusInd Bank would have put its neck in. And that was the state. In the last 1-2 years of Mr. Sopti, I think there were some accidents which happened, but that was well managed. Now, what has happened right now beats me completely. And looking at the way the market has reacted, that also, according to me, seems illogical. Stating that the Hindujas, according to me, they should be understanding banking better than most other industrialists, are there and they will put in money. That is being hopeful. So in a market in which there are plenty of opportunities which keep on coming every passing day, I would say, why go in for a stock of a bank which is right now facing wrath from virtually everybody right now? So I would clearly give it a pass. And this stock, honestly, or this unfortunately is not on my trading screen, and I'm not going to look at it again. Clear disclosure, I have exited the stock more than 1.5, 2 years ago.
Okay, all right. So staying absolutely far away from IndusInd, that's Mehrabun's view. I guess, Mehrabun, the only reason is looking for cheap bargains, right? That's what explains the resilience that IndusInd Bank has shown.
I think so. I would like
may
to
not
add
always
one
be the
thing.
right course.
Were there not many?
Yeah.
Were there not many hopefuls as far as Yes Bank goes also? I think if we remember, Yes Bank was the most discussed stock. Everybody was talking about it just because the stock price came down, and we all know what happened to it ultimately. So being hopeful is one thing. Good luck to them. But at the end of it all, if the story is destroyed, ignore it. If the stock has to go for whatever reason, let it go up.
Okay. Got that. In fact, that's the point well taken. Earlier today, in fact, we spoke to multiple industry voices over IndusInd Bank. Listen into what they had to say.
I think the near-term fundamentals appear challenging for the stock. The growth is likely to be very subdued given the liquidity constraint that they will be grappling with. The incremental funds that they are raising, they are still at 50, 70 basis points higher than what the other peers are raising at, and hence the margins will remain under pressure. And the path to a normalized 1% ROA seems a bit long drawn from the current moment. Given that the next 1 to 2 months, the news flow is likely to be a bit more positive vis-a-vis what we saw in the last 3-4 months, do not expect a significant negative stock price action from the current levels. However, as I mentioned, post the CEO appointment happens, we expect the stock to start reflecting the fundamental trends, which we expect to be a bit more challenging still for the next 12 months.
We have had similar cases in the past, right? There have been a couple of such banks who went through a similar journey, I mean, in a different form, but they had serious losses, change in management, regulatory interventions. And post that, what typically happened is you see a consolidation in metrics, like the growth disappears. The focus goes back in terms of protecting the depositors versus shareholders. That generally is the script from regulator. And in the, generally the period followed by maybe 18 months to 24 months, in that period, you typically see no activity, from such companies. In terms of growth, generally it's a cleanup period.
Okay, it's time for a break. Mehrboob, thank you very much for joining in. As we do that, let's also tell you we're very excited to unveil our brand new global business news channel. The all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. So tune in to CNBC TV18 Prime at 12 noon for the Global Reset and the Global Lens at 8:30 p.m.
Welcome back. You're tuned in to Closing Bell and you're watching CNBC TV18. Well, Vaibhav Sanghi, CEO of Ask Hedge Solution, joins us on the show. Hi, Vaibhav. Good afternoon. Good to see you, Ben. Market's not doing anything, at least for today. But how are you all positioned? I mean, what kind of positioning do you all have? If you'll have a long-short ratio, if you could help us out with that.
Sure, Nigel. I think market, as you rightly mentioned, actually are consolidating between 24,500, 25,000 at this point in time. The way we view it in terms of the market situation as of yet is that, as against earlier kind of time period, especially in the last 3 to 4 months, whatever headwinds we were kind of witnessing, or probably a market, had on an overall basis, I think they have to a great extent kind of being mitigated, in the sense that the tariff news or the tariff noise, I would say, actually is being fading away in that sense. Lastly, in terms of a geopolitical situation as well, I think that is kind of settled well, in all its context. So what we are seeing from here onwards is that is a market where the earning expectations were pretty low, and I think the earnings have been pretty okay as per the expectations, along with the worries which are out, from a market standpoint, which brings to the point that on an overall basis, we may see market consolidating to kind of move inching up over medium term, from here onwards.
Weber, but do you think we can clock in some decent gains, at least in the second half of the year? We were just chatting with the BofA top team in the morning, and their view is that we're in the last leg of the rally. From here on, their target price for Nifty year end is 25,000. And they're saying that earnings expectation, though there has been a recovery, is still very high, and we could see earnings downgrade. So basically, in a nutshell, it's not that they're seeing too much downside, but the upside appears to be limited. What would your call be, say, for the next 6 months?
So I would say 6 to 12 months. In a scenario where we may see dollar depreciating, I think continued inflow to emerging markets will happen. If that happens, along with your domestic flow pretty strong, we may see, or we continue to see, the markets kind of getting supported on the technical side. Whereas in terms of the fundamental side, our strong belief is that because of the measures, both on the monetary side and the fiscal side, which have been taken from the government to kind of increase the momentum in terms of the GDP growth, while we had always had focus on investment side, I think consumption starts to become a play purely because of the tax benefits and the monetary policy, which have become kind of accommodative. So decreasing interest rates, higher liquidity, fiscal incentives, all these are likely to help the GDP growth kind of surprise the street on the upside, which is where I do think that, yes, the earning expectations is reasonably okay, or probably marginally high as per the street expectations. But my sense is basically, I think we should start some decent recovery on the same in the second half. So markets, I think, are looking up at this point in time. Whether it goes to 25,000 or 25,500, 26,000 is just a number. But whenever we've seen in our experience that the earning momentum starts to kind of improve, then the PE multiples also start to kind of improve.
What would be your top bets from here on? What do you like? What do you dislike? Any new changes that you've made? Any new trends that you've spotted?
Sure. So I think from a sectoral perspective, I think our preference for the next 12 to 24 months would be consumption and consumption-driven sectors, starting with consumer discretionary. Our view is that because of the pretty good focus from both the state governments or central governments and with the RBI in terms of the monetary policies as well, this is a piece which earlier was absent, is now going to kickstart the incremental growth from here onward. So that's a sector which we like. In addition to that, we are slowly and gradually, but surely getting constructive from a medium-term perspective on the IT. We were neutral for quite a long period of time, but now, as the global worries recede, and we see some amount of improvement in terms of your quarterly numbers along with the guidance on a gradual basis, we do think that the valuations are reasonable from an IT space. So that is, again, a sector which we will look at. Lastly, banks is something we continue to be neutral on. We are waiting for the bank rate cuts to kind of probably happen, and then we will probably take a call, on that sector. And financials is something which we like.
Interesting. From the IT pack itself, what do you like? I recall, I think 12 months or so ago, you all were positive. Then I think you all went into a neutral stance on IT. And now you're again taking a fresh look at it. Will you all go for the mid-cap names that grow at a faster clip, or will you stick to the larger cap names from the tech pack?
See, I think it will be a mix of both, in the sense that from an individual company, growth prospects is something where we would probably lay our attention to. Also, all those companies where we've seen a good amount of deterioration because of the lack of visibility in terms of the discretionary spend, our view is that while the free cash flow yields are looking pretty comfortable there, we will try and look for opportunities which give you some amount of downside protection, along with improvement in terms of the future potential deals which may come about. So that is a space which we may look at. And it is, to be honest, I think it can be a little bottom-up driven as well. To go fully bullish on the IT sector, probably it will take a quarter or two to take that view.
I might be wrong, but did you like cement a couple of months back? In one of our conversations,
Yes, I think we were bullish on cement. I think cement has done well in terms of the sectoral performance. The way the southern prices have kind of held up, I think it's a good sign. Probably it's just at the start of the monsoon, and probably you may see some amount of consolidation in terms of the cement pricing. My guess is basically structurally we may see improvement in the profit matrix because of the overall consolidation in the industry. So cement on declines is something which we continue to like, but not at this point in time.
Any tactical trade on IndusInd Bank?
No, I would probably pass that.
All right. Thank you very much, Vaibhav, for joining in. We'll get into a break. As always, on the other side, we'll get you a check on what dealing rooms are saying in our segment, D Street Chatter. We'll also get you a few BTST calls from our technical experts. Welcome back. Expiry move seems to be playing out. It's just 3:02 and you can already see the fireworks in the market. In 2 minutes, the Nifty's moved up close to about 50 points and now inching towards the 24,800. Oh, it's crossed 24,800 as well. As Nigel was earlier pointing out, one key level to watch on the way up will be our intraday high, which is 24,890. But as you can see, sharp 3 o'clock, as the monthly expiry plays out, you can see the market spike up. So the move directionally is on the way up. But let's find out what dealing rooms are saying. Nimesh is now joining in with all the chatter. Nimesh.
Hi, Rimana. So you'll expect this up move because the feedback is that the rollover has been quite strong. So you might see a bit of a reaction in the upside on the Nifty and in the Bank Nifty in the last 30 minutes. But otherwise, it's been a quiet day. The flows are quite muted as well. I guess today's flow will not be much important because of the expiry. So not much to read into. A couple of things which stood out for me. One, the entire May series belonged to the broader market sector stocks, and looks like that momentum is going to continue in the June series as well. So again, could be a series where the Nifty could be range bound, but you might see a big action in the broader market names. Second, I guess now that the earnings season is coming to an end, the most important thing to watch for the next series would be the RBI policy and the rate cut. So again, you're seeing a bit of traction into the rate sensitive names. All the real estate stocks are buzzing in trade, so are some of the NBFCs as well. So that could be one space which can see a lot of action in the beginning of the June series. So that's something to watch out for. And I guess, in the May series also, there's been a quite rotation happening from banks to IT, and within IT it's the mid-cap IT where there is a bit of flow moving back from the larger institutions. So looks like for the June series, the sector to watch would be IT, and within that, the mid-cap IT could be in focus. So that's the overall feedback from a market position point of view. But I guess from a flow perspective, being an expiry day, nothing much to read into.
Well, that's right. Nimesh, at the start of the show, the girls were saying that it's too quiet a day. I said that, we'll get some move, and it appears that's taking place, at least as of now. Nifty moving towards the higher end of the range. And the Nifty Bank, actually, that was down 200 points, moving up. Purely expiry-related play is playing out. That 3 p.m. move has come about. But Nimesh, individual stocks, what are you picking up?
So in terms of individual names, the first stock is Hyundai Motors. Been consolidating in a very narrow range of late. But again, the feedback is that there could be a large block coming soon in Hyundai Motors, so that's something to track there. Second stock is LIC. We saw big moves yesterday post the earnings and the management commentary, but the volumes have actually picked up. There is a bit of buying as well. I understand one domestic large mutual fund has been an active buyer in the last couple of days in LIC, so that's the second stock. And remember, 950 is the IPO price, so once it crosses that, you might see a bit of further traction as well. So that's something to track there. The third stock is Canara Bank. Within the PSU Banks, this is one stock which has consistently been delivery marked by larger institutions. So again, there is a bit of buying interest in Canara Bank in today's market. And the last is a couple of stocks where there is delivery-based selling. Vedanta as well as Power Grid, both have seen some delivery-based selling today. So looks like some bit of profit booking for larger institutions in both those names today.
Thank you very much for that. Nimesh, I was looking at Midcap IT since you said that it's finding favor. And it has. This month, in the month of May, Zensar is up 18%. So is Coforge. Tata Tech is up 17%. Hexaware has a 16% rally to boast of. First Source Science have gained close to about 15%. Tata Elxsi, LTI Mindtree are up nearly 11 to 12%. We're talking about the month-to-date gains for the month of May. So buying has really come back in Midcap IT compared to Frontline IT. But thank you very much for that. Mitesh is now back with us for a few BTST calls. Mitesh.
BTST on the buy side, the JS side to begin with, trading at the near today's high. Take a BTST here with a stop at 662 for targets of 680, and the other one is LMT, which is a BTST with a stop just below levels of 36.29 for targets of 36.80.
Thank you very much for that. And now, in a massive development which will have global ramifications, U.S. court has struck down President Donald Trump's tariff. So we've now moved over to the big wall to tell us what this order implies and what could be the options for the Trump administration going ahead. Surbhi.
Well, almost 2 months after it was unleashed on the world, the Trump tariff juggernaut has finally hit a legal roadblock. On Wednesday, the U.S. Court of International Trade struck down a series of executive orders which had put Trump's global tariffs in motion. The court's view is that the International Emergency Economic Powers Act, which the U.S. president had actually invoked while declaring a national economic emergency back in April, simply doesn't authorize him to take unilateral tariff calls and levy universal tariffs. Basically, the court has said that Trump has overstepped the authority that was granted to him by the legislation. And those are the highlights that we just had on the screen earlier. These are the executive orders. So let's talk about what these executive orders were, which have been struck down. Now, the court has basically said that there are 4 executive orders that have been struck down. So let's start with the latest one, Executive Order number 14257. With this order being declared invalid and quote-unquote contrary to law, Trump's 10% baseline tariffs, as well as the reciprocal tariffs which were levied on countries around the world, become null and void. The other executive orders that have been struck down render the fentanyl tariffs levied on Canada, Mexico, and China invalid. Finally, the court order also strikes down the 25% tariffs levied on goods that were not covered by the US-Canada-Mexico agreement. It is, however, important to note that the 25% tariffs on steel and aluminum remain unaffected by the court's order, as these were imposed under a different act, a different piece of legislation, and I'll come to that in more detail in just a bit. So what happens now? Well, the US administration has already swung into action and it has challenged the trade court's order at the US Court of Appeals. Legal experts feel that this battle, in all probability, is likely to head to the US Supreme Court. Now, in the meantime, Trump has several other legal options in his arsenal to keep the tariff heat on. The first of them is a wider use of Section 232 of the US Trade Expansion Act. Remember the steel and aluminum tariffs, which I just spoke about, and they're still in effect? Now, they have been levied under this very section of the Act. Trump could expand the scope of this Section 232 to other sectors as well. In fact, the administration is already evaluating potential tariffs on aviation, on electronics, and pharma imports under this Section 232. So watch for this. Next, there is the US Trade Act of 1974. Section 122 of this particular act allows the president to levy a baseline tariff of up to 15% to address quote-unquote balance of payment concerns. And, the current trade issues could fall in this category. The levies can last up to 150 days without the need for any sort of congressional approval. Let's move on. There is then the Section 301 of the same US Trade Act. This allows the US government to launch a wide trade investigation against any US trading partner and then impose tariff levies. However, this could be a very cumbersome and time-consuming route, so may not be the US administration's first port of call. Finally, there is the option of using the US Tariff Act of 1930, which has not been used till now. The section number 338 of this legislation allows the US to levy up to 50% tariffs on imports coming from countries which discriminate against the US. That's a pretty wide term, so it can be interpreted in any way. Now, as the tariff war takes a legal turn, here's a statement from the White House spokesperson, Kush Desai. This was immediately after the court order. He went on to say, and you can see it on the screen, it is not for unelected judges to decide how to properly address a national emergency. So this was first. And then we had a social media post from the man himself, Donald Trump. And it's very cryptic, but he goes on social media and he says he's on a mission from God and nothing can stop what is coming. Now, it's cryptic, whether it means more tariffs, the use of any one of these factors that I described, only time will tell. But the markets could be rejoicing for now in the interim. However, the only thing that is certain after Wednesday's court ruling is that this is only round one of the legal battle, that the US president has a wide array of legal and executive options in his arsenal to keep the tariff blitzkrieg on.
Okay, all right. Well put. Thanks a lot for that, Surbi. Well, let's get back to the equity markets then. And as Surbi was explaining that neat piece for us, take a look at the markets. The Nifty Bank actually should come up for you. This is an expiry-related move. Just take a look at it. Big move is what we are seeing. Kotak Mahindra Bank, ICICI Bank. I think at some point of time that graph should come up for you. The Nifty Bank is what we're talking about. So we have Kotak Mahindra Bank, ICICI Bank, and HDFC Bank. All of them spiking up to the high point of the day. Big move being seen out there. And that's the reason why we've seen a big spurt. All of this in a matter of around 10 minutes, we've seen this big move on the Nifty. But let's focus on the broader markets then. Deepak Nitride, that's rallying in trade better than expected. Fourth quarter, margins expand. And also a couple of the divisions did very well. Upasana joins just to fill us in with a quick analysis. Upasana?
Well, it was a strong beat versus the street estimates. Now, growth was mainly driven by company's key segment, that is phenolic segment, which witnessed volume improvement and revenue saw an uptick of 5% and margins also improved by 150 basis points at 15.6% on a YoY basis. Now, coming to the consolidated numbers, revenue saw an uptick of 2%, EBITDA saw an uptick of 5%, EBITDA margins saw an uptick of 30 basis points at 14.5%, while the street was working with a number of somewhere around 9.7. PAT was impacted down about 20%, and company has indicated that the PAT remained impacted because of the higher input cost and also the performance of the agrochemical segment. Now, coming to the con call highlights, the company has given a upbeat commentary. FY25 was a challenging year for chemical industry, but coming to the domestic demand, company has highlighted that the domestic demand showed early signs of recovery. Company has also expanded its product portfolio and has secured long-term contract is what they have highlighted. Now, company is confident of profit bouncing back to normalcy in FY26 after the profits being impacted in last couple of quarters is what they have said. Now, demand for dyes and pigments also have improved after Q3 is what they have said, while agrochemical demand continues to remain subdued, and company expects this trend to continue for some more quarters. Now, company anticipates market conditions, it will improve coupled with softening of input prices, which will certainly aid margin trajectory from here on is what they have said, but they haven't put an exact number to this. Now, Vadodara R&D facility of 1100 crore is set to be commissioned in Q2 FY25 is what they have highlighted. And they've also said that the nitric acid facility will be commissioned either by end of Q1 or at the start of Q2. Now, coming to the guidance, company remains confident and optimistic about growth in FY26. It has given a positive and a strong outlook for FY26 with several projects which are set to commission in Q1 and Q2 as highlighted earlier. So overall, good set of numbers and commentary remains also quite upbeat.
Thank you very much for that. By the way, there are going to be quite a few earnings which come out today. So Bajaj Auto is there. You've got an Ola Electric that the street will be tracking closely. You've got a Prestige. You've got an Amara Raja. You've got Sobha. So, you know, Mazgao. Some of the Motherson numbers are already out. EIL numbers are flashing for you on your screen. But even post-market hours, lots of important numbers. And I remember last time Ola Electric numbers were quite weak. The loss had widened. So let's see what they report this time around. EIL stock has spiked. Anand Tandon is now with us on the show. Anand, the stock of the week appears to be Apollo Microsystems. 3 days in a row. And in 3 days, the stock is up 35%, another 6-7% up move on Apollo Micro. Looked at it?
No, I'm sorry. Not a stock the right time.
Okay. Do you want to comment on EIL? I can see the numbers on the screen. Bottom line has gone up substantially, 280 crore versus 115.
Well, obviously, you know, the kind of investments that one is looking at in terms of refining capacity and in the oil sector, etc. You know, Engineers India will be one of the beneficiaries of that, especially since our relationships with in the Middle East are doing quite well. The domestic side, you know, also we are looking at expanded capacity. It's not that I have anything specific to add to this particular company, but consultancies in general have done reasonably well, especially on the infrastructure side, if you look at what's happening on railways as well. So the question in all these cases is obviously how much you pay for it, and that remains a problem even today.
All right. Hi, Anand. Good to see you this afternoon. What about a stock like Midani? Are you tracking it? One of those defense plays that last year they didn't grow at all. But when we spoke to them last, they said at least factor in a 10% growth for this year. And they're optimistic that they can grow at a faster clip. Any view?
So, you know, obviously we have repeatedly mentioned that there is going to be a fairly strong order position for most of the defense PSUs. Midani just happens to be in the metal space. So to that extent is a little more niche than many of the other contractors. The challenge, however, is the execution. Most of the PSUs are just not able to execute fast enough to be able to take up a greater share of the revenues. So the conversion from order to revenue remains rather lackadaisical, and I think you're seeing the same thing in Midani. But overall, I think in the global space also you will find that most defense companies will trade at higher valuations going forward because the order books are just brimming over. The question really is whether we have, you know, and if, for a company like Midani, obviously the question would be how much they can push their production out. I would think that the best way to approach defense is to take a basket of stocks rather than take any particular one. Midani, as I said, is somewhat unique among the basket that there would be in India, therefore should form part of the companies.
Well, that move indeed happened, the 3 p.m. move, and how Nigel called the storm right, 100 points up. And that's how the market is.
I was saying, right, it is too boring, too quiet a day. The market said, okay, Surbi and Rima didn't like it too much. It's expiry day, fireworks.
Some action.
And the bulls came challenge.
100 points higher. Actually, lots and lots of stocks moving around right now. Garden reached rebuilders, 7.5%.
And it can be a very, very interesting final 13 minutes. I'll tell you what, because there was a lot of call writing that was seen at the 24,800 call. And now we have gone to 24,850. So some of those call writers are stuck very, very badly on the wrong side. We could get a big swing even from here.
Okay, all right. So this is charging higher and higher. Anand, just very quickly on some of these solar stocks like Wari, Premier, what thoughts here? I mean, do you like anything from a more sort of steady portfolio picking perspective?
Not particularly. I think the sector is obviously going to grow quite well. But for the EPC players, I don't think that there is a kind of sustainable mode there because, obviously you set up a project last 20 years, there is a certain amount of money coming through it from the government because of, the home subsidy, etc. So there will be a large amount if you are in the retail space. A company like Wari, which is looking at institutional kind of business, perhaps, there is a move towards renewables, but I think there is going to be again challenges that you'll see on the transmission. Broadly, unless you are manufacturing the panels and so on and providing some technological advantage, the rest of it is simply a question of execution. On the panels itself, we have always a protection from the Chinese because otherwise we'll just be swamped over by them. So it's a business which is dependent on government policy far too much to be something that I would be very comfortable with. That said, the current environment globally and in India seems to favor this sector. So I would expect to see reasonable performance from here on, but it's more tactical than strategic.
Okay, fair point. So tread with caution if you're venturing in. It's more of a tactical move, says Anand. Got that point. We'll take a quick break, come back and get more questions going with him. But as we take the break, let's get you some market opinion. Bank of America Securities 2025 India Conference kicks off next week. We caught up with Amni Shah, head of India Research, and asked him about his outlook for the Indian market and some of their top sectoral choices.
We had set out a target for Nifty at 25,000 for December. I think we are right about there. So we think markets are now likely to mostly consolidate as far as Nifty is concerned. Valuations are full. Clearly, we can't fault the long-term drivers or the growth in India. Macro story continues to stay well. But 21 times at Nifty, it's almost at +1 standard deviation. So if you're a near-term investor, our advice is that maybe start booking some profits. If you're a long-term investor for a 2 or 3 year period, then the view is that you should expect muted returns going forward. Some sectors which were going to be more impacted, like autos, maybe pharma, IT, on the worries that US economic slowdown could cut down on tech spends, there might be some rally as a relief as of now.
What are the top 3 things that you would tell a young entrepreneur today, which you believe are the non-negotiables?
If you're a first-time entrepreneur, or you're below 30, you gotta swing for the fences.
And so, how soon can we expect PhonePe to build from India for the world?
Ask the CTO. It's India's time to build for the world.
How do you look at competition?
Shamelessly, I think in our sector over the last 10-15 years, the most innovative by far and away has been Paytm, and we talk about this.
Yeah. Right to win comes in from how we execute, but the right to play comes in from whether we have the building blocks to be able to enter a new business, even if we are entering late.
The Tatas empire, I see the Birlas or the Ambanis, or more recently the Adanis and the Mahindras. They have things that every new business can take for granted.
Welcome back. We were just talking that it's going to be a busy evening. Lots of earnings expected. Bajaj Auto is right on top. And Sudarshan joins in with the expectations.
We are expecting a steady set of earnings from Bajaj Auto. As far as revenue growth is concerned, it would be supported by healthy volumes, which have seen an increase of 4% year-on-year. Also, realization is expected to improve both year-on-year, also on a sequential basis, and it would be supported by better product mix. Now, talk about the headline numbers. Profit is seen rising 3%. Revenue may increase by 4%. It may come around rupees 11,995 crore. EBITDA too can increase by 4% to rupees 2,406, and margin may hold above 20% for 9th consecutive quarter. It may come in around 20.1%, same what company had reported in Q4 of FY24. Volumes were higher 4% year-on-year, but were down 10% sequentially. Realization is seen increasing 1% year-on-year and up 4% on a sequential basis. In the commentary, what exactly would be watching out for? First, what does company say about the domestic outlook? Because as of now, whichever companies have reported earnings, they believe that growth in FY26 is going to be at the similar level what the industry saw in FY25. Apart from the domestic, what would be important for Bajaj Auto is the export outlook, because Nigeria is a very important market for Bajaj Auto. So we'll have to see what does company say on export front. And lastly, about the outlook on EV, because the EV contribution in the last few months has seen a significant rise for Bajaj Auto. But as far as earnings are concerned, we are expecting a steady set.
Okay, all right. Thanks, Sud, very much for that. So those earnings definitely in focus. Let's go back to Anand Tandon for some thoughts. Anand, the auto space, barring Mahindra and Mahindra, I mean, has really failed to fire. We've been waiting for many, many quarters. Beyond M&M, I mean, do you think anything else looks like a decent buy at this point?
Well, the only other company which has shown some kind of volume growth has been actually ICE. The rest of them have done pretty much nothing. And, while the management has, especially in the case of Bajaj, tried to talk it up by saying that, volumes will pick up, the reality is that two-wheeler volumes have been inimical in terms of growth. And with the fight still on in terms of who will win in the EV space, and therefore new manufacturers stepping in and increasing the size of the production pipeline, it's unlikely that you'll be able to see any kind of price increase or margin improvement or any of that because the competition is just too high. The volumes are still not recovered enough to actually be able to grow the market meaningfully. So I think two-wheeler still remains dubious in terms of the private vehicles. You are looking at only the SUVs, hence Mahindra. Here too, there are a lot more new models going to come in, both from Maruti as well as, we've already seen a pipeline coming in from Kia. So I think the production, it's unlikely that you'll see marquee brands getting created here other than the ones which are already there. So by and large, it remains a space which is somewhat tepid. You may see a little bit of an improvement in the international market because of this tariff changes in the US. But I think all is not settled as far as where the tariffs will finally reach out. If the tariffs improve, maybe somebody like Tata Motors may have a bit of a kicker on the upside.
And from the auto ancillaries, anything you like?
Well, overall, I think, you are going to look at two major trends. One is that people will be looking to restructure their supply chains and look at little more onshoring. And therefore, while the opportunity remains fairly large, it still is a bit dicey because you don't know how many countries will actually put up protectionist barriers. The second thing is that if the market itself doesn't grow very much, and I think the global market will kind of slow down this year more than last year, you will not be able to make that kind of a headway that you would expect. So the larger players with the international markets obviously benefit, companies like Motherson and so on. But by and large, I think this is also a space which will remain somewhat under pressure, because when the OEM is not doing well, the pressure passes on to the entire supply chain, including the ancillaries.
Okay, all right. So that's a view on the auto space. Final thoughts, Anand. Earnings season pretty much over. Anything that really stood out for you where there's clear visibility of growth and valuations don't look sky high? I mean, any names, Midcap, Largecap, anything?
So broadly, if you look at where the market is, we are looking at a decent macro and poor micro as far as India is concerned. Decent macro because inflation is under control. Fiscal, foreign exchange deficit may not be high because of oil prices and so on. macro is poor because we are overvalued. I mean, if you take out 21 times 1 year forward earnings, take out the banks, you're looking at 24 times 1 year forward earnings, almost 2 times standard deviation higher. So near term, I don't think you're likely to make too much money from the market, which is exceptional. Slightly longer term, again, depends on where you are. Muted results are likely. The expectation, the only sector that people are betting on is things like cement and IT. To my mind, it's a hope trade. It's not really anything that we have a concrete reason to believe it will do well. But the hope is that things like may improve from here on, and hence you may want to get into that. But those are perhaps two of the sectors that could give you a positive surprise. I think real estate is something I would watch out for negative surprises going out 12 months from now.
Okay, all right. Anand, request you to stay with us, but we need to take let's take an intraday chart of a few stocks. Pull up the Nifty Bank. It's up 300 points right now. So that's a close to 450 point move in the last hour itself. Big move is what we're seeing out there. Kotak Mahindra Bank, HDFC Bank, those two heavyweights from the red, they move quickly into the green. And that's the reason why, in fact, we're going to go home with solid gains. The Nifty as well up 130 points. So beautiful looking screen as we wind down. Broader markets, well, there was a lot of gainers in today's trading session. V2 switch gears, that one was up close to around 20%. Federal Bogle Gods, that was up close to 13%. You had a couple of other, Unimec was up close to around 10%. Welspun Corp is up close to around 10% in trade today. UTI as well up 7.5%. Axis Gates was locked in upper circuit with a gain of close to around 5% or thereabouts. So it was a solid trading session, plenty of winners from the headline index and from the broader markets as well. Things looked quite good.
Oh, indeed. It looked like a quiet day till about 2:30. And then all the action in markets finally closing. 130 points up, 24,880 is the final tick on the Nifty. The large cap winners are IndusInd Bank, unfazed by the news of SEBI's investigation into the high officials and insider trading. Stock is up 2.5%. Sun Pharma, Eternal also up nearly 1.7, 1.8%. Giving it company on the way up are Adani Ports, Trend, IT stocks came in for buying, Tech Mahindra, Wipro. Banks on the whole also up and about in trade. So Axis, ICICI Bank, HDFC have the 3 p.m. up move. On the way down, Tata Consumer went ex-dividend, so that was the top loser. HDFC Life, BEL, Jio Financial, Bajaj Finserv under pressure. Pull up Bajaj Auto. The street is awaiting numbers from Bajaj Auto. And that brings us to a close on this edition of Closing Bell. Don't go anywhere. On the other side is Markets Forward.
The Wall Street ends higher in a volatile session. Nifty ends about 24,800, led by IT stocks. Midcap index outperforms. Banks mildly underperform.
A U.S. federal court halts President Trump's tariff juggernaut rules as he overstepped his authority by invoking an emergency law to impose sweeping tariffs on numerous countries. Trump administration appeals the ruling even as it explores other legal options to impose tariffs.
SEBI bars IndusInd Bank ex-CEO Sumant Katpalia, ex-Deputy CEO Arun, as well as Anil Rao, a member of Executive Committee, and 2 others for insider trading. The naming of Anil Rao is a blow for the bank's current management structure.
You're watching us here on a fresh new edition of Markets Forward. This is your go-to show where we aim to get you all the key data points to get up for the next trading day. I'm Mangla Malu, with me, Vinny Motiwala. What a day it was, Vinny. It was perfect expiry day. We started with a gap up that got sold into swiftly. We started with a lot of overnight cues that came in from the US, domestic as well. Then for a large part, we were absolutely flat with the market going nowhere. And then suddenly, the last 30 minutes, it was a big bazooka that took place.
200 points recovery from the day's lowest point is a good day. I think we're ending.
Great day, great series.
I think we're a day to celebrate with tacos, right then?
Tacos, started with taco. But, you know, be that as it may, it was the May series that got you almost 600 points on the Nifty. And that's the third straight series of gains that we've seen for the market itself. And, you know, just the 600 point doesn't do justice to what the May series saw. At the start of the series, we had the border skirmish on India and Pakistan. There was a lot of volatility, and the market at one point went below the 24,000 mark. After there was some relief, and the market went above that 25,000 mark as well. So it was a near 1,100 point range that we saw in the market, of which we managed to hold on to 600 points in terms of gains. So the street would like that. Third straight series of gains, the street would like that.
Absolutely, street would like that. And the mid and small cap, the broader end of the market, that's our good performance coming in today's trading session as well. The outperformance, actually, what we could say. So that is something interesting to watch out for. 5/10 or 6/10% of gain coming in from the mid cap as well as the small cap. So interesting to watch out for. But yes, that's the market setup that we're watching out for right now. But on the show, we have an exciting lineup for you all in the next 20 minutes as well, where we will take you all through what is happening in terms of the top movers and shakers of the day, and then in terms of the key development in terms of important stocks to watch out for, and last but not the least, the events that we should be tracking ahead of tomorrow's trading session. So now on that note, you know, we'll get started with the top stock and segment for the day as well. For that, we have Hormas Patakia joining in with us from the big wall with the top stocks and movers for the day. Hormas, over to you.
Well, the business end of the day is actually going to begin now with a lot of these earnings that are yet to be reported. We'll come out with them. And of course, the ones that were reported saw a very significant reaction during the course of the day. MMTC ending 20% higher on an upper circuit, continuing to build on to the gains that it has been seeing over the last few trading sessions. Samvardhana Motherson, after the results announcement, fell initially, but then had a spike from the lows of the day to end 2.5% higher. Cummins India, after a strong commentary from in the earnings call. EIL also at one point was up 5% after a very strong earnings performance, and Bharat Rasayan, the negative earnings reaction today, 9% lower after the results that were reported after market hours yesterday. Among the newsmakers today, Vari Energies, after the order win that it had during the course of the day, ending 8% higher. Castrol, of course, the news reports over a potential stake sale. Olectra Greentech continues to grind lower. Vedanta, of course, after the NCLAT relief and another earnings reaction in the form of Deepak Nitrite. PSU stocks continued to do well in today's session as well. KIOCL was one of them. Of course, mind you, barely any float in this stock for almost 5% higher. Midani ending 5% higher as well. And Garden Reach continuing to grow from strength to strength. Another 7% in today's trading session. And Oil India and NMDC also having a good day at the office. Oil India, of course, because of the rise in the crude oil prices. Stocks that ended at a 52-week high today. Welspun Corp, after a very strong earnings performance, ending 10% higher today. And GE Vernova continuing to build on to the gains. Deepak Fertilizers too, ending at a 52-week high. And lastly, some stocks that ended on the losing end today. Olectra Greentech continuing to grind lower, also from profit booking in Schneider Electric and GSK Pharma in today's session as well. Back to you guys.
Bunch of stocks on the way up and down. Those were the top stock movers. But let's welcome our guests on the show today. We have Anand Tandon and Ruchit Jain joining in for the views on the market. Anand, so much volatility across the world, global uncertainty. Set the next month up for us? Monsoon, that's been one glimmer of hope. It's arrived earlier than usual, and the street is believing that maybe this would bring some good rural recovery and gains in the second half of this year. How do you view the next few months in the market?
Well, I think, the fact that monsoons are up and are supposed to be reasonably, well spread out is good news, but it's not something that is a market moving event. Broadly, it doesn't make too much of a difference unless it is highly negative, which is when the demand kind of falls. So yes, it is one more positive in a long list of positives. We have a situation today in the market where we are set up for reasonable growth compared to the rest of the world. And, falling oil prices helps the current account deficit. The inflation is coming down. By and large, if the ruins are good, you will not have any reason for food inflation to go up, which had been a problem last year and so on. But with all that, the issue is that, we are also in a situation where the IIP is falling and the earnings are again under some amount of stress. So we have already seen a growth of hardly, a single-digit growth in earnings in the current year. And to my mind, you're going to see the same thing for the next year as well. So in a market which is valued at 21 times 1 year or 22 times 1 year forward earnings, for it to grow at single-digit kind of earnings growth, it doesn't leave too much upside on the table. So unless you find something dramatically different over the course of the year, then there is a possibility of making higher gains. Otherwise, you should kind of assume that you will get debt-like returns for the year forward, and therefore even the next month you may see some volatility, but not much else. The global market is a lot more interesting because of the fact that we are seeing a lot of volatility around the US and the US tariffs, etc. Whatever way it settles, irrespective of the Supreme Court judgment or any of the judges coming through, I think you will find the tariff rates in the US will be higher. And that will mean that there will be a slight global slowdown as well. So there again, the outlook is somewhat not so positive. India may be in a sweet spot again, assuming that we do enough to be able to open up our market for domestic growth and for foreigners to come in and set up business, not only for international markets, but also for India. But that will require a significant change in mindset. Coming to the sectors, I think, we have already, most of the current sectors are pretty much fully priced. You are really looking at a hope trade in terms of IT and cement going forward, that things may actually do better. Next month, cement not likely to do well. Trains, not a good season. You will see price increase, but volumes will flatten. IT may begin to do a little better in terms of volumes.
Okay, that's a view coming in on the market. But let's move on and get more stock specific now. Welspun Corp, that rallied as much as 10% after a solid set of numbers in Q4 FY25. Nigel is here to tell us what got the street excited about the numbers. Nigel.
Well, that's right. Welspun Corp came out with a solid set of numbers, and the management commentary as well was fairly encouraging. Let's give you a few points now. On the EBITDA front, in the past quarter, they delivered an EBITDA of close to 460 crores. Now, that's the highest we've seen the last 5 quarters, and it's close to a record high EBITDA per quarter number. So that was positive. Not just that, the outlook as well seems very, very positive because they have guided for an EBITDA number as per their calculations to come in at around 2,200 crores. Remember, their EBITDA includes the other income. But even if you take into account the 2,200 crores and compare with what they've delivered, it would mean an 18% growth in terms of an absolute EBITDA number. And they have a good amount of visibility because the orders that they're sitting on is 19,500 crores odd. So clearly for the next few quarters, they're fully booked out and they have good amount of visibility. The balance sheet as well is looking very, very good because from being a net debt company, now they're sitting on net cash of close to under 1,000 crores. That equates to nearly around 4 to 5% of the total market cap. And since they're so confident on business, remember they have a unit in the United States. They're setting up another LSAW plant unit because domestic demand is very, very strong. And they're saying that, in fact, these capacities are likely to bode well for them in the time to come. So that's why they're going ahead and setting up an LSAW facility. Earlier, they used to, ship the LSAW pipes from the India facility to the US facility, but now they're setting up shop in the United States itself. So all in all, a big beat coming in from Welspun Corp. Good numbers, good commentary, and good visibility as well.
All right, Nigel, thanks a lot for that. So that's one gainer in today's trading session. Welspun Corp on the back of good numbers. The other gainer today is, we have Cummins, which was almost double digits in terms of gains at 1%. And eventually ended about 7 to 8% higher in today's trading session. That's on the back of fourth quarter numbers, but also management commentary, which suggested a double-digit revenue growth aspiration in FY26. Vamakshi Dhuria joins in with the key takeaways. Vamakshi.
Well, Mangalam, good set coming in from Cummins. You know, when you look at the revenue, saw an uptick of almost 6%. This is lower than what the street was expecting, but the operational performance was much better. Remember, we were working with a margin contraction of somewhere over 400 basis points, but the margin contraction this time around came in just at 235 basis points. This is better than what the street was anticipating. The net profit number as well at 521 crores were above the street expectations. So overall, when we look at the numbers, it's an operations-led beat for Cummins. Now, in the con call, like you said, the company said that they will be posting double-digit revenue growth in FY26. They're likely to sustain or slightly improve the margins, that is the gross margins from here on. They, however, are cautiously optimistic as far as the demand outlook is concerned. What they've highlighted is that the pricing for the new CBCP4 plus products is, is likely to settle in the next 1 or 2 quarters. Competitive intensity has picked up, but they're still able to hold on to their prices. They have also highlighted that they see very good demand coming in from data centers as well. And as far as their Capex plan is concerned, that will be in the similar range that we saw in FY25. This is largely expected to be sustenance Capex. So overall, good set of numbers. The commentary from the management looks positive. Resultantly, the stock was higher in trade today.
Okay, thank you so much for that, Vamakshi. Ruchit, just coming to you, firstly in terms of Welspun Corp, how are the charts looking like for this one as well as in Cummins India? What are you watching out for? Are these the better plays that you're looking out in the Capex story?
Yeah, very good afternoon, Rini. Well, I think the broader trend for both the stocks is positive, but Welspun Corp is more of a continuation of the uptrend where recently we have seen that the correction towards the 200 DMA got bought into. And the price up moves in last couple of sessions today and yesterday has been supported by very high volumes. So there's a rounding bottom kind of pattern technically, which gives a potential targets around 1030, 1050 in the near term. So I think we should see a continuation of the trend in the Welspun Corp in the near term towards 1030 kind of levels. But yes, there has been quite positive change, positive change in today's trading session as far as Cummins India goes, because the stock was in a consolidation phase. The 200 DMA was last breached in December, and post December, for the first time, you have seen such volume-based buying happening in the stock. So the risk-reward ratio for fresh longs is still favorable over here, and we should see a level up move towards 3500, 3550 kind of range in the near term. So while Welspun could be a good stock to hold on if existing positions are there, I think Cummins is a structure where reversals are placed. So the risk-reward ratio is good for going fresh longs over here.
All right, so that's about individual stocks. Let's also get in another stock that was a big gainer, and we'll probably get both Ruchit and Anand's views on that. That's Deepak Nitrite, gained about 5%. Beat estimates in the fourth quarter. Recovery came in the fourth quarter despite geopolitical tensions and elevated input prices. Upasna joins in with the details of the numbers and what the management said. Upasna.
Well, certainly it's a strong beat versus the estimates. The growth was mainly driven by company's key segment, that is phenolics, which saw a volume recovery. The revenue was in this segment was also up about 5%, and EBITDA margin saw an uptick of 150 basis points at 15.6%. Now, coming to the overall consolidated numbers for Q4, revenue saw growth of about 2%, EBITDA saw growth of about 5%, and EBITDA margin saw an uptick of 30 basis points at 14.5%, while Street was working with a 9.7% EBITDA margin. So certainly a beat on that. But coming to the profits, profit remained impacted due to higher input prices and also performance of the agrochemical segment. So the profits were down about 20%. Now coming to the con call highlights, the management commentary remains quite upbeat. Management says that the domestic demand has showed early signs of recovery, and company is expanding its product portfolio, and it is expecting a long-term contract in any time soon. It is confident that the profits which were impacted this year will likely to normalize in FY26, and it has also commented on the demand for dyes and pigments. It is picking up after Q3. Coming to the agrochemical sector, the demand in this sector continues to remain subdued, and company expects this trend also to continue for some few more quarters. On the guidance, company continues to remain confident about optimistic growth in FY26, but has not given a definite number here. But the company has also said that the overall outlook remains strong and positive, with several projects set to commission in Q1 and Q2 FY26. So overall, strong set of numbers and upbeat management commentary, which led to such a surge in the stock.
Okay, thank you so much for that, Upasana. But IndusInd Bank, that was also in focus today. Now, what happened was market regulator SEBI has barred former IndusInd Bank CEO Sumant Katpalia, former Deputy CEO Arun Khurana, Executive Committee member Anil Rao, and 2 others from securities market for insider trading. With Rao's name on the list, the bank's current management structure raises concerns around governance. Amit Tandon of Institutional Investor Advisor Services believes IndusInd Bank may see some internal churn and brace up for some turbulence. Listen in.
If you read what SEBI said that, look, we've appointed KPMG on the basis of a board note. So again, you have to ask whether the board were shielding the management or whether they were taken by surprise. I think that is really not clear at this stage, and we'll need to hear a little bit more. So if there is action against the board, you can expect that there is going to be some more tumultuous times going ahead. It's clear that the board has not lived up to what RBI's expectations were and what the investors' expectations were. So I think we are going to be in for some amount of volatility or internal churn as far as the bank is concerned. Likely to be a shakeout as far as the board is concerned. There is, of course, the existing board structure, existing management structure or the leadership structure will change. So the question is, how quickly will they be able to bring in a new CEO? And that in itself will mean there's going to be a round of internal cleaning up. Every bank is going to become much, much more internal focused, rather than looking at opportunities out in the market. So I think there's going to be some degree of slowdown as far as this bank operations are concerned.
Right. So much happening. But despite that, IndusInd Bank actually ended slightly higher in today's trading session. It's seen a big cash already. And does it tempt you? I mean, the big decline that happened in every subsequent news that happens, do you get tempted to buy after that big cut, or is it something that you just stay away from?
Well, one is waiting for the entire book to be cleared up, and once that is done, or at least all the information is out, then you can be looking at it as a bank again. The problem with IndusInd Bank is that 2 parts of their portfolio are always going to be somewhat suspect. One is the micro-lending business, which I don't particularly fancy. And the other is that they have fairly strong book on the autos, which is not particularly doing very well in terms of the auto demand itself. So with both those sectors, and they form a large part of their book, so they are not best positioned in terms of the growth going forward. These are problems that the ones that you're mentioning are problems that they have created for themselves. So it's not even the problem that the market has done, which they are trying to face. It's self-inflicted wounds. Once that is out of the way, then yes, it looks relatively cheap, assuming that there is no major impact on the book. But we have to see how the book actually turns out to be once all the news is in.
Okay, Ruchit, your view that is coming in for IndusInd Bank as well as Deepak Knight, right? We've seen good set of numbers coming in from the company. So what are you keeping an eye out on the technicals here?
IndusInd Bank technical trend is still on the negative side. This has been one of the underperforming stocks, amongst all the private sector banks because of these news flows. And still there is no signs of reversal or high top, high bottom structure getting on. I think before any kind of reversal also, we would see a decent time-wise corrective phase as well in the stock. So I think in this time, other private sector banks could do better. So definitely avoid IndusInd Bank. Deepak Knight, I think there could be some pullback move because the stock is beaten down. We have been witnessing some positive momentum post the numbers today. But frankly, if we see the broader trend, then upside should be limited towards 2240, 2250 kind of range where major resistances come. But within the entire chemical basket, if we see, then I think a couple of other names such as SRF or PI Industries could do relatively better in case there is an uptrend in most of the chemical names. So I think other stocks such as SRF or PI Industries should be more preferable over Deepak Knight, but outperformance could continue.
All right, we take that point. Let's get in another one as well, which is Max Financial Services slipped in trade today. And this is not on the back of numbers. This is on the back of a management change. Prashant Tripathi, who's the managing director and CEO of Axis Life, he announces early retirement effective September end. Yash joins in with the details on that one.
Well, Mangala, you spoke about numbers. Max financial numbers also came out last week. The numbers are very strong. So in a way, it is ending an ending for Prashant Tripathi on a strong note. But, the stock slipped today in trade, and that was largely because of that unexpected and surprising decision which came from the managing director and CEO of Axis Max Life, Prashant Tripathi, taking an early exit as MD and CEO from the company. How early is this exit? It's really early because he was supposed to retire in 2028 as against which he has announced his retirement, which will be effective September 2025. So good 3 years remaining in his professional career as MD and CEO. He has decided to retire from Axis Max Life Insurance. That certainly came as a surprise to Street. But of course, as far as his term at Axis Max Life is concerned, the company certainly has outperformed the life insurance industry in terms of the new business premium that it has collected, in terms of APE as well as retail APE. The stock has given very strong returns to its investors, and importantly, it was under him that the deal with Axis Bank got consummated. So another important milestone which the company achieved under the leadership of Prashant Tripathi, but nevertheless announcing his retirement about 3 years from his scheduled time.
Okay, Yash, thank you so much for that. So keeping an eye on Max Life as well. But, thank you so much to both our guests, Ruchit as well as Anand, for joining in with us on the show as well and helping us break down in terms of the technicals as well as the fundamentals on the stock. But before we head into break, we will leave you with market voices on the impact of US tariff as well as what's next after a US court scraps tariff imposed by US President Donald Trump under the International Emergency Economic Power Act. Listen in.
It's a very messy situation for sure. Why would any country now want to proceed with negotiating with the administration when the court just questioned whether the tariffs have any constitutional right to exist in the first place? But I think everybody knows that there's no way that you can negotiate a trade treaty in 90 days. I think we're still going to get some letters of agreement between us and our major trading partners on continuing to negotiate fair trade deals. So I think there'll be a lot of face saving going on, and I think the president is basically going to declare victory and try to put this whole thing behind him by the middle to the end of the summer.
Welcome back. You're watching us here on Markets Forward. What a day it was for the bulls. The last hour rally is what we saw, but let's look at some of the key corporate voices we had over the course of the day. First up, Aurobindo Pharma's management spoke to CNBC TV18, said that they expect growth across all its businesses in FY26, while the US business, which currently holds about 11% market share in prescription, is operating at a high base. It's the US business which is projected to grow in the mid to high single-digit mark, and the management also noted that key drivers like China growth markets or Indonesia and South Africa continue to perform well. They do not expect global uncertainties to impact the company's generics business.
Next up is EID Pari. The management says FY25 was a taxing year for the sugar business. Meanwhile, they had to be cautious about FY26 due to lower cane availability in Tamil Nadu as well as Andhra Pradesh. However, the management added that the distillery segment has witnessed good growth in FY25, added it is expecting a slight uptick in margins in FY26, whereas EBITDA margins are expected to remain at 8% for the upcoming quarters. And before we wrap up this edition of Markets Forward on CNBC TV18, we'll bring you the key events to watch out for in tomorrow's trading session. And for that, we have Upasana joining you with us. Upasana.
First up, let me start with the global economic cues. US will be reporting its trade balance data. Japan will be reporting its industrial production data. And back home, India, we will get to know our provisional Q4 GDP data tomorrow. Now, let us look at the key stocks in focus on the back of corporate action. Results like Apollo Hospital, Vodafone Idea, Nykaa, AstraZeneca, Genesis Power, KNR Constructions, Greenlam Industries, all these companies will be reporting their Q4 results tomorrow. Now, stocks like Angel One, Bajaj Finance, Infosys, Jupiter Wagons, Uno Minda, GSK Pharma, all these stocks will be in focus as they go ex-dividend tomorrow. Now, in terms of board meetings, stocks like Vodafone Idea and Equitas Small Finance Bank will be in focus on the back of fundraising plans. And also, India Glycol will also be in focus as board will consider stock split plan tomorrow. So all in all, it looks like quite an eventful day tomorrow.
Pasna, thanks a lot for that. So a bunch of events that are in focus for tomorrow. With that, we'll wrap up on this edition of Markets Forward. You stay tuned to CNBC TV18. More news and updates on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. A U.S. federal court halts President Trump's tariff juggernaut, rules that he overstepped his authority by invoking an emergency law to impose sweeping tariffs on numerous countries. The Trump administration appeals the ruling even as it explores other legal options to impose tariffs. Defending the tariffs in court, the Trump administration argues that any legal setback could put the India-Pakistan truce at risk. Commerce Secretary Lutnick tells the court the ceasefire was only achieved after Trump intervened and offered trading access to avert a full-scale war. The Sensex and the Nifty end with marginal gains after a volatile session. India underperforms other Asian markets, which saw strong gains after the U.S. court order blocking Trump's tariffs. European markets also move higher. The Reserve Bank's annual report shows that the balance sheet is up more than 8%. Net income jumps 27% on forex gains. The value of gold holdings up 57% as the central bank adds 54 tons of fresh gold in FY25. The RBI report shows a 33% drop in bank frauds in FY25 compared to FY24, but the amount involved in frauds rises nearly threefold to more than 36,000 crore rupees. Public sector banks account for 71% of the fraud amount.
With President Trump, crypto finally has a champion and an ally in the White House.
U.S. Vice President J.D. Vance attends a Bitcoin conference, declares U.S. government rejects regulators and promises to fire anti-crypto regulators like the current SEC chairman Gary Gensler. Bitcoin prices are up 60% in the last 12 months. Tesla CEO Elon Musk leaves the Trump administration after a 5-month stint at the Department of Government Efficiency. Tweets that his scheduled time has come to an end. The announcement comes days after he criticized Trump's so-called Big Beautiful tax cut bill. NVIDIA reports a record quarterly revenue of $44 billion. This despite its inability to ship semiconductors worth $2.5 billion to China following the U.S. restrictions. CEO Jensen Huang warns against curbs on China, saying the platform that wins in China will lead the world. Hailey Bieber sells skincare brand Road to e.l.f. Beauty for $1 billion just 3 years after incorporating it. This is e.l.f. Beauty's biggest deal yet.
President, Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
Oh, isn't that nice? Chicken out. I've never heard that yet.
Well, President Trump enjoys his fast food, but not tacos. Reporters' question on the so-called taco trade leaves the president fuming. We will explain in just a bit. But the top story this evening. In a big blow to the U.S. President Donald Trump, a federal court has blocked his so-called reciprocal tariffs under emergency powers. The Court of International Trade in New York declared the orders issued on what Trump called Liberation Day as illegal and an overreach of power. Now, the court has not only put a permanent halt to most of the tariffs, it's also barred any future modifications to them. The Trump administration was swift to appeal the ruling. Trump is yet to respond to the ruling, but a White House spokesperson claimed that unelected judges cannot decide how to address a national emergency. In an attempt to justify the tariffs, the Trump administration cited the recent ceasefire between India and Pakistan. In a submission to court, U.S. Commerce Secretary Howard Lutnick said, and I quote, "This ceasefire was only achieved after President Trump interceded and offered both nations trading access with the United States to avert a full-scale war," end of quote. Lutnick went on to say that any adverse ruling will constrain presidential powers and could lead to India and Pakistan questioning Trump's offer, which in turn threatens the security of an entire region. The judge did not accept this argument and ruled that sweeping tariffs invoking an emergency law was an overreach. Surbi joins us now with more on the U.S. court's tariff order and its implications for the Trump administration and his tariff juggernaut. Surbi.
Well, almost 2 months after it was unleashed on the world, the Trump tariff juggernaut has finally hit a legal roadblock. On Wednesday, the U.S. Court of International Trade struck down a series of executive orders which had put Trump's global tariffs in motion. The court's view is that the International Emergency Economic Powers Act, which the U.S. president had actually invoked while declaring a national economic emergency back in April, simply doesn't authorize him to take unilateral tariff calls and levy universal tariffs. Basically, the court has said that Trump has overstepped the authority that was granted to him by the legislation. And those are the highlights that we just had on the screen earlier. These are the executive orders. So let's talk about what these executive orders were, which have been struck down. Now, the court has basically said that there are 4 executive orders that have been struck down. So let's start with the latest one, Executive Order number 14257. With this order being declared invalid and quote-unquote contrary to law, Trump's 10% baseline tariffs, as well as the reciprocal tariffs which were levied on countries around the world, become null and void. The other executive orders that have been struck down render the fentanyl tariffs levied on Canada, Mexico, and China invalid. Finally, the court order also strikes down the 25% tariffs levied on goods that were not covered by the US-Canada-Mexico agreement. It is, however, important to note that the 25% tariffs on steel and aluminum remain unaffected by the court's order, as these were imposed under a different act, a different piece of legislation, and I'll come to that in more detail in just a bit. So what happens now? Well, the US administration has already swung into action and it has challenged the trade court's order at the US Court of Appeals. Legal experts feel that this battle in all probability is likely to head to the US Supreme Court. Now, in the meantime, Trump has several other legal options in his arsenal to keep the tariff heat on. The first of them is a wider use of Section 232 of the US Trade Expansion Act. Remember the steel and aluminum tariffs, which I just spoke about, and they're still in effect? Now, they have been levied under this very section of the Act. Trump could expand the scope of this Section 232 to other sectors as well. In fact, the administration is already evaluating potential tariffs on aviation, on electronics, and pharma imports under this Section 232. So watch for this. Next, there is the US Trade Act of 1974. Section 122 of this particular act allows the president to levy a baseline tariff of up to 15% to address quote-unquote balance of payment concerns. And, the current trade issues could fall in this category. The levies can last up to 150 days without the need for any sort of congressional approval. Let's move on. There is then the Section 301 of the same US Trade Act. This allows the US government to launch a wide trade investigation against any US trading partner and then impose tariff levies. However, this could be a very cumbersome and time-consuming route, so may not be the US administration's first port of call. Finally, there is the option of using the US Tariff Act of 1930, which has not been used till now. The section number 338 of this legislation allows the US to levy up to 50% tariffs on imports coming from countries which discriminate against the US. That's a pretty wide term, so it can be interpreted in any way. Now, as the tariff war takes a legal turn, here's a statement from the White House spokesperson, Kush Desai. This was immediately after the court order. He went on to say, and you can see it on the screen, it is not for unelected judges to decide how to properly address a national emergency. So this was first. And then we had a social media post from the man himself, Donald Trump. And it's very cryptic, but he goes on social media and he says he's on a mission from God and nothing can stop what is coming. Now, it's cryptic, whether it means more tariffs, the use of any one of these factors that I described, only time will tell. But the markets could be rejoicing for now in the interim. However, the only thing that is certain after Wednesday's court ruling is that this is only round one of the legal battle, that the US president has a wide array of legal and executive options in his arsenal to keep the tariff blitzkrieg on.
So, many thanks. Well, the markets are not rejoicing. They are waiting to hear from President Trump and anticipating what possibly could be coming, in his words. In fact, the Dow futures have given up some of the gains that we saw early on. Global markets did cheer the court ruling that blocked Trump's reciprocal tariff. Stocks in Asia Pacific and Europe surged, as did Wall Street futures. The US dollar rallied in a knee-jerk reaction, providing some relief to the currency that had weakened amidst the trade uncertainty. But as I pointed out, US futures have given up some of those gains. Wall Street has been abuzz with a new term. It's called taco trade, where taco is short for Trump always chickens out. The phrase, first used by a Financial Times commentator, is meant to describe Trump's on and off tariffs and the manner in which stock markets respond to them. And this has left President Trump fuming. When questioned by a CNBC reporter about taco trade, Trump referred to it as a nasty question and defended himself, saying he had never chickened out in trade negotiations. Here's that exchange.
President, Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
I kick out?
Chicken out.
Oh, isn't that nice? Chicken out. I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said you have to open up your whole country, and because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now. And I said, okay, I'll give you till July 9. I actually asked them, I said, what's the date? Because they weren't willing to meet. And after I did what I did, they said, we'll meet anytime you want. 6 months ago, this country was stone cold dead. We had a dead country. We had a country people didn't think it was going to survive, and you ask a nasty question like that. It's called negotiation.
Well, that's President Trump on the taco trade. Now, back home, the Sensex and the Nifty ended with marginal gains after a volatile session. The Nifty ending above 24,800, largely led by IT stocks today. The Sensex closing 300 points higher, 81,633. The Nifty Bank up by over 100 points, and it's a 300-point higher on the Nifty Midcap as well. Now, the Reserve Bank's annual report for FY25 has showed the balance sheet is up more than 8%. Net income rose 27% on forex gains, while the value of gold holdings rose 57% as the central bank added 54 tons of fresh gold in FY25. Lata joins us now with the fine print. Lata.
Well, the interesting takeaway are all over the place. One of them is that the RBI has bought a lot of gold. They have bought 54.13 tons of gold. So the total value that they hold is up by 57%. From 2.75 lakh crore, it's gone to 4.32 lakh crore. Only, 7% of that has come from the actual amount of gold increase by 54 tons, as I told you. The rest is because gold prices have shot up. You would think that 7% is a very big number, but it's bigger. It's the highest in the last 3 years. Last year, their gold holdings, the amount in tonnage rose by 3.5%. The year before by 4.6%. But way back in FY22, they had bought 65 tons of gold. So at that time, it had gone up by 9.3%. So this is not the highest, but clearly highest in 3 years. The other thing you learn is about why they reported this subdued dividend compared to what the market was expecting. That's entirely because they've increased the reserves, which is why the board met. The board met and said that instead of a contingency reserve of 5.5 to 6.5, they will expand it to 4.5 to 7.5. They've increased the reserves to 7.5. And that means 76,254 crores more had to be set aside to take the reserves to 7.5%. And if they had not done that, that 76,000 crores would have been added and the surplus could have been 3.6 trillion. But obviously, they probably want to smoothen it out and they could lower the reserves this year, who knows. The other point to note is that they've not made so much money in selling dollars. You know, when the Bimal Jalan committee allowed them to book the dollar profit, the RBI was making some 14-15 rupees every dollar sold because the purchase price was the historical price. But now all that has been juiced out. Today, if you do the math, in FY25, they have earned only about 2.8 rupees per dollar sold. Not a great deal of profit because a lot has already been juiced out. That could be the reason why they wanted to change the reserves and give elbow room in the future. Finally, the most important part of the annual report is the economic outlook. No surprises there, except some extra optimism, more than we were prepared for. The global outlook is, of course, bleak. They point to the slowing disinflation. That's important. High public debt, highly leveraged governments, geopolitical and trade tensions, market volatility, and, of course, climate shocks as well. On the domestic economy, the adjectives are a little more glowing than one would have expected. High optimism because of, recovering consumption, continued Capex push by the government, strong bank and corporate balance sheets, easing liquidity, financial conditions, a resilient services sector. What they're not pointing out is that rural has done very well, not urban consumption so much. Government Capex is very good, private Capex is not so good, but those nuances are not there. The one conclusion the bond market can draw is, therefore, will they not cut too much? Are there only 2 more rate cuts, not 3, as some were expecting? That it leads to that kind of a doubt because the optimism stands out.
Lata, many thanks for joining us. And we're not done with the RBI annual report because it also highlights that the total number of bank frauds, while they fell by 33% last fiscal when compared to FY24, the fraud amount has risen nearly threefold to over 36,000 crores, with public sector banks accounting for 71% of the same. Ritu joins us now with more. Ritu, take us through some of the key highlights of what the RBI is saying when it comes to bank frauds.
Well, let's start with something that always raises eyebrows, and that's bank frauds. In FY25, the number of fraud cases actually dropped by a third compared to the previous year. But here's the twist. The amount that was involved actually tripled from FY24, hitting a massive 36,014 crore rupees. But the spike is explainable because a big chunk of more than 18,000 crores actually came from 122 older cases that were initially missed and then reclassified as frauds later. Now, when we look at where the damage was, public sector banks bore the brunt, making up for more than 71% of the total fraud amount, while private banks saw the highest number of cases. In other interesting highlights, India continued to shine when it comes to digital payments. It accounted for 48.5% of all the global real-time payments driven by UPI. Digital payments surged, with total digital transaction volumes rising by nearly 35% and value by 18% year-on-year in FY25, with UPI leading the growth. Overall, 99.9% of all the non-cash retail payments were done digitally in FY25. But even as digital payments continue to rise, cash is not really going anywhere. The value of banknotes in circulation went up by 6%, with the 500 rupee note making up 41% of the volume, followed by the humble 10 rupee note. Now, here's something new as well. The central bank digital currency, or the e-rupee in retail, that rose by 333% in circulation to more than 1,000 crore rupees in FY25, and the CBDC pilot now has 60 lakh users in India. And finally, some good news on the fake note front, where the number of counterfeit notes detected was down to 2.17 lakh pieces in the year.
Ritu, many thanks for joining us. Let's talk about the commodity markets. Now, oil prices rose after the U.S. court blocked U.S. President Donald Trump's tariffs from taking effect. Supply concerns on account of Trump's threat of potential new sanctions on Russian crude have also pushed prices higher. Meanwhile, gold prices hitting a one-week low this after the court's decision came in, which dampened the metal's safe haven allure. A robust dollar further pressured the bullion. U.S. Vice President J.D. Vance reiterating the Trump administration's support of cryptocurrencies, saying that the White House was an ally and a champion of the digital assets. Speaking at a Bitcoin conference in Las Vegas, Vance declared that the U.S. government rejects regulators and promised to fire anti-crypto regulators like the current SEC chief Gary Gensler. Take a look.
And I'm here today to say loud and clear, with President Trump, crypto finally has a champion and an ally in the White House. We've got to clean up the wreckage that the last administration left us. And since day one, that is exactly what we've been trying to do. Our administration, we prioritized eliminating the rules, the red tape, and the lawfare that we saw aimed at crypto by our predecessors. We're ending the weaponization of federal regulations against this community. To put it simply, Operation Choke Point 2.0 is dead, and it's not coming back under the Trump administration.
J.D. Vance going all out for cryptos, and Bitcoin has been on a bull run for last year, with the currency up 60% in just the last 12 months. Manisha's here with more. Manisha, plenty of action there in the crypto market, especially as the Trump administration throws its weight behind cryptocurrencies.
Oh, well, yes. Cryptocurrencies as a segment has continued to do well for 2025 in sense of prices, market capital and institutional adoption. If you look at the market cap, that's at around 3.6 trillion. This is derived from nearly 16,690 cryptocurrencies tracked across 1,277 exchanges in the global markets there. Bitcoin has gained up by 50% since the month of November 2024. That is when Trump put out that election victory there. Also, Bitcoin hit an all-time high in the previous week itself at around 111,000 per Bitcoin. Well, while we have seen President Trump continue to say that they will make U.S. as the crypto capital of the world, it was just this week itself that we also have seen U.S. roll back a guideline which urges companies to, exercise extreme caution when they are looking at cryptocurrency, especially offering crypto in their plan of 401k. This is what goes in for pension funds and various other funds as well. Apart from that, the annual Bitcoin conference in Las Vegas also has gained in shape, form, and the kind of attendance it is seeing. This is the first time ever since it started that you have a sitting U.S. Vice President delivering a keynote, notice there. J.D. Vance also said that he himself owns cryptocurrencies, also urged the crypto executives and enthusiasts to continue to put Congress for more crypto-friendly legislations there. Also said that the President Trump will sign a legislation as early as August on stable coins. So a lot of positive moves coming in really from U.S. and various other parts of the world as well, which is keeping cryptocurrencies in a very strong favor.
Manisha, many thanks. And staying with cryptocurrencies, Bharti Enterprises Chairman Sunil Bharti Mittal has called for urgent regulatory clarity on cryptocurrencies, citing the sector's unprecedented growth in the last few months. Speaking at the CII Annual Business Summit, Mittal stressed that India cannot afford to stay on the sidelines. Take a look.
Things have started to move very fast on crypto. And of course, AI, we already discussed, is moving very fast. And this is an area where the government will have to start applying their mind on how to ensure that the right regulatory framework is available for India to make full use of AI, crypto, whenever the time comes.
Well, regulatory clarity are needed in India for cryptocurrencies. That's Sunil Bharti Mittal. We'll head into a break, but up next, Tesla CEO Elon Musk leaves the Trump administration after a 5-month stint at the Department of Government Efficiency. That and more when we return. Chip giant NVIDIA reported a strong set of numbers in the first quarter, posting a record quarterly revenue $44 billion. This comes despite the company's inability to ship semiconductors worth $2.5 billion to China on account of the restrictions imposed by the U.S. government. The company's data center business also recorded a growth of 73% on an annual basis. NVIDIA said it expects around $45 billion in sales in the current quarter. The company's CEO Jensen Huang has warned against curbs on China, saying the platform that wins in China will lead the world. Take a look.
The platform that succeeds is the platform with the most developers. Just like iPhone successful because of lots of developers, Windows successful because of lots of developers. All these platforms succeed because there are a lot of developers. China is home to 50% of the AI researchers in the world. And so we want the world to build on American technology stack. We want every developer in the world to prefer the American technology stacks.
That's Jensen Huang there, the CEO of NVIDIA. And Tesla CEO and billionaire Elon Musk has exited the Trump administration, bringing an end to what has been a tempestuous 130-day stint as a special government employee heading the Department of Government Efficiency. Musk took to X and thanked the U.S. president for the opportunity to slash what he called wasteful federal spending. Musk's off-boarding announcement has come days after he criticized Trump's tax cut bill. Here's a wrap of Elon Musk's controversial tenure as a key figure in the Trump administration.
Elon Musk is leaving his role in government. A White House official confirmed the move late Wednesday, saying the billionaire's offboarding would begin the same night. Musk set out to slash government spending, saying in March he could cut at least $1 trillion off federal expenditures.
If we don't do something about this deficit, the country's going bankrupt.
But DOGE attracted huge controversy, with critics saying it was making indiscriminate cuts that threatened vital services without even delivering the promised savings. The controversy may also have done deep harm to some of Musk's businesses. Tesla sales have slumped in some markets, notably Europe, amid anger over his embrace of far-right politics in some countries. Now he says he'll devote himself to business again, and says his firms will be revived with world-changing products, including humanoid robots and robotaxis. Signs of a possible rift with Trump had been apparent in recent days. On Tuesday, Musk criticized the president's big tax bill, saying it was too expensive and undermined DOGE's efforts to trim the budget deficit.
Well, that's the end of Elon Musk at DOGE heading back to business. Now, global cosmetic giant e.l.f. Beauty has bought Hailey Bieber's skincare brand Rhode for $1 billion. This comes as the beauty giant plans to expand its footprint further into the skincare segment. The transaction will comprise of $800 million in cash and stock, including an additional potential of $200 million payout based on Rhode's performance over the next 3 years. This will be e.l.f.'s biggest acquisition to date. So Hailey Bieber sells her company Rhode to e.l.f. for $1 billion. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. But for now, from all of us here on the team, goodbye. Thanks for watching. Stay tuned. The news will continue.
Well, it is my great pleasure now to welcome Dr. Raghuram Rajan to our program today. Dr. Rajan needs little by way of introduction, but let me be brief. He is one of the world's most respected economists, currently the Catherine Dusac Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. He served as the 23rd Governor of the Reserve Bank of India, where he was widely credited for bringing down inflation, strengthening the banking system, and introducing key reforms that have had a lasting impact on India's economy. Dr. Rajan's distinguished career also includes serving as the Chief Economist and Director of Research at the IMF. Dr. Rajan, great to have you with us here on the program. It's an honor, sir. Prashant this side. Dr. Rajan, if I can start by asking you whether the good news on tariffs, when I say good news, I mean, this handshake type of deal that we saw between the US and China. It's not even a deal, as someone said, not even a framework deal, but at least an agreement to start talking. Or the one with the UK. Have we seen the peak of the good news cycle as far as tariffs go? And will things get more contentious into the rest of 2025? What's your assessment, sir?
Well, I certainly think that what we need to have is more certainty on where the tariffs will land. Right now, we have, as you just said, an agreement to talk. But at the end of this talking, what happens? And talking takes a long time. So even while people are talking, are tariffs going to go back to the Liberation Day level on July 9th, 10th? For the rest of the world, is it going to go back to the Chinese levels on August 10th, 11th? I think the sense is certainly the level of tariffs that were announced in Liberation Day are probably untenable. And so they will have to be negotiated down. But where and when is the kind of uncertainty that harms business considerably also. So a lot of businesses waiting to see, are they going to keep the tariffs, at least while the talk is going on, at the 10% level for most of the world, or is it going to go back up? So some certainty on that would also be most welcome.
Dr. Rajan, when financial markets do well, it kind of papers over a lot of other stuff, some of the underlying issues, etc. And if you look at global, the big markets, they're all a few percentage points away from all-time highs. It's almost as if tariffs really will not hurt. I mean, they're pricing in little to no damage because of tariffs. What is your sense? Is it possible we actually, escape any consequences, or do you think it'll show up? Not now, but maybe a little later.
Well, there is something somewhat funny about financial markets that as far as policy goes, especially when policy is as unpredictable as in the current situation, it seems to almost be putting a probability of 1 based on the current environment persisting. So when the US raises tariffs on Europe, immediately markets react negatively. The moment there is a discussion of a pause, they react positively. So I don't think markets are really pricing outcomes effectively. They don't quite know, and they're putting a lot of weight on continuity right now.
Just one more question to finish that loop. Do you think the tariffs are being used by the Trump administration as threats to negotiate, or do you think they're very ideological about this? And, as someone said, President Trump, in all likelihood, will not, this is his last term, so it's not as if he's standing for re-election. So he wants to effect change and bring manufacturing jobs, American manufacturing jobs, back to the States. So I think, is this going to be a lasting theme throughout? Or do you think at some point, he's going to give in and then, watch the markets and the good stuff comes? What's your sense?
I think the tariffs are not going to go back to the old levels. I think there is some level which will stay, maybe the 10%, and certainly maybe more in certain areas like autos. And that's partly because of the ideological underpinnings of the current administration. They do believe the U.S. has been unfairly treated by the rest of the world, but they also believe that tariffs can give the U.S. a certain amount of sort of playing power. But I also think that right now with the tax bill, the big, beautiful bill under consideration, tariffs also play a role in being a source of revenues. And the U.S. desperately needs a source of revenues to justify the level of tax cuts that are coming in the bill. So for all those reasons, plus the fact that I think it gives the U.S. a lot of power because it's a big market for the rest of the world's goods, I think they're not going to go back to the old levels. The question is, are they going to be uniform across the board? Or are they going to be especially high for certain countries that are disfavored? And what is the longer-term certainty about the levels that are reached? Could it be that the administration turns on a dime and starts elevating them again for a country that it doesn't like or that has antagonized it? So I think a lot is up in the air, but almost surely we're not going back to the 3% level that the US was happy with before. It will be a higher level of tariffs.
Dr. Rajan Surabhi here. I'm glad you brought up the big, beautiful bill. I have a two-part question. So we're looking at two very big sort of events playing out right now. One is tariffs and whether the Trump administration can bring manufacturing back to the US or not. The second piece is the US deficit. And the bill is only going to be boosting that further. In the near to medium term, let's say if you take a 2 to 3 year view, what is the big economic reset that you forecast for the US economy? And the second part of that question is, and therefore, do you expect a flight of money, maybe not a big flight, a small flight of money, away from US assets, US treasuries, US equities?
First, I think the short run tariffs are disruptive, even to manufacturing. So we will see the consequences in the second half of this year. Will it bring back manufacturing jobs? Probably not a whole lot, because a lot of manufacturing, even in India, has been automated. Look at a cell phone assembly line in India, and you see machine after machine. These are not people screwing in stuff into the motherboard. That job disappeared a long time back. So I think when the jobs come back to the US, to the extent they come back, they have to take into account the high cost of labor in the US, which means it's going to be largely automated jobs. And jobs that will be created will be for technicians who man the machines, not for the guys doing the work directly. So big increase in manufacturing jobs, unlikely. But in the longer run, I think one of the concerns this has created in the rest of the world is, are we overly exposed to the United States? And you can see it in the talk amongst financial investors. 70% of global stock valuation was in the US. And now people are saying, well, maybe we are overly exposed. We need to rebalance our portfolios, both on the equity side, but also on the fixed income side. Are we holding too much in US treasuries? So when you talk reset, I think this portfolio rebalancing will play out for some time. It is one reason why the US dollar hasn't appreciated, even while there are global concerns about economic growth. It's because people are saying, do I really want to put more assets in the US at this point? And many portfolio managers are saying, maybe I need to rebalance, not necessarily because US growth is going to fall off a cliff, but because I just think I am overly exposed to my sense that the US exceptional performance will continue. I think more broadly, we're going to see supply chains move nearer home, wherever home is. That is a process that has been underway, but that'll get a special oomph under President Trump's policies.
Okay, so sir, do you then see only a mild reset in market flows or in sort of investment portfolios? And what about the deficit? I mean, we're very used to it. Every year there's a debate on the deficit, and then, they sit on the fence. Eventually, the bill gets passed. Just a word on how you see that shaping up, and therefore what happens to yields?
I think it's not a mild reset. I think there is going to be a significant reset, especially as areas like Europe start considering whether they should be spending more, whether they need more financing. And Europe has been sending a lot of capital to the US. As Europe starts doing more infrastructure, as it does more defense spending, some of that financing will go towards financing European asset creation. And so I think there is going to be a global reset in portfolio holdings. And that will also be accompanied by price changes. You're already seeing a somewhat weaker dollar than anticipated at the beginning of the year. And that's something that could possibly continue. So this is on the cards. Sorry, what was your next question?
On the deficit and the direction of US yields, sir.
Yeah, I mean, look, I think the big, beautiful bill is not yet fully done. I think the Senate will have a role to play. And some of the worries in recent days, which has sort of shown up in higher yields, not just for US long-term assets, but also across the world, Japanese long-term bonds. I think people are very wary at this point about being locked in to longer-term investment in government securities, given the uncertainty about fiscal space, both in the U.S. but also in Japan as well as Europe. So what this means is that you can't take U.S. financing for granted. The U.S. debt to GDP is crossing 100% net in the next couple of years. And add to that a wider fiscal deficit embedded in a big, beautiful bill. And there are some sort of fiscal engineering also embedded in it, which says some of the spending or some of the tax cuts will come to an end at the end of the Trump administration. That is probably unlikely. So when you put it all together, this bill has to satisfy markets that it is not totally irresponsible. And I think the Senate, including the Senate Republicans, will have to play a role there.
Well, I wanted your view on India being able to get a fair share of the global supply chain diversification. Do you think a lot of MNCs will look to set up shop here in India?
Well, it could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them. And if India can put out the red carpet and say, we will have a predictable tax and policy regime, we will allow you to also produce for the domestic market, and don't worry about the pushback from Indian industry, which feels threatened. We will make sure these policies are in place for the foreseeable future. It could result in a significant increase in foreign direct investment. Of course, industrial countries don't want to see supply chains moving from China to India and not coming back into the domestic market. But if India plays its cards well and doesn't make it front and center all about subsidies, that it is about a better production environment and it offers a very viable alternative. And some of the states in India are very interested in doing this. I think if we can do that, it could be India's moment. But a lot more action is needed, and it has to be proactive, not just reactive. It is about creating a better environment in India for foreign direct investment, something we haven't paid enough attention to in the last few years.
Dr. Rajan, in that context, President Trump's almost warning to Apple, that we've tolerated you making in China, but now come back home. And the iPhones that you sell in America need to be made in America. How much attention should we pay to those kind of statements? And actually, the question is, how much attention will Apple pay, or other large global MNCs pay to something to things like this? Because I mean, companies have got to think beyond 4 years, right? Which is the presidential term.
Right. No, I mean, it would be the rare CEO who wants to cross the Trump administration at this point. But it is a negotiation. ploy, not so much ploy, but there is room for negotiation. Apple can point to all the work it's doing in the U.S. and the profits it's generating in the U.S. as a result of its creation of new designs, new intellectual property, etc., and say that the manufacturing is essential in a cheaper place so as to get Trump products out at a reasonable price to U.S. consumers, but also to consumers in the rest of the world. That kind of reasonable argument has to be made, but also it does indicate the importance of not trumpeting the fact that you're coming away from China and putting it in India. There is a lot of value to flying under the radar screen at this point and doing what you need to, but also having a frank discussion with the administration on what can be brought back and what can't. Screwdriver technology, assembly, stuff like that is going to be hard to bring back to the US. But certainly, Apple can say that there's a lot more R&D going on as a result of its ability to sell its products across the world. And that R&D happens in Cupertino, not elsewhere in the world.
Global captive centers here in India has been a huge growth industry with, I think, pretty much all large MNCs here, American and otherwise. Dr. Rajan, let's talk about the trade deals themselves, right? So we've got one with the UK. The US one, we heard, I think there were some reports saying that over the next 7 to 10 days, we perhaps will get some sort of a framework deal, like an MOU, and then the actual stuff will take more time. What is your sense? On the India-US deal per se, but more also about these bilateral deals, right? Because these multilateral kind of setups, trading setups are breaking up. It's all sort of one-to-one, country to country. So just wanted your thoughts there.
Well, yes, it is unfortunate that we're not really talking about a global mega deal. But what I do hope is some of these bilateral deals create the kind of momentum which lead a country to think about the bigger picture. It would not be appropriate for India just to do tariff deals with the US while inhibiting other countries from benefiting from that. It makes sense for US industry to have the same kinds of rights that, for example, European industry has, which then benefits India because it locates production, it buys for production in the best place possible for India. So, these bilateral deals could get converted into a more multilateral deal, and that would make sense from India's perspective. Now, as you said, these bilateral deals are really, interim arrangements, a statement of principles on where the negotiations are taking place. Actual trade deals take a much longer time to negotiate, while there is an impetus to do it quickly, to dot the I's and cross the T's will take more time. But I do hope that, bringing down tariffs with respect to the US gives the impetus for India to bring down tariffs more generally, and thereby reintegrating itself in global supply chains, which it has missed out on. This may be India's moment, and it should use the negotiations to advantage, not simply be driven by the incentive to protect certain segments of Indian industry, but to make Indian industry much more competitive globally and take advantage of this moment in that way.
That's a strong point, a point very well made, sir, that this could be India's moment. We should not look at protecting specific pockets of industry. We should look at the bigger picture and seizing the global opportunity here. Got your point completely. So moving now to the general sense of, monetary policy and regulation here. We're coming off from a phase where, there was a sense being built up, or there was a sense that, unchecked, unsecured lending had to be regulated, and that was done by the previous governor. And since then, some of those prudential norms have been eased out, and now there's an expectation building in the market that we will be in the era of ample liquidity and perhaps big rate cuts as well. In your assessment, does India right now need that level of a monetary growth kicker?
Well, I don't usually comment on Indian monetary policy. I probably know less than I should about it. But let me set it in the global context. Outside the United States, the raising of U.S. tariffs has been a negative demand shock. There's less demand for goods produced by the rest of the world because of the U.S. Tariffs. But also, it does give countries like China, which are big manufacturers, the incentive to look for new markets, which is also going to hold down the price of goods. China is going to look to Europe, to India, to other places to send some of the goods that are not going into the U.S. So all this means that inflation is less of a problem. Of course, there are India-specific reasons why inflation has come down, including the prospect of a good agricultural crop going forward. So for all these reasons, I think countries outside the United States have the ability to ease monetarily. And if that also implies easing on the liquidity front, that's a good thing. But as you caution, we have to also make sure that as we are enhancing domestic demand, it doesn't get imbalanced. We don't see pockets of excessive credit growth as we saw with the unsecured lending. We have to be a little careful as we expand, once again, that credit is reasonably well allocated, which means a continuing role for careful supervision and regulation.
Dr. Rajan, wish we could go on, but I understand you also have a tight schedule there at the UBS conference. I'm going to just ask you one last, if you will humor me, sir. You're at the UBS conference and you're meeting so many investors and so many people who are there. As you kind of sort of soak in all the feedback and all the commentary there, can I get one big non-consensus view from you, sir? What do you strongly disagree with that from everything that you've heard there? If I can ask you that.
Well, let me put it this way, consensus tend to build up, and because they're the consensus, they tend to be wrong. The consensus at the beginning of this year in places like Davos was, U.S. exceptionalism, this is going to continue. And we've seen 5 months later that, it's going the other way. There's enormous skepticism about the U.S. And its policies. And I would say that's again, a reason to rethink that maybe, all this plays out in a reasonable way. And at the end of it, there is still some sort of faith in U.S. exceptionalism, the innovation, the energy in the U.S., is still maintained, maybe at a somewhat weaker level. You won't see that in current U.S. policy. There is a lot of ferment going on in the U.S. Administration is trying to do one thing. The courts are trying to do something else. Things will settle down. But if there's one consensus right now, it is everything else is moving up. The U.S. is moving down. And maybe this consensus will prove to be wrong.
That's lovely. And I think it's something we should pay attention to, and we'll keep the back of our mind when we conduct these interviews, because you're absolutely right. That seems to be the prevalent consensus view at this point in time. Dr. Rajan, we'll leave it at that. Thank you very much for taking out the time and joining us here on CNBC TV18. It's a pleasure, sir, and hope we can do this again soon. Thank you.
Thank you.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the top story this evening. In a big blow to the United States President Donald Trump, a federal court has blocked his so-called reciprocal tariffs under emergency powers. The Court of International Trade in New York declared the orders issued on what Trump called Liberation Day as illegal and as an overreach of executive power. The Trump administration was swift to appeal this ruling. Trump is yet to respond to the ruling, but a White House spokesperson claimed that unelected judges cannot decide on how to address a national emergency. Let's quickly sum up the court order. In fact, Trump's 10% baseline tariffs as well as the reciprocal tariffs levied on countries around the world become null and void. The other executive orders that have been struck down render the fentanyl tariffs levied on Canada, Mexico and China invalid. The court has also struck down the 25% tariffs levied on goods not covered by the United States-Canada-Mexico agreement. However, that the 25% tariffs on steel and aluminum remain unaffected by the court orders as they were imposed under a different act. Also, Trump still has enough legal ammunition to impose tariffs. And well, joining us now to take this discussion ahead is with us Mr. Jayant Dasgupta, former Indian ambassador to the World Trade Organization. Mr. Dasgupta, thank you so much for joining us. Help us put this development in context. The U.S. court viewing things very dramatically different from what Donald Trump has been pitching it as justified as reciprocal tariffs. The U.S. court saying, look, this is an overreach of your executive powers. Put this development in context. What does this do to the tariff battles that we have been seeing over the last very many days, weeks?
There are 4 points which have been highlighted in this order of the Court of International Trade, New York, which is a federal court. And we need to bear in mind that there is an appeal which can be filed within 10 days in the Federal Circuit Court of Appeal. And if one of the sides loses and decides to appeal, then the final appeal will lie with the US Supreme Court. So it is likely to take a few weeks at least before a finality is reached on this decision of the Court of International Trade. Now, the most important thing on which the Court of International Trade has ruled against the Trump tariffs is that this is a delegated power which was given to the president. And the delegated power cannot be without any bounds or limits. And if the delegation has been done without specifying under what conditions it can be exercised and what would be the boundaries, then it is invalid. So on that count alone, the Trump tariffs have been struck down. The second point is that President Trump has been saying that there is a trade deficit which the US suffers from. Now, the court has mentioned that there is a Section 122 of the Trade Act 1974, which says that for 5 months, 150 days, tariffs up to 15% can be imposed to tide over a trade deficit situation. So that President Trump can use, but it will be restricted to 150 days and only for up to 15% of tariffs. The third point is this national emergency which he has invoked, that has not been upheld by the court. The court did not see enough reason to uphold that, barring, of course, the issue of steel and aluminum tariffs, which have been allowed to carry on. The next point is about the applicability of the tariffs. Applicability of the tariffs. The Court of International Trade has mentioned that it should apply to the whole of the country because tariffs, excise duties, etc., they all apply uniformly across the board. And the Supreme Court has a few matters in the US pending before it on this issue. So this will give finality if the appeal goes up to the Supreme Court as to whether it should be applied across the board all over the US or selectively. So these are the few
Right, Mr.
issues.
Dasgupta, Right, Mr. Dasgupta, you've given us valuable insight. Let me then ask you, this court ruling was limited to striking down the tariff orders that had been issued under the International Emergency Economic Powers Act. That's the legislation under which all tariff orders that were issued were struck down. However, like you yourself pointed out, tariffs on aluminum, on cars, on certain specific products have not been struck down. It's because they were passed under separate legislation. Are we all looking at a possibility that Donald Trump, if he loses this legal battle, could simply revive these tariffs under a different legislation, under a different law?
Well, under Section 232, which he had invoked even in his first administration, for invoking steel and aluminum tariffs on the national security issue, that can be used by President Trump. But that is also subject to challenge. Now, in this case, there were a few small business enterprises and associations which had filed the case, along with some Democrat-ruled states. So, were he to extend the steel and aluminum tariff example to cover all the other products that he has covered under reciprocal tariff, I'm sure this challenge will again be made about whether a condition of national emergency exists or national security concern of grave, of gravity is there to justify.
Right. Mr. Dasgupta, you also mentioned the appeal process. Of course, it concludes with the United States Supreme Court. I just want to get your perspective. The U.S. Supreme Court, 9 judges, 6 of them appointed by Republicans, 3 of them appointed by Donald Trump himself. Is he on a stronger footing as this matter travels north towards the U.S. Supreme Court?
Well, from the reports which have come out of the Court of International Trade, there were 3 judges. One was appointed by Ronald Reagan. The other one was appointed by President Obama. And the third one was appointed by President Trump himself in his first stint. So I think the judges have not really, been moved to who has appointed them and their political inclinations. They have risen above that, and they have given judgment which can be tested in the Federal Circuit Court of Appeals and in the Supreme Court later. And I think that the U.S. Supreme Court will also, because this is something which is of great importance and significance, because it tests the U.S. Constitution, the delegation of powers to the president, whether they are unfettered, if they have not been, the boundaries have not been specified by the legislation to delegate powers, or there will be fetters. So it is a major constitutional issue because it will have a bearing on subsequent actions of this president as well as successive presidents on the powers of the president and the standing of the U.S. Congress.
Right, Mr. Dasgupta, thank you so much for joining us. Clearly, this will be a long-drawn affair. The Trump administration, of course, has taken the legal remedy of appealing this order in the United States Court of Appeals for the Federal Circuit. So clearly, it's going to be a long-drawn battle. But in the short term, in the near term, there is some reprieve. At least the markets are giving a sigh of relief. The markets going up, even as this order came up last night. But Mr. Dasgupta, thank you so much for joining us, for sharing some more perspective on this. But with that, it's time now for a very short break. But coming up, defending the tariffs in court, the Trump administration argued that any legal setback could put the India-Pakistan truce at risk, in jeopardy. A special discussion when we come back. Welcome back. You're watching News Center, and we're discussing the ramifications of an American court blocking Trump's tariffs. Now, in an attempt to justify those tariffs, the Trump administration cited the recent ceasefire between India and Pakistan in a submission to the court. U.S. Commerce Secretary Howard Lutnick said, and I quote, "This ceasefire was only achieved after President Trump interceded and offered both nations trading access with the United States to avert a full-scale war," end of quote. Lutnick went on to say that any adverse ruling will constrain presidential power and could lead to India and Pakistan questioning Trump's offer, which in turn threatens the security of the entire region. However, the judge did not accept this argument and ruled that sweeping tariffs invoking an emergency law was a case of executive overreach. I beg your pardon. Joining us now to take this discussion ahead are with us two of India's former External Affairs Secretaries, Ambassador R. Kanwal Sibal, as well as Ambassador K.C. Singh. Gentlemen, thank you so much for joining us. Ambassador Sibal, let me come to you first. It's one thing, Trump is known to be a loose cannon. He's known to make comments which surprise, which shock, which bring in a sense of awe. But now to be making those statements in a formal court of law in the United States, in diplomatic terms, knowing that this comes at the cost of India's stated position repeatedly after Operation Sindoor, in diplomatic terms, what does this translate into, Ambassador Singh?
I think you asked him as a symbol.
Well, I think this is almost visible. It just shows how inept and U.S. diplomacy has become, where they can actually communicate total nonsense to the court. I mean, saying that the ceasefire has been based on giving access to India and Pakistan to U.S. trade. What kind of nonsense is this? We already have over $200 billion of trade with the United States. Are they going to block that because of what happened between India and Pakistan? And how would they block that? They export to us, we export to them. We already have agreed on the broad parameters of a multi-sector trade agreement, which we are negotiating. This has been officially announced even by the US Vice President who was here. Our Commerce Secretary Commerce Minister was in the United States fairly recently. The negotiations are going on well. I have inquired with the powers that be, and they say that there is absolutely no impact of what Trump has been talking about trade in the context of the India-Pakistan conflict on actual discussions that are going on, which are proceeding pretty smoothly. So I don't know. They're just clutching at straws and bringing up a security issue, a ceasefire issue to the U.S. court as if it has to decide on these matters is almost ridiculous. It's almost ridiculous. And moreover, the government of India at various levels has categorically said that the trade issue was never mentioned. Remember, it is Vance who spoke to our Prime Minister, and Rubio spoke to our Foreign Minister, and it has been made very clear from our side that there was no reference to trade at all. So, you know, one should take all this seriously because it has no basis at all.
All right. Ambassador Singh, let me come to you. Like Ambassador Sibal was pointing out, there doesn't appear to be any basis. That appears to have been a sentiment that even the U.S. court agrees with, rejecting that argument and in doing so striking down the Trump tariffs as well. Given that we are operating now in the domain of the Trump era, the tariff era, give us a sense, what does this change do with the U.S. court rejecting the argument about the India-Pakistan ceasefire, with the U.S. court also striking down the Trump tariffs? What does that do for trade negotiations, especially with countries like India, who, at least for now, are not seeing eye to eye with the U.S.?
You know, this is an important U.S. tribunal. It's the Tribunal on International Trade. And what they have said is the 1979 law that the Trump administration is using was meant really for sanctions against countries or other trade-related issues, but certainly not tariffs. So what Trump administration have done is they've taken that law and assumed the power to impose tariffs arbitrarily. And it happens almost, he goes to sleep with the tariffs with China at level X, he wakes up next morning, lowers them. They keep going up and down. The markets keep going up and down. So there is no rationale to it. But I think what they're doing is he's convinced that tariffs are a very effective weapon in his hands to influence other countries and therefore set right what he thinks are distortions in multilateral trade. Now they've combined it in case of India with security issues. So it's more a question of thinking that for them tariff is the main weapon. And so wherever they're wielding it, they think it's useful even where India-Pakistan standoff is concerned. So I think it's mistaken. And secondly, as Ambassador Sibal said, our trade is around $200 billion. Pakistan's trade is $5 or $6 billion. So there's no comparison at all. What is it they propose doing for Pakistan, which can help their trade or which can harm their trade? Maybe they can harm their trade, but certainly can't help them much. But this is not the first time. Even Trump, standing next to the South African president, again said it. And before that, he's also said it. So it's somewhere stuck in his head. I don't think it's a one-off that they went to a court and they said it. But somewhere in his mind, there is this use of tariffs as a weapon to influence any country to do whatever he wants it to do, whether it's security-related issues or trade or anything else, or visas, or fentanyl, as in case of Canada and Mexico. Canada doesn't have a trade imbalance with America, but they're saying, no, you are exporting fentanyl and you're letting people come in, which is not based on facts. With Mexico, again, it's fentanyl and people coming through. So the issues vary. It is not a single issue. Issues vary from country to country, and tariff is the one weapon that Trump is wielding. So I think we can just ignore what he's saying. But the problem is that the Indian government has shown a certain reluctance to openly confront the US administration. I think there is a hope that somehow the trade deal with America will come through. The initial a kind of an interim trade deal is expected very soon. I think we may be disappointed because with Trump, nothing can be taken for granted. Even what is on the table, you may just say, no, it is not acceptable. It's not something which doesn't meet all my conditions. So but that puts the government on the back foot because they have not openly confronted the Americans on this argument. We do it indirectly, we do it sort of reject it, but we've not every time they've raised it, we've not openly said that, please don't use this, this has nothing to do with it. And I think that's what makes them perpetuate and go on with it.
Let me then ask a supplementary question, Ambassador, saying that when you say that India has not done enough as a show of strength in terms of rebutting some of these claims that are made repeatedly by President Trump, what more is required at this stage in terms of taking a substantial position that manifests not just to Indians but also to the world at large, that look, this is a position that we clearly refute, that this is not something that transpired, this is not a narrative that India will stand by?
Well, Foreign Secretary is in Washington at the moment. He should take it up. He's gone to discuss critical technologies and so on and so forth. I think before we behave as if it's business as usual, there has to be some intervention on his part and tell the Americans, please stop it. We can't continue with business as usual. It's causing domestic issues in India. And you've got 7 delegations which are going all over the world. Even they'll be wondering, even countries they are engaging will be wondering what's happening. Because when you're explaining, you are trying to bring the focus back on Pakistani terrorism, Pakistan-sponsored terrorism. And Trump goes on shifting it, creating equivalence between India and Pakistan, and introducing trade into it, and recreating a hyphenation, which doesn't help our arguments abroad.
Sure. Ambassador Sibal, let me come to you. Again, on the issue of the trade deal, all of this is happening in the midst of India negotiating a trade deal with the United States. There was an understanding that perhaps before the end of 2025, it could yield some returns. The question I want to ask you is that if we were to continue along this current trajectory, with the overarching tariffs that we had seen, India was seen required to make concessions. So whether that's bourbon whiskey from Tennessee, whether that's Harley-Davidson bikes, we were required to make those concessions. Now with the tariffs having gone, is this a trade deal? Is this a lever that perhaps the Indian administration can now use to send a message to the United States? There are sticky points, whether that's defense buys, whether that's IP protection, whether that's MSPs that we provide to our local crops here in India. So there are sticky points. Can they now be used as levers perhaps in conveying the Indian message?
I think we should continue down the path that we are following and try and have some kind of an agreement, an interim agreement, the first phase of a larger trade agreement by autumn this year, as had been planned when Prime Minister Modi went to the United States in February. As I mentioned earlier, my understanding is that those talks are going on well enough, and we should continue. Unless, of course, the basis of the talks is completely eroded by the American side and they want something else altogether, or they introduce issues which are not acceptable to us. So far, that is not happening. The point is that if we want to increase the levels of our trade to $500 billion with the United States by 2030, then some changes in our tariff regime would also be required, as against which we should have more access to the United States in terms of technology, investment, or what have you. It has to be a win-win deal. So why stop this process midway just because of the ruling or whatever it is? Because in the US system, you don't know which way the wind will blow and what next may happen. And as you said, that this matter is going to go to the Supreme Court, which will ultimately decide. So why anticipate anything? Unless, as I said, the Americans are putting roadblocks, which we find totally unacceptable. There's a much larger relationship with the United States that we need to preserve, and it goes beyond tariffs. Unfortunately, Trump is absolutely fixated on tariffs at the cost of any sense of geopolitics. This is a big flaw in the American administration today, because you have a president who cannot think beyond tariffs, who makes loose statements, who makes unsubstantiated statements, and even on Indian tariffs, on trade figures between India and the United States, he's totally ill-informed. He says whatever comes to his mind. And Sputnik again is not particularly well versed in these matters. I saw the statements he was making at the Lycina dialogue, where they were putting enormous pressure on us on agriculture, and he was pretty demanding in that regard. It's not going to happen. And then Trump says that India has agreed to zero tariffs. Are we going to agree to zero tariffs in agriculture? What nonsense is this? So, and coming back to all this talk about the ceasefire being under jeopardy because he had promised trade. What has he promised to India? What? Nothing. And why should we disregard what our leaders have said repeatedly? You mentioned just now that we should be more clear. How much more can we be clear? You said this. Why go on and get into a battle with Trump, who's totally unpredictable, who likes to always want to win, and he's very impulsive and unpredictable. And why rattle him quite unnecessarily? We've said what we have said, and there's no point in taking him head on. Just ignore him.
Sure. Right. We're running out of time, Ambassador Singh. Let me come to you for a quick final comment. Trump has repeatedly been making these comments, knowing that this is coming at the expense of the Indian position that, look, it's a bilateral issue between India and Pakistan. A third party has no role. From a broader geopolitical standpoint, when you look at the truce that Donald Trump is trying to strike with countries such as China, is that a lens that deserves, that merits perhaps a look, that there is a broader game at play where India perhaps is the bargaining chip between US and China?
I think there should be no assumptions where Trump is concerned. The old game of India being very critical to America in terms of balancing China, I think we should just discard it for the time being, because with Trump, there are no givens. Also, you take these tariffs. Some of the tariffs are not under that law, which the court has struck down. For instance, on steel, aluminum, and cars, it's under the standard laws. So he will shift some of the tariffs to standard laws. This he was doing because there was no constraints. He didn't have to do any calculations, and you just top of your head said 50%, 70%, 100%. Whatever percent he wanted, he just went ahead. Problem is, the 90 days he gave the world are close to being over. And he said July will be 90 days, will be over. And he said in 90 days, he'll have 90 trade agreements. We don't see those trade agreements anywhere nearby. Somebody has said that he might be able to use this court decree to actually get away from the tariff thing. I doubt it very much, because he's stuck Otherwise, he's got an excuse now. He could say, look, the court didn't allow me to do it. I was going to reshape the global trade. And now I'm sorry, I've had to go back on that. He probably won't do that. So he will try shifting as much as he can to normal laws. He'll try challenging this. But I don't think we should take it for granted that India is considered as important by him as previous administrations have done as a balancer of which he just reduced the duties on Chinese products. But then he's gone after the Chinese students in America. He's gone after our students. So, there is not one front. Every morning he gets up, depends which side of the bed he has got up. He's got a new idea and starts implementing it without looking at the repercussions or implications of that. So I think we are in for volatile, troubled times, and we have to be used to it. And diplomacy will have to adjust, literally on a day-to-day basis.
Right, Ambassador Singh, Ambassador Sibal, thank you so much for joining us, for giving us more color. Again, volatile times, Ambassador Singh pointing out that the statement coming from Donald Trump may, in a large part, depend on what side of the bed he wakes up on. So clearly, a lot of volatility for now. The US court striking down the Trump tariffs. Trump clearly pointing out that there will be an appeal, and this will be a legal battle that he will engage in. So clearly, the final word is yet to be had as far as tariffs are concerned and as far as Donald Trump is concerned. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here. Keep watching CNBC TV18.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. As savers and investors, we spend most of our lives trying to create wealth. But perhaps knowing the rules that govern the transfer of this wealth within the family or maybe even outside the family is perhaps as important. And that is what we are aiming to do on the show this week. The idea is to understand the laws that govern succession and the importance of creating a will to ensure smooth succession of assets. Joining me to do that today is Neha Pathak, Head of Trust and Estate Planning at Motilal Oswal Private Wealth. Neha, thank you so much for coming in. Welcome back to the show.
Thank you.
Always a good thing to have you on. I remember it was an earlier show where we were generally talking about what women need to do, and we had you on as a teaser. And I remember saying that to viewers that we need a full-blown classroom on this. These are legal matters, can get quite tantalizing to say the least, I'm guessing.
Absolutely, it's tantalizing. You're so correct with that word.
The idea is that, let's start with some broad thoughts. When we talk succession, at some point in life, it's about knowing what's my due. Will I get my share? Because I am due to get some inheritance. And then beyond a certain stage in life, it's about how I need to plan the transfer of my assets to the next gen or to whoever might be the intended beneficiary. How should one overall look at the concept of transfer of this wealth?
So see, if let's understand this, that in India, there are many personal laws. So multiple religions are there. There are multiple personal laws that are there. If I have got assets and if I pass away, what is the law that's going to govern me? And if I die without having anything in place, so be it to say that if I don't have a will in place, I pass away as an intestate without anything in writing. Now, when I pass away without a will, my personal succession law will come in. For Hindus, it's going to be a Hindu Succession Act. If I'm a Muslim, then it's a Sharia law.
Sure.
If I'm a Parsi or a Christian, then probably the Indian Succession Act.
Okay.
So that is what is going to govern what happens to your assets if you pass away without anything in writing. So it becomes pertinent for all of us to actually make a will, so that we can mention things, how they should be done and what should be the procedure of doing that.
Sure. Right. So we'll obviously come to that, and that's the bread and butter of what we're trying to do today. But just to understand the law, like you said, if someone passes without a will, then it's called passing away intestate, right? Yeah. So these succession laws between different religions, are they tremendously different, or is the Indian succession law somewhat similar to, say, the Hindu succession law?
I would say Indian succession law and Hindu Succession Act are pretty much similar.
Okay.
It's a little different from the Muslim succession law, Sharia Act rather. Right. The main thing is mostly it's the family member that is covered.
Right.
The near and dear ones who are covered in the law. It says that if a person passes away, how much share will go to his wife, how much share will go to his mother or to his children. That is written in pretty much most of the laws.
Sure.
So that is what a personal succession law is.
Got it. So for the sake of understanding, now viewers, remember, this is what we're trying to understand, that if you or if we pass away without a written, clear, stated will, then how do the succession laws come into play? So let's take the Hindu succession law as example. If I pass away, I've not made a will, who gets my money or my wealth or my property and my assets?
So depending, if I talk about a male Hindu, if a male Hindu passes away without a will, his share gets equally divided between his mother, his wife and his children in equal proportions. In case either one of them is not there, then the remaining people will get it in the equal proportion. If none of them are there, then their children, so if my the man's grandchildren are there, they will get it. Or else if he has nobody, then there is something called a class 2 heirs that are defined under Hindu law. They will be getting the assets of the deceased.
Now, do these legal heirs, do they have to prove that they're legal heirs to get these assets? For instance, if this Hindu man passes away, will the children or the grandchildren, what do they have to do? Or is it simply passed on because it's built into the law?
No, it doesn't get passed on because it's built into the law, because there is going to be an equal proportion of everything. So generally people have these common consensus amongst themselves that let's distribute assets, father's assets between us in this manner. However, there are certain places like maybe a bank locker or a property where you would require a legal document to state that I'm a legal heir of such and such person. Now, these legal documents can be procured by a court. So one has to go to the court to get these assets transferred in their name.
Okay, all right. And what's also important to note, like you said, the succession laws, I think, were amended a couple of years back. You're saying it's equal proportions. So sons and daughters, technically as per the law, are entitled to an equal share of the assets.
As much as mother and wife.
As much as the mother and the wife. So mother, wife, the children, which might be son or daughter, everybody is entitled to an equal share of assets. Okay, now we come to the operative part. If this is already clearly defined in the law, then why is it so important that we make a will regardless?
So we'll continue with the same example. This man has passed away. His assets are going to 4 people. Now, he may not want that. His mother is quite old and he might be having some other siblings also. Probably his idea of earning the assets was giving it to his wife so that one can take care of his children and his mother, and his wife is capable of doing that. He didn't want that his assets are divided 4 ways equally between 4 people. So it becomes important for him to have that thought in place and have that writing in place that in case something happens to me, my assets go to my wife. And in case she is not there, then it goes to my children. Probably he doesn't want to give anything to his mother. So that probably he wants somebody to take care of his mother. So think about it that way. Also, there is a possibility that one may want that a certain portion, like people say that I want to give back to the community. I want to give back to the community. Now, if this man's wish was that I want to give a certain portion to the community or to an institution, then that will not come true if he has not done anything in writing.
Oh, absolutely. So, I mean, that has to be a starting point. You have to state your intentions in the form of a will. Okay, so let's move to the next brass tacks questions then. How is the will created? I believe you need 2 witnesses. How complex or easy is the process? So how should one go about it?
So it's a fairly straightforward process. When you are looking at creating the will, there are certain basic guidelines you should follow. When I talk to my clients also, I tell them that when you are thinking of creating a will, put down who are the beneficiaries, who are your family members, or who are your beneficiaries. It may be a possibility your beneficiaries and your family member are different people.
Correct. You want to give it to some non-blood relative, your assets or
it can be a friend, it can be an institution, it can be anybody. Write down what your assets are. So my assets are real estate, investments. If I have got investments, where do I hold them? If I have real estate, what is my property? Where is it held? What's the complete address? Write down my bank account details, write down my insurance details, write down the details of the locker. Very important to write down the details of the locker. Where is it held? Write down where, if I have art or artifact, how have I procured them? Who has made it? So you should be as elaborate as possible when you are making the list of these assets. Even the shares that you hold of, if you are running a company, the shares of the company, you should mention the details of the shares. Right? Partnership firm or an LLP, put in the details of that. Post that, you put in front of every asset, you write who's going to get
the
this
beneficiary.
Yes.
Okay.
And the next to that, put in that what if this beneficiary is not there, then who will it go to? Most likely the beneficiary is the spouse. Spouse will be pretty much the same age group as you are. If the spouse is not there, then who will you want this asset to go to? Very important aspect. Put in a residuary clause when you make a will, that if I have not mentioned something in this will, it will be covered by this residuary clause. Put in an executor. Executor is a person who takes the will to the court after the person who has made the will is not there anymore. This is an important person. Most likely it is again going to be your spouse, but preferable will be person younger to you, much younger to you, who can do all these things for you.
Usually the executor of the will is a family member. Can it be a non-family member as well?
It can be a family or a non-family member. Absolutely no issue.
And the executor can be one of the beneficiaries of the will as well?
Absolutely. Thereafter, you should have your PAN card, Aadhaar card mentioned in the will so that one can figure out where your investments are if they are linked to the PAN or Aadhaar. And always mention that in case the executor is not there anymore, then who's the next in line executor who will be taking care of these things? Now, we have made the will, we signed the will, the person who's making the will should sign it. The two most important people again are the ones you just said, the witnesses. So 2 or more witnesses can sign the will. That is what validates the will.
Okay.
After that, you can look at registration, or you can just keep the will at your house in a safe place.
The witnesses?
Yes.
Do they have to be non-related, related, family members,
Ideally,
non-family
they should
members?
not be the beneficiaries in the will.
Yeah.
They can be relatives or non-relatives, doesn't make any difference.
Okay.
But they should not be beneficiaries of the will.
Okay, there should be independent witnesses.
Yes.
Got that point. So this is pretty much how it can be drafted. There's also a lot of talk of adding at times maybe a medical certificate, proving that the person who's making the will is of sound mind.
Yeah.
Why is that important, and how does one prove that?
So one goes to the medical practitioner, and he gives a certificate that a person is of sound mind and is physically able to go ahead and register the will or make a will.
Okay.
If you are of unsound mind, then you surely can't draft any document. So it's important that one gets this kind of document from the doctor.
Okay, fair enough. You brought up the point of registration of a will. And I know that I think it's not mandatory to register every will, but why is it then advisable to do so? And when you say register a will, is it registered in a court? What's the process like, and what's the upside of doing this?
Okay, so registration under law is not compulsory.
Okay.
Why do we register the will? The first and most important point is that it gives me satisfaction that I have registered it with some government authority. Now, registration is done either at the sub-registrar's office, or there can be a lower court in different jurisdictions. It's a different place. It can be a lower court that is registering the will for you. It creates a copy with the government.
Okay.
So if the person who has made the will is not there anymore, but he has informed his family members, I have made the will and I have registered it, the beneficiaries can go to the registrar's office and can get the will, copy of the will.
Okay.
It provides a sense of security that I have done something right, and it is there in the, and people are aware that I have done something right. Also, when you go to the registrar's office to register the will, they actually ask you these questions that, do you know the contents of the will? Are you aware what is written over here? Show your identification, and then they register the copy.
Okay. So, but a non-registered will is also legally binding?
Absolutely. Absolutely binding. So, say for example, I made a will and I registered it.
Yeah.
But 2 years down the line, my asset base changes. Then maybe I might want to change my will. And I will change my will. So, in that case, the will that I have made subsequently becomes the recent will.
Correct.
And that's going to be my will and not the registered will.
Okay. All right. Got that. So those are the nuts and bolts of making a will, which maybe is the easier part. Yeah. The harder questions are when to make, how to discuss it with your family, how to ensure that, there's, as less acrimony as possible, what to do about existing nominations, all of those technical questions we discuss with Neha after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we're discussing how creating a good, solid, foolproof will is probably the cornerstone of any plan when it comes to transfer of wealth, assets, or succession planning. And of course, I'm in conversation with Neha Pathak. Neha, before we continue, question cropped up in my mind in the break. We're talking about the interstate laws, which define how wealth will be transferred if there is no will. And they say, for instance, it will be shared equally between the deceased wife, spouse, and children. Where do nominations feature in all this? Because for all our assets, mutual funds, fixed deposits, everywhere, there's always a nominee. So how does that nominee tie in with the interstate laws and, of course, the will?
So if I talk about nominee, a nominee is a legal representative of the person who was the owner. He's the person who's supposed to hold on the assets as a custodian and thereafter transfer it to the legal heirs. A lot of times it so happens that the nominee and the legal heir is the same person, or there might be more legal heirs. So if I have nominated my husband as a nominee, but I have got kids, then in that case, my legal heirs are my husband as well as my kids. Right. However, nominee is only him. So he is supposed to hold on to the assets and distribute it amongst himself and the children.
So nominee does not, that's really important. Nomination does not mean that you get the asset.
Yes, it does not mean that. It means you get the asset to hold it in as a custodian.
As a custodian. It is not for you to use and for you to, throw away the wealth or enjoy its benefits. So all you nominees out there, please realize that you're only the custodian of that asset. You cannot hold on to that asset as your own or use it as your own. Very, very important point there. Which gets us back to then, therefore understanding that the will is, making a will is the way to go. Just explain to us this concept of probate. And we keep hearing that despite a will, there are disputes in the family. The will is getting challenged, so on and so forth. Yeah. How can one try and minimize all of this?
So will is a challengeable document that we have seen.
Yeah.
Now, what happens is that when one makes a will, there can be an concept of fraud or coercion that may have played. And that is why, and some of the beneficiaries in the will might feel that I am getting less as compared to the other one, or I should have gotten that particular asset and not the other person. And which is why a person might contest the will. Now, when does this come? So when does a will come to light? I made the will, I have kept it in a safe storage. However, my executor will bring it out after me, after I'm not there. He would have to take the will to the court and get an order from the court, which is also known as probate, that this will is right, the contents are perfect, and the assets should be distributed between the beneficiaries that are mentioned in the will.
So this is really important. The will cannot be implemented, quote unquote, till there is a probate or this order from the court. Is that right?
Exactly. Not for all the assets, probably. Some of the assets can be distributed between the beneficiaries if they are of the like mind or they think that it should be distributed.
When it's amicable, yeah.
But when it comes to real estate specifically, the asset would be distributed only after probate, and it's safer to do so.
Okay. Okay. All right. So therefore, you go to the court.
You get an
order saying that the will is, has been sort of approved by the court, so to speak.
Yeah.
And then it can be implemented and the assets can be distributed. Got that. So that clears up a lot of the technicalities. Now, just some, life situations as we're coming to the final leg of this conversation, Neha. And life can be very uncertain, right? There could be cases where you are creating a will, whether it's for your children or, family members. There could be separations, there could be divorces. So what do you do in such a case? Because in a happy situation, you wouldn't mind the asset being shared by your son or daughter and their spouse. But in a different situation, you might want that asset to be secured only with your own child.
Right. Now, two aspects of divorce. Either the parents are getting a divorce or the child is getting a divorce or a separation, right? These are the two aspects.
Yeah.
Either which ways, I think the best way to move forward would be to ensure that the child is well protected, is well taken care of. So there should be enough insurance to cover his medicals. For his education, there should be a fund. There should be fund for his education, medical and maintenance. Maybe sometimes people do create a certain portion for his marriage. So all these things are very important and they cannot be just be done by a will. maybe one can look at creating a private trust where these assets can be housed and they can be secured against anybody getting a separation. And they are used specifically for the child or children and their well-being. So,
okay, that's how it goes. From a broader legal sense, whatever are the assets that I own as a male or a female, going back to the interstate laws, they typically go to, like you said, spouse, mother, and children. Do the spouses of my children also have any direct rights on the family assets, my assets?
So, spouse of the family, of course, yes, they have a direct right if my child is not there anymore.
If the child is not there, only then in that case.
In that case, he might get a right over there. So, one needs to be careful about what is written in the will. So, when I said that the first leg of beneficiary, you should identify that who's going to get the asset. The second leg also should be identified, that what if my spouse is not there, what if my child is not there, then who will the asset go to?
Okay, all right, fair enough, got that point. Last but not the least, the assets once they're transferred, are they still subject to any kind of scrutiny? It could be, the authorities, it could be the income tax department, ED, anyone. Are inherited assets still subject to government scrutiny?
So if the government thinks that you have received the funds and these funds were tainted funds, yes, there can be a scrutiny on that.
Okay.
So sovereign is always above
everything.
Yeah. So yes, that can come.
And taxes?
Taxes in India, we do not have inheritance tax or estate duty. So one who's inheriting doesn't have to pay tax on the inheritance.
Yeah, so far so good. Fingers crossed.
Fingers crossed for that one. However, there is, if there is any income that is earned on the estate before it was distributed, that tax has to be paid. So income tax or capital gains has to be paid. After it is distributed, it is upon the inheritor, whether he's selling it, he's keeping it, he's earning rentals or dividends, then there might be income tax or capital gains,
whatever. I mean, then it's your asset and you have to pay taxes as per the applicable laws. Got that. Now, finally, to sum it all up, I mean, what's your final advice? I'm sure you've seen enough families, enough situations out there. I mean, usually is it simple and clean with a will? What can be done to ensure? And it's also taboo subject. I also come across people who don't want to discuss the division of assets, right? It's a difficult topic to broach with the family.
Yeah.
And usually it's left till the very last minute or it's not openly, I mean, no one knows if there's a will or not.
Yeah.
How can this best be handled?
So I think the best way and the most straightforward way is be practical about this approach. People tend to get very emotional about it. But till the time you are practical about it, you can go ahead and finish this process. And it's a fairly straightforward process. Do it, finish it, keep it aside. People think that when I am about 80 years old, that's when I'll make the will. It's not going to happen. You don't know when you might die. So might as well create a will and put it aside. So that's the simplest and the most straightforward way, whatever your age group is. If you have assets, might as well create a will and keep it aside.
Okay, all right, do it now.
Yes.
And then sleep easy, sleep in peace, so to speak. All right. Neha, thank you very much. This was a good, quick crash course on the basics at least, enough to get us started, to take appropriate advice and to ensure that succession planning is far more structured and clearly done. Thank you for joining us on this.
Thank you very much, Surbhi.
All right, folks, hope you found this conversation fruitful, useful. I certainly did. Keep sending us your feedback, comments, queries, and as usual, we'll see you again next week with another theme.
Let's talk money.
who's the maverick and who's the goose, since we're talking about the
he's
wing?
the maverick. He's the maverick.
You're both pointing at each other.
I think we have more conversations with each other than our wives.
You've known each other longer than you've known your wives, so it makes
That is true.
kind of makes sense.
That is true.
People talk about the Flipkart mafia and all the startups that came about. I think
You're part of the mafia.
I'm saying, I think it's the startup university.
Still are.
Equal number of good decisions and bad decisions.
Yeah.
But the fact is that looking back, vision is always 2020. And I think we have that advantage building PhonePe after having seen the Flipkart journey.
I want to have the ability to look somebody in the eye and say that I have a clear path to profitability before I can say that I will IPO.
I think the business is in a good place, the org is in a good place, the sector is in a good place. If you're a market leader in a growth sector, I think it's a good time.
What are the top 3 things that you would tell a young entrepreneur today, which you believe are the non-negotiables?
If you're a first-time entrepreneur or you're below 30, you gotta swing for the fences.
And so how soon can we expect PhonePe to build from India for the world?
Ask the CTO. It's India's time to build for the world.
How do you look at competition?
Shamelessly, I think in our sector over the last 10-15 years, the most innovative by far and away has been Paytm, and we talk about this.
The right to win comes in from how we execute, but the right to play comes in from whether we have the building blocks to be able to enter a new business, even if we are entering late.
The Tatas empire, I see the Birlas or the Ambanis or more recently the Adanis and the Mahindras. They have things that every new business can take for granted.
Hello and welcome to the Young Turks podcast. I'm Shireen Pan. We're here in Bengaluru to talk to someone who bet on India's digital ecosystem well before India had its UPI moment. Digital payments was where it started, but the story of PhonePe is more diverse than that, and they're attempting to build it even bigger. Joining me now to talk about PhonePe and the road ahead and that much talked about IPO, Sameer Nigam and Rahul Chari. Gentlemen, thanks very, very much for joining us here on the Young Turks podcast. I'm going to start with exactly that. You on stage in August of 2024 said that I want to have the ability to look somebody in the eye and say that I have a clear path to profitability before I can say that I will IPO. Can you look me in the eye and tell me what's changed today? What gives you the confidence of wanting to go for an IPO today?
Not sure I said exactly that, but
paraphrasing, but broadly that.
I think the profitability part of it, we reported we shared our annual report for FY24 already, and we were adjusted PAT positive for the first time, so I'm very happy about that. I think directionally too, I think the company's at a stage where I feel like the core payments business, consumer and merchant combined, is at a stage of maturity and market leadership where we should, hopefully from here, remain sort of very, very stable and hopefully quite profitable in years to come. Conditioned well enough to say without setting any targets or goals. I think it's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place. Payments is still growing very rapidly. So if you're a market leader in a growth sector, I think it's a good time.
So Rahul, did the two of you sit and have a conversation about it makes sense to do it now? This is the right time, this is the moment, and we should go all in?
Oh, yeah. We have a conversation about everything. I think we have more conversations with each other than our wives.
You've known each other longer than you've known your wives, so it makes kind of makes sense.
That is true. No, we did have a conversation. I think like Sameer mentioned, just given the current state of the org and the business, specifically on the core offering that is payments, given how exciting financial services and payments in India is, and the fact that we also have a few new businesses that we are diversifying into, we felt that this is the right time where the core business on the path to profitability, being able to actually nurture new businesses, is the right time to take PhonePe to the public markets. It is also a reflection of our maturity as a company from a compliance and governance perspective, that we are ready to actually take on this larger role. So yeah, we did have the discussion and felt that it's perfectly the right time to actually push forward?
I think we knew that we'd want to actually eventually list.
Because
a few years back, because we moved to India with that whole view.
Exactly. I mean, to pay a hefty bill of 8,000 crore rupees to reverse flip and move back to India, I would imagine had its roots in this eventual decision, right?
Of course.
I think directionally, if the right answer for a business like ours is to list, then this is the right market. I mean, I think we're very proud of the fact that we are a household name or brand in the country today. It doesn't make sense to list anywhere else. So I think the reverse flipping was a precursor towards an eventual listing someday.
But, I want to understand for the two of you, what's the motivation to list? I mean, we've had this conversation with several founders. Some have decided to go the IPO route and some have decided not to go the IPO route.
Sure.
Another one of your peers next door, Zerodha, choosing not to go down the IPO route, even though that is a very real possibility for them. What is the motivation to IPO, besides, of course, providing exits to whoever would want an exit?
So I think that last part is a big motivation for companies like ours that actually have outside investors. So Zerodha is a good example where
they have
wildly profitable and the family owns the entire company. So I think they can get the liquidity that they desire through dividends, but more importantly, they can keep investing in the future of that company also through their bottom line. We took a path, which is, the sort of tried and tested path of getting outside in capital.
Yeah.
And it's also a very fiercely competitive market when you're actually trying to build on microtransactions at population scale. So we needed that capital. We didn't have it. So I think in this case, you have to have a steady liquidity environment, not just for us, employees, shareholders, current and future. I think that's one part of it. We're blessed. We don't have a rush on that front. We have the money to invest in all the businesses that we need to. We have really good investors, both. I think for us, it's more the nature of our business. We're just so heavily regulated across all the financial regulators now.
Yes.
Wanting to operate not just in payments but in other sectors also at population scale. I think the governance the stamp that comes with public governance standards is a higher order stamp than being privately governed. I think that's a big reason.
So, do you believe that because you're now regulated not just by the RBI but also by SEBI, and of course the insurance regulator as well, since you're now in the insurance business as well, that this need to IPO kind of gives you the added legitimacy as well?
I think that's the right word.
I think it's not just the legitimacy, just given the scale that we operate at on the payments business that is regulated by RBI for sure, but also on the other businesses, the scale that we expect to get to. It becomes more of a responsibility, like moving back to India, having a jurisdiction in India was one aspect of it. But going public, I think, becomes another responsible action by the company in terms of ensuring that being in the regulated space, we're taking all the right steps to give confidence to the regulators as well as the public who have placed the trust on us and our platform that we are the company that we stand for. Yeah.
But could you not have IPO'd even if you were still domiciled in Singapore? I mean, it doesn't stop you from listing in India. It does come with added constraints, but was that ever a consideration?
Not for the two of us.
No?
So when we started PhonePe 10 years ago, we actually had incorporated here. It's when we merged with Flipkart.
Yeah.
Because they were domiciled in Singapore, we became a sub there. I think to Rahul's point, we want to play in financial services, not just in payments, but in lending and insurance and broking and whatnot. And I think these are all not just sensitive sectors. These are, I think, sectors where the regulatory norms and the laws in every major economy in the world require you to abide by them.
Yeah.
And I think there's an expectation that you will list in that sort of home market. So I think from the governance standpoint, the argument for the IPO, it just makes so much more sense in India.
Yeah.
I think even in terms of creating shareholder value, the number of my extended family members and friends and others who come in and ask, hey, can I ever buy PhonePe shares? That's what I want to solve for. If you're going to create shareholder value in the public market, I'd rather create it in home market, right? why would I actually list and open up to HNIs and retail investors or DIs in some other market? I don't want to. I mean, there's no.
Plus, I think we are a company, we take a lot of pride in the fact that we are a company that has been built in India for every Indian. And used by quite a few Indians, right? Our ambition actually takes us to say that we'd like to be used by every Indian. We always talk about population level scale. With that, I think trying to take any other route, if we are going to be a listed company, I think falls short of the expectations we have set for ourselves and for the company, really. So we love the fact that we are a product that is recognized, used and trusted by so many Indians. And in that scenario, to actually list outside versus list in India, I think it wouldn't be as much fun at all.
So made in India by Indians for Indians, that of course is the ethos as far as PhonePe is concerned. But since we're talking about expectations, let's talk about the timeline. What is the likely timeline as far as the IPO is concerned? What's this process been like of putting everything together, preparing yourselves for an eventual listing?
I can't, unfortunately, speak to the timing just yet. I think we're working towards it, and I think we've said that formally now. Sometime in early Feb, we got the approvals that we needed from our board to start the process. It's been an interesting process, to say the least. I mean, just all the scatter-gather of all the paperwork and all the participants. It's been it's like launching another startup. So we're enjoying the process. I think like everything else we do, we go a little slower, but I'd like to believe a little more purposefully about the process. We're trying to make sure that we cross all our T's, dot all our I's, do it slowly enough. That's why I'm not putting a timeline to it.
Sure.
Hopefully not too far away, but I can't say yet. And before you ask me about valuation, that's a discussion that's not even started. That I'll answer after we're done with roadshow somewhere down the line.
In terms of the opportunity to grow, what's the kind of headroom for growth that you see in each of these businesses? They're nascent today. What could they look like 5 years on?
From a size, I think just because of the fact that payments reaches practically every Indian, our opportunity to create out of that cohort multiple Indias that deserve different kinds of financial services products, that's the opportunity. So that's what really excites us, right? Even in insurance. We've taken the path of trying to actually build out insurance distribution purely on the digital platform.
Right.
We've seen success with two-wheeler and four-wheeler, and we hope to replicate that how much of a time it takes on health as well as life. Today, we believe that the traditional modes of selling insurance are broken for a variety of reasons. They're either selling the products that is the easiest to sell, not necessarily right for the consumer. Or it's being sold through the physical channel where the commission dictates which is the product that should reach the consumer. We want to solve for both, which means that get the right products and get them at the price that is right for the consumer. And that can be done only if you potentially take the digital-only route, let data dictate the terms, and then let the consumer make the choice. So I think that's really the opportunity on financial services.
The opportunity on financial services, but I also want to understand from you the opportunity as far as PIN code, which is more your baby, and how you see that playing out given the competitive landscape.
There's a national supply chain that reaches the last mile in every city in India. Goods already reach there. The pricing is really attractive. It's not like natural, the MRP doesn't change from a dark store to a white store. Capital being used to discount prices lasts only so long. We've seen the e-commerce cycles play out. Ultimately, you have to make money. So when you take the price discounting out, it's really the quality of service that they offer which is better, and the ability to actually find a large selection. That's the thing that digital platforms do better. But the model is to reinvent the entire supply chain. And I think the same is happening with quick commerce. I mean, there's dark stores in every neighborhood next to the retail stores, right? And I think what we are trying to do is say, hey, again, just like our insurance approach, can we go in there and build every single piece of technology required for a store to become real-time available?
Okay.
And I mean scanning your barcodes to get a digital catalog, and then having a pick and pack app, and then having an app integrated with third-party logistics, and having a full ERP so that all your orders go through this ERP and you know what inventory you have. And these are the real problems on the ground. They're not fun. They're very hairy problems to solve because every store has a different level of capability. But I think what gives us comfort is the fact that we can do these as skunk projects at a low-cost basis. You can work with 5 stores for 6 months. See, I think where we are blessed, again, going back to one, quality and patience of our investors and our own capital efficiency, we have the reserves to go slow and do it right. We're not rushing to our Series A and B and C. These are all businesses incubating within the umbrella, quite like multi-platform players in the West.
But this is not a skunk project for you.
Oh, no. I'm just saying that each of these experiments of trying to integrate a pharmacy store or a network of pharmacy stores in one pin code in Bangalore, while I'm separately actually experimenting with, say, florists in Pune, I can run multiple experiments on the cheap. That's part of the reason, I think, why we're very excited about things like pin code or Indus. I mean, you don't have to start with a winning hand, but as long as the market's large enough and you have time, you either need time or capital, right?
We look at all the building blocks that it takes to build the business. We evaluate whether the IP that we have already created or the data that we have plays an important role or not. That becomes a decision to enter a business. Because that's our right to play. Right to win comes in from how we execute, but the right to play comes in from whether we have the building blocks to be able to enter a new business, even if we are entering late. And then we actually say that, do all of these add up to value for both the consumer as well as the partner that we're bringing on board? If those questions are answered, I don't think we really let market or time, in most cases, dictate when we actually launch and when we amplify.
I think there's learnings from the sort of conventional family business houses or the big ones, right? If you see
good ones or
the good ones.
Okay.
I mean, if I see the Tata's empire, or I see the Birlas or the Ambanis, or more recently the Adanis and the Mahindras, they play across so many sectors. I don't even mean verticals, like sectors, right? They all started with one that started making money, then built the second, and so on. But I think they all also have a common infrastructure. They have common corporate services. They have things that every new business can take for granted. Your starting point is also further along. It's not like PIN code is starting zero base. It's not like Indus or lending or insurance is starting zero base. The building we are in is available. The cafeteria is there. All of the HR and finance and other functions are around. So if PhonePe is 10,000 employees, there's the standalone PhonePe payments business would have needed, say, 1,000 people in the corporate functions. The incremental cost of 5 other business projects, maybe just another 100 or 200 on top. So the cost of incubating new platforms is also lower. Where it spirals out of control, if we decided to say, play the quick commerce game right now, I'm seeing the cash burn happening in the market. If we decided to play the quick commerce game with the cash discounting coming into play, then there's no end to it, because then you're going after market share. You're not necessarily...
So you draw the line there.
I think we've only once, and for a period of about 18 to 24 months, fought that battle. I think we got seduced into it somewhere around 2018 in payments. This is when Google and Paytm and Amazon Pay and others, everyone was going ballistic with cashback. We entered, and I think hard date, December 31st, 2019, we just said we are done.
Cold turkey.
We had we literally, like, we was burning $10 million a month. And we spoke to our board and said, we're going to test the metal of our product. We just went literally cold turkey, like just stopped on the first. The partners were upset because we were fueling cashback for the ecosystem as an industry.
Yeah.
The entire industry was spending. I'm seeing that cycle still repeating out.
In quick commerce?
In payments
In
today.
payments.
I mean, now it's the new players who are doing it, right? The Navis, the Super Moneys, the Creds. The new players are doing it. There was a phase where Paytm and us and Google Pay did it. There's a phase where the wallets did it. So we did. I'd be a hypocrite to say we didn't play that game. We played it for the first platform we were setting up. Luckily, as Rahul mentioned, in lending, you don't have to discount. It's a category that always makes money if you play it right. Same with insurance, same with broking. So financial services anyway, luckily you don't have to burn cash. Commerce, you could theoretically burn cash. I've seen it now for a while. Not the game we want to play.
You know, if I could pick up on what both of you are saying and the example that you gave of how we've seen this conglomerate model as far as large legacy companies are concerned, is that the ambition of creating a digital conglomerate? I mean, the organizational structure certainly seems to suggest so.
I mean, I think one thing that both of us and a third co-founder, Boris, and we are very clear about, when we started PhonePe, this was not our first gig together. This is a second or third stint together, and we're old entrepreneurs, so we said we want to build a legacy company. We don't want to be valuation chasers, we want to be legacy chasers. In that, like, we want to create an institution that outlasts us. Multi-generational is not a word you hear in the consumer tech space.
No, you don't.
So we said we want to try and do
a multi-generational great company.
Yeah.
You know, does it help? You talked about VCs, and very often we've seen this sort of play out. You bet on the short term as opposed to betting on the long term. And we've seen that sacrifice being, and it's a fine balance as well. But does it help then to have, Walmart parentage in that sense?
It definitely helps. I mean, they're 70 years in. They're massive. They're public. Families still got a very large share of Walmart. So in that sense, I think they're as patient capital would get in this space, right? So that definitely helps. I think they themselves have invested into multiple markets where they've taken long positions. So they're invested in that sort of long multi-generational play automatically. So that definitely helps. I think there's a meeting of the minds there for sure. Much more than we would have had if we were talking about early stage VCs. Especially during those cycles where there's hyper growth, right?
Yeah.
It's very hard telling a VC who's put a third of their fund in your Series D, I'm going to stop cashback tomorrow because I want to test capital efficiency.
You wouldn't have been able to do it.
You wouldn't, because they'd be like, but I'm all in. I'm like, but I want to get all out of this game and play the long game, right? So I think it was the right time for us to actually get more sort of sovereigns and strategics in. We have Microsoft on the cap table. We do a lot of work with them. Qatar, Tencent, GA more recently. TVS. I think all of them are very, very patient. So I think, and it's a cozy small cap table today of very high quality investors.
But, does it worry you? Does it concern you? Because we're seeing this play out at this point in time of how companies are going to be viewed as far as their foreign shareholding is concerned. And, whether there is likely to be any regulatory change, any regulatory pushback.
I think for India to be globally competitive, we will need to compete with global players. So there's going to be an FDI entry route. Now the question is, am I competing with Google and Amazon and WhatsApp only, or is capital coming in? I don't think you can have one without the other. So I think we'll have to make a choice as a market. Do we become insular or do we compete? And I think for the last 15, 20 years, they've chosen the path of compete.
Yeah.
So to that end, I think this is irreversible, and I think we're better off for it as a market. I think the only limited concern that I have, obviously, not an ostrich, just looking at the world, I think there's a global trend against globalization right now.
Yes.
And I think that's the only one that I'm a little worried about. But I'm an optimist. I think this is cyclical. I think once people have met across borders, across shores or whatever, I don't think you get enough of each other. So I think the market will keep opening up from here.
I think India, for its scale of population, diversity of population and diversity of problems, we should take a view of what allows us to leapfrog the lack of infrastructure in the various domains, segments that we have, and choose the path that allows us to get there the fastest. Within that frame, if there's a choice to be able to say take local capital versus foreign capital, I think it makes sense.
Yeah.
But to actually elevate the conversation about capital and investors being local or foreign, at the same level of whether the problem to be solved for is right or wrong, I think is that's the issue.
Speaking of regulation, the other overhang, of course, now pushed out to 2026. But you've lived with this for the last many years. It's a 2-3 year cycle that keeps playing out. How do you deal with this? Are you now working with the fact that, look, we'll wait till 2026 and see what happens then? Or are you working with the fact that, look, we've got to be prepared for 2026 to actually happen?
I wish this were an app update that I could sort of work on, right? Some of this is just because the deadlines are cyclical, some of the build-up is. I'll say this. I think because this was the third cycle that just finished in 24 December, and because I think there's also, I think the media really starts dialing this up as you get closer, right? It's almost like this.
Are you not checking your WhatsApp every few days?
No, actually we don't.
And
I think honestly, the ecosystem has become it. I genuinely think that media, because NPCI was reporting monthly numbers for all the players, unlike a lot of other segments, the attention to the leaderboard on UPI. Right now I see people reporting this person jumped to number 7 and that one jumped to number 9. It's like,
because 1 and 2 is done and dusted.
No, can you tell me? E-commerce is a decade older. Could you tell me who the number 7 and 8 player in e-commerce are? Could you tell me in food tech? Could you tell me in cap tech?
Or
could
do
you
we
tell me
even
in any
report
sector?
it?
You can't. Now the point is, because the data is there, it's a talking point.
Yeah.
And because they put this cap circular out, it's a larger talking point. I think this time, I think the comfort that we got, the comfort we were seeking was when we spoke to the policymakers, the regulators, ecosystem. I think one assurance that was provided was that whatever they do, I think there is a desire by the regulators to actually create a more diversified market. I agree with that.
Sure.
The fact that burden is somehow falling on us did not sit right by us, and we express why. It can't be the entrepreneur's burden to actually reduce market share, and I think they agree with that at some level. But I think the approach to then get past this impasse has to go from circular to something else, and I think that broad understanding after 4 years of dialogue has happened, and it sort of it's translated into two things. One, everyone's agreed, no matter what happens, you don't hurt the customer. Not PhonePes, not GPays, not ATMs, not the 10th persons. You just don't hurt the customer because payments is sacred. Second, newer players have to stop calling themselves smaller players you're small because you're new. And if you want market share, you can't just say, I want that. You got to earn it by differentiation.
Yeah.
And I think even Dilip at NPCI said this now. I think people need to give users new reasons
to
buy their toys.
Yeah.
So otherwise, it's aggregation theory, the rule of three, or whatever you want to call it. If these are free apps to the consumer and there's 100 of them, over time you have to trust consumer choice will converge around the best 2 or 3. That doesn't make the 20th app or the 25th app disadvantaged. That just means in perfect competition, you didn't prevail. And in the context of sort of this overhang, I'm hopeful before 26 arrives this time. There's been so much discourse around this publicly, privately, at the ecosystem level that I think they will unleash, hopefully, the next wave of innovation on basic interoperable UPI paradigms. You need one QR in any app to work. You need one app to work. Beyond that, everyone should be able to innovate. I think because of the cap, what's happened is innovation significantly slowed down. Because now what's happening is, the large players can't launch first. Okay, the small players don't want to launch first. They want to gain growth. So no one's launching. And I think that's actually the only way in which you change the market.
But, do you worry? And we're seeing this the world over at this point in time, including in the mother of, the capitalist markets like the US, where they're talking about breaking up large tech companies because of competition-related issues. So do you believe, while I get what you're saying, that you see this as a perverse regulation, anti-entrepreneurship, anti what you're doing, but do you believe that it's something that perhaps environmentally is gaining momentum?
So couple of things there. I actually don't think it's perverse regulation. I understand the intent.
Yeah.
I think the approach needs more thought. In the West, particularly in the West, nobody is going and saying ChatGPT should not have a lion's share of AI or Gemini can't, as long as neither of them does something to prevent the other's usage. Majority of the lawsuits are in the Google ecosystem or the Facebook one. And they're of two kinds. Facebook is staring at regulation, or not regulation, I think activism around the fact that they bought out pretty much all their principal theoretical competitors.
Yeah.
Right? So they have every major social network in their stable. We've not acquired anything in payments, life till date. We built everything we have, and slowly and painfully, as we just discussed. So that argument here doesn't hold. We've not muscled anyone out using capital. Yeah. And the Google argument, which is now playing out in 50 states and they're paying penalties left, right, and center, again had to do with abuse of monopoly, not monopoly. India had a monopoly, anti-monopoly law. We removed that in law and took a position that abuse of monopoly needs to be demonstrated, and that lies with CCI.
Yeah.
Because if you don't remove that, you remove any incentive for anyone to innovate. If being the leader of something or being large in a sector in of itself is inherently bad, somebody then publish these leaderboards on day 0 so that I know I don't need to actually go past some number, right? I'd like to believe that we trust our markets and our innovation cycles more than that.
Secondly, I think specifically to UPI, there's no barrier to entry. You still have new TPAPs, apps coming in practically every month, right? NPCI is trying to create a more vibrant environment. It is a completely interoperable platform, which means effectively the consumer is not tied to any specific app, but it's a choice that they can easily migrate from one app to the other. In fact, many consumers have multiple apps.
Fair enough.
So it isn't a monopoly by design or force. It is, first of all, it's not a monopoly. We talk about
it. It's not a closed-loop system.
It's not a closed-loop system. It's consumer choice that is ultimately playing out. There is no barrier to entry. You have some of the largest conglomerates like the Tatas entering.
Yeah.
You have completely new startups that are getting funded on the back of their play in UPI.
Yeah.
In such an environment, it's very difficult to actually see why consumer choice playing out with one or two apps is really a problem.
There's another very important element here. It's not that any of the tech conglomerates in the West are just really large or they're abusing monopoly power. there, China, other markets. I think the activism's coming about because they also have pricing power in the advertising market or in particular like device markets. Who are we charging in UPI? Who's anybody charging? I mean, we are waiting to actually make some money. So I think that
like to charge
that's central.
But that's gone cold, right? That discussion has gone cold.
I know, but I'm just saying, if the entire industry is saying we need a direct monetization vehicle, clearly the problem is not that we are sort of price gouging. PhonePe is free, GPay is free, the 10th app is free, the 50th app is free. They're all free.
How many do we have, by the way, as of today?
I don't track these, but I know that it's well over 30 at this point. I mean, last I checked, there's more.
There's more.
More.
There's definitely more.
Right
I think if you put together all the bank apps, you put together the other apps, they're significantly larger, but they're all options. They're all options for the consumer.
Yeah.
So there are quite a few apps that actually work on UPI.
this is not your first rodeo. You've both have been around the block and you've done this several times over. And I want to go back to the Flipkart days and the Flipkart Association, because I was telling Rahul before we started that in many ways, what HUL is to sort of the legacy companies as the CEO factory, Flipkart kind of has done that for the digital ecosystem, has it not? And you're kind of part of that story in many ways.
Flipkart, I think...
over 100.
People talk about the Flipkart mafia and all the startups that came about. I think
you're part of the mafia.
I'm saying I don't think people understand. It's not just in Bangalore. I think the change in psyche in 20-year-olds and even late teenagers today, where everyone wants to actually get out there and ride the sort of startup wave and try their luck at building something, being innovators, that fearlessness you see today, which I think we all celebrate. I think so much of it can be mapped back to that one company. And I think the two Bansals, but they also had a phenomenal group around them. They're early believers.
Yeah.
We joined a little later. We were missionaries, but we were late missionaries. They already had a very strong core. I tell people at PhonePe this often. I have a tremendous amount of pride in the talent and our bench strength. But there was a point at Flip where the caliber of the bench strength was actually scary good. Right? I mean, every IIT graduate and every IIM graduate was working there, and every lateral, peak of their career, sort of smart person that I know of. And I think the country, forget markets and IPOs and all this stuff. The country owes companies like that just as much as we do in this generation, just as much as you do for the Tatas for creating haloed institutions. Definitely the OGs in this space. I mean, there's no doubt in my mind.
Right. I think it's the startup university.
Still are.
Equal number of good decisions and bad decisions.
Yeah.
But the fact is that looking back, vision is always 2020. And I think we have that advantage building PhonePe after having seen the Flipkart journey, because there's so many learnings, right? There's so many learnings in terms of, you're talking about incentivization, cashback, use of data, building for scale. I think a lot of us who have graduated from that startup university called Flipkart enjoy having that 2020 vision when it comes to actually building a
we learn from our mistakes there, but the boldness to go after $1 billion. I mean, I'm sure you've met both Sachin and me.
Yes.
25-year-old Sachin had that. I mean, the way he used to talk about creating a $20 billion and $100 billion company back then, I'm like, he's either crazy or he's brilliant. Probably some combination. I mean, the first reaction when you meet somebody like that, right?
Yeah.
And you're seeing that now. There's some entrepreneurs today.
Yes.
They're just so wildly ambitious. It's awesome. So I think...
Recently moved to Bangalore.
That's one of many, actually. I think that's the... But like the one that moved to Bangalore, I think the world's their oyster. And I think we're all better off.
And all power to them.
Yeah. But and here's what I want, because this is essentially not just a show about entrepreneurship, it's also a show about paying it forward. So what I want to understand from the two of you, of all the lessons that you've learned over the years, over the course of building your previous startups and now building out PhonePe to becoming a multi-generational institution, what are the top 3 things, yes, fingers crossed, what are the top 3 things that you would tell a young entrepreneur today, which you believe are the non-negotiables? You draw the sort of red line there.
First-time entrepreneur?
Yeah. First-time entrepreneur, and then someone who's sort of mid, 5-6 years on and then going for scale.
I think the first-timers, definitely, I think integrity/ethics above anything else. I think the second is, if you're a first-time entrepreneur or you're below 30, you gotta swing for the fences, because if you don't do it then, you're not going to do it with baggage later, or you'll do it on the other side when you have no airline left, right? So swing for the fences, because I think India's time has come. This is not about whether there's a market you could get to. This is now a connected 800 million people market with all the infra and the capital available. So if you don't aspire for massive and global today, you're not even playing the game. You're playing the wrong game. So I would tell anyone between 25 to 26, 27, swing for the fences. You can, because you can do it multiple times over.
Yeah.
I didn't know that coming in. I started my first venture at 29, 30. 29, 30?
30, 31,
Yeah, I mean, middle class, go to school, go to grad school, work.
4G kid.
4G kid.
Were you a 4G brat, though?
I was a 4G brat.
He's still a brat.
Like, I mean, I'm still a brat.
He's still a brat.
But the idea of like quitting your job and working in a startup was such a pain when I worked in my first startup. That if I told my parents I want to actually like start up at 21, my dad would not know how to react, right? Whereas today, if my kid told me that I want to go and work more than a year or two, to apprentice, I think that's important, but said, I'm scared of starting up, I'm like, dude, I'm throwing you on the deep end of the ocean. Like, you got to try. And I'd say the third one is you really got to be clear about why you're in it. I think in India, making money is still a dirty word at some level, whereas when you're young, sometimes it's just change in lifestyle that you're seeking, and that's okay. But somewhere along the way, you get trapped in that rat race and actually your priorities change and everyone's still telling you to chase it. So you got to know at different stages of life.
How do you look at competition? Do you look at competition from the perspective of focusing on your competitors' strengths or your competitors' vulnerabilities?
Definitely not the vulnerabilities, because that's a perverse game, right? I think even on the strengths, I think we definitely look at whether they're innovating in interesting ways.
Who's innovating today, to your mind?
I think shamelessly, I think in our sector over the last 10, 15 years, the most innovative by far and away has been Paytm. And we talk about this. I think it's fair to say that.
Yeah.
They brought the wallet to market. They got the QR to market. They got the soundbox to market. They've done a lot of things. I think that's perfectly all right. Like, I should be able to say that my competitor is actually very innovative, right? I think Cred got gloss to design. It's glossy. It looks like really polished. I think each of our competitors, there's certain things that they do better. BillDesk is the OG in payments for 20, 25 years. They've gone in the hardest work in the entire sector. They've gone and taken state utilities and digitized them, right? So huge respect, because we all benefit. There's no BBPS if there's no BillDesk. Simple. So I think you have to first respect what their strengths are. You have to acknowledge the innovations, and you should shamelessly say that I'll create a variant of it if I think I can do better, or even just try and actually sort of create more of the same if there's a market out there for two brands.
What is it that we will not see on PhonePe? You've given us a glimpse of what we could possibly in the future see on PhonePe. What would we not see on PhonePe?
Well, it's never say never, but I can give you an example of what you haven't seen so far on PhonePe, just to give you a reflection of how we look at things. Cryptocurrency, right? There have been many times at which whether we create our own crypto, whether we distribute cryptocurrencies has come up. One of the things that the reason we've stayed away, apart from the fact that RBI has been very clear about their position on crypto outside.
Unequivocally, they hate it.
But there's a legal representation of crypto that still allows it to operate and exist and trade.
And be taxed.
And be taxed, right? We believe that the way crypto has been positioned and interpreted by a large set of the population as being an investment vehicle, many times marketed as safe enough to actually put in and grow your money, putting something like that out on PhonePe at the scale that we've operated at would be just socially wrong, right? And that's why we've never actually taken a view that we would never put crypto out on PhonePe.
What is the global ambition? Because I know it's made in India by Indians for India largely. It's an India first ethos, but do you have global ambitions?
Absolutely. So today, Indians traveling to those UPI countries or partner countries can spend if they're traveling there. We will definitely, for the core payments business, we will definitely venture out and start building operations in other markets. I think we publicly already announced we are entering the UAE. We are going to be entering Singapore.
The IPO side of the brain is working overtime.
Little birdies trapped in my hair. I don't have hair left, right? So it's like, so we are applying to enter the Middle East. We are applying to enter Singapore. For right now, that's all I know I can share. But we absolutely do believe that certain products that we've developed will find appeal in consumer markets or even merchant markets in other geographies as well. Yeah, it's India's time to build for the world.
So how soon can we expect PhonePe to build from India for the world?
Ask the CTO.
Now he's pointing a finger at you.
When it comes to timelines, he points at me. Yeah. But I think we just applied for the license. We'll have to actually wait for the license approval. And as and when that comes in, we'll be able to actually offer a timeline on when we go international. Yeah.
Okay. So it's been a pleasure speaking to the two of you, and we wish you the very best of luck with all of PhonePe's plans, and of course your journey to the Lal Street as and when it does take shape and when it happens. But are you going to give us a broad timeline before we let you go?
I'm getting better. I'm learning. No.
Well, but thanks very much, Amir, and thanks very much, Rahul. We wish you both the very best of luck, and thanks for having us here at PhonePe.
Thanks, Shireen. Thank you so much.
Well, with that, it is time for us to wrap up this edition of the Young Turks podcast here from the PhonePe headquarters in Bengaluru. From all of us here on the team, for now, goodbye. Thanks for watching. Stay tuned to CNBC TV18. There's a lot more coming up. The Gates Foundation, one of the largest charitable foundations in the world, is marking its 25th anniversary. Now, the Silver Jubilee comes with a big commitment. Bill Gates is pledging to give away, in his words, virtually all of his wealth over the next 20 years, which means the foundation plans to spend $200 billion over the next 2 decades. Now, this accelerated timeline has meant a change to the foundation's charter, which had stated that the organization would sunset 20 years after the death of Bill Gates. The last big change to the foundation had come in 2021, when Bill and Melinda Gates announced their divorce. Melinda Gates resigned as co-chair in 2024, which left Bill Gates as the sole chairman of the Gates Foundation. Now, from combating infectious diseases to agriculture research and reproductive health, the Gates Foundation has been at the forefront of solving some of the biggest issues in the world today. And joining me now to discuss the foundation's future and his pledge to give away virtually all of his wealth is the man himself, Bill Gates. Bill, many thanks for joining us on CNBC TV18. And let me start by congratulating you on 25 years at the Gates Foundation. But Bill, why this decision to set yourself a new deadline of 20 years to give away virtually all of your wealth? What has prompted this decision? Why this change from the original position?
Well, looking back on these 25 years, it's amazing what we've been able to accomplish. You know, together with partners, just, you know, the one statistic of cutting the number of children who die every year in half has been phenomenal to be part of that. And so as I was thinking about that, I decided that we should essentially double down and spend all the rest of the money I'm lucky enough to have through the foundation on these causes over the next 20 years. And that'll allow us to be very aggressive, make some fantastic progress, and, you know, we'll have real clarity. A lot of resources for 20 years, and then others can step in with whatever we haven't been able to finish off.
If I may, Bill, is this decision to accelerate or speed up the giving that you're doing linked to the overall environment that we're currently seeing, where there is a retreat from multilateral institutions, from multilateral arrangements, from development aid? How much of this acceleration perhaps is also linked to the change in the environment as we see it today?
No, this decision was made before all of these reductions were clear to us. I would say in the short run, it means the work we do is going to be challenged. You know, although I expect every year we'll have progress in India and some of the countries we work in. In Africa right now, these cuts to the aid budgets, the debt situation, some of the instability means the next 4 or 5 years will be difficult. But over the time period that all my money will be given, I still expect to see pretty incredible progress. You know, so in the short run, I am very disappointed that aid generosity is down. But with the innovations in the pipeline, you know, with, I think, going to people and saying that those aid budgets should come back to some degree, I'm, you know, super excited about what we can achieve in these next 20 years.
Bill, you know, you talked about doubling down on the significant resources that you've already committed. $100 billion was the previous amount that you did over the last 25 years in spending. You're doubling down on that, $200 billion between now and 2045. So help me understand, these are big numbers. Prioritize for me how you intend to use this money and what are you hoping to achieve in terms of impact?
Well, the first 25 years, we got childhood deaths down from 10 million to under 5 million a year. And we also took the 2 other diseases, HIV and tuberculosis, and the deaths were cut substantially for both of those. We also came up with ways to save mothers who are giving birth. And so we're really putting most of the resources into the global health work. You know, we hope to be able to cut the number of children who die more than in half. Again, and also to make dramatic reductions in all infectious disease. We need to finish our polio eradication. Still a lot of hard work left there. And we also think some other eradications, guinea worm, malaria, a number of diseases could be taken all the way to zero. And so by having, for the next 20 years, over $200 billion in resources, double what we spent in the first 25 years, we'll be able to partner with scientists, and we have a great partnership with the Indian government to help them achieve their ambitious health goals. And this field, the field of global health, will be able to perform miracles, and our resources will be a meaningful part of that.
Bill, you spoke about the ability to deliver miracles. What have been some of the hardest fought battles over the last 25 years? You talked about some of the important outcomes, especially on the global health front, that you've been able to achieve. What's been the hardest part of making those a reality? Resource is one thing. Execution is another thing altogether. What's been the tough part on the execution front?
Yeah, so for the foundation, we both work on the R&D side, so like creating new vaccines. And so, with Serum, a great Indian partner, a meningitis vaccine was one of the first new ones the foundation did. Later, a rotavirus vaccine that was very low cost, a pneumococcus vaccine. Then with other partners like Bharat, a rotavirus vaccine that also brought prices down. So it's the vaccine work, both in the R&D and the delivery, is probably at the top of the list of the impact that we've had. Vaccines, you need to keep them refrigerated, you need to make them cheaper, you need to convince mothers to bring their children in. So, there are plenty of challenges just in that one area.
Bill, you talk about India. Now, you've been spending a fair amount of your time here in India, and of course, the foundation has been working in India for a good part of the last 25 years. Let me ask you about what excites you about what's happening in India today. How important is India going to be for the Gates Foundation over the next 20 years?
Well, certainly India's a very, very important place for us. It's our biggest overseas office, and it plays two big roles. One is that the Indian government has very aggressive goals for improving health, and so we get to partner and try out the latest advances in medicine, and that we've seen great results from that. But the actual creation, the R&D of the new tools, whether it's diagnostics, vaccines, drugs, new seeds to help farmers, or ways of taking AI and helping with health and agriculture as well as education. India is going to be a place where there's so many smart people, so much desire to see these improvements that will pioneer a lot of things first in India, and the brilliant work there will then benefit the entire world. Paradigmatic of that is the work in digital finance, where Aadhaar and now we work with the Indian government to make that available to all countries.
But Bill, you've been spending more and more time here in India and doing lots of fun, interesting things, not just linked to the foundation, but even outside of the work that the foundation is doing. What about being in India, about making the connections here in India, the people that you're spending your time with inspire you today? I mean, is this a new romance with India that started over the last few years?
No, I've always been fascinated by India. And of course, Microsoft has had a fantastic relationship in terms of the huge development offices that we have in India, as well as amazing people like Satya Nadella that have come and made huge contributions to the company. And so as I moved from Microsoft to the foundation, I took that understanding of the great talent that's there with me. And so, I get to India on a regular basis and get to meet with the partners there. The majority of the world's vaccines by volume are made in India. We've had, so many important partnerships with that, and that's really growing. The quality of research in India, its desire to go even beyond vaccines with the tools that are provided, it's very timely. And, part of that is Prime Minister Modi's been very generous at sharing with me his goals, and so we can talk about how the foundation helps with that.
Bill, you've referenced vaccines, and I want to ask you this in the context of the last conversation you and I had, which was in September in New York last year. Now, there you had talked about being a salesman for Gavi, the Global Vaccine Alliance, in its quest to raise funds. You've been central to Gavi's ambition and aspiration of providing affordable vaccines to the world. At this juncture, with the very real possibility of funding drying up, specifically from the US, how concerned would you be about Gavi's future?
Well, I'm very, very concerned. It would be tragic if Gavi weren't able to raise as much or more money for this next 5 years as it's had for the last 5 years. And yet, it's pretty clear that we're going to see a reduction. I continue to talk to all the governments about the impact. There's nothing more amazing than making sure all the children of the world have these miraculous vaccines. So we'll see what we're able to raise, but it's looking tough. I'd say the next 5 years, the whole aid picture, whether it's Gavi or Global Fund, are going to mean that we might go backwards a little bit before we resume the progress we've seen since the turn of the century. And that's just a mistake, and I'll be speaking out very loudly, try to get the U.S. back in, try to get others to maintain or even increase, in some cases, their giving.
But do you feel confident or optimistic about that? You said you're going to try and draw people back to the table. But at this point, with the global retreat that we are seeing, especially from development goals, Bill, how much of a slide back do you believe we should be prepared for? Are we set for?
Well, we have two forces. One is the power of innovation, that is new tools, whether that's new drugs, new vaccines. We have AI to even help with the delivery, to talk to patients and give them advice about care seeking, things like the ultrasound that'll help figure out about the whether a pregnancy needs special care. So the innovation side is, if anything, going faster than ever. The generosity on resources for the delivery side, the next 5 years are going to be tough. And that might mean some of our statistics that have been improving, we might have a period where they'll get somewhat worse, particularly in Africa. And that's tragic. That shouldn't happen. If you look at the full time frame that all my money will be given over, I'd say we will be much better off by the end of that than we are right now, despite this period where the aid budgets are really going to hurt our work, particularly, as you said, things like Gavi and Global Fund not being fully funded.
Well, we are going to head into a break and continue our conversation with Bill Gates on his big pledge to spend $200 billion as part of the Gates Foundation over the next 20 years. Welcome back. You're watching the CNBC TV18 exclusive. We're in conversation with Bill Gates on the big pledge of accelerating the spending being done by the Gates Foundation, $200 billion over the next 20 years. Bill, the last 25 years, the Gates Foundation has worked very closely with Warren Buffett. He's been instrumental in the $100 billion that you've spent in the journey so far. Is there a disappointment that he isn't going to be a co-traveler, a fellow traveler over the next 20 years for you at the foundation?
Well, I'll certainly be very sad not to have Warren's regular advice. I mean, Warren is so wise, so generous. He's been a great friend to me. He's his example as a philanthropist, I think, has influenced many people besides myself. As you say, he's a huge contributor to the foundation. His family is very committed to the causes the Gates Foundation works on, and so they'll continue to be, his children will be great partners of ours in many of these areas. But no, it'll be tragic if Warren's not around. He's 94. I hope he lives this whole 20 years, but he might not.
Well, speaking of milestones, it's 25 for the Gates Foundation, it's 50 for Microsoft, and it will soon be 70 for you in October. As you look back and reflect on the many milestones that you've achieved personally and in your careers, if you had a chance of a do-over, would there be anything that you'd change, anything that you'd do differently?
Well, I'd be very reluctant to go back and change things since I've been so unbelievably lucky. My parents, who I got all my values from, and they made sure I got a great education. I've had amazing friends like Paul Allen, who helped found Microsoft, Steve Ballmer, who allowed Microsoft to be so successful, and now an unbelievable number of great partnerships at the foundation with the incredible team there, and partners all over the world. So. I'm the luckiest person in terms of what I've been able to be involved in. So yeah, I've made plenty of things that I've had to learn and do better, but I don't think I'd want to risk going back and making any changes.
Well, speaking of wanting to do better, you're no stranger to criticism, and it's been constant, but perhaps post-COVID even more so. Questions about the influence that organizations like yours build on decisions that have been taken. Many call it the tyranny of the unelected. How do you now respond to that criticism, Bill, and how do you believe the foundation should learn and position itself over the next 20 years to take some of that feedback and criticism on board in some constructive way?
Well, I think the agenda of saving children's lives, and making sure they're well nourished so that their brains and bodies fully develop, fortunately, that's not a super controversial agenda. All the governments we work with, including India, have goals to reduce those deaths, and so we're able to work together. Vaccines themselves, we test them to make sure they're incredibly safe, and so there is some controversy about those. But for example, with polio, there's not a single kid in India who's been paralyzed since 2011, when the final case, which was tragic, was taken care of, and so we get pretty strong support for the work we're doing. Sometimes seed technologies or contraception, we have to make sure we're communicating well about those things. I wish there were more people involved in, critiquing what we're doing in malaria and TB and HIV. Some of the work we do can actually be pretty lonely because it doesn't get the attention, the resources or the number of people engaged. So, I'd love somebody to criticize our TB drugs or vaccines or diagnostics and, share their ideas, because TB is back to being the world's biggest killer, and there's just so few people funding the work there that we wish there were more.
You talked about TB, malaria, and you're hoping that we see breakthroughs on both those fronts. But outside of health, the innovations on energy, the R&D work that's happening on Alzheimer's, I know that there's been a large part of your mind space and as well as your resources that have occupied these areas in the last few years. What are you most optimistic about, both on energy, specifically nuclear energy, and the work that's happening on things like Alzheimer's, the tuberculosis vaccine, etc.?
Well, if I had to pick one, I'd say, getting to the bottom of malnutrition and really solving that might get to the top of the list. It's a tough competition because we've got a HIV vaccine, a TB vaccine that you mentioned, a malaria vaccine, all very important. I also support new energy innovation. I do that through for-profit investments, including, for example, TerraPower, that's working on new lower-cost nuclear reactors. And so climate change, avoiding the worst of that, and getting cheaper energy is important. But I'd say the malnutrition would be at the top of the list.
Well, it's clear that you're definitely not retiring anytime soon, Bill. What keeps you going? I know pickleball is definitely not going to be something that's going to occupy a lot of your time outside of the foundation's work. But what keeps Bill Gates going today?
Well, I'm very lucky. I love reading. I love, traveling. I have great sisters and friends, and I love tracking the innovation. Meeting people who are out in the field doing the tough work. So it's fascinating. And, even though we'll have setbacks overall, the possibility of what we can achieve in these next 20 years keeps me going, makes me want to travel and work hard.
And the possibilities that you alluded to, what we're seeing on the AI front at this point in time. But for AI to really address the world's real challenges, healthcare, finding solutions to the many access deficits that exist. What are we talking about? Are we 5-10 years out before we start to see an inflection point on some of these big, real transformational challenges?
Well, there's no doubt in the next 5 years it'll be pretty radical, both in terms of how we discover new things, where the AI will help, and even healthcare delivery, where the patient will be able to talk with the AI and share everything that's going on with them and how they should interact with the health system. And so, no, that's near term. We have a lot of partners who are doing pilots even this next year.
Well, you've been part of the private sector and, of course, then moved to the development world. If I were to ask you for your message to the private sector in the current volatile environment that we're in, to other philanthropic organizations as well, organizations that you're perhaps partnering with or you're hoping to partner with in the future, what would your message be to them? What would your message be to governments today? You said you want to ensure that your voice is heard. What would you tell governments around the world today as we perhaps face what could loosely be called a leadership recession?
Well, the value of helping other people is pretty strong in all the world's religions. And so, that should extend to the poorest, those most in need. And so the idea that we're having less money to buy vaccines for the world's children is a bit of a surprise. And my advice is, hey, let's reverse that and accelerate the progress we've seen, which we should all be so proud of.
Well, Bill, with that, thanks very much for joining us here on the Global Dialogue today. Thanks very much for giving us a roadmap of where the Gates Foundation is headed. It's going to be an accelerated timeline for you to spend $200 billion over the next 20 years. It's a significant amount of money and, of course, a big change as far as the foundation's charter is concerned. Bill Gates, always a pleasure. Many thanks for joining us here. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more. Good evening. Thanks very much for joining us on India Business Hour. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The U.S. halts student visa appointments as the Trump administration looks at expanding social media screening of applicants. A U.S. Embassy spokesperson says students can continue to submit visa applications and scheduled appointments will not be affected. India and the U.S. likely to sign the first tranche of a trade deal by the last week of June. The director of U.S. Economic Council, Kevin Hassett, says India is close to the finish line.
It could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them.
Former RBI Governor Raghuram Rajan says this could be India's moment if it lays out the red carpet to draw foreign direct investment with proactive policies. Adds India must use trade negotiations wisely to seize the opportunity. That's an exclusive. SEBI passes an ex parte interim order in the IndusInd Bank insider trading case, finds prima facie violations by 5 bank executives, including the former CEO Sumant Katpalia, orders impounding nearly 20 crore rupees, bars all 5 executives from the market till further orders. Relief for former SEBI chief Madhabi Puri, Buch and her husband. The anti-corruption ombudsman Lokpal refuses to probe the allegations against them, calling the charges palpably unfounded and devoid of merit. SEBI approves Hero FinCorp's IPO, is expected to give the green light to HDB Financial's 12,500 crore rupee issue soon. This could be the largest NBFC listing in recent times. British American Tobacco trims its stakeholding in ITC with a sale of shares worth over 12,000 crore rupees. This comes a day after another 12,000 crore rupees stake sale in Indigo by co-founder Rakesh Gangwal as promoters continue to cash in. The government hikes the minimum support price for Kharif crops by 7% compared to last year. Ragi gets the highest hike of 14%. The government also imposes stock limits on wheat. The co-founders of edtech firm Unacademy set to exit the company. Sources say Gaurav Munjal and Roman Saini are in talks with the board to spin off the language learning app AirLearn as a separate company.
We want to build a legacy company. We don't want to be valuation chasers. We want to be legacy chasers.
We're chasing legacy, not valuation, say the founders of PhonePe as they aim to build a digital conglomerate. That's a CNBC TV18 exclusive. Well, let's go straight to the top story this evening. U.S. President Donald Trump has ordered embassies to stop scheduling new appointments for student visas. Now, Indians account for close to 30% of the international student community in the United States. The Trump administration is preparing to implement comprehensive social media screening for all international applicants. The U.S. Embassy told CNBC TV18 that students can continue to submit applications, but the appointment process for interviews is dynamic. Scheduled appointments are expected to go ahead as planned. Just yesterday, the U.S. Embassy in New Delhi had cautioned Indian students against skipping classes or dropping out of their program without informing their respective schools. The embassy warns students that who resort to such actions could have their visas revoked, and this may be rendered ineligible for further visas. The U.S. Education Secretary Linda McMahon said that President Trump has concerns that there are foreign students who come into the U.S. to create unrest. Take a look.
The president certainly had great concerns that